Hello everyone, good afternoon, good morning, good evening to all of you. Welcome once again to this live एनालिसिस स्टार्ट करते हैं आज का सेशन। फिलहाल देखोगे क्रूड ऑयल को तो कल मार्केट क्लोज होते होते वहीं का वहीं साइडवेज चला गया था। अभी वहीं पर ओपन हुआ है। ऊपर देखते हैं रेजिस्टेंस से एक सेलिंग अगर बनती है अपर लेवल से। बाकी नेचुरल गैस का भी सेम ही था, नीचे एक सपोर्ट से एक बाइंग बनी थी, उसके बाद कंप्लीटली साइडवेज हो गया था। अभी तक निकल जाना चाहिए था। लेट्स सी कोई नए लेवल बनते हैं, अदरवाइज ये पुराने ही लेवल हैं। नो न्यू लेवल राइट नाउ। बाकी कल नेस्डैक को देखोगे और नीचे एक लेवल बताया था 17,830 वाला, मार्केट ने सपोर्ट लिया, मार्केट वहां से ऊपर चला गया। काफी अच्छा लेवल था। बाकी डेटा की बात करें, 6 PM पे कोर पीपीआई का डेटा है और 7:30 पे कंज्यूमर सेंटीमेंट और इन्फ्लेशन एक्सपेक्टेशन, मोस्ट इंपॉर्टेंट डेटा फॉर द डे। इम्पैक्ट करेंगे गोल्ड और सिल्वर को। बाकी कल एक न्यूज़ और आई थी कि इंडिया और दो तीन कंट्री और हैं, उन्होंने नेगोशिएशन स्टार्ट कर दिया यूएस के साथ, तो उन पर टैरिफ और हट सकते हैं। इंडियन मार्केट एक पॉजिटिव टेरिटरी पे ओपन हुआ है, फिलहाल साइडवेज चला गया है। 15 मिनट फ्यूचर निफ्टी बैंक निफ्टी। भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम। थोड़ा मोमेंटम करता है प्रॉपरली तो फिर देखते हैं, मोमेंटम होना तो चाहिए प्रॉपर आज। गुड मॉर्निंग। सी देखते हैं कुछ बनता है तो ट्रेड, अभी तो कुछ नहीं है। हाँ गोल्ड भी देखोगे तो गोल्ड भी एक गैप अप ओपन हुआ था, थोड़ा बहुत प्रॉफिट बुकिंग आई उसके बाद। फॉरेक्स एमसीएक्स में, फॉरेक्स में भी देखोगे तो अपने ऑल टाइम प्रीवियस ऑल टाइम हाई को ब्रेक करके ऊपर निकला था, वहाँ से थोड़ी बहुत प्रॉफिट बुकिंग आ रही है। सी कोई अगर ट्रेड यहाँ पे इमर्ज होता है, अभी तो नहीं है। देख में देखो ऊपर वही रेजिस्टेंस कल वाला ही है फिलहाल के लिए, 18,740 730 वाला। अभी तो कोई नया बन जाए तो बात अलग है। कल सपोर्ट बताया था वो, स्ट्रॉन्ग सपोर्ट वहां से। अगर इंडियन मार्केट तो क्लोज हो गया था उस समय, रात के 11:30 11 बजे के आसपास। वहां से देखोगे 600 पॉइंट रिकवर किया है मार्केट, अभी भी ऊपर ही जा रहा है। ऊपर जाता है तो देखते हैं, वहां पर एक रेजिस्टेंस है छोटा सा 18,750 वाला, 740 750। कल वहां से ऐसे रेजिस्टेंस ले चुका है, आज फिर से लेता है तो ऑल एंड गुड। क्रूड में देख लेते हैं कोई नया ट्रेड बनता है तो यहाँ पर ना। बिल्कुल, नेचुरल गैस में तो सपोर्ट है ही, कल वाला कल का लो अगर बाई करके रखा हुआ है मॉर्निंग से तो बैठे रहो। मॉर्निंग पे वहीं पर सपोर्ट पे आया था, फिर से आया था, फिर से ले लेना। उसके अलावा और कोई नया सपोर्ट नहीं है वहाँ पे। कल वाला सपोर्ट बना हुआ है ना, कल मार्केट मूव ही नहीं किया क्लोज होते होते। तो वही अभी पेंडिंग है, अगर लिया हुआ है तो बने रहो। मॉर्निंग पे एग्जैक्टली वहीं पर ओपन हुआ था। इसके अलावा और कोई ट्रेड भी नहीं है यहाँ पर। ऊपर एक एफईजी है इसलिए जाने नहीं दे रहा है प्राइस को वो। एफईजी के ऊपर निकल जाता तो अभी तक तो मुड़ जाता प्राइस। मॉर्निंग पे पहली कैंडल देखोगे 9 AM की, वहीं पर एग्जैक्टली ओपन हुई थी, चल कहाँ पर कल था। लेट्स सी ये इस एफईजी के ऊपर निकल जाता है तो, अदरवाइज तो ये एफईजी रोक देगा प्राइस को ना। नीड टू सी 310 के ऊपर निकल पाता है या फिर नहीं निकल पाता है। 310 के ऊपर निकलेगा तभी कहीं एक पॉसिबिलिटी बनेगी वापस से 313 के आसपास जाने की। तो ये बीच में छोटे से एफईजी की हर्डल है यहाँ पर। लेट्स सी इनको क्रॉस करता है तो प्राइस। आज तो इन्वेंट्री भी नहीं है तो मोमेंटम आ जाना चाहिए। 314 के ऊपर चला जाए ना प्राइस तो सही है। 14 के ऊपर अगर सस्टेन किया, 314 के ऊपर अगर सस्टेन किया तो फिर आप मान के चलो कल का हाई मिल जाएगा, इजीली मिल जाएगा। लेकिन अगर 314 के ऊपर नहीं सस्टेन किया तो फिर, क्योंकि अभी भी ऊपर से सेलिंग का प्रेशर है मार्केट के पास, तो 314 के नीचे अगर होल्ड कर गया रिजेक्शन लेके तो बड़ी प्रॉब्लम हो जाएगी फिर प्राइस के लिए। क्योंकि जो कल का हाई है वही रेजिस्टेंस है फिलहाल के लिए मेजर एक, अभी के हिसाब से बता रहा हूँ मैं। तो देखते हैं एग्जैक्टली वहां तक कल के हाई तक जाता है या फिर बीच से ही रिजेक्शन लेता है, बिकॉज middle of those levels are very important for, if price want to become a trendy today on a buying side। नहीं तो अगर ब्रेकडाउन रीटेस्ट हो गया 300 के नीचे तो भैया फिर हम सीधा देखेंगे प्राइस को नीचे जाते हुए। कहाँ तक हम देखेंगे प्राइस को नीचे जाते हुए? आराम से 290 के नीचे। तो ये लास्ट फाइनल फ्रंटियर वाला लेवल आप कह सकते हो नेचुरल गैस के लिए। कितनी फाइट कर पाता है देखते हैं आज। दो तो एफयूजी हैं, दोनों ही हर्डल हैं यार इसमें। लेट्स सी एटलीस्ट 314 तक चला जाए बस, 50% भी कवर हो जाएगा वहाँ पे। ठीक है, अगर वो नहीं गया ना इन लेवल के ऊपर जो बना रहा हूँ मैं एफयूजी, तो फिर हमें अनफॉर्चुनेटली यहीं पर पूरा प्रॉफिट होकर के निकलना पड़ेगा, सेल ऑफ में जाना पड़ेगा। इस चीज़ का ध्यान रखना। क्योंकि वो लेवल फिर ऑटोमेटिकली एज अ रेजिस्टेंस की तरह काम करना शुरू कर देता है। समझ में आ गया? बाकी लाइक भी करते रहो फिर। जिन लोगों ने लाइक नहीं किया स्ट्रीम को, डोंट फॉरगेट टू लाइक द स्ट्रीम, सब्सक्राइब द चैनल एंड डू वट एवर यू वॉन्ट टू डू आफ्टर दैट। इसमें भी है तो सही, वो ऑलरेडी टेस्टेड हो चुका है ना नीचे लेवल पे, यहाँ पर देखो। लुक एट दिस, नहीं है। नीचे नीचे देखो, मैंने जैसा बताया, अगर यहाँ ये होल्ड नहीं किया ना 297 तो 290, फिर हम 290 की ओर चले जाएंगे, वहां पर ही बाई करेंगे फिर। इसलिए अगर देखो मार्केट को सुपर बुलिश होना है तो 312 314 के ऊपर, 312 314 के ऊपर मस्ट सस्टेन होना जरूरी है। नहीं होता है सस्टेन इनके ऊपर, ये कुछ जैसा मैंने कल प्राइस एक्शन बताया था, कल सेलिंग आई थी, कुछ ये प्राइस एक्शन बन जाएगा मार्केट में, समझ रहे हो। दूसरा है कि अगर सस्टेन कर गया तो कुछ ये प्राइस एक्शन बिल्डअप हो जाएगा, फिर ऊपर से जो सेलर हैं वो रिस्क में आ जाएंगे। अभी भी बायर ही रिस्क में है। इंद्रजीत अग्रवाला जी, गुड मॉर्निंग, कैसे हैं आप? सब बढ़िया। टेस्टेड है नीचे के लेवल, आई नो इट, बट वही है लेवल फिर, और कोई लेवल बचता ही नहीं वहां पे। फिलहाल के लिए ये एफयूजी एरिया हमारे लिए कंसर्निंग है, दिस एफयूजी एरिया। यहीं तक चला जाए, इस एफयूजी तक, वही काफी है। बाकी अभी 12:30 हो जाएगा तो मुझे लगता है थोड़ा मोमेंटम आ जाएगा उसके बाद, अभी तो थोड़ा मोमेंटम भी कम है ना। राइट नाउ मोमेंटम इज वेरी लो, वेरी स्लो है, क्या कह सकते हो अभी आप। 12:30 के बाद लंदन सेशन ओपन हो जाता है तो फिर थोड़ा वॉल्यूम प्रॉपरली और आना स्टार्ट हो जाएगा। दैट विल बी अ गुड साइन, ग्रेट साइन। क्रूड के बारे में बताएं सर, कहाँ तक जा सकता है? एच श्रीधर भट्ट जी। एच श्रीधर भट्ट जी, क्रूड ऑयल एक क्रूड ऑयल ही है। बाकी जहाँ तक चाहो वहाँ तक जा सकता है। और बताओ, और क्या जानना चाहते हो इसके बारे में? और डिटेल चाहिए तो चैट जीपीटी यूज़ करना पड़ेगा मुझे। फिलहाल तो देखो, एक क्रूड ऑयल भी एक रेंज के अंदर कल वाली रेंज में फंसा रह गया। ऊपर रेजिस्टेंस है, देखते हैं एक सेलिंग अगर बनती है तो इसको मैं थोड़ा रिमूव ही कर देता हूँ। काफ़ी कंसोलिडेशन हो गया। थोड़ा कल के बाद ना मोमेंटम आया नहीं मार्केट में, क्रूड में। लेट्स सी, कुछ पॉसिबिलिटी बनती है तो। ट्रेड है नहीं, ये नेचुरल गैस में बन रहे हैं ट्रेड, क्रूड ऑयल में अभी कोई ट्रेड नहीं है। किसी लेवल पे आएगा तभी कुछ कर पाएंगे, नहीं तो नहीं कर सकते अभी। डिस्टेंस है कि बना हुआ है 5280 वाला। वैसे एक बार कल टेस्ट हो गया था, कल क्लोजिंग ओपन होते ही होते। थोड़ा ये ब्रेक करके ऊपर जाए और फिर गिरे ना, तो मुझे लगता है ज़्यादा अच्छा रहेगा, नहीं तो। नहीं, क्रूड में अभी कोई ट्रेड नहीं है, देखो बनता है तो कुछ। नो ट्रेड इन क्रूड। नेचुरल गैस में ही बन सकते हैं, अभी क्रूड ऑयल में मुझे कुछ दिख नहीं रहा है खास ट्रेड। करो गाइस, कम ऑन, डोंट फॉरगेट टू लाइक द स्ट्रीम। न्यूज़ देख लेते हैं एक बार, न्यूज़ ऑफ द आवर, कुछ डेटा अपडेट या न्यूज़ अपडेट है तो। डेटा तो वैसे इवनिंग पर है, न्यूज़ ही देखते हैं। Treasury suddenly trade like risky asset in warning to Trump.
News when you want it with Bloomberg News Now. I'm Stephen Carroll. The dollar has weakened to a 6-month low as an escalating trade war raises further fears over the US economy. The greenback saw its biggest plunge in 3 years yesterday and is falling further today, driving the euro to its highest since 2022. The sell-off in treasuries is continuing too, with yields on long-dated US debt rising as investors question its safe haven status. Speaking to Bloomberg, Bridgewater Associates founder Ray Dalio warned the tariff turmoil is damaging America's credibility.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Dalio went on to say that this was a moment to question if bonds are an effective store of wealth. 30-year Treasury yields surged by 13 basis points on Thursday and are rising further today, close to 4.9%. The sell-off in the dollar and treasuries was echoed in the stock market. The S&P 500 ended the day down 3.5%. The MSCI Asia Pacific Index is on track for its third consecutive week of losses as market relief turns to angst after the White House clarified that total US tariffs on China are in fact rising to 145%. Founder and CIO of Heyman Capital, Kyle Bass.
We must reset our trade relationships with the rest of the world. We also must narrow our fiscal deficit in the United States. And both of those things might be slightly recessionary. And if that's true, we might have to go through a brief recession in order to rebuild our foundation.
Kyle Bass says in the end, America will be stronger. However, many investors are continuing to seek havens and non-US alternatives. The euro climbing to a 3-year high, while the yen and gold have also gained. As the market sell-off once again gathers steam, President Trump has conceded that his approach to tariffs will cause some issues. Even after the pause on higher levies for many countries, Bloomberg Economics says average import taxes for the US will be 24%. Speaking at a televised cabinet meeting, Trump conceded this will have an impact on American.
There'll be a transition cost and transition problems, but in the end it's going to be a beautiful thing.
Trump says he believes the first tariff deals are very close, while also voicing optimism that China will eventually come to the table. He also indicated willingness to be flexible on exemptions for companies or countries from the tariff regime, including the 10% floor he's established for all trading partners. Top European officials are planning to visit China to discuss trade with President Xi Jinping in late July, according to a report in the South China Morning Post. The European Commission President Ursula von der Leyen and European Council President Antonio Costa have reportedly agreed to the summit in Beijing. Despite President Trump's 90-day levy reprieve, global leaders are still unsure. Germany's Chancellor-in-Waiting, Friedrich Merz, referred to the maximum uncertainty in America, while voicing hope that the US and the EU can negotiate the abolishment of tariffs on both sides. Chicago Fed President Austin Goolsbee says the tariffs are a stagflationary shock for the central bank. Speaking at the Economic Club of New York, he went on to argue that the levies pit the goals of price stability and full employment against each other.
A tariff is like a negative supply shock, which is to say it makes both sides of the Fed's dual mandate worse at the same time. Prices are going up while jobs are being lost and growth is coming down. And there is not a generic playbook for how the central bank should respond to a stagflationary shock.
The Fed's Austin Goolsbee there. He went on to note growing business anxiety, which he says can lead to lower investment. According to Goolsbee, the sooner the uncertainty dissipates, the sooner the Fed can lower borrowing costs. He believes that interest rates will be lower in the next 12 to 18 months, but added that the Fed is currently in a wait-and-see mode. Tariffs will not only hit UK growth, they might also weaken the pound. That's the warning from the Bank of England's Deputy Governor, Sarah Breeden. She says the currency may lose out if the trade war escalates. And a helicopter has crashed into New York's Hudson River, killing the 3 adults and 3 children on board. The aircraft broke apart in mid-air while taking a Siemens executive and his family on a sightseeing trip. New York City Mayor Eric Adams updated the press on the incident.
All 6 victims have been removed from the water. And sadly, all 6 victims have been pronounced deceased.
The helicopter was operated by New York Helicopters, and US aviation authorities are investigating the crash. Those are your top stories on the markets. The MSCI Irish Pacific Index 0.8 lower this morning. The Nikkei in Tokyo down by 4.4% after the slide that we saw on Wall Street yesterday when the Nasdaq finished down 4.2%. European stock futures are pointing higher though, up 0.25% for Eurostoxx 50, 0.2 higher for FTSE 100 futures at the moment. The Bloomberg Dollar Spot Index further weakening today. The Euro's 0.9 stronger at 113 against the dollar. The Japanese yen is 0.9 stronger as well at 143.18. The 30-year Treasury yield and the 10-year Treasury yield both rising this morning. The 10-year's up 2 basis points to 4.45%. That's news when you want it with Bloomberg.
EDP's 5G Living Lab is transforming a 70-year-old dam into a digital innovation hub.
Vodafone Business has deployed 5G infrastructure to transform the way we do things better, faster, more efficiently.
The retaliatory tariffs, you have a situation where basically production sort of grinds to a halt because there's these interdependencies. And that is very bad. It's almost like another COVID in that it raises costs, it lowers revenues for companies, and it worsens the capital markets.
Dalio sounds like a worried man. Bridgewater Associates billionaire founder Ray Dalio there speaking to Bloomberg. The tariff turmoil obviously sparking massive swings across multiple markets. We've seen losses in US stocks. They were up on the week. We've obviously got what is happening in the debt market, much more significant. The FX story is definitely worth paying attention to this Friday morning. Valerie has more.
Guy, yesterday I think was a unprecedented session where we saw a crash, frankly, in the dollar. Take a look at how dollar Swiss reacted yesterday. The Swissy moving around 4% stronger on the day as we fled dollar assets and went to other safe havens, being it the Swiss, being it the euro, and the Japanese yen. I think this is just another sign that international investors are selling their dollar assets and repatriating them back home. I want to show you another chart, Guy, which I thought was very, very telling. Previously, in times of financial stress, we've seen a spike in volatility, a spike in the VIX. That's this white line here. We have also seen a flee into U.S. assets, into the dollars. That's that blue line here. That is notably absent from this week's turmoil. Instead, we have seen the exact opposite. A decline in the U.S. dollar alongside this volatility is really posing big questions on whether there now is a risk premium built in to the dollar and to U.S. assets. I want to end on treasuries because this is another asset that is trading like a risk asset, is not trading like a safe haven. Take a look at the 30-year yield over this last week, 45 basis points higher. A lot of this, Guy, is speculation that if trade between China and the U.S. does come to a standstill, does that mean that those recycling of dollars into treasuries will essentially come to a halt for China? And China is a big holder of the treasury market, is a big incremental buyer of treasuries. Without that buyer, do yields have to be structurally higher going forward?
Cost of capital goes up. That's a big problem for America. American exceptionalism certainly being called into question. Valerie, thank you very much indeed. Camilla Astabarega, Senior Portfolio Manager at EFG Asset Management, joining us around the table. Good morning.
Thank you. Thanks for having me again.
You may regret saying that. Let's talk about what is going on out there in these markets. What do you do? Where's the safe? The safe haven right now? If I need a port in a storm, what is it?
Yeah, so, I mean, it has been a very entertaining week, to say the least. I mean, looking at the TV, like, nonstop. But I think, like,
Bloomberg,
if we go back for... Of course, only Bloomberg. If we go back for 1 second, I mean, I think that what Trump wants to do, in theory, is not necessarily so bad, although we see, in reality, tariffs are never, like, the solution. But I don't think it's all bad. However, as they say, the road to hell is done by, good hopes or expectations.
Good intentions.
Exactly. And I think that's what happened here, that the execution has been really badly. And I guess it's another way of negotiating. People sometimes say, if you don't do this, I will increase the tariffs. And what he has done is like, I will increase the tariffs and then we negotiate. So what it has definitely happened, though, is that a lot of uncertainty has been brought to the market. And that, of course, will spill into the real economy. So companies will, take a step back and say, well, I'm going to wait until the rules of the game are more settled to see how much capex or people I'm going to hire or fire, depending on what are the expectations and costs. If my costs are going up, of course, that's a big thing to consider. So I think in reality, people, especially the real economy, are more waiting for what's going to happen.
So what do you do?
Reacting.
What do you do? What do I do?
So the most important thing is that I do believe that this, whether you like it or not, has brought a lot of more negative scenarios for growth.
Yep.
Some people are calling for 60% recession, some people for 40. We can talk about that later. But in reality, the probability of lower growth than was initially expected has increased. And then you have to think, which economies then are less reliant on growth to pay their debt? Which economies or countries are less reliant or less dependent on GDP? Because, of course, if GDP is going to go down, then your capacity to pay goes down, and therefore you want to try and avoid those countries that are going to be in a situation where they'll have to refund their debt at high rates, and therefore the only way to attract capital it will be to increase their interest rates. So then they go into a negative loop. So to be in these economies where they are more that have higher assets or more savings and other economies less reliant on growth. I think that's the way of looking at it. Of course, it will be a volatile market, but I think that this is the part where you actually really have to look at fundamentals.
But
if we're going by the fundamentals, it feels like the narrative shift around the credibility of the United States and assets was for driving all this repatriation, as Val talked about, in every market. But if we're looking at the fundamentals, as you say, still the most liquid market. The Treasury is still the most liquid market. The S&P 500 still has the most liquidity. And in times of volatility, shouldn't you be flocking to liquidity? So can you explain why the narrative is perhaps overshadowing the fundamentals at the very moment that liquidity matters?
Yeah, no, I agree. I think that overall the market is relatively liquid, so maybe the priority is not only liquidity, although, of course, the treasuries have always been like the safe haven. But with all that's going on politically, I think that people are looking at other, options of safe haven or to diversify at least. Before China, and I think that we spoke about it last time, like China was a big buyer of treasuries, and now maybe they're like, I will diversify a little bit more. It's not that they're not buying nothing or that they don't hold, but on the delta, maybe that's why gold is going up so much. I mean, now, of course, a bit of a relief, but to diversify a little bit the economy. So Japan has been a good, and Swiss franc has been a good, place for now to be.
Where does gold fall into that?
Oh.
Does it?
I mean, I got no idea. Honestly, like oil and gold, when people ask me, like, where do you think it's going? I'm like, your guess is as good as mine. Sometimes it moves on demand supply. Other times it moves on just sentiment. So we'll see. The important thing I would say is credit spreads as well. It's a very good reflection of where the probability.
And they're going higher? They go wider?
Yes.
They've already gone a bit wider.
Yes.
Much wider from here?
Not sure. So now they're implying around a 40% recession, which I think is relatively, fair for what's going on. The most important thing I would say, again, is to look at those companies that have strong fundamentals, at the moment. And because where are you going to take the risk? If everything is going up, everything has widened around like 30, 40 basis points from the tides. The clear message, I think, is like we've seen the tides. I don't think we're going to see them again. The cat is out of the bag. Putting it back in is difficult. So I think people are waiting to see for the next 3 months how the real economy is actually going to be impacted.
We'll talk to Bruce Richards about this a little bit later as well.
Yeah,
joining
absolutely.
us from Marathon.
Camila Astaburuaga, Senior Portfolio Manager at EFG Asset Management, joining us around the table this morning. More on the markets coming up. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it on Balance of Power.
Governor, I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area. And they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now and I just don't know. All I know is that people were promised lower prices on Inauguration Day, and guess what? They're going up.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
"30 minutes of the cash open here in Europe for equities at the moment. Futures are higher. Euro dollar is also higher, but off its highs. And the US 30-year is catching a little bit of a bid right now, Chrissy.
Absolutely. And we're looking at 10-year, by the way, of 441. So let's go a quick check of how that's translating over into the European bond market. Not as much volatility, as much action as perhaps we were expecting.
No, the day is still young. We'll wait and see exactly what pans out a little bit later on. We've got some key meetings coming up. We'll go to one of those in just a moment. I want to take you first to Beijing, though, and show you what is happening there. Pedro Sanchez, the Spanish Prime Minister, is currently addressing journalists. He will take questions, I would understand, very, very shortly. This obviously comes as we see the European Union maybe reaching out to China, talking about the idea of maybe developing ties in a way that probably wouldn't have been there maybe before the arrival of Donald Trump's tariffs. A critical part of this narrative, von der Leyen's about to go as well. That's a big move forward in terms of that relationship.
And we should say that Pedro Sanchez and the Spanish government broadly has actually been the lone wolf on that take when it comes to China. A lot of that specifically when it comes to that EU tariff vote on overcapacity and tariffs that they were putting on China independently. Spain was the holdout because they were already in negotiations. So Pedro Sanchez kind of leading the charge on that front as well. So that's going to be something that's very, very crucial as we monitor the situation.
What he's saying is that Spain and China, it's interesting he's saying Spain and China, not the EU and China, are seeking a high-level political dialogue. And it's going to be interesting to see who speaks. Ultimately, Ursula von der Leyen appears to be the one that will speak. Sanchez is maybe kind of paving the way for that conversation. But as you say, maybe he took a different level took a different look at the level that the relationship should be at. Anyway, let's carry on the conversation from a different angle. Let's figure out what is happening in Warsaw.
Let's do it. EU finance ministers will meet in Poland today to discuss the latest on tariffs and the European response, as well as financing European defense. Over in Warsaw is our very own Oliver Crook standing by with an exclusive interview. Ollie.
Yeah, that's right, Crude. I mean, for the task of finance ministers gathered here in Warsaw, it's really about sort of retaliation. What are the right measures? What's the right architecture to
Expand your business efficiently with our 3
support resistance level for crude oil अभी कुछ नहीं है support resistance crude oil के. There is no level in crude oil right now. Wait करेंगे कुछ बनते हैं तो. नेचुरल गैस में भी ध्यान रखना, ऊपर ये एफईजी है, अगर यहाँ से रिजेक्शन मिला तो यहाँ से सेलिंग कर देंगे, फिर नेक्स्ट सपोर्ट नीचे रहेगा. ये कल वाला ही सपोर्ट था, यहाँ पर अभी रुका है.
New York City this morning. Good morning for our audience worldwide. Bloomberg surveillance starts right now, coming into Thursday as the White House chooses de-escalation.
Many of you in the media
clearly missed the art of the deal. You tried to say that the rest of the world would be moved closer to China when in fact we've seen the opposite effect. The entire world is calling the United States of America, not China, because they need our markets, they need our consumers, and they need this president in the Oval Office to talk to them.
The president backing down, authorising a 90-day pause on major reciprocal tariffs while choosing to double down on China.
So every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
One social media post sending equities to their biggest one-day gain since 2008 and offering some support to a nervy bond market.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy.
The bond market very much in focus going into inflation data later this morning. The latest read on consumer prices, that number is just around the corner.
And that number won't probably matter very much at all at a time where President Trump, whether some people are saying that now we've reached a new level of calm, not quite so much. It is unclear to see what kind of data could supersede what we saw yesterday, which sure, on one hand, gave us some insight. Number one, it took the worst case scenario off the table. And number two, it showed that, yes, he does care about markets, the bond markets, and that they do have a call. They do have a strike price. It's just not maybe as comfortable as we previously thought.
Check out the equity market this morning. We're down again. We're down by 2% on the S&P 500. We're down across the board. We've got 10% baseline tariffs still. We've got 125% tariffs on China. Goldman's Jan Hatzius putting it this way, Anne-Marie. We've gone from a recession-level increase to a still very growth-negative increase.
There's still a tremendous amount of uncertainty when you look at what's going on in China and the tit-for-tat and the rhetoric you see out of China and Washington, D.C. Many economists are looking at this, and they're basically saying this is decoupling when it comes to goods between these two economies. And then it comes to the 10% baseline. Donald Trump talked about this on the campaign trail. There's going to be a 10% tariff wall. So he's going back to that promise. The issue is when it comes to the reciprocal tariffs, it's a 90-day pause. It's a reprieve. It's a halt. What happens when he doesn't get the deals he wants for some of those top trading partners? We're going to be doing this for weeks and months on end.
The uncertainty remains. Sure, we've taken the temperature down over the last 24 hours, but for many people, investors, officials alike, business leaders, they face similar risks this morning.
If you're counting on the psychology of one person whose insight into his decision-making process was it was fluid, I just did it on the fly, it was an impulse, it was a feeling, it doesn't give people confidence in how to predict. How do you trade in a market where 6 stocks can gain $1.7 trillion in market capitalization in one day?
I heard that maybe he just wants to relax and watch the Masters over the next 4 days. Maybe that's what this is about.
So we're basically going to look at the golf schedule and then decide when things are going to ratchet down before they ramp up again. Again, this goes back to what does this do over the longer term to U.S. assets? I think it's notable that the dollar is weaker again today and that gold was the best performing asset that had a best day yesterday in a couple years. To me, that speaks to the moment we're in.
Rory McIlroy teeing off at 1:12 Eastern Time. Coming up this hour, Ross Kostrick of BlackRock on tariff whiplash, Andrew Bishop of Signum Global Advisors as the White House backs down, and Subhadra Japa of SocGen as Trump watches the bond market. We begin this hour with stocks falling following their biggest daily gain going back to 2008. President Donald Trump announcing a 90-day tariff pause on most trading partners. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the program. Let's just start with where we are and where we might be in 90 days' time.
Yeah, hey, John, good morning. Well, that 90-day pause only applies, as you've been discussing, to those so-called reciprocal tariffs, but that 10% levy is still in place across the board, plus that 125% tariff escalation with China, not to mention that Canada and Mexico didn't see any reprieve from this because their plans were never rolled in to the so-called reciprocal tariff plan. But it does appear that this White House did have its limit, particularly after really downplaying the investor concerns in recent weeks. You heard President Trump yesterday indicating that the market turmoil did have an impact on this decision. He said he felt that people were getting, quote, yippy, a little bit afraid when it came to the economy. And of course, as you've been discussing, pointed out explicitly that he was watching the bond market amid, of course, as you know, these heightened concerns about the future stability of the debt markets. Now, Interestingly enough, Treasury Secretary Scott Bessent did come out yesterday and he said this was the plan all along, that this shows the White House wants to negotiate in good faith, and it actually gives the U.S. more leverage in these negotiations. But we should be clear that President Trump said that this decision was only made yesterday morning after earlier in the week dismissing a pause altogether. Now, John, the Treasury Secretary did confirm that he does have meetings on the books with Japan, South Korea, Vietnam, and India. But it might not just be countries that are soon negotiating with the U.S. President Trump was asked if he would consider exemptions for companies, and he said that those would be coming in the future. But when asked how he would make those determinations, he said that it would be based on his instincts.
Tyler Kendall with the latest from Washington. Tyler, thank you. The door just slightly open for one particular company, Apple. Can we have some exemptions in the months to come?
Absolutely. And I'm sure Tim Cook is putting on his diplomatic hat, calling the White House and saying, look, something needs to be done, or we're going to be dealing with $3,000 North iPhones, which I don't think you want to have under your presidency when it comes to a consumer that's pushing back on higher inflation.
Futures down across the board this morning. NASDAQ futures down by 2 percentage points. A wild start to the week in financial markets. Russ Kostrick of BlackRock joins us now for more. Russ, a big change, a U-turn from the President of the United States. Does it make you more bullish on equities or on bonds?
I'd say right now it makes us cautious. Good morning, Jonathan. We have been pulling in risk for a while. Clearly, yesterday was a relief. Market took it as such. But, as I was looking at a report this morning, you often get these big rallies during periods of turbulence. Our view is that you're still in an environment where policy uncertainty is heightened. You're also in an environment that wherever you came into 2025, whatever your economic assumptions were, they've got to be lower today. So if we've got a world of higher uncertainty, probably higher volatility, slower growth, you've got to adjust the portfolio accordingly.
Russ, in the past, that would mean going to bonds. This time around, is that still true?
Well, we have been raising our allocation to bonds. We're underweight, as you might remember, over the last few years, we've been talking about it. Generally modestly underweight bonds, particularly on the long end of the curve. We've been bringing that back closer to benchmark. And I'd say that is more of a reflection of the economic environment than trying to make a bet on policy. Now, if you do have an environment where growth is going to be slower, it's not crazy that your bond allocation is going to be closer to home. But by the way, we've done a similar thing in equities. We brought our equity allocation down closer to benchmark. So what's happened, generally lowering the risk in the portfolio in this type of environment, rather than a strong bet on you want to be in bonds and equities, you want to bring risks down.
Maybe the larger question is U.S. assets versus ex-U.S. assets at a time where the source of volatility is the United States, and this has to do with bonds, but more broadly with dollar-denominated assets. Does it make you rethink some of what you have in your portfolio based on where the source of volatility has been coming from?
This is a great question. I think this is actually a harder question to answer, but what I would say is I don't think you'll have a knee-jerk reaction to move away from dollar assets. Couple of points. First of all, we might remember 2011 during the debt ceiling crisis. The U.S. gets downgraded, the epicenter of the crisis. What happens? Treasury bonds go up. The dollar is still the reserve currency. We can debate what's going to happen in 5 or 10 years. It is still a safe haven asset. And I do think that you've got to be skeptical about calling the end of dollar dominance. The other point on the equity side, we are still modestly overweight the U.S. Now, why would you do that with all the turbulence going on? Simple answer, we still find better companies in the U.S. We think about what do we want in this environment? We want profitability. We want companies that can generate consistent earnings. Still find more of those companies in the U.S. rather than Europe or Japan. So to my mind, even with the turbulence, from a bottom-up perspective, still an argument to be modestly overweight the U.S.
Given all the uncertainty, even whether or not Trump decides to blink, walk off the cliff, give these reprieves, do you still like gold?
We do like gold. Again, I think you have to trade around it. It's been a huge move. We like gold back 6 months ago. We definitely like it today. Couple of reasons. First of all, Emery, as you suggest, still a asset that works during times of turbulence. You look at the performance of gold when volatility is rising. And again, I think it's safe to say we're probably in a more volatile environment. Generally does very well versus stocks. The other argument is the long-term fiscal picture. One of the reasons we like gold is you can't print more of it. It is a store of value. it's still not obvious that there's going to be a significant improvement in the fiscal picture. If we are in an environment of these $2 trillion structural deficits, they're not necessarily going away. Having something that you can't increase the supply, that is a store of value in the portfolio, we think that makes sense over the longer term.
Russ, just wanted to jump in with some news out of the European Union. The headline just crossing the Bloomberg terminal that the EU is considering pausing counter tariffs against the United States for 90 days, in line with that 90-day pause that the president announced just yesterday. Just taking the temperature down just a bit more this morning.
And I also think the European Union is looking around the room and saying, look what's going on with Japan. Look what's going on with South Korea. They are pushing out olive branches. They are saying they want to do deals with this president. He's come out and said you're going to get a 90-day reprieve. So why should we escalate? At this moment, maybe we should send a team over and try to de-escalate and come to a trade agreement.
The latest headline from the team here at Bloomberg that the European Union is considering pausing counter tariffs against the United States on metals for 90 days. Russ, just to bring you back into the conversation as we take the temperature down worldwide, how close did we come to an accident in this bond market? What did you see developing in the previous few days going into the announcement from the president just yesterday afternoon?
Well, I think the bond market move was definitely something we were paying attention. And it was not just the Treasury market. You'll remember that, during the initial phases of the sell-off, credit markets were remarkably well behaved. That all started to change on Friday. We saw spreads back up dramatically. I think that gave a lot of people pause because now it's not just a matter of growth. It's a matter of liquidity. It's a matter of what's happening with the availability of credit. And that was something that definitely unnerved investors. If you see the bond market calming down, that's definitely a development that's going to give a little bit more comfort to the equity side of the market.
Things settling down in the bond market this morning. Russ, appreciate your time. Russ Kostrick there of BlackRock on the latest. The latest in fixed income. Yields lower across the curve. We're down 5 basis points on a 2-year. On 10s down a similar amount. Your yield this morning is 4.29. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. That move puts Trump on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. In China, the top leaders there are set to meet today to discuss additional economic stimulus in response to those increased tariffs. Sources tell Bloomberg that the meeting will focus on support for housing, consumer spending, technological innovation, among other areas. A check on U.S. steel shares in the pre-market down nearly 12%. President Trump has said that he doesn't want a Japanese company buying the steel manufacturer. Earlier in the week, the president ordered an additional national review of Nippon Steel's proposal to buy the company. The U.S. Committee on Foreign Investment has 45 days to finalize its review. And that's your brief, John.
Hey, Danny, thank you. More drama. More from Danny a little bit later this morning. Up next on the program, the president backs down.
We had to take the medicine. We had to go through the operation, and that's what we've been through. And a lot of presidents would not have done it. No president would have done it, I think.
That's for sure. Andrew Bishop of Signum Global Advisors joins us next, live from New York City this morning. Good morning. The latest from UBS this morning and the team. Trump blinks, but the damage isn't all undone. You see that again this morning. We're down 1.4% on the S&P. We're down 1.7% on the NASDAQ 100. Under surveillance this morning, the president backs down.
A lot of winning out there. We're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Our country's stronger than it's ever been, and somebody had to do that. We had to take the medicine. We had to go through the operation, and that's what we've been through. And a lot of presidents would not have done it. No president would have done it, I think.
It's the latest this morning. President Trump sending stocks to their biggest one-day gain since 2008 after announcing a 90-day pause on higher tariffs. The president making an exception for China, raising duties to 125%, and China responding to moderately reduce the number of imported U.S. films. That headline just crossing the Bloomberg terminal Ollie Crook, seconds ago. Ollie, let's talk to you, sir, in Brussels about how the Europeans might respond in the coming days and weeks.
Yeah, well, Jonathan, it's sort of hard to know because we're on our third global tariff regime, and it's just Thursday of this week. And this is what the basically European policymakers need to be sort of reacting to and really feeling a lot of whiplash. I mean, I've already spoken to a few today. Everyone is intensely relieved, but let's not lose sight of the fact that you still have 10% tariffs that are going from all goods going from the European Union into the United States. We're talking about 500 billion euros worth of goods. And let's not also lose sight of the fact that you have 25% tariffs on cars. You have 25% tariffs on aluminum and steel. And now the European Union has said, because they come up with these measures to retaliate, to hit $21 billion worth of American goods in retaliation just to the steel and aluminum, that is now on pause for another 90 days in order to have conversations with the United States. Of course, it was very difficult for the Europeans to get into a room with the Americans in the sort of lead up to this, to get those negotiations going. They have wanted to have negotiations from the very beginning. But if you're a European policymaker today, how much reassurance are you taking in what you've gotten out of the Trump administration? We also know from sources that next week they're not going to deliver the architecture in retaliation to the reciprocal tariffs. They were originally planning to do that. But I suspect, John, they're still going to put up that architecture. They're going to have it written down somewhere. They're just not going to talk about it, because if this is a problem not today, maybe next week, maybe the week after.
Ollie, the press secretary called out the media yesterday in a briefing and said you tried to say that the rest of the world would be moved closer to China. Has Europe moved closer to China? What's your reporting in Brussels?
There has been a little bit of discussion on that. So we were hearing something about that from the Spanish side. We know that Pedro Sanchez, the Prime Minister of Spain, the socialist from Spain, will be arriving in Beijing tomorrow. But whenever I spoke to policymakers earlier in the week, and I did drill these sort of different trade ministers about this, saying that basically if the U.S. is an unreliable partner, does that change at all your relationship to China? Does it change even how you think about it? They were very, very cautious about moving in that sort of direction. Because remember, before Trump was elected president of the United States, the biggest threat to Europe, they thought, was China. They have this whole new commission. It's all about European competitiveness and trying to push back against that Chinese threat. And again, that is sort of a caution that is well appreciated, I would say, by the Trump administration over the last few days, given what we heard from Scott Bessent saying yesterday, that if Europe moved towards China, they'd be slitting their own throat.
Ollie, appreciate the update out of Brussels. Ollie Crook there, Bloomberg's very own. A lot to stay on top of over the last 15 minutes or so. So in the last 24 hours, the president is backing down on Europe and doubling down on China. And this is what we've heard so far this morning. Just in the last 10, 15 minutes alone, the Europeans weighing a pause on retaliation, and the Chinese reportedly moderately reducing the number of imported US films.
So there's trade war certainly happening between Beijing and Washington while it's cooling off, as the president said, be cool, when it comes to everywhere else. China right now is going to reduce the number of imported U.S. films. This has been circulating in Beijing for a number of days. There was an illustration of a potential response from a number of Chinese bloggers that people watched to try to read the tea leaves of what's going on with the CCP. And they were saying it include duties on American farm goods and a ban on Hollywood films. And we're starting to see a lot of that play out.
Let's continue the conversation. Joining us now is Andrew Bishop of Signum Global Advisors. Andrew, welcome to the programme. Just describe for us what you think the next 90 days are going to look like.
So I think the most important thing to keep in mind, given the news yesterday, is that in Trump's modus operandi, a delay is not a cancellation. So I know that a lot of people are saying, the tariffs have been put on pause, but that doesn't mean that the uncertainty is gone. I would go a step further. That doesn't mean that the tariffs are gone, right? And very tangibly speaking, what we've seen time and time again in the past with this president is that he'll hit pause, but will then actually move forward with a measure. So what I suspect may happen is that by the end of the 90 days, we may have perhaps a more competent team in place to actually see these tariffs through, but just with, a more professional framework in place and being rolled out.
Has the strategy somewhat changed to squarely focus on China and bring allies along for the ride?
So that's always been a hypothesis, and it's a hypothesis that gets a lot of backing from recent news, right? Given the president's decision to focus on China. We at Signum have been warning not to jump into these monocausal explanations, right? So up until a few days ago, it was a war against everyone with no negotiations. Then it was a negotiation with everyone. Now it's a negotiation with everyone except China. Our view, to be very clear, is that the president does not have a single motivating driver for his use of tariffs. And as he as he has himself said, the reason he likes tariffs is because he can accomplish many different things. So I would not focus too much on China, actually.
When it comes to this pause on tariffs, how does this work hand in hand with what they're trying to do on Capitol Hill? Because I thought part of the tariff regime is to bring in revenues to pay for the tax extension.
So our view at Signum has been that that was never the goal, right? I.e., they will talk about that, they will say that it helps, et cetera, but that the president's approach to tariffs has always been and will remain more transactional than any measure really bringing in revenue would need to be, right? The exception to that is now probably the 10% baseline universal tariff, and that does bring in some revenue. But considering the fact that it's done outside of Congress, as you say, and the fact that it's not enough revenue, we really don't see it as a one-to-one measure with the tax cuts.
Andrew, what is your timeline now for the tax cut plan?
So the president, I think, and the president's team are trying to hasten it, right, and shorten it to sort of paper over some of the bad news on the tariff side. Our timeline has not changed, which essentially means that late summer at the earliest, around the period when Congress will go on a break, is the absolute earliest we could see a bill. And frankly, we lean much more towards post-summer.
Interesting. Andrew, thanks for the update. Appreciate it. Andrew Bishop there of Signum Global Advisors. So what do the next 90 days look like? Neil Dutta of Renmac. He says this: the issue is prolonged uncertainty. It weighs on investment. Consumers save more. Labour markets are still frozen. And his words, not mine, housing still sucks. No data.
Well, this is the issue. Can you really put the genie back into the bottle, put the toothpaste back into the tube? This is what we've been talking about. To more tangibly talk about it, Amazon already canceled orders in China. We talked about Haas Automation, which already said that it was reducing production and in some of the hours for its workers. You start looking at the moves that companies are taking. They're taking risk down. They're not taking a lot of comfort in this pause.
We should give Neil a little bit of a high five and a hat tip, because before Trump came out and announced this plan, Neil had a note out that said exactly what they should do. It makes more sense. Start with a 10% universal baseline tariff. Check. That's what they did. Work on bilateral deals on country-by-country basis and starting the process for 232. Check. That seems to be what they're doing. Starting from a ceiling and working backward. That is what they're doing now. And this was actually the plan the Treasury Secretary set forth moments after Trump announced Liberation Day with that huge chart. He said, actually, this is going to be a cap. Don't retaliate, and we will do deals with you.
So we've got bank earnings tomorrow morning. Kicks off with JP Morgan. I don't think this makes it any easier. I don't think it makes things any clearer. How can they offer guidance in a moment like this one? It's a 90-day pause, and that's all it is.
I mean, this is the reason why a lot of people are just darn frustrated, because how do you come up with anything? The fact that Goldman Sachs retracted their recession call yesterday after the 90-day pause, again, what we just got was taking the worst-case scenario off the table. Maybe. Taking the temperature down. Does that really remove the threat? And this is the reason why earnings are going to be interesting, not only for what they say, but also the reaction of markets.
A major move on stocks yesterday, the biggest one-day pop on the S&P 500 since 2008. This morning, equity futures lower by more than 1 percentage point. Up next, Amrita Sen of Energy Aspects saying crude could trade under $50 a barrel. Live from New York, you're watching Bloomberg TV. What a phenomenally wild few days in financial markets worldwide. Equity futures this morning down by 1.5% on the S&P 500. The S&P trading like a penny stock in yesterday's session. Check out this range on S&P 500 futures. At the highs, plus 10%. At the lows, negative 3%. A 13 percentage point range intraday on S&P 500 futures. Just absolutely mental. Danny Berger, chaos. Danny Berger has your morning movers this morning. Good morning, Danny.
Unfortunately, John, I've got another big company for you that is trading like a penny stock. So add this to the headache of market participants. U.S. Steel dropping nearly 12% in this morning's session. This coming after President Trump late yesterday saying that he doesn't want a Japanese owner for U.S. Steel, of course referring to Nippon Steel, which has been trying to take over this company. Part of the reason we're seeing such a big reaction is there was a lot of hope built up to start the week on Monday. Trump ordered a national security review of this deal, sending shares their highest since 2024 with hopes, hey, maybe this will actually happen. maybe now this is finally the time we can stop talking about this deal. Also on the move to the downside this morning is Constellation Brands. This is the maker of the beer Corona, along with other brands. It was lower in the pre-market session. It has now moved to unchanged, it would appear. They had their earnings, and again, you see the impact of a consumer company that was already struggling, plus tariffs. Yes, we don't have the dramatic tariffs on Canada and Mexico, but there's still a 25% tariff if you're importing beer cans into the U.S. Constellation Brands pointing out that and changing consumer behavior for giving a dim outlook. The last mover for you, this one just starting to be on the move. It is Disney. It was unchanged, starts to fall 2.6% after the headline that China would reduce some of the U.S. films coming into the country. This, of course, has a direct impact on Disney, which produces films that go into China. Just looking at their financial statements, about 10% in fiscal 2024 of their revenue came from Asia Pacific. So that would indeed be a hit if it starts to get pared back. John.
Danny, thank you. Great work. More from Danny later on this hour. On our radar this morning, President Donald Trump announcing a 90-day tariff pause on most trading partners. The move coming roughly 13 hours after higher tariffs took effect. At the same time, Trump also raising duties on China to 125%. Just finding out what Europe's official response will be from the European Commission President Ursula von der Leyen, saying, "We took note of the announcement by President Trump. We want to give negotiations a chance while finalising the adoption of the EU countermeasures that saw strong support from our member states. We will put them on hold for 90 days. If negotiations are not satisfactory, our countermeasures will kick in."
So here's the start of the negotiations really between Brussels and Washington. 90 days. Can they get to some sort of framework to get to the bottom of a deal? What I would take note in a lot of this is the fact that President Trump gave them an olive branch. They're coming back with an olive branch. But what does this mean in terms of the uncertainty in the market? It still remains, at least for the next 90 days, because if Trump doesn't get what he wants, who's to say he doesn't come back with a vengeance when it comes to Brussels?
If you want that supply side response, you've got to know what the rules are. 5 years out, 10 years out, 15 years out. And if you keep getting told that there is a 90-day pause for negotiations, those plans to build a factory in the United States are going to be on hold, perhaps indefinitely.
Absolutely, because why would you spend any capital when you don't know the rules of the game, which is probably why this cannot extend longer than 90 days. I'm sure there's a tremendous amount of advisors. I know the president has been taking phone calls. Susie Wiles has been taking phone calls from executives, and I'm sure they're telling him this is the problem with not having clarity. So I think a lot of these executives are pushing him to get to an agreement by the end of the 90 days. But with Trump and trade, you might see 2 steps forward, 1 step back.
Waiting to see the reaction from China. China's top leaders set to meet today to discuss additional economic stimulus. Sources telling us here at Bloomberg the meeting will focus on support measures for housing, consumer spending and, Lisa, technological innovation.
This is the tricky place that China is in. As much as everyone is talking a hard line, there is some sort of incentive to come together. And one thing that we've seen from Goldman Sachs, from Bloomberg Economics, they've been downgrading their expectations to Chinese growth. This will be a hit to them at a time where so many U.S. factories produce in China. Remember with Shein, however you say it, they actually prevented them from exporting jobs overseas and said, we will arrest you and we will make sure that you get fired if you do that. So there clearly is more tension under the surface in China.
How are companies responding? So here's the latest from Walmart. Apparently asking a factory in China to leave price stickers off Christmas ornaments for the first time in 10 years. The change comes as the company continues to navigate tariff uncertainty. That's the challenge many companies face. And at the moment, this is something that Mohamed El-Erian has warned about repeatedly.
What I find interesting, though, is that when it comes to China, Trump suggested yesterday that this number, this rate of 125%, that's going to be the top when it comes to how high he's willing to go in that tariff rate on China. And then he said, I can't go any higher. He did say that we calculate it very carefully. I think there's a lot of criticism towards how they actually got to these calculations. And then he said something interesting. He said, at some point, we're going to get a call. He is waiting for Xi Jinping to pick up the phone and call the Oval Office.
And he hasn't done it yet. And we've heard that from the president repeatedly over the past few weeks. Let's turn to commodities. Crude is lower this morning by 2% on Brent to 64, on WTI to $60.91. Oil still flirting with $60 a barrel as trade tensions between the US and China continue to escalate. And Rita Sen of Energy Aspects writing, Trump needs higher supplies to lower oil prices in a manner that can provide a tailwind for global growth as an offset to his tariff policies. Instead, tariffs will lead to lower oil prices by hurting demand growth. And Rita joins us now for more. And Rita, welcome to the programme. You made some headlines in the past few days on some very, very low numbers in the crude market. So what are you expecting now?
Well, I think the prices, or just the general trajectory is still lower. I know there's been a 90-day pause. We saw a little bit of a bounce, but ultimately, if you look at the trade-weighted tariffs, reciprocal tariffs globally, on the 2nd of April, it was actually 19.1%. Yesterday, it was 26.2%, despite the pause, because of just how much the China bit has escalated. It just tells you that that is ultimately the one that matters the most when it comes to kind of global growth. Of course, it's better news for some of the countries. Some of those tariffs have been paused, but like you guys were saying just now as well, there is definitely no certainty that they will remain off. We are hearing more and more from our clients that consumer and particularly business sentiment has completely come to a stall. Nobody's investing. There's no capex investment. And we're going to see a pretty big demand hit. We've just reduced our oil demand number for the second half of the year by 450,000 barrels per day, the same for 2026. So I just don't see how oil prices are going to start moving higher anytime soon until we see the supply response.
How low are we talking, Amrita, do you think oil prices can go?
So look, the difference now versus in the past cycles is that the shale break-evens are higher. And when I was there just last week as well, I would say my biggest takeaway was that outside of the Permian, all the other basins, you're talking about like in the 60s, well into the high 60s in some basins, which are now their break-evens. In the Permian, it's in the 50s. But that is effectively the floor. The difference is it's the timing of it, right? We need to be here for one whole quarter before supply response. And the response will be significant this time around. You are going to lose a few 100,000 barrels per day pretty quickly. But it is just that timing. Like within that time frame, prices can continue to go lower. Remember, there's positioning driven. A lot of this is positioning driven, and people are just liquidating positions. So then it just becomes a number. But ultimately, the floor should be around where we are now, maybe a couple of dollars lower. But I don't necessarily see sustained prices in the 40s or the 50s. But we can absolutely test the 4 handle in the short term.
I know that OPEC Plus and Saudi Arabia says they do not target price. But given this environment you're describing, why did they go further and add even more barrels to the market?
Yeah, I mean, look, the timing of it has obviously led to plenty of rumors about, like, you know, were they doing this on the back of tariffs or to appease President Trump ahead of his visit to the kingdom. In reality, OPEC just has its own timelines for doing things. The Saudi OSP always comes out around the 5th of the month, so they had to take the decision before that. So it was an unfortunate timing, but the decision was entirely to do with internal OPEC dynamics. As we've been saying, you know, we have seen laggards, a couple of, you know, OPEC as in Middle Eastern countries itself, but it's mainly Kazakhstan. If you look at Kazakhstan's production, 400,000 barrels per day higher than where they are meant to be. And they are just not showing any signs of coming off. And I think that is where I worry, even for next month, regardless of price. Because if this is about getting cohesion and getting the message across that everybody needs to do their bit, then it will not matter until and unless Prince Abdulaziz sees that compliance number pick up.
Rita, let's put that into English. Basically, this is all designed to punish Kazakhstan with lower oil prices for a margin grab unless they are into compliance, and then there could be some sort of agreement.
Yes, I think long story short, that's it. And not just Kazakhstan, the few of the laggards. But yes, it's to say the cuts need to be equitable. It can't just be Saudi Arabia that carries the cuts for everybody.
At a certain point, there's also a knock-on effect that this potentially could become punitive at that kind of level for U.S. shale producers, for the U.S. oil export system that has been one of the drivers of a lot of growth that we've seen in the United States and the GDP here for the past decade. I'm just wondering at what point that factors in as well.
Mm-hmm. Well, that's what I was saying just now, right? The shale break-evens are significantly higher now, which is why I was saying that I don't see prices sustainably going below 55 to 60 or even 65. But in the short term, it could be, because even at these price levels, we are hearing from our shale producer clients that they have just stopped drilling, or they're planning to stop drilling. They could even drop rigs. you're going to see a very significant turn down in shale production very quickly. And like you said, that has, and we forget this, we tend to talk about the U.S. as a consumer nation. Production, and given how much U.S. production is a huge part of U.S. GDP right now.
And Rita, just quickly, we've seen commodities drop across the board over the past week or so. Seems some evidence that, particularly with copper, Chinese buyers might be stepping back in. Ahead of stimulus, are you seeing anything like that with crude?
We've seen a little bit here and there, but I do think right now there's just a bit more panic because it's still a moving target. They have come out with an SPR program as well, saying that we need to stockpile, but that's really from July onwards. The biggest hit is actually going to be on LPG, ethane in particular, and propane. Crude's still okay, but the physical market is actually still very strong. Even in the East, it's, stocks are still drawing, but it is really about the fear of the future.
Got it. Amrita, appreciate the update. Thank you. Amrita Sen there of Energy Aspects. Quick update on prices for you. We're down 2% on Brent, 2.3% on WTI, $60 and about 94 cents on WTI crude. Brent crude this morning, $64 unchanged. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The EU will pause counter tariffs on U.S. metals for 90 days. Sources tell us the bloc is weighing a proposal where it would move forward with tariffs on around $23 billion of U.S. goods, but then immediately suspend them. EU Commission President Ursula von der Leyen saying this morning that she wants to give talks a chance. Goldman Sachs has rescinded its recession forecast in the space of just a few hours' time after its initial call. The reversal came after President Trump announced a 90-day pause on most tariffs, and as there still see policy uncertainty leading to a sharp economic slowdown this year and 45% odds of a recession in the next 12 months. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny later on in the next hour. Up next on the programme, a beautiful bond market.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful.
It's beautiful. Subhadra Jaffer of SocGen joins us next, live from New York City. You're watching Bloomberg Surveillance. Futures this morning down by 1.5% on the S&P 500. On the S&P on Tuesday, a close below 5K for the first time since April 2024. By Wednesday, we closed above 5,400 with a major move higher. This morning, we take some of it back. We're down by 1.8% on the Nasdaq. Speaking of wild trading ranges, check out the bond market and look at the front end of the curve, the 2-year 388, down just 2 basis points. Look at the range yesterday. At the low 365, at the high 4.03%. A 38 basis point trading range in a single trading session. Under surveillance this morning, a beautiful bond market.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy. The big move wasn't what I did today. The big move was what I did on Liberation Day.
So here's the latest this morning. The president backing down from major tariffs, attempting to offer some support to a very nervy bond market. Subhadra Jaffer of SocGen writing, Trump raising the pressure on all U.S. trading partners may not bode well for their willingness to hold treasuries. Subhadra joins us now for more. Subhadra, good morning.
Good morning.
Is it a big, beautiful bond market this morning?
I think it still is, but the signals from the big, beautiful bond market is worth heeding to, right? Less bad is not good. If you look at the effective tariff rate, it's still around 25%. You're going to see that impact on both consumer, spending, consumer sentiment, business investment, and ultimately growth. And yes, we have kind of reduce the odds of a recession, but growth is still going to be at or close to flat for this year. Mind you, in December, in the summary of economic projections, the Fed had 2.1% growth for this year, and core PCE heading lower. Now we're looking at inflation somewhere between 3 to 4%, and very nearly flat growth. So that is not necessarily a good thing.
So still negative for growth, which should be good for bonds, but at the same time bad for trading relationships, which might be bad for bonds. So is this good or bad for bonds this morning?
I think it's still, somewhat bad for bonds. And the reason why I'm saying this is that coming into April 3rd, our expectation was that that would be the day we get certainty on tariffs. And then that stays in place for a while. People can go about their business. But guess what? It turns out that's the beginning of the volatility in bonds, not the end. So the next 90 days is going to be quite volatile in the bond market. And we're going to be looking at every news that comes in, how our trading partners respond. And that, I think, is going to add to a lot of volatility. And that skittishness is going to be very evident in the bond market.
The bond market will remain yippy. That's what I hear from you, that yippy is not going away. I'm curious about the auction that we saw yesterday. It was pretty hyped. People were very concerned we could see some sort of failed auction of 10-year bonds. But it was actually really successful. There was a record amount of indirect buying of these notes. What signal did you get from that, given that that came before President Trump's announcement?
It's definitely a step in the right direction, because that was really the most important data point of yesterday that I was watching to see if we'd see another tailed auction. I mean, the 3 basis points tailed auction, the 3-year on Tuesday was quite dramatic. So, if you start seeing more tailed auctions, then you start questioning the demand for treasuries. I mean, today we get a tranche of 30-year supply, and we'll have to see how the market takes that down. But that's one of many barometers that I use to gauge the demand dynamics for the treasury market, because you're looking at a trajectory for debt and deficits that's still quite dire, right? Even if we have some sort of a tax deal, you're looking at deficits going up. We could raise some revenues by way of tariffs to offset those deficits, but it's not going to be nearly as enough as people think it will be.
So what do you need to see to not be yippy? I mean, I guess, what do you need to see to feel like you're confident that U.S. bonds, U.S. treasuries could act as an offset in some sort of economic downturn?
So we did see that price action initially when you saw the rout in equities. You saw investors fly to the safety of bonds. The 10-year yields got to like 380, 390, but then it kind of moved all the way back up because the market started to view that as a sign of instability. So when you have sort of a little bit more of a crisis of confidence, if you will, then you're going to see that bias towards higher yields. And that's my concern, is that you need to see stability in the data. You need to see some level of clarity, if you will, on tariffs for this sort of volatility to subside in the bond market.
Is there a problem with subscribing a narrative to something that might be more just fundamentally liquidity driven? The fact that we haven't gotten the regulatory break to a lot of banks to hold a certain amount of treasuries, that there are certain liquidity constraints. And frankly, when you get that level of uncertainty, all buyers step back at the same time that there's a basis trade unwind. How much is this purely liquidity driven? And we can't really make too much of all of these moves.
A lot of it is liquidity driven, but when it is liquidity driven, you have to make a lot out of these moves, right? Back in 2020, in March, the entire rout in the bond market was because of a lack of liquidity, and the Fed had to step in to be that backstop provider of liquidity. So the lack of liquidity is something that's definitely a serious concern. What was also interesting to me in the price action in the last week was the fact that the haven assets were actually bonds and JGBs, because that Treasury bond and JGB spread actually widened. So that leads me to believe that investors are not viewing Treasuries in the same way that they did or they used to in past crises. I mean, going back to either COVID or you look at the great financial crisis, you see that the market very quickly prices in a lot of cuts. You see a pretty dramatic rally in bonds. You saw none of that this time around. So that's something that's worth paying attention to.
Nouriel Roubini this morning is talking about how the bond, credit, and stock vigilantes ended up being the most important people in the world. What do you take in terms of this entire episode of signal we should learn from to understand potentially what Trump might do next, depending on where bond levels or stock levels are?
So I think it was wise on his part to pay attention to the signals coming from the bond market, because As Lisa was pointing out, the basis trades, the unwind of any sort of unruly unwind on those basis trades, any sharp move higher in repo rates could be something that could really roil the markets. So we need to see that there's steady demand for treasuries. There's not that same level of volatility in the bond market going forward. So if anything, I think that President Trump is going to be paying more attention to the bond market, because that's something, if we see more uncertainty, you're going to have to see the Fed or some other big, large backstop buyer step in to provide that liquidity.
CPI data, 8:30 Eastern Time. Are you going to hang around? Going to look at it? How useful is it?
We have CPI today.
Precisely.
So, no, the data is, of course, very, very important. We saw this sort of services side inflation coming off. But really what was interesting to me in last month's print was really the fact that you saw goods inflation starting to rise. So the sort of divergence between goods and services inflation might start to become a theme for this year. So we saw that during COVID when we had supply chain disruptions. This is sort of the same, type of event where you're going to see disruptions potentially from the supply chains reorganizing and redistributing.
Are you expecting higher prints in months to come?
It really depends on what tariffs stick, right? If there is a very high tariff regime as it stands, if we see at least 10% tariffs on all the countries and maybe 50-60% tariffs on China when the dust settles, that's still a big number, and you should see perhaps higher inflation over the next couple of years.
Subhadra, it's good to see you. As always, a lot to figure out. Subhadra Japa there of SocGen on a big, beautiful bond market. Yields are lower this morning on a 10-year by 5 basis points or so, around 4 now to about 4.30 on 10s. At the front end of the curve, down 2 basis points. Lisa, just wild swings at the front end of the curve and across the curve in yesterday's session.
There was this feeling, and you alluded to this earlier, that potentially it was getting dysfunctional, given these wild swings and given some of the sell-off that we saw. And there was this speculation that the Fed would have to step in. After what we heard from President Trump, now all of a sudden you have Neil Kashkari of the Minneapolis Fed saying the bar is very high right now to make any kind of move because of the uncertainty, because of tariffs. And frankly, that has made inflation and getting inflation expectations under control our primary objective before even our dual mandate.
The Federal Reserve has played this really well over the last week or so, but they're still stuck between a rock and a hard place. Downside risk to growth and upside risk to inflation. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Stuart Kaiser of Citi. We'll speak to the former Deputy Treasury Secretary Wally Adeyemo, Eric Resnick of KSL Capital Partners on the luxury hotel business, and former Kansas City Fed President Thomas Hoenig on what the next move should be for this Federal Reserve. Live from New York City this morning, following some wild swings in financial markets worldwide. Equity futures this morning down by 1.7% from New York. This is Bloomberg.
You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession.
It's the volatility, it's the uncertainty. Where are we going from here?
The scarcity in the marketplace is certainty.
Certainly the markets are challenged.
Everyone knows there's going to be pain, but the issue is they just don't know that the cure seems to be worse than the disease right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Trump blinks, but the damage isn't all undone. That's the line from UBS this morning, and it's reflected in the equity market. Live from New York City, good morning. The second hour of Bloomberg Surveillance starts right now, with equity futures on the S&P lower, and on the Nasdaq too. We're down by 1.6% on the S&P 500. On the Nasdaq, down by close to 2. On the S&P, the range on futures yesterday, positive 10%, negative 3. A 13 percentage point range on S&P 500 futures. Wild. Even wilder than that, in the bond market, major swings at the front end of the curve. The 2-year yield, a 38 basis point intraday range at the front end of the curve. Yields lower by 3 basis points this morning, 387.65. Later on this morning, 90 minutes away, CPI data in America. No one's talking about it. Lisa, more inflation data just around the corner.
Yeah, no one cares. I mean, at a certain point, it's backward looking, and people are trying to understand what is the policy backdrop in a quickly moving world. It is hard to get much much confidence from what happened yesterday. Yeah, you had the biggest rally on the NASDAQ going back to 2001. Yay. But there isn't a sense of exactly why or how durable this is. How much are tariffs still on? We don't even understand what the average blended tariff rate still is. There's one particular average of 27% going now down to 24%, others saying around 15%. No one can actually pinpoint what to even model at this point for the effective tariff rate at this moment.
It's super difficult. Trade's not static. And if you come up with a major tariff on China, presumably some trade will shift away from China. In the meantime, though, compare where we are now to where we were only a week ago, and tariffs are higher. They're not lower.
They are when it comes to China, 125%. That is the levy for these Chinese goods coming into the United States. You also have a 10% tariff ring around the United States. That is staying put. The issue that investors have, the market has, is the goalpost keeps changing when it comes to reciprocity for each individual trading partner. And we're not going to know where they end for another minimum 90 days.
We have revealed one thing. We've discovered that the Trump put has moved away from the Dow to the bond market based on comments just yesterday.
That, to me, was the big takeaway. The bond market's in the driver's seat. It was yippee. He actually responded. What is the strike price of that, though? Is it just almost getting to a dysfunctional place where the Fed would have to step in? Does it mean that Scott Bessent now has the ear of the president? What's to say that it's not going to be Peter Navarro tomorrow? There is this question of how much can you rely on something that seems to be driven more by impulse and intuition rather than some sort of formulaic policy.
The Treasury Secretary said yesterday outside the White House that he had a conversation. They all had a conversation on Sunday. And on Sunday, what happened? On the way back to Washington, D.C. on Air Force One, who is standing behind the president? I peeked my head out. It's Scott Bessent, the Treasury Secretary. On the way down to Palm Beach, it was Howard Lutnick. It does feel like this idea is really stemming from the Treasury Secretary. It is what he told me after Liberation Day. This is a cap. We can do deals coming down. And the president said this has been percolating for a few days. We decided to make the decision this morning. I was looking at the bond market overnight, and then we sat around and wrote it from what he calls their hearts.
Looking at the bond market this morning, yields are lower. We're down 3 basis points on a 10-year to 4.30. On twos, we're down 4 to 387. Coming up this hour, Stuart Kaiser of Citi as stocks stage another historic bounce. Former Deputy Treasury Secretary Wally Adeyemo as President Trump's U-turn isolates China, and former Kansas City Fed President Thomas Hoenig as Fed officials signal they'll stay on hold. We begin this hour with stocks lower following their biggest one-day climb since 2008. Stuart Kaiser of Citi staying cautious, writing, "We shift to a neutral footing on U.S. equity risk as 2/3 of the dip buying conditions were fulfilled by a 90-day tariff pause. We are not necessarily comfortable with long equity exposure and expect continued headline volatility." Stuart joins us for more. Stu, good morning.
Good morning.
Wow. OK, so this is what we've got. 10% baseline tariff and then something north of 100% on China. Good or bad?
As you said, worse than last week, probably better than Sunday night as a blended, type thing. I think basically what the market is telling you now is they sort of took some of the tail out of the tariff risk. And we're going to need to see successful and observable negotiation progress over the course of actually probably the next couple 2 to 4 weeks, without the market to react negatively.
It doesn't sound like you've got too much confidence that this is over.
No, I mean, look, even if you just, to Lisa's point, we don't know what the blended tariff rate is. At steady state now, to your point, is much worse than it was last week. And we have not really gone very far to pricing in the knock-on recession risks if the current tariffs are held in place. I'm also of the view there's probably less than 3 people in the world that know exactly, what the future looks like on this front. So just a tremendous amount of uncertainty there. So, yeah, we're still pretty cautious, though. To be fair, I think in instituting this delay does trim some of your worst case tail risks off, which is why we're kind of a little more neutral than I think we were extremely cautious over the weekend. We're kind of more neutralish now.
Can you take us into some of your conversations with clients recently to give us a sense of what the flavor has been like, what the tenor of them has been, and what you say?
Look, I think honestly, as many opinions as are around the table is what we're getting from clients. I would say, look, the outlook has been very, very bearish on U.S. equities. You see that in positioning, you see that in flows, you see that in our conversations where it's, maybe the view was, hey, I don't know, the plurality of outcomes is you get a negotiated deal and it's better than worst case. But there is this situation where if you took your tariff hit and you threw a decent sized recession on top of that, you get S&P earnings down to $200 or below, and you put some reasonable multiple on that, and the number doesn't look as big as you would like it to. I think is the best way to put it.
3,600. Right?
Yeah, you could be 4,000 or below with reasonably conservative math. So I think a lot of folks were saying, even if I wanted to buy this dip, I can't fully discount that negative there, because if you think of that number as, let's say that's your recessionary outcome. Well, what are your recession odds? If your recession odds are anywhere near 50-50, now you have a 1 in 2 chance of an outcome that looks really poor. So I think investors were respective of that and were just very, very cautious about putting risk back on. And the fact is, we've had 2 of these 5% rallies, over the last week. They lasted about 15 minutes. So it wasn't like, as an investor, you had the opportunity to catch those, really. You either happened to have the risk on or you didn't. And I think that's been equally frustrating, that I suffered all the way down. The market rallied, 6% in 15 or 20 minutes yesterday. You didn't get a chance to engage in that.
Have you noticed a difference in tone between domestic investors and international investors?
A little bit. I mean, I think in a lot of these cases, when you have domestic policy issues, the domestic investors tend to be more bearish, than the international investors are. In this case, I think it's shades of gray, because the international investor is also very frustrated. If you're up in Canada meeting with those investors, they're not feeling so great either. And I think the same is in Europe. But I think U.S. investors probably incrementally a little bit more negative than the international folks, just because we're so close to it. But again, it's going to be hard to find a bullish or optimistic investor right now.
If these markets were Chinese, wouldn't we be calling them uninvestable?
I wouldn't, but you you might be.
I'm asking the question right now, how investable this market is, given these wild swings.
No, I mean, I think it's not particularly. And I think you saw that actually on Monday, where you had that, very sharp squeeze in the morning. And then after that, you got some negative China headlines on tariffs. Shorts did not really aggressively lean back into that. And I think it was because you got so hurt in that sort of flash rally that you didn't have confidence, to put the risk on in the other direction. And I think what you're seeing overnight is a little bit of that, where the market rallies so quickly higher. Sponsoring the next leg of that feels really poor risk reward. And I think you're seeing that a little bit overnight. So, yeah, it's from a tactical perspective, it does feel, very, very hard to invest in. I won't call it uninvestable, but very hard to invest in. And, even from a long-term investment perspective, it's really hard to handicap stuff, and you're probably thinking, I might get a better entry point here to begin with.
Things have been really brutal. You've set up the next month or so. We need to set up the next 90 days. What these negotiations are going to look like over the next 3 months.
And trade deals normally take 2, 3, 4 years, and they're trying to get stuff done in the matter of 90 days or maybe a little bit more, a few months. What I would take from everything Donald Trump has said, on the campaign trail, he promised 10% tariff ring around the United States, 60% on China. We know that he goes into everything with a maximalist approach. Well, maybe the China is going to come down. That tariff rate will come down to 60%. And we might end up exactly where he planned on starting, but just going through a lot of emotions to get there.
In the meantime, we're going to be looking at uncertainty, negotiations and more uncertainty. And Stu, I've got to ask you how you and the team will be navigating the incoming data. We just caught up with Sokjan Sabajrajapa, who said CPI, what's CPI? 8:30 Eastern time, there's an inflation report. There is. How are you navigating the data? How will this market respond to incoming information?
Well, I mean, CPI, look back to payrolls last week, they probably felt like the forgotten child a little bit. I think the data we're getting last week and this week is much more what was the state of the economy coming into this. And if you got a strong enough labor market report where at least it was, okay, the economy was solid before I put these tariffs on. If you had gotten a weak payrolls report and then added tariffs, that would have been incrementally negative. I think that today's data is going to be interesting because the last inflation report, the data was actually pretty good. The market traded down because they treated that softer inflation as weaker demand. So the data today is going to be really interesting. If the data prints hot, it's going to be, oh, my God, we had an inflation impulse before tariffs. If it's light, it's going to be, oh, maybe the demand's getting destroyed already. So it's hard to see actually a positive outcome from the inflation report today, but luckily it might get ignored. So I guess we don't have to worry about it too much.
Earnings get ignored? Because right now it's very hard to really trade on the guidance that also seems a bit, I don't know, unreliable as well.
Earnings, I think, are going to be all over the place because if you're a company, you either have to defend numbers, and boy, you better have a good story about why you're defending them. You say, I don't know. Frankly, I don't think that's going to be rewarded as an answer. Or you kind of throw in the towel a little bit, which I think we talked about a month ago. And that side of it, I think if you kind of throw in the towel and your stock is washed out enough, that might help you. But again, none of those three outcomes are good. Broadcom the other day announced a buyback. It wouldn't surprise me if you get some guidance may be pulled or widened, but then some buybacks announced behind it to kind of support the stuff. But yeah, it's going to be a very, very interesting earnings season.
Stu, it's good to see you. Thanks for breaking it down. What a couple of days. We all need some rest. Stuart Kaiser there of Citi. Your equity market on the S&P 500 negative by 1.7% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. House Speaker Mike Johnson has canceled a vote on the Senate's budget resolution last night, with fiscal hawks saying it would add too much to the nation's debt. The House and Senate need to adopt identical versions before they can move on Trump's domestic agenda, led by a $5 trillion extension of his expiring 2017 tax cuts. Elsewhere, U.S. Supreme Court Chief Justice John Roberts let President Trump temporarily fire top officials at 2 independent agencies while the High Court decides how to handle presidential power. The case tests a 1935 ruling that let Congress shield high-ranking officials from being fired. The decision could determine whether Trump has the power to fire Fed Chair Jay Powell. And Amazon CEO Andy Jassy out with his annual shareholder letter, writing that the company has to act like the world's largest startup in order to meet demand for AI and trim its bureaucracy. Jassy said that Amazon will continue to invest heavily in AI alongside forays into healthcare, including Amazon Pharmacy. That's your Bloomberg Brief. John.
Hey, Danny. Thank you. More from Danny later this hour. Up next on the program, doubling down on China.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. They're in the process of figuring it out, but they want to make a deal.
Up next on the program, the former Deputy Treasury Secretary Wally Adeyemo, live from New York City this morning. Good morning.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm a business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Equities this morning lower across the board on the S&P 500, negative at the moment by 1.8%, down 2 on the Nasdaq 100. Under surveillance this morning, doubling down on China.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
So here's the latest this morning. President Trump isolating China as the primary target of his trade offensive, hiking tariffs to a record 125%. China's top leaders set to discuss additional economic stimulus later on today. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, what's the state of play this morning?
Yeah. Hey, John. Well, you heard President Trump there signaling optimism that there could be a potential deal with China. He said that once Beijing calls, they'll be, quote, off to the races. The only thing is that per our current knowledge is it appears Beijing hasn't called. And as you've been reporting this morning, there was that apparent escalation with China announcing those potential curbs when it comes to imports of U.S. films into the country. President Trump did say yesterday, though, that he couldn't imagine raising that tariff, that 125% levy, any higher when it does come to Beijing. Now, when it comes to the other countries, Treasury Secretary Scott Bessent has said that this was all part of the plan all along. It shows that the U.S. wants to negotiate in good faith. But Bloomberg Economics writing that these whipsaw movements do very little to quell any of the record high uncertainty that we are seeing, not to mention that companies have been really hitting the pause button of their own as they try to discern if any deals can actually get done in this 90-day timeline. Now, Bessent has confirmed that he has meetings on the books already with Vietnam, South Korea, Japan, and India as we try to see if any deals can be done there. But the big question is, what does it take to actually clinch something in such a short amount of time? John, the Commerce Secretary yesterday did give us some further hints to things that we've already been tracking. He said that the U.S. has been rather intrigued by the concessions these countries have been putting on the table, particularly when it comes to those non-tariff barriers.
Tyler, appreciate the update. Tyler Wiley Kendall down in Washington, D.C. I think we're all just totally desensitized. You wake up, see futures down 1.8%, just kind of shrug your shoulders. Big deal. What's 1.8% these days? Extending the conversation now. Joining us around the table, the former Deputy Treasury Secretary under President Biden, Wally Adeyemo. Wally, good morning.
Good morning.
How good does it feel to be on the other side?
It feels really good to be on the other side at the moment.
What do you make of what you've seen down in Washington so far? Give us your opinion on things.
I do think that everyone agrees with the president that we need to do more advanced manufacturing in the United States, and tariffs can be a tool. But as the markets have shown us over the last few days, broad-based tariffs ultimately are going to cause pain for American businesses, but also American consumers. And I think that everyone was encouraged, and that's why we saw the relief rally when the president paused. But the important thing is a pause is not a stop. And you still end up in a place where you have 10% tariffs across the board and 125% tariffs on China. And that's going to mean that Americans are going to pay more for groceries, they're going to pay more for housing, and our companies, especially small businesses, have uncertainty because what's going to happen in 90 days. But the thing the president has said that I think is encouraging is that he's open to negotiating, and the goal now is for him to define what does he want to accomplish in these negotiations, and hopefully for those things to happen very quickly.
But trade deals take years. You've been in the rooms with all of these counterparts. Do you think they get deals done in 90 days?
It's really hard to get a trade deal done. We negotiated a deal with the Japanese over critical minerals as part of the IRA, and that happened relatively fast because both sides wanted to get to an agreement. And the hope here is that over the next 90 days, the administration can accomplish three things. One, lower tariff barriers for the United States so our companies can compete level playing field, and non-tariff barriers as well. And then the third piece is also important because what we found was after President Trump cut his first deal with the Chinese companies moved to Vietnam and Malaysia. So the question now becomes, when you're cutting a deal with these other countries, can you get them to put in place restrictions so the Chinese firms can't take advantage of their economies to ship things to the United States? But even more importantly, when you think about what's going to happen now that China has these huge tariffs on them, they need to sell their things, and they're going to sell them to Southeast Asia, they're going to sell them to Europe. So now they need to think about, do you need to put safeguards in place to make sure that Chinese overcapacity doesn't overtake our shores? And that's where you have the opportunity potentially to partner with some of these countries to confront China. And my hope is that the president and the secretaries he's appointed to do this work with our allies and partners to confront the Chinese.
Recently in The Economist, you wrote that the global trading system needs new rules, not tariffs. Is this what you're talking about? Basically more bilateral rules and then taking the friends along for the ride to confront Beijing?
It's critically important because what we've seen is that if you care about our steel industry, preventing Chinese steel from getting to the United States doesn't mean the price is going to be lower if they're selling that steel to the rest of the world. So we've got to work with the rest of the world if we want to put our companies on a level playing field. We all agree that we should do more advanced manufacturing in the United States, but the U.S. is 4% of the world in terms of population. We want to make sure that Ford cars, our steel, we can sell it in other parts of the world, which represents 96% of the population. And if we're not willing to work with those countries, it's going to be really hard for our companies and our workers to be open to those markets.
When it comes to the end goal, you actually sound a lot like a Trump official, even though you were part of the Biden administration. But the Biden administration used subsidies, industrial subsidies in the United States to try to cajole business to do work here. Do you think Trump is right to use this carrot and stick approach as well?
I think the key thing to remember is that we did do things like the CHIPS and Science Act, where we provided companies with funding to help them build in the country. And it wasn't just about the manufacturing jobs, it was about the entire ecosystem. But we did also strategically use tariffs, because the key thing you have to do is, on all of the above strategy, ultimately you have to give incentives to companies to build here, but to create really good paying jobs. But when a country is unwilling to create a level playing field for you, for example, China, sometimes you have to use tariffs strategically. The problem is when you do broad-based tariffs, you get into a situation where it hurts American consumers, farmers, and also our businesses more than sometimes it hurts the other country. Ultimately, the hope is that when you get into negotiations, we're able to pull back some of these tariffs, with the idea being that if you can reach an agreement, where you end up with is fewer tariff barriers for American companies, because I think the thing that you believe across the aisle in D.C. today is that if American companies are given the ability to compete on a level playing field, our companies and our workers are going to do well. The key now is how do you get there?
Given your negotiations with international partners, do you think that there is legitimacy to this feeling that maybe some of the other nations who used to be our trading partners are going to get closer to China, not further away, as a result of some of the tariff turmoil?
My view is that the United States still has an incredibly good hand, but it matters how we play it. And over the next 90 days, we have the ability to work with our other countries to build a coalition by getting them to reduce tariff barriers and non-tariff barriers. But we also have to remember that the U.S. has tariffs on their economies too. So, for example, we have tariffs that protect certain industries here. Are we going to be willing to lower them as well as part of this process? And then what we have to remember for all of us is that Chinese overcapacity is not a problem just here in the United States. It's a problem in Southeast Asia. It's a problem in Europe. And we have to be able to work together to solve it, because if we take a unilateral approach, ultimately that overcapacity is going to wash up on the shores of other countries.
Why aren't Democrats coming out and saying that Donald Trump's goals are the right way to go? That actually this is correct. It's just that we disagree with the measure.
I think that what you heard from Governor Whitmore yesterday was exactly that, which was that we think that we should have more manufacturing in the country. We can use tariffs, but ultimately the problem is that it can't be the only tool. You can't do it in a broad-based way. What are you doing to create incentives for businesses to build advanced manufacturing in the United States and to create good jobs is going to be just as important as how you strategically use tariffs. The challenge we have today is that for American people, when they go to the grocery store, when they go and try and buy a house, the prices are going to go up, but their incomes haven't. If you're a small business today and you're thinking about your supply chain, how are you going to buy the things you need to be able to get things to your customers? That's harder today than it was a week ago. And if you're a big business thinking about earnings season, how do you give forward guidance in a world where you have a 90-day pause? And I think ultimately we agree that we need to have more manufacturing in the country. And I think that Democrats and Republicans can work together to accomplish that. Tariffs should play a role, but it has to be an all-of-the-above strategy that includes how do we create the right incentives here in the United States as well.
Wally, can we just finish on what I'll call the European problem? Why is it so difficult to get the Europeans on side with US policy? Why is that so hard?
I think Kissinger put it well in terms of Europe is not a country, it's a jurisdiction, and there are a number of different countries there, and it takes them time to get to the right place. But the reality is that we'd rather the Europeans be arguing with each other over politics than what happened before we had the European Union. And fundamentally, Europe has been an ally, but we have to hold Europe accountable as well to being in a place where they create a level playing field for American firms as well. And in doing that, it's going to be not only good for the United States, but it's ultimately good for Europe, frankly, because Europe needs to grow. Their economy has been stagnant for too long. And without a partner like the United States that can help drive that growth, it's going to be really hard for Europe to compete with China and compete in Asia. So ultimately, the goal here has to be to reach an agreement that will be good for the United States, that will mean that the United States is in a better position to manufacture things, but ultimately needs to be good for Europe too, because overcapacity from China is a serious problem that is ruining Europe's industrial base as well. So there is room here for a deal. The key is to make sure that both sides get into the same room and think about ways in which we can grow the global economy and Europe and the United States economy.
Wally, tremendously smart, as always. It's good to see you. We've missed you. Let's catch up again soon. We need to talk taxes. Former Deputy Treasury Secretary Wally Adeyemo. Up next on the programme, Eric Resnick of KSL Capital Partners as tariffs weigh on global travel. From New York City, this is Bloomberg. "60 minutes away from the CPI report, equity futures are negative and near session lows. We're down 1.7% on the S&P 500. 2 hours away from the opening bell. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. It's the deal that refuses to go away. U.S. Steel share prices falling nearly 10% this morning. President Donald Trump saying that he does not want to see a Japanese owner for this company. The reason it's moving so much on that is the fact that there had been hopes to start the week that maybe this deal would go through, with Trump ordering a review of the deal. He has said, Nippon Steel, you can get creative, but he's been advocating for something of a minority stake, not a majority stake. Also on the move this morning, we had earnings from CarMax. Another sort of case study in how you address the macro uncertainty. They've removed their timeline for long-term goals, saying we're still keeping those long-term goals, but we don't know exactly when we're going to get there. The interesting thing is if you look through the earnings report, they don't talk about tariffs. They don't talk about trade. It's literally business as usual, except for one little line that says broader macro uncertainty. That's what they're attributing to. But, of course, used car prices very impacted by tariffs, considering new used car prices are likely to move higher. Those shares down by more than 7.5%. Wrapping up with Dell, another case study for you. This and what happens when component prices go up. A Bloomberg study of their website shows that they have removed countless discounts on their products. It appears that Dell indeed will be charging consumers more when the component prices go up. The company did not respond to that study from Bloomberg, but the CFO did say earlier this year that they plan to pass prices on. Those shares down more than 2.5%, John.
Hey, Danny, thank you. Appreciate it. Danny was talking about this a little bit earlier, exemptions. How many exemptions will we see for big tech? And I'm thinking almost exclusively of Apple at the moment. How many exemptions will we see in the weeks to come?
Well, there's certainly all these companies are lining up and they're asking for these exemptions, these carve-outs. You saw exemptions and you saw carve-outs in the first Trump administration. And then Trump yesterday pretty much signaled that he's open to it depending on what it is and what the company is. So I think if you make your case to the president, you likely are going to get one.
Futures down this morning on the Nasdaq by 2%. On our radar this morning, President Donald Trump pausing tariffs on most global trading partners for 90 days, but raising levies on China to 125%. The U-turn coming roughly 13 hours after duties on 56 nations and the EU took effect.
So obviously the Trump administration is coming out, Caroline Leavitt saying this is art of the deal. We all missed it when it comes to what the president was doing. I think maybe it was a bit of both. We know that the president likes to start out from a maximalist position. At the end of the day, he wants to get deals done. At the same time, this did happen at a time when you saw some unraveling in the bond market. That certainly got the attention of the Treasury Secretary Scott Bessent, who on Sunday, after an interview with the American media, went down to Mar-a-Lago, clearly had a meeting with the president, and then they came back to Washington, D.C. together. So how this played out, I'm not actually surprised about. The question now is uncertainty remains. Who gets the deals first?
Certainly felt like the bond market had a key role to play in all of this. This was the president's quote just from yesterday, Lisa. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. But I saw last night where people were getting a little queasy, and maybe he was getting queasy too.
It shows just how much the bond market is the ultimate constraint right now on a president who is looking to reduce borrowing costs, and he's a debt king. He loves debt. He could see the disruptions that were happening in the market. Key question is how long this will last, what kind of level he's targeting, and do we have a better understanding of a strike price, or is it just simply that level of volatility that could potentially invite the Federal Reserve to have to intervene because of market dysfunction that could potentially get his attention?
So we've got lots of talks coming up and a 90-day pause. Is a 90-day pause realistic? Is that long enough, a decent time frame to get a lot of this stuff sorted out?
To be honest, I didn't think it was. Maybe when you're talking about a comprehensive bilateral trade agreement, it's not. But what did Wally Adeyemo, who's the former Deputy Treasury Secretary, say just now? There was an impetus and a need to get a critical mineral deal done with Japan, and they got it done very quickly. So when you have two parties that want to get to an end game as quickly as possible, then potentially they can get at least some of these, a handful of these deals done within 90 days.
Speaking of Japan, the president also had some comments on U.S. steel. He doesn't want to see U.S. steel owned by a Japanese company. Trump pointing to the steel producers' rising orders as evidence that it doesn't need outside investment. And on Monday, ordering another national security review of Nippon's proposed takeover.
So I think his comments are really interesting because on Monday, what individuals took from that memorandum and that new order he gave for CFIUS is that potentially that he would amend the decision by the Biden administration and the predecessor to block this $14 billion transaction. Now what he's saying is CFIUS is going to look at it, but I still don't want it to be U.S. owned. Potentially, though, on the margins, there's a way to get a deal done. And it'd still be an American-owned, maybe just more money coming in, a bigger just investment, not a full takeover. Remains to be seen.
Watch this space. So at the moment for companies, it's a tricky moment. How much guidance can you actually provide for 2025? Delta Airlines pulling full-year guidance, warning of uncertainty in global trade. The caution comes for what is expected to be a resilient 2025, according to travel and leisure investor KSL Capital Partners. The CEO and co-founder, Eric Resnick, joins us now for more. Eric, good morning. Good to see you.
Good to see you. It's great
What
to be
does
with
this
you today.
mean for you and your investments? What changes for you in the last week or so?
I don't think anything changes today. If anything, I think with all the stress in the markets, people need a vacation even more than ever.
Amen.
Are you offering a discount? That's what everyone wants to know.
No discounts. No, we can't bribe the media. But we're happy to arrange bookings for you, though. I think, in all seriousness, we've been investing behind the trend towards experiential travel, especially amongst the mass affluent consumer, for 30 years. We've invested through half a dozen different downturns at this point with different sources of volatility. While certainly we're on our toes, we're alert, we're paying a lot of attention to what's going on in the markets and the discussions that are happening, it doesn't change anything that we're doing today. We're about having great assets, great businesses, providing a unique experience for our customers and guests. And so if we can deliver on that, I think we do well in the long term. In the short term, there's disruption. Uncertainty isn't good for anybody, but we like to think in that disruption there can be investment opportunity.
Well, that's what I was going to ask you. Is this dislocation a sort of golden opportunity for you after having just raised a new fund? Is it something that you want to get really active in? Or do you think that right now there's sort of a new level of uncertainty permeating some of the disruptions?
Well, this is a little different, right? I mean, every downturn you have is always a little different. I don't know whether this will be a blip or something significant when you look back, in 6 months and we have more data. We just closed on our Tactical Opportunities Fund number 2 last night at its hard cap, and we're grateful for the investor support in that because I think they see what you're referencing, Lisa, that there is an opportunity to step into the breach if there are some companies out there that maybe don't want to sell but need capital, and that's what our special situations or tactical opportunity strategy does, is we provide partnership capital to those businesses. Our main equity fund, which invests in control positions in businesses, we've had a quiet time on the acquisition side over the last 2 years, really, since inflation reared its head and rates came up and there were those challenges. But we've seen that thaw gradually happening, and actually we have a really strong pipeline right now. How that pipeline materializes in the wake of what's gone on in the last week, that remains to be seen. But we're looking very closely at the data to see whether or not there is any sign of the consumer weakening in any way.
So let's talk about that. Given that the wealthiest consumer has really driven the American economy over the past couple of years, and it's been driven by the wealth effect, driven by what we've seen in equities, is there any sign, even if people aren't withdrawing bookings, that maybe they're not going for the most luxurious of luxury options out there?
Right now, we're looking for that because we are asked that, and we understand the logic behind the question. But right now, we're seeing a message of resiliency. But it's too early, I think, to extrapolate from the data. We're up about 10% in bookings for the current year, and we have seen that number drift down a little bit since the beginning of the year. I mean, maybe we started off at 12 to 13, and now we're 3-4 points behind that, but still up healthily. Over where we were at the same time last year. I was eagerly awaiting our booking data from last week to see what happened the week of these announcements. And I was a little bit surprised, and it's one data point, it's 1 week of data. We were actually up 15% in bookings last week, which I wouldn't have expected that. I don't think that's because people rush to make vacations. I think that's idiosyncratic.
It depends. Last week was a week.
But certainly the data could have said we were down 20, and I would have been telling you people naturally pause when there was such a news cycle, right? That didn't seem to happen. Will that happen? We'll see.
There are trends within the trends, though. This question of whether U.S. consumers are still going to go to Italy.
Yeah.
I mean, some of them will, but not all of them in the same kind of way, especially if there's a weaker dollar and a stronger euro. Whether international consumers are going to be coming to U.S. resorts in the same kind of way. Have you seen any changes in that?
The one data point that you can look at and say it is different is, and there has been a little more time on this one, is Canada. We have seen a pretty dramatic reduction in the Canadian demand to the U.S. Now, example, Hawaii, right, which is a meaningful destination for Canadians, Palm Springs. We've seen kind of double-digit reductions in demand already from Canadians, saying, you know what? We can take our dollars elsewhere. And so that is something that concerns us. Now, Canada is a relatively small proportion of the total business in those markets, but that we think is statistically significant because that's been happening for, if it's 4 or 6 weeks now. On the converse, we're up more than 20% in our bookings in Mexico and the Caribbean from Canadians and from Americans. So it's the overall travel picture is pretty strong, but there are definitely gives and takes, and you can see that in the Canadian data.
What I'm hearing from you, Eric, is that there's going to be no deals because the bookings just keep holding up.
I hope not. I hope that's true.
At any point, are there going to be any hotels, packages that have to cut prices?
We've seen pricing power be reduced. right? And the CPI data comes up today. It'll be interesting to see what that shows. But what we have seen right now is when I said bookings are up about 10% for the year, that's virtually all volume. Only a couple points of that are price. Now, price is up a little bit more if you look year to date at the more luxury end of the travel spectrum, but it's not up tremendously. The pricing increases that we saw in 21 and 22 were unique. It was a unique period of time. Those have come off quite a bit in 23 and 24, but the prices have stayed high. So I think what you're reacting to is that high level price more so than a dramatic increase in price that's happening right now. We're not seeing that today.
So what's the number one destination right now?
Look, for Americans, one of the most attractive destinations is Mexico and the Caribbean. Always has been and always will be. Lisa mentioned Italy. We actually see Italy being off a little bit right now from Americans. I don't think that's because of the tariffs. We saw that before. I think that's coming off of the incredible peak last summer in Italian travel.
So right now, going forward, what are going to be the signs to you that there is a material shift? Where do you expect to see it first? In the low end, the medium term, the high end, the bleisure, which we talked extensively about? Where do you think what will be the sort of front-leading indicator?
That indicator we have already seen a bit, which is, I would say, the lower end, bookings to select service hotels, to mid-scale economy hotels. Those are not as robust as they are at the luxury end. Bleisure is definitely not bleisure. Bleisure, we've talked about this term before. It's a terrible word, but 75% of people want to combine business and pleasure trips. Bleisure, right? But we are seeing, we have seen pretty soft trends at the more economy level. So I think that's where you're seeing it in the data, and that was before last week.
Eric, it's good to see you. Keep us updated.
Great to see you.
Thanks for dropping by. Thank you. Eric Resnick there of KSL Capital Partners. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. China is reducing the number of imported U.S. films and introducing more films from other countries. According to a statement from the Chinese government, U.S. tariffs on China will make the films less favorable to domestic audiences. Elsewhere, Lego has opened a new factory in Vietnam. The world's largest toy maker says it plans to invest $1 billion over 15 years in the complex, which will produce toys for Asia. Lego's CEO told Bloomberg that the company sees growth in new markets as a buffer against any possible headwinds from tariffs. And a new United States Postal Service proposal would see first-class stamp prices increase by 5 cents starting in July. That amount ties the record as the highest increase ever. It'll be the first of 5 planned price hikes for stamps currently planned through 2027. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on in the program. Up next, the Fed on the back burner.
What gets the Fed to move by more is financial conditions.
I don't think there's any case for the Fed to cut interest rates.
The Fed can't play the hero anymore.
Up next on the program, the former Kansas City Fed President Thomas Hoenig joins us next. Live from New York, this is Bloomberg. Equity futures negative here by 1.6% on the S&P. On the Nasdaq 100, we are down by 1.9. On the Russell, by 2.4. Out of Savannah's this morning, the Fed on the back burner.
What gets the Fed to move by more is financial conditions.
Now what we're seeing is deglobalization. That ties the Fed's hands. And the Fed can't play the hero anymore.
I don't think there's any case for the Fed to cut interest rates.
It would be best for the Fed to be patient as we go through this price shock.
They're kind of in a position where they can't act. They're going to have to wait and see.
So here's the latest this morning. The Fed isn't blinking in the face of downside risk to growth and upside risk to inflation. The former Kansas City Fed President, Thomas Hoenig, looking ahead to the March CPI print due in less than 1 hour, writing, there will be an expectation that if it is favourable and if oil prices continue lower, the Fed should be thinking about an interest rate cut. Thomas joins us now for more. Thomas, welcome to the programme, sir. Let's just take a step back. I'd love your opinion, your view on how you think the Fed has conducted itself over the last week. Have they done all the right things?
Well, yes, I think they've done all the right things. They've stayed calm, apparently. At least on the surface, it seems calm, although I think we're very much aware of the effects of the tariffs. And around that, the risks it had for liquidity in the various markets, especially the Treasury market, as you saw the yields going up fairly rapidly without anyone having a clear explanation of that, and they've kept calm. So yes, I think they've done pretty well this last week. I think their challenges still remain. The tariffs haven't really, the war has narrowed, but we're still in a tariff war, especially with China, and so there's a lot of uncertainty remaining.
Thomas, I'm curious what you think the Fed could have done or should have done should that dysfunction have continued yesterday. And I ask you because there was some speculation that it would have prompted them to have some sort of emergency quantitative easing. Do you think that that type of bond purchasing is a tool that they are really looking at right now in the face of perhaps potentially additional turmoil?
Well, I don't think they're looking at. I don't think they're looking there yet. I think they were watching it very carefully. And I have to tell you, one of the things that you need to think about here is, as we have dealt with this tariff and the uncertainties that it brings, it also brings to the front, I think, a bigger issue. And that is the national debt is going to go up. I mean, we have this resolution. We'll have another $2 trillion of deficit. The debt grows. Who's going to fund that? And if the world's saying, well, wait a minute, I can't rely on the U.S., that becomes more problematic for the U.S. and for the Fed, because if your foreign buyers of our debt recede somewhat, even modestly on the margin sometimes, it puts more pressure on the domestic market to do that, and that's putting pressure on the banks. That will then put pressure on the Fed. And it's when that begins to occur, if we continue with the trade war, that I think the real pressures on the Fed will come forward to monetize, that is, buy some of this debt. One other thing I want to point out to you, though, is you may have seen where there is a proposal, and the Secretary of the Treasury talked about it, the incoming Vice Chair for the Fed on supervision talked about it, and that is removing any exempting treasuries from the so-called capital leverage ratio. This is very significant because it means the banks don't have to capitalize any of this national debt. Their cost of capital will be favorably affected. And that's designed to make them more able to buy more of the U.S. debt. That is, a banking industry to buy more of the debt. And then when they put that debt on, the Fed has to backstop that for liquidity reasons. If the interest rates were to shoot up, the Fed would have to be right there. So the Fed's it's going to still be the backstop, but in a little bit different way.
How much is this the reason why you're hearing from an increasing number of Fed officials a real priority on inflation ahead of even the employment mandate? And Minneapolis Fed President Neil Kashkari wrote a blog post this morning where he came out and said, our first priority must be keeping long-run inflation expectations anchored. And he said, in my view, the hurdle to change the federal funds rate one way or the other has increased due to the tariffs. Do you think that this prioritization of inflation over the employment mandate, over the dual mandate, is what they have to do?
I think it is what they have to do, frankly, because, we've said it for years in the past. That is, you can't have maximum employment without stable prices. And inflation right now is 3%. That's 50% above their target. And 2% inflation is a fair amount of inflation over time. So I think it's about time the Fed refocused. In the 2010 period, they decided to make the dual mandate in the sense of employment much higher, that part of the mandate much higher. And Chairman Powell has emphasized that even more recently. And that, I think, takes shall we say, the eye off the ball. They have to focus on inflation. It's not going to come down a lot today, I suspect, when they report it. That's even before the tariff war. So, yes, I think Kashkari is saying the right thing.
How difficult is it to focus on inflation when the goalposts keep moving in terms of the rates the U.S. is going to charge trading partners?
Well, that's the difficult thing, because the U.S., instead of focusing on its national debt and its increase of national debt and the debt that has to be funded, they're starting to fight a war, a trade war, and therefore they've taken their eye off the ball in one sense, made it more difficult for the Fed and for the Treasury for that matter. So they need to get back to, we can solve a big part of our trade problems if we solve our own national debt problem and our spending, our government spending problem, which is a problem. And they're not looking at it, I think, carefully enough.
Yesterday, we had the U.S. Chief Justice letting the President of the United States, Donald Trump, remove 2 agency leaders for now. Are you concerned about Powell and his position?
Well, I think this is a big deal. I think the fact that you can fire board members of an independent agency. The Fed is always thought to be special. I saw where one of the justices said that. But when you come down to law, if they make that decision for one independent agency, people have got to immediately think of what does that mean for the others, and that includes the Fed with its independent board of governors.
What kind of market response, Thomas, do you expect should there be some sort of threat to Jerome Powell in his role as Fed chair?
I think it will be pretty significant because it clearly says we're going to politicize the Fed completely. And what's going to happen then? That's another source of great uncertainty in the market. And I think it will be destabilizing to a degree.
How much do you care about CPI, which comes out in about almost 40 minutes?
Well, I care a lot about it because it tells people where are we taking things. And, 3%'s been there for a long time now, more than a year, in my opinion. And it's not coming down. They're going to spend a lot more money. The Fed's going to be under a lot of pressure to monetize some of that. The banking industry is going to be under pressure, especially if they make it easier for them to take on these debt. So there's no discipline to our fiscal side. And the Congress is going to pass another very significant spending and, shall we say, borrowing bill. So, yeah, CPI is going to tell the world where we're headed.
CPI drops at 8:30 Eastern Time. Thomas, appreciate your time. Thoughtful stuff. The former Kansas City Fed President Thomas Honig there, going into the next Federal Reserve meeting. The first week of May, Bramo, not too long away.
Honestly, what are they going to say, given the fact that right now they've played it cool? They've said we don't want to get ahead of our skis, but they have to talk more about what tariffs do. And we are hearing some of that from Neil Kashkari saying that the bar is a lot higher for them to move either way, which is the first time I've heard rhetoric like that for a while.
If we don't have the trade deals and the goalposts keep shifting, we don't know what the final rates are going to be, how does the Fed take anything into consideration and decide to cut? Because they don't know what the future is going to be. Imagine they moved before Trump's decision yesterday to pull back.
Then they're offside.
Exactly. It's very difficult right now. And the uncertainty is not just pervasive in the business community, in the media, trying to understand what the Trump administration is doing, but it is at the Federal Reserve.
The fate of the economy at the moment dictated by one individual who can dictate how talks go over the next 90 days or so. Equity futures at the moment on the S&P 500 negative by 1.6%. In the bond market, we get a bit of stability after a rocky few days. In the bond market at the moment, yields are lower by 3 basis points, the 10-year 4.30. On twos, we're down about 5 or 6 basis points at the moment, the yield 3.85. The data drops 8:30 Eastern Time. In the next hour of Bloomberg Surveillance, we'll catch up with Greg Bowdle of BNP Paribas, Erica Najarian of UBS, Torsten Slok of Apollo, and David Kelly of JP Morgan Asset Management. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance just around the corner.
I don't think Fed cuts are necessarily the help the investors might be hoping for.
I don't think there's any case for the Fed to cut interest rates.
It would be best for the Fed to be patient as we go through this price shock.
What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher.
Now what we're seeing is deglobalization, which is now an inflationary process that ties the Fed's hands. And the Fed can't play the hero anymore.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning to you. Equity futures on the S&P 500 negative here by 1.6%. Let's check out the price action and move to the Nasdaq. We're down by 2%. This was the biggest one-day pop since 2008 on the S&P 500. Coming off the back of it with some declines. What's changed? Not much has changed. We still face 125% tariffs on China and 10% tariffs across the board. If you're looking for what's happening right now in the bond market, bond yields at the moment down by a few basis points. We're down 3 on 10s to about 4.30. On 2s, we're down 5 or 6 basis points to 3.85. And Anne-Marie, the bond market playing a major part in the back down from the president in just the past day.
It is absolutely. When you heard from Scott Bessent, the Treasury Secretary, and the president, that they've been thinking about this for a few days. The Treasury Secretary talked about the fact that he was at Mar-a-Lago on Sunday. They had this meeting. He came back with the president to Washington, D.C. But then it felt like yesterday morning, and the president talking about the bond market overnight. He said it's tricky, but now it's beautiful. And he looked at it. And apparently that was the final threshold for this president to decide, I need to walk some of this back. We're going to go all in and dig our heels when it comes to China. But our other trading partners, we're opening the doors. You have 90 days to strike a deal.
Does it put a ceiling on the volatility? Later on this morning, it's going to be about the economic data, 8:30 Eastern time. We get US CPI. That's the next stop for this debate in this market. Inflation data, Lisa, just around the corner.
And how much does it actually matter given the volatility that we're getting in some of the policy? We just heard there from Thomas Honig, formerly of the Federal Reserve, saying it does matter quite a bit to get a sense of where we're coming from. And I think that will matter, but also what will matter is data like how much foreign buying will there be? How much are people actually buying the bond market when there is volatility in the stock market? And those are some of the data points that might be more constructive going forward about the future path.
Truly historic swings worldwide in the past few days. Coming up this hour, we'll catch up with Greg Battle of BNP Paribas as stocks whipsaw on changing tariff policy. Erica Najarian of UBS looking ahead to bank earnings, and Torsten Slok of Apollo reacting to the latest read on inflation. We begin this hour with stocks struggling to add to Wednesday's major rally. Greg Battle of BNP Paribas writing, bear market rallies can be very large and violent. A short-term market rally and compression vol, similar to what we saw yesterday, sets up entry points to add hedges ahead of earnings season. Greg joins us now for more. Greg, good to see you.
Good to see you.
Would you describe the last 24 hours as just a bear market rally?
I mean, it has the attributes of it. If you go back through history and you look at what were the largest one-day rallies for equity markets, they all occurred in bear markets and generally not at the end of them.
The president's in control here. He seems to dictate things. Does that make it different?
I'm glad somebody's in control. I think it makes it incredibly hard to navigate. We see that the way things have flip-flopped over the last week. I think anyone who says they have certainty on where the growth outlook is going, where earnings are going, where the tariff picture is going to settle, is probably exaggerating somewhat.
How much do we have a real price check at a time when anyone who tries to short this market is, you know, we talked about this before, going to get their face ripped off based on a tweet? How can you really get any conviction to give a check on any potential volatility?
I think one of the things that we've seen develop over the last couple of years are flows in the equity market that have changed the market structure of how the equity market trades. We saw absolutely massive flows yesterday. Some of that was discretionary buying. There were very large inflows into the ETF complex, but some of it is systematic. There's essentially a short gamma profile in the market, which means there are forced flows when the market has large moves. So we think these systematic flows contributed more than 50 billion of buying flows yesterday. So this is something that amplifies moves in the market, both on the downside and the upside.
This is important. CTAs you're talking about, right? To some degree?
I'm not talking about CTAs. So CTAs are trend following that contributed to the first legs of this sell-off. But what we're talking about is more flows from things like the levered ETF complex or rehedging of option flows.
Okay, so if that's the case, how much does that structurally mean that the biggest tech stocks will keep trading like penny stocks for the foreseeable future? Because if that's the dynamic in markets, that's how you get a $1.7 trillion increase in valuation of just 6 names.
It creates this reflexivity that when you have large moves, say a 5% move, it's much easier for it to snowball into a 10% move, as we saw yesterday, than it would be in another market regime. So that's something that's structural, and it hits there.
So you think the next leg lower is down? Sorry, the next leg is lower.
I think it's more likely that we revisit the lows than we don't. I think looking forwards, things are going to move a little bit from a very macro headline-driven environment to one where we try and distill what is the impact for this. Earnings season is coming up. Obviously, the backward-looking earnings aren't going to be a focus, but the forward-looking guidance and the commentary from CEOs will be.
So what do you do in the next 90 days if everything is headline-driven and they're working on striking deals with 70 trading partners?
I think you have to look for asymmetric opportunities. So the option market is really where we would focus. And it has been challenging because equity volatility has absolutely exploded. But as we get moves like yesterday, when the market rallies, we see volatility come in rapidly. And we think that can give some opportunities to strike hedges. So one of the things you can look at is the implied probability from the options market as to where the market could trade. So, for example, if you think the NASDAQ is going back to where it was just yesterday morning by the end of next week, the market implied probability of that is about 10 to 1.
So you have a Trump put and a Trump call. Basically, what are they? What's the price? What's the strike price?
So I think the strike price is less of a market level, and I think it's more a function of volatility when things are breaking. This is also how we've tended to think about the Fed put historically. People will ask you, where is the Fed put struck, thinking that you can think in S&P terms. My view is it's more when things start to become dysfunctional and you get signs of stress in the market, that's when you're more likely to see a policy put kick in.
We're talking about the most liquid, deepest, most traded market in the world. And we're talking about a greater likelihood of a 10% move on any given day, up or down. John was saying earlier that if we were talking about Chinese stocks, we would say almost uninvestable. How much does that change the profile of U.S. markets in a pretty profound way if this is the new normal?
I think it obviously has an impact on people's ability or willingness to put money to work. The anecdotal evidence, though, is that there are still pockets of the market, I think particularly retail, who have this very entrenched buy on dip mentality. And right now the flows tell you that is still what they've done right the way through this crisis.
Oh, you don't think we shredded that at all over the past week or so?
No, I think the anecdotal evidence of that in terms of what we see in flows is that there was dip buying from retail last Thursday, last Friday, and indeed at the start of this week.
Domestic retail. What about international, institutional?
I think it's much more challenging for institutional investors, particularly international investors. And I think when we look at the positioning data that we track, we basically saw that the institutional positioning landscape basically reached capitulation point going into yesterday. And that also, I think, plays a part in the velocity of the move higher.
So at this point, going forward, how much do you see reduced interest in U.S. equities than you had from international investors? Or is this just a momentary blip? Do you get the sense that maybe this isn't necessarily structural? This is a moment in time that we're going to look back on as, oh, yeah, that time, but we've moved on.
It was something where this was already emerging at the start of the year in a more positive than negative way, where people were starting to look at other markets such as Europe and make a more positive case, which definitionally means some rotation out of other markets that are overowned, like the US. So I think at the back of people's mind, there is this idea of this rotation trade can play out. But when you go to markets like Europe, which have historically been more volatile, had fatter tails, tend to have more leverage and lower quality corporates in general, that's a hard thing to navigate in this market.
Is this fun?
It is a little bit, yeah.
Is it really?
I think it's something that if you work in markets, then when you get some of the largest moves in markets, you get massive outliers understanding why and what's driving that.
Tweet or a truth posting.
Off one tweet, yeah.
Yeah, so that's fun, evidently.
You're going to be saying that in a few weeks' time?
Probably not.
Yeah, I wonder. Greg, it's good to see you.
Thank you.
Appreciate your time. Thank you, buddy. Greg Battle of BNP Paribas. Truly historic moves we've seen in the past 24 hours. And one social media post shaking up this market big time, sending equities to a monster rally and attempting to put a floor in this bond market, because the moves we saw in bond yields over the past few days clearly unnerved the White House. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of those moves from the White House, President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. The move puts Trump on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. The U.S. and Vietnam, though, are set to start negotiations on a trade deal. The two sides have agreed to consider minimizing non-tariff barriers and strengthen coordination to prevent trade fraud. Vietnam was among the first countries singled out by Trump for showing willingness to negotiate. China has bought an unusually large amount of Brazilian soy this week. People familiar with the matter telling Bloomberg that importers scooped up at least 40 cargoes of beans, taking advantage of the recent dip in Brazilian prices. It also comes as U.S.-China trade tensions escalate. Soy is America's top agricultural export to China. And that's your brief, John.
Brazilian farmers driving around in Lamborghinis at the moment, that's for sure. Up next on the programme, the morning calls. Plus, a little bit later, we'll catch up with Erica Najarian of UBS. Looking ahead to big bank earnings. That kicks off tomorrow morning. Live from New York, you're watching Bloomberg TV. We said this yesterday morning, you can't look away from the Bloomberg terminal at the moment. Blink and you miss it. It's a 10% rally. Just like that. Equity futures on the S&P 500 at the moment negative by close to 2% on the S&P. On the Nasdaq, we're down by 2.4. Just a little bit of stability for now in the bond market. Let's see if it sticks. 10s at 432. At the moment, 2s at 388. Let's get you some morning calls. First up, Goldman Sachs downgrading Ford to neutral, citing weak demand and higher costs from tariffs. Your second call from Mizuho, lowering its price target on Tesla to $375, noting Trump's 90-day tariff pause does not apply to autos. Tesla's down by 3.75%. And finally, Dan Ives of Wedbush cutting his price target on Microsoft to $4.75, pointing to uncertainty from the, quote, tariff game of poker. That name is down by 1.5% in the pre-market. Let's turn to the big banks. Earnings kicking off with JP Morgan, Wells Fargo and Morgan Stanley reporting first quarter results tomorrow morning. Erica Najarian of UBS writing management teams are between a rock and a hard place, as any outlook seen as quite bearish could also punish the sector. Erica joins us now for more. Erica, always good to see you.
Good to see you.
What do they tell us tomorrow morning? What can they tell us?
What can they tell us that will matter? A lot of investors are thinking that whatever they'll say, which is actually not so bad, is going to be seen as backward looking. Now, I think there are really two things that investors are looking for. Number one, are activity levels now just permanently impaired from both the corporate side and the consumer side? So clearly we had this animal spirits economy that we really wanted to come through. And if you're a corporation, how do you make decisions in this environment, right? And so as you think about investment banking and loan growth in commercial, you would think that has to be at least delayed. Although I wonder if the equity market continues to rally, obviously not today, but I wonder if there's some deals that it's going to get pushed through the pipeline over the short term. On the consumer, American Express is not normally seen as a bellwether report, but given that 10% of Americans account for, or high-end Americans that make $250 account for 50% of the spend, all of a sudden they're a bellwether report, because if they're slowing down, that's not good for consumer activity for the rest of the year.
So the banks are the best data points we have at the moment. It's the best real-time data we'll get. A lot of people looked at payrolls and just said that's old news. When you were in touch with the management teams over the past few days, you put together a picture of where things are at currently. What are they telling you about activity at the moment? Have things slowed down?
Things are slow. If you look at the regulatory data and you catch up with the banks, commercial activity, it's slow. It's quite flat. And if you look at the deal logic data, I mean, it's depressing. The whole capital markets renaissance is just not quite happening. But trading, as you can imagine, given all this volatility, trading could be lights out for this quarter.
Okay, hold on a second. I remember when we used to get volatility, and it was good volatility, and then it was bad volatility. Yes. And volatility isn't always a good thing. So is this good volatility or bad volatility in terms of bank profits?
So far, again, speaking about backward looking, if you think about the month of March and think about the equity market volatility, sell-side desks are typically long volatility, so that could be good for them. Now, what makes me nervous is what's been happening to the Treasury market in terms of dealer capacity. So the key question for the month of April is, is there something going to happen? Is there bad volatility now happening in the fixed income markets that is not going to be good news for the second quarter?
So going forward, what do you think is going to potentially be the bigger driver? Is it going to be the trading side of things, or is it going to be the M&A wave that doesn't come to pass? Or is it going to be deregulation, which we've seen some of, but not necessarily the full package?
So investors just never really value trading earnings much, right? It's super volatile. It's like throwing a dart on the board. Who knows in any given quarter, right? I think what they're really looking for is, honestly, any signs of credit at this point, because the reaction of banks up until yesterday really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, let's say if credit costs go up in anticipation of a tougher economy, I think that's what the market sort of needs to hear for now. On the deregulatory point, what's gotten lost in all of this is I feel like the deregulatory momentum in Trump 2.0 is actually much stronger than Trump 1.0. I mean, we went to that lunch. I mean, he started off, Secretary Bessent started off with bank deregulation at this lunch at the Economic Club in New York, and everybody just wanted to talk about tariffs. And he started off with bank dereg. But for now, until we understand, the range of outcomes for the economy, the macro volatility uncertainty will trump the deregulatory positive catalyst.
But do you even believe these CEOs when they come out and potentially say we're not going to have a recession, or we are? Goldman Sachs pulled their call yesterday after Trump came out and blinked.
Again, rock in a hard place, right? So, if you think about how banks set credit costs, they think about the future, they think about the outlook, and they're saying to themselves, well, I don't know what the outlook is, So perhaps they're going to build reserves a little bit, but you don't have an inventory of losses that are coming down the pipeline. Card delinquencies are actually flat to down, and commercial delinquencies or non-performing loans are pretty flat and improving. And so it's tough, but they have to talk defensively, or else investors will think they're burying their head in the sand.
It's an important point you brought up about Scott Besson at the Economic Club of New York, where we saw each other last, because he wanted to talk about deregulation and tax cuts, but the entire room wants to talk about tariffs, because at the moment there was all this uncertainty what they were going to do with trade. When you take the entire policies of the Trump administration, deregulation, tax cuts, and tariffs, how much more constructive is that for banks towards year end?
So deregulation is super, super constructive, right? Particularly as we start thinking about changes in the stress test, which I think could be a 2026 catalyst. I know it's not 5 minutes from now, as we like. So deregulation, I think, is a big catalyst. Tax cuts, obviously the continuation of, the Tax Cuts and Jobs Act would be, beneficial for corporate activity, but that's something that's already embedded, right? It's already baked in the base case. So just extending that isn't necessarily going to pump up activity, which goes back to trade, right? It's like the big overhang that is overshadowing everything else that's good.
So do the big banks benefit the most from deregulation and an uncertain regime where they consolidate a lot of trading volumes?
So I think that in a deregulatory environment, you get to unlock a lot of excess capital. And I think that's great. But if there's not a lot of demand for that capital other than trading, what good is it to unlock excess capital, right? And by the way, remember, buybacks tend to be very pro-cyclical. Like, if we're staring down the barrel of what we stared at last week, I don't feel like bank management teams are going to be like, I'm going to buy back a ton of stock now, right? They tend to be like, well, we're going to keep the capital, tight and excessive for a rainy day. So, we have this regulatory or deregulatory momentum to unlock the excess capital, but we need somewhere to put it. And I'm not sure it's going to be like shoe factories in Binghamton, right?
Do you think there's some pressure on them to cut costs now?
Pressure to cut costs. I think it's too early. I mean, trading is great. No one is giving up on the outlook yet for investment banking. And, especially a lot of regional banks have PTSD from cutting too much in 2023. And now, they're, lost some A players, and now they're scrambling to hire even like a B plus player, right? So I'm saying, so there might be some durability in costs. It's too late to use that as a lever.
So
too early, rather.
Looking across the companies that you cover at the moment, just identify a couple that you do like in a moment like this one, because this sounds tremendously bearish at the moment, but I'm sure there's some names you like.
So,
what do you like at the moment?
Counter to everything that I said, I am obsessed with Capital One. I think that, here's the tagline: cycles are temporary, but networks are forever. And buried under all of the Liberation Day chaos on Thursday was the New York Times headline that the DOJ is okay with the deal, right? And this is a once-in-a-lifetime deal for Capital One to own a debit network and a credit network. So in an environment like this, I have no idea what the macro is, or else I wouldn't be sitting here. I'd be on the beach, right? But in that case, what investors will support and like are stories where they can self-start, they can, grow earnings power in a different way that's completely exclusive of the macro. And that's what's happening with this Discover deal.
We all want to come to the beach with you. Erica, it's good to see you. Thanks for dropping by. Thanks for your time. Erica Najarian there of UBS, looking ahead to those bank earnings that drop tomorrow morning, kicking off things on Wall Street with JP Morgan. In just a moment, 8 minutes away, you'll get US CPI, the latest read on inflation data in America. Mike McKee joined us now for a preview. Good morning, Mike.
Good morning, John. Well, coming into this, everybody's kind of expecting a little bit of good news, drop in the year-over-year rate of inflation for both the headline and the core. The core is going to get a lot of attention because people are going to want to see what happened in terms of prices during the month of March. We did have some tariffs on. So did they affect particularly goods coming in from China, apparel, furniture, toys? And we'll keep an eye on that for you. And then jobless claims have just been a good news story ongoing, even though we've seen all these reports of layoffs from the federal government. And now we're beginning to see them from companies. So what is the status of the labor market? That's another one to watch because Fed officials are saying labor market's okay. They're on inflation watch. Let's see if the data give them anything to watch today.
Mike, Fed officials did not blink. And a lot of people frame the situation they're in at the moment as facing upside risk to inflation and downside risk to growth. And they seem to be very keen over the past few days to really lean into the idea that they are going to anchor inflation expectations. That seemed to be the priority of Chairman Powell going into the weekend. When do you expect this inflation data to change, Mike, in the months to come off the back of some of the announcements we've seen from the White House over the past few weeks?
Well, we could start to see it this month in the April data if we see prices go up for goods coming in from China, because remember, he raised tariffs on China in February, so we could see an impact there. But it would probably take another couple months before the rest of the world gets to that point, because you don't know what people have in inventory and you don't know what is on its way and when it would hit the ports. But probably by the June meeting, the Fed would have an idea of where they're going.
And there's a meeting between now and then. Mike McKee, appreciate it. May 7th is going to be an interesting one, Lisa, for this Federal Reserve. A Fed official you follow closely, the San Francisco Fed President Mary Daly, making the point that she believes the policy is in a good place.
Yeah, because they cut by 100 basis points. It still is, less restrictive, but at the same time, it's restrictive enough to bring inflation down. There is dissonance for them because on one hand, they're looking at companies that still have pretty healthy situations with consumers that are still spending, but they have to project forward at a time where that's unknowable. Erica Najarian was saying that, if, next year isn't 5 minutes from now, which might not be desired. Actually, I think it would be very desired for a lot of us. And it's sort of hard to see the path from here to there.
And we're in the midst of a trade war now between Beijing and Washington. Look at the headlines this morning. You have China coming out and saying, actually, we're going to ditch some of our U.S. soybeans and we're going to lean into Brazil. It's exactly what they did in 1.0. And guess what the U.S. government had to do? Trump's administration in that time around, they had to go to Congress and ask for a bailout for our farmers. So if you're the Federal Reserve, how difficult are these decisions in the midst of really whipsawing policy and the escalation from trading partners?
Got some deals if you want to talk about it. Prada agrees to buy Versace. Enterprise value of $1.375 billion. Got a deal there. You happy with that one?
That's why I wore Prada today. I was expecting this deal to come through for Versace. No, I'm just kidding. I did not know that. Well, luxury, I guess, back in play. Remember it was that former deal between the FTC wouldn't agree upon when it was the handbags, Jonathan?
Yes, entry-level luxury.
Yes. So this is full luxury. And I guess Prada's expanding.
This is super high-end luxury. Inflation data up next. Let's move on from that conversation. Torsten Slock of Apollo joins us in just a moment. David Kelly of JP Morgan Asset Management here to react. From New York, CPI up next. Inflation data in America just seconds away. CPI just around a corner. Your scores going into it look like this. Equity futures on the S&P down by 1.9% on the S&P 500. Yesterday, the biggest one-day pop since 2008. This morning, declines resume on the Nasdaq, down by 2.3. In the bond market, bond yields, 2-year, 10-year, 30-year. Your bond market looks a little something like this. The 10-year Treasury at the moment, yields down by 4 basis points. Your yield, 4.29. Your data with Mike McKee. Good morning, Mike.
Good morning, John. Well, we come in much better than expected on headline CPI and a little bit better than expected on the core, up by 0.1%. The forecast was for 0.3%, and that pushes us down to a 2.8% annual rate for core, which is going to be the lowest in some time. I'll have to get a statistic on that for you. Headline goes down by 0.1%, and that pushes the number to 2.4% on a year-over-year basis. We're getting very close to the area in which the Fed thinks we should be, what they're looking for. Jobless claims right on the screws. Forecast 223,000. We get 223,000. Continuing claims 1,850,000, and that is a bit of a decline from 1,893,000 revision to last week. So are we getting any kind of pop from this, John? I'll check the details here while you
We're seeing some moves, Mike, but in the bond market. So yields down at the front end of the curve. We're down 9 or 10 basis points. Your 2-year at the moment back to 381. But the volatility we've seen at the front end of the curve has just been unreal. As we mentioned a few times on this programme yesterday, a 38 basis point trading range intraday at the front end of the curve. This morning on 10s, we're down about 4. So off the back of that, you unlock some dollar weakness, euro strength. Euro dollar now highs at a session through 111, 111.22 at the moment on that currency pair. Equity is the smallest of bounces. At the moment, we're down about 1.4%. Mike, as you go through the details, when you get softer prints like this, just to frame things, typically we'd have a conversation about the Federal Reserve maybe getting some confidence to reduce interest rates even more. But Mike, this time around, I just get the feeling that for the Federal Reserve, they've just got to wait a whole lot longer to see how these policy changes of the past few weeks bleed into the data in the coming weeks and months.
Absolutely. This is backward looking, and it's also been eclipsed by the tariff news, which should push up inflation. So the Fed is going to look through this. It's good news. It shows that they were on track. Remember, they were telling us that we were going to get down to 2%. They'd leave rates where they were, and that would put pressure on inflation. So to the point of Trump putting on tariffs, they were making progress. Now the question is, what happens from there? And speaking of Donald Trump, here's something that's not necessarily going to be good news for the White House in these inflation reports. It was energy. Gasoline prices went down during March, and that held the headline number down to a 1/10 decline. But food prices went up by 0.5%. Food at home by 0.5%. So people are going to go to the grocery store and say, well, we're not seeing inflation relief here, and the president promised that. That's something they're going to have to deal with.
Mike McKee on the latest data. Mike, we'll come back to you in just a moment. Stay close. Torsten Slok of Apollo joins us around the table. Torsten, good morning, sir. It's good to see you.
Morning.
Can I ignore all that?
Well, this is a Goldilocks starting point for the Fed, at least. I mean, the dual mandate says inflation should be 2. We moved a little bit more in that direction, better than expected. And on jobless claims, we also had a labor market that still is reasonably strong. So from that perspective, this is absolutely good news for the Fed that we did not get yet any inflation surprise to the upside. But obviously, we still have tariffs in the pipeline. And what's left on the tariff front could still add as much as 1 percentage point to tariffs over the next, to inflation over the next 12 months. So in that sense, this is backward looking, as Mike is saying. The risks are, of course, that there's now more upside coming to inflation.
So this is the issue, and it's a sequencing issue, and I'd love to get your thoughts on it. So sentiment's collapsed, basically created over the past few months. What we've started to see with CPI is just a bit of softness. That's encouraging. How long before we see the weakness in the output data, before we then see the higher prices in months to come? What comes before the other?
Well, let's think about how companies might respond to this. So now you know tariffs are coming. For example, if you think about Amazon, of the sellers on Amazon, 71% they source their goods in China. So one very important aspect is that it will be visible for everyone that prices are going up on things that are imported, of course, from China. So the conclusion to your question is, how do you respond to that? Do you take your existing inventory and sell that at the old prices? Do you take your existing inventory and raise the price immediately? That profile will probably be individual for different companies, depending on the competitive situation, which sector they're in, how sensitive they are to tariffs. So we just don't know yet what the impact will be and how quickly this will feed through. But we do know that higher prices are coming as a result of goods coming from China becoming significantly more expensive. So even if companies decide to sell the existing inventory at the old price, we will over time see some upward pressure on goods inflation coming from this source.
Is there a risk that we ignore this data at our own peril? The idea that actually lower energy prices are giving more disposable income to consumers to potentially go out there and buy, and that, oh yeah, it's also an offset for a lot of potential producers in the U.S.?
Absolutely. Low energy prices is very, very helpful for the consumer. But the other thing, of course, is that the whole surrounding sentiment around what's been going on is that we literally went from the last few days from nuclear winter to now back to talking about stagflation. And stagflation has these risks, of course, that you have headwinds from consumer sentiment being weak, corporate sentiment being weak. If you look at the Fed surveys for CapEx planning, they are really beginning to turn south. So companies are beginning to pull back more, likely because of the uncertainty. And let's not forget, we still have a $5 trillion net wealth effect on consumers from the stock market going down. So if I add this whole list together of weaker corporate sentiment, weaker consumer sentiment, tariffs coming, and a negative wealth effect, and on top of that also retaliation from foreigners who might be doing things to us simply because of the trade war, that brings you a fairly long list of downside risks to the outlook overall.
Which raises this issue of how we even game out the idea of inflation. why potentially are we not talking about deflation or disinflation? And I say this given the fact that we see Walmart, for example, saying that they are going to invest in price competitiveness. Basically, they're going to absorb all of the costs from tariffs. At what point could potentially the lack of demand be the main story more than inflation?
And that's why the key issue here is who is going to absorb the increase in tariffs? Who's going to absorb the price increase in goods that are coming here, in particular from China? Is it going to be consumers that will face higher prices? Or is it going to be taken out of margins? Will the E in the PE ratio go down as a result of this, as companies such as Walmart, Costco, and of course Amazon begin to say, well, maybe we are going to absorb some of this. And that remains to be seen exactly. Maybe it's going to be split across corporates and across consumers. But the bottom line still is that someone has to foot the bill when tariffs are going up.
Wall Street Journal has this morning that the president privately acknowledged that his trade policies could potentially lead to or trigger a recession, but he said he wanted to make sure it didn't cause a depression. Where are you now in terms of potentially having a recession this year?
So, of course, the last few days, it was pretty clear that there would be a sudden stop in the economy where prices would go up significantly, literally on all trading partners and everything coming in. So that was a scenario where a recession was very likely, almost at 100% where we came from. Today, the recession probability is probably 50-50%, meaning we think that there is still a likelihood we will have a slowdown. But the risk is we just don't know what the response is going to be from consumers, corporates, how much will markets go down further. In particular, this wealth effect on its own. Think about how we normally talk about when the stock market is going down. We go back to the spreadsheets and say, what's the marginal propensity to consume? How do consumers react when the stock market goes down? Here on its own, the stock market down now 5 trillion so far. And of course, now it's rebounding and then coming a little bit back again. That's on its own a fairly significant hit to consumers and the wealth effect for the consumer outlook.
We still don't know what the policy will be in a few months' time, including the tax code. This came from the president just moments ago. A social media post saying, great news, the big beautiful bill is coming along really well. Republicans are working together nicely. The biggest tax cuts in US history getting close.
Well, it's because yesterday they had to pull a vote to vote on the budget resolution from the Senate in the House because fiscal hawks are saying that Senate bill doesn't do enough for cuts. So what's happening this morning? Speaker Johnson, Leader Thune are having a press conference later this hour to outline a plan to get Trump's tax cuts through. The president sees this and he says, oh, look, they're working together now. This morning, they weren't working together last night.
Can they change the conversation? Moments ago, we just had CPI data. Let's bring Mike McKee back in for an update. Mike, you've had a second look. What stands out?
Well, a couple of things, John. We talked about grocery prices, and meat prices were up 1.1%. Chicken prices were up. Pork prices were up. So people will really be noticing it at the meat counters in their stores. More bad news for the president. He'd been bragging about the price of eggs coming down, but they rise by 5.9% on the month, which puts them up 60.4% for the year. Last month, it was 58%. So egg prices are going back up. Now, the China impact, perhaps. We saw furniture prices rise on the month, and that is something we get a lot of from China, up 0.6. Bedroom furniture up 2.7%. Apparel up 0.4 after a 0.6 rise the month before. Also something we do get a lot of from China. Toy prices went down, though. Maybe that's because Christmas and Hanukkah are behind us. Smartphone prices, surprisingly, go down by 1.1%. So maybe that's an inflation number that is coming, but is not there yet. The big well, let me do housing because everybody follows that. Owner's equivalent rent up 0.4. That's a rise of 0.1%. So I was going to say the big thing that people are going to be watching going forward is energy prices, which were down 6.3% for gasoline. If that continues, it takes some of the edge off the food prices, and it does help the administration's case a little bit. But all in all, this is sort of a mixed report. The things that we thought would go down, airfares were down 5.4%, did go down. Some of the things we got from China did go up, and that's something that could continue with the big tariffs that they now have.
Mike, thank you for the update. Mike McKee there, following inflation data about 10 minutes ago. David Kelly of JP Morgan Asset Management joins us now for more. David, welcome to the programme. How encouraging is that data this morning?
I don't really think it changes the narrative much. I think, Mike McKee was pointing out that airfares are down 5.4%. Actually, lodging, hotels and motels and so forth, was down 4.3%. So I think what we're seeing is a lot of softness in the travel industry, which I think is going to get worse over the course of this year. It is the calm before the inflation storm. We're going to get some higher inflation out of the tariffs. I mean, remember, we left the 10% universal tariff in place. That's a lot higher than anything we've seen really for decades. So that's high. And then, of course, there's an enormous tariff on China, which is going to clog supply chains and push up prices too. So I think we will get some inflation there. But what I actually see in the data, looking particularly at the travel numbers, is a sort of a deflationary tinge to the economy or slowdown tinge to the economy already. So I'm glad that the market rallied yesterday, and I'm glad that we've got rid of the worst of the reciprocal tariffs apart from on China. But I think that we are far from out of the woods here. I think that these data do sort of still suggest that there is a slowdown coming in the economy.
So the slowdown is what worries you more than the inflation, David, if I'm hearing you correctly, at a time where CPI just came in, when you strip out energy and food at the lowest level going back to 2021. Are you saying that that's really what markets ought to be focused on, both bond and stock?
Yes, because people talk about stagflation all the time, but really it's always inflation stag. You get the inflation first and then you get the stagnation. And the problem is that, with the labor supply falling away, with these impediments to trade, with cutbacks in government spending, government grants and so forth, a lot of fiscal drag this year, I can see a lot of things that are going to slow the economy down. We'll get a temporary surge in inflation from this, but I think we're going to be left with a pretty stagnant economy afterwards. And the real question is, does that revolt in the House yesterday in terms of House members who are fiscal hawks, is that really something or not? Are we going to have a bigger deficit in fiscal stimulus next year or not? If we have fiscal stimulus, then I start worrying about inflation again. But in the absence of major fiscal stimulus, I think that people need to worry about recession more than inflation here.
Are bonds still the best bet? U.S. Treasuries in that type of scenario, recession, comes very much back on the table.
Well, yes. I mean, I think that, first of all, I think, long-term interest rates at 4.3%, 4.2% on a 10-year Treasury, I think that's fine. And I think people need, I'd be level weight in fixed income. I realize that we may have a mild recession here, but, longer term, whatever recession we have, we'll pull out of it again. And these bond yields are reasonable for the long run. I don't expect inflation to hang around the long run because, we'll get these tariffs and then tariffs just don't work and eventually we'll pull back from them and that'll actually have a deflationary impulse in the economy. So long term, I'm not that worried about inflation. I am worried that there won't be much dynamism about the economy overall.
David, appreciate the update. I know you're busy this morning, so thanks for making time for us. David Kelly there of JP Morgan Asset Management. If you are just joining us, downside surprise on CPI. Market just kind of looks through it. Equities still session lows. We're down by 2% on the S&P 500. There is a bit at the front end of the curve. You see yields falling back by 8 basis points at 383 on a 10-year. And in the FX market, that unlocks further dollar weakness. Euro dollar through 111. We're at 111.15. Torsten Slock of Apollo is still with us. Torsten, David Kelly, calm before the storm. Focus on a growth story more than inflation. Do you agree with some of that?
Well, I'm not so sure. I mean, the last few days, the Fed has made very clear that they will also be focusing on inflation. So the real big question for them here is, do they want their legacy to be Arthur Burns or do they want their legacy to be Paul Volcker? Because if they walk out the door and have allowed inflation to be a lot higher, then, of course, they will have a serious risk. So I do think that this becomes a very, very important debate inside the Fed in terms of what weight should they put on the dual mandate when one side of the dual mandate says the Fed should be cutting, namely growth, and the other side of the dual mandate, inflation, said they should be hiking.
It's difficult to read minds, but based on the communication of the past week or so, do you get the feeling the weight of history is on their shoulders?
Because I do see some finer nuances between what's being said, in particular compared also with Jay Powell on Friday. Very importantly, can they get away with just saying, oh, we're going to cut because long-term inflation expectations in markets are very well anchored, because survey expectations are going up quite significantly, both in the short term and in the long term. So it really becomes a matter of where do they put their weight when it comes to inflation? Is it on actual incoming inflation or is it on some measures of inflation expectations which are well anchored?
But Torsten, you said it earlier. You have tariffs still in the pipeline. Can they do anything until they actually understand the rules of the road?
I think they do the same calculations, of course, that the street is doing in terms of the impact on inflation is between half and a full percentage point higher over the next 12 months. Then I do think that they come to the conclusion that the forecast is saying inflation is going up and therefore it's going to be difficult for them to signal a lot of rate cuts. So that's why the market currently pricing 3 cuts. It does make sense that we have a modest amount of cuts, but not more than that, even if growth does start to slow down more meaningfully.
Do you have a sense of how close they were to intervening with the Treasury market yesterday?
I don't know the answer to that, but I do know that they bought $100 billion during COVID, of course, in March of 2020, every single day in the Treasury market. And I do guess that they were probably worried that they would have to take out some of the same tools if this were allowed to continue. So if both it was caused by Japanese sellers, if the sell-off in rates was caused by risk reduction in asset managers, and if it also was caused by the basis trade unwinding, that combination and the fact that we don't even know which of these things were most powerful just still created a significant amount of risk to financial stability if this were allowed to continue.
Do you think people are trying to drift away from dollar assets? Do you see that building over the past week?
I don't see that because the dollar would have gone down a lot more in the last few days than it actually did. So there are some discussions around maybe China or others were selling in custody holdings and just kept the money in dollars and didn't sell it and took it back home. But nevertheless, the fact that the dollar index just moved relatively sideways, the yen did appreciate, suggesting that it's correct that there might have been some Japanese sellers. But broadly speaking, the DXY index on my Bloomberg screen was relatively flat for the last few days, suggesting that this was not a questioning about U.S. exceptionalism. I still think the U.S. is exceptional, still the most dynamic economy, still the biggest financial market. We still have, of course, a lot of investors that are looking here to come and invest, and that does make sense. We just have, at the moment, some turbulence, of course, that people are thinking about, that this is probably mainly viewed as a short-term quibble in markets.
I hope you're right, Torsten. Well said. It's good to see you, as always. Torsten Slok there of Apollo. Equity futures at the moment down 2% on the S&P. The opening bell is about 43 minutes away with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March headline and core CPI both rising less than expected. A softer print with markets weighing the whiplash from the White House. The data is a welcome signal for the Fed. The central bank so far has been saying that it's prepared to stay on hold as it awaits any inflationary impacts from tariffs. And we have a deal in the luxury retail space. Prada is buying Versace from fashion conglomerate Capri Holdings. Prada will pay $1.38 billion for the company. Capri said it will use the proceeds of the sale of the business for investments, debt reductions, and stock buyback. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Live from New York City, you're watching Bloomberg Surveillance. Downside surprise on CPI. This equity market not taking comfort from that. We're down by 2.2% on the S&P. We're down 2.8 on the NASDAQ. As we count you down to the opening bell, should we get you some movers? We can get those movers right now. Let's cross over to Danny Berger, I believe, for more. Hey, Danny. No, Danny. Let's get to your trading diary. At 1 p.m., the US Treasury auctioning $22 billion in 30-year bonds. At 4 p.m., President Trump participating in a bill signing. On Friday, PPI and UMich sentiment, plus bank earnings kicking off with JP Morgan, Wells Fargo and Morgan Stanley. On Monday, Goldman Sachs earnings. Tuesday, Bank of America and Citi reporting, plus United Airlines results after the closing bell. One thing that is happening right now, I'm pleased to say, Speaker Johnson and Leader Thune will be holding a news conference, a briefing, any second from now. Tyler Kendall joins us from Washington with more. Tyler, what are you looking for?
Yeah, hey, John. Well, this presser comes after last night the House delayed a crucial vote on passing the Senate's budget resolution. At issue here is that fiscal hawks in the House don't think that the Senate's plan has enough spending cuts. The Senate plan calls for about $4 billion worth of spending cuts. You'll recall the House had wanted that number to be up to $2 trillion. Now, there is reporting that the two leaders could be announcing here a deal for $1.5 trillion in spending cuts. We'll have to see, because that is still going to raise some pretty big questions when it comes to what that could potentially mean for some benefit programs like Medicaid that really started this disagreement between the two chambers to begin with. John, these two chambers do need to ultimately agree in order to kickstart actually crafting the budget reconciliation process, which President Trump is really banking on because it's tied to his tax cuts.
Tyler Kendall, thank you with the update from the White House. Tyler, thank you so much. Anne-Marie, Are we getting closer to this deal? How long is this going to take?
Well, obviously, having Speaker Johnson and Leader Thune come together and talk about potentially how they can bring both their caucuses together, yes, we are getting closer. But this is going to be so challenging because say you have these fiscal hawks in the House that say, I'm not signing up for something until I see the Senate cut back on some of their spending. Well, then you're just going to have Republican senators saying there's no way I'm touching anything close to Medicare. So you're going to have this dance back and forth for a while. Push is going to come to shove if they include the debt ceiling within the package, and they have no choice but to vote it. And also when Speaker Trump starts getting on the phone and pressuring these individuals to sign up to his plan.
The president says the biggest tax cuts ever. There's a big difference between extending tax cuts and delivering new ones.
These aren't tax cuts.
Are we going to get additional tax cuts?
Potentially. We'll get no tax on tips, maybe one other add-on, one other sweetener. But all this is an extension of current policy, which is why, Erica was talking about it earlier. This is all already baked in. There's nothing that exciting about this bill. I know it's one big, beautiful bill potentially for the president, but all it is an extension of current policy.
That would have implications for this big, beautiful bond market at the same time.
Very much so, because if you end up with a bigger fiscal deficit, then all of a sudden, how much does that become the main driver? I remember a long time ago, like 3 days ago, when people were actually talking about how the bond market cared more about the budget than they did tariffs. Well, that changed for a hot second. But now there's going to be also a focus on the fiscal sustainability, especially if there is Japanese selling, especially if there is potential aversion from international buyers. We've heard mixed things, but that, I think, will become very much to the fore.
3 days ago feels like an absolute lifetime ago. Just yesterday, the president backing down, authorizing a 90-day pause on tariffs and doubling down on China, 125% on China. That unleashed a major rally in the equity market, the biggest one-day move we've seen going back to 2008. This is what Peter Chi of Academy said this morning, a Liberation Day do-over. And that's exactly what it feels like. Where will we be 90 days from now? Will we have to have another pause for another 90 days? And what happens in between? This market is not paying attention to the economic data. A downside surprise on CPI, and we're taking very little comfort from it. Your S&P 500 is down by 2 full percentage points. Coming up tomorrow to continue the conversation, Cameron Dawson of New Edge Wealth will be catching up with us as bank earnings season kicks off. On Wall Street, we'll catch up with Gerard Cassidy of RBC. We'll speak to Sarah Hunt of Alpine Saxon Woods, and we'll catch up with Veronica Clark of Citi before we go into a much-earned weekend for you all. From New York City, enjoy the Masters at Augusta National. From New York, get some rest if you can. This was Bloomberg Surveillance.
News when you want it with Bloomberg News Now. I'm Stephen Carroll.
And I'm Valerie Teitel.
We are seeing dramatic moves on markets as we have some breaking news for you this hour. China is increasing its tariffs on US goods to 125%. These additional levies coming after Donald Trump announced that the cumulative level of tariffs confirmed by the White House would now be 145% on Chinese imports into the United States. That's the 125% levy that he raised the amounts to, and the 20% previous tariff that was announced as well. We are seeing some instant moves on markets in reaction to that. European stocks pairing some of their earlier losses, and we are seeing stock futures fluctuate on Wall Street after the major sell-off that we had yesterday, when we did have S&P E-mini futures down by 3.5%. China saying that it will ignore the US if it keeps imposing tariffs. This new tariff rate will be effective as of tomorrow, the 12th of April. That is the latest we're hearing from China on tariffs.
Now on to our top stories. The dollar has weakened to a 6-month low as the escalating global trade war raises further fears over the U.S. economy. The greenback saw its biggest plunge in 3 years yesterday and is falling further this morning, driving the euro to its highest since 2022. Thursday saw another sharp sell-off in treasuries as well as investors begin to question their safe haven status. Speaking to Bloomberg, Bridgewater Associates founder Ray Dalio warned the tariff turmoil is damaging America's credibility.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Dalio went on to say that it's likely the U.S. economy will go into recession and that the turmoil is raising questions about if bonds are an effective storehold of wealth. 30-year Treasury yields yesterday surged by 13 basis points and are rising again this morning, another 3 basis points to 4.90.
Well, in reaction to the latest tariff headlines out of China, we've seen the euro strengthen against the dollar, now 1.7% higher, reaching almost €1.14 against the dollar. That's the highest since February 2022. The Bloomberg Dollar Spot Index is 1% weaker this morning. The Japanese yen also strengthening by 1.3% against the dollar to 142.56. The violent market moves suggest scepticism about any planned talks with US trade partners and the fears over escalating tensions with China, even after President Trump's decision to delay some of his sweeping tariffs. The founder and CIO of Heyman Capital, Kyle Bass, says it's all part of a necessary resetting for the American economy.
We must reset our trade relationships with the rest of the world. We also must narrow our fiscal deficit in the United States. And both of those things might be slightly recessionary. And if that's true, we might have to go through a brief recession in order to rebuild our foundation.
Kyle Bass says that in the end, America will be stronger, but many investors are seeking refuge elsewhere, along with the euro, the Swiss franc and the yen are all surging, while gold has hit another record high, now over $3,200 a troy ounce.
Donald Trump has conceded that his approach to tariffs will cause some issues. Even after the pause in higher levies for many countries, Bloomberg Economics says average import taxes for the U.S. will be 24%. Speaking in a televised cabinet meeting, President Trump conceded that this will have an impact on America.
There'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing.
Trump says he believes that the first tariff deals are very close, while also voicing optimism that China will eventually come to the table. The U.S. president also indicated willingness to be flexible on exemptions for companies or countries from the tariff regime, including the 10% floor he's established for all trading partners.
Top European officials are planning to visit China to discuss trade with President Xi Jinping in late July, according to sources who've spoken to Bloomberg. The European Commission President Ursula von der Leyen and European Council President Antonio Costa have, according to other reports, agreed to the summit in Beijing. The possible meeting comes as Spanish Prime Minister Pedro Sanchez visited Beijing today, saying he sees China as a partner of the EU.
Britain's economy grew much faster than expected in February. GDP rose by 0.5%, well above the 0.1% forecasted by economists, with all major sectors recording growth. The figures come as the Bank of England Deputy Governor Sarah Breeden warns that tariffs could hamper UK growth in the months ahead. However, she says the impact on inflation is less clear, with the value of sterling remaining a key factor.
And a helicopter has crashed into New York's Hudson River, killing the 3 adults and 3 children on board. The aircraft broke apart in mid-air while taking a Siemens executive and his family on a sightseeing trip. New York City Mayor Eric Adams has been speaking about the incident.
All 6 victims have been removed from the water, and sadly, all 6 victims have been pronounced deceased.
The helicopter was operated by New York Helicopters, and US aviation authorities are investigating the crash. Those are your top stories. On the markets, the dollar weakening 0.9% on the Bloomberg Dollar Spot Index. The euro 1.5% stronger, 113.67. The 10-year Treasury yield 2 basis points higher, 4.45%. The 30-year yield up 3 basis points to 4.9%. On Wall Street, S&P E-mini futures are now 0.3 higher. Nasdaq futures 0.5% higher as the Euro Stoxx 600 is down by 0.3%. That's news when you want it with Bloomberg News Now. I'm Stephen Carroll.
I'm Valerie Teitel, and this is Bloomberg.
I'm extremely excited about the opportunities thrown up by the redefining of supply chains in a multipolar economy.
Hong Kong, particularly innovation and technologies, AI, robotics, green tech, as well as biotech.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Investors, they are back on edge after President Trump's tariff pause and monster rally yesterday. And this as tariffs on China remain in place. Markets now bracing for a potentially protracted period of global trade volatility. Let's check in on these markets. We're currently up over the last 2 days, almost 8%. Remember the euphoria that swept through the markets as tariffs were put on pause. All countries except for China now have a 10% blanket tariff. But we drop again once again today, Ed, and it looks as though the anxiety about what China really means for the broader markets is still there.
Yeah, let's give some illustrative examples of the companies impacted, right? Tesla jumped 22% yesterday. This is a 2-day chart. It's pulled back today. So it goes from having its biggest jump since 2013 to pulling back. Apple, another company impacted, right? Switching up the boards and looking at Apple. 90-day pause on 56 countries that had tariffs implemented while the administration boosts the tariff level on China. Apple's so interesting, and later in the show we'll dig deep into it. Why? That Reuters report that they airlifted tons, literally 1.5 million iPhones from India into the US. This is kind of crazy markets news cycle, and I'm here for it.
Aren't we just? And President Trump's tariff pause is a welcome relief, Ed. But look, investors are remaining wary of the wider economic impacts of those 125% tariffs still on China. White House National Economic Council Director, that's Kevin Hassett, saying there have been well-advanced trade talks and offers with other nations. Bloomberg's Kayleigh Lyons breaks it down. Just the intricacy, the 10% blanket tariff on everyone but China, but some get close to a deal, it seems.
Yeah, according to Kevin Hassett, who was speaking on another network, he's the director of the National Economic Council. They've already had more than 15 deals presented to them, and they are intending to take these bilaterally, one by one. The entire trade team, which could include Hassett, but as well as Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick, and of course President Trump himself, who admitted yesterday that while this is about negotiation, it was also about the market, despite the messaging we initially got from the White House press secretary and Secretary Bessent that this was always part of the plan. This was the art of the deal. It's all about negotiations. The president himself admitted he was watching the bond market get a little queasy and felt that people were getting yippy. And that contributed to this move, at least to lower or to pause 90 days reciprocal tariffs on all countries except China. But yes, that 10% is still in place, and that 125% levy on China in place as well, in addition to the 84% reciprocal tariff that China has placed on U.S. imports. And that could effectively have the effect of starting a decoupling of the two largest economies, which obviously has major implications for firms with heavy Chinese exposure, including the technology companies that we saw ripping yesterday, as you guys were just talking about, giving back some of those gains today, as there is still risk here for a company like Apple and Nvidia. And although President Trump said yesterday he does think China wants to make a deal, he's expecting a phone call from Beijing and would love to talk to Xi Jinping. There has been no sign from Xi or the Chinese government yet that they are interested in making that forward progress, suggesting that China does not necessarily want to blink first here, keeping in mind that the idea that there's still ongoing conversations over a TikTok divestiture deal adds an additional piece of leverage and complication to any conversations that are had.
You know, Apple's going to be a big focus in the show today because the White House keeps talking about it. Yesterday's jump, the biggest since 1998. It's just crazy times, and India's a focus. I was interested in our reporting that Bessent listed India as one of the nations he'd speak with early on. What is the DC reaction, right? If you're a Democrat and you're trying to respond to the White House tariff policy, what are you hearing?
Well, essentially what Democrats argue is that this is just chaotic, that there is so much uncertainty around the policy, and then that has the same detrimental impacts of these policies staying in place. There was also a lot of concern on the part of primarily Democrats yesterday about the potential market manipulative effect of President Trump's swings when it comes, or vacillations when it comes to this policy, keeping in mind that it was yesterday morning he said on True Social it was a good time to buy, then hours later sparked the biggest rally we've seen since 2008 with this decision. And many, including Senator Adam Schiff of California, have suggested that this requires an investigation into possible insider trading. So that is another narrative we are hearing. All of it, though, just speaks to the uncertainty around this policy, keeping in mind that while the president is now saying that China tariffs are sticking in place, that there is a 90-day pause in place for other countries, we have seen time and again that he does have the power to change his mind and to do so very quickly. What stands today on Thursday isn't necessarily going to stand tomorrow necessarily. And of course, we're going to have potentially multiple opportunities to hear from the president today. He's scheduled to be holding a cabinet meeting right now, signing a bill later, presents some opportunities for him to speak to the press, and we'll see if he has any additional surprising tariff news for us.
Bloomberg's Kayleigh Lyons in Washington, D.C. Thank you very much. Another story overnight. China also announced it will, quote, moderately reduce the number of U.S. movies allowed into the country in response to the U.S. government's tariffs. The move is seen as a new front in the trade war and could signal Beijing's willingness to target American services, which could include travel, intellectual property, royalties and transportation. Karen.
Still so much to digest on the wider tariff implications on tech. Let's get to it. Jay Hatfield's with us, Infrastructure Capital Management CEO. Can you trade in this erratic market?
You can, but it's very easy to lose a lot of money doing so. So it's really better for most investors just to hold their positions. Although I will say, we have been, even before the tariff halt, we had said that 5,000 was a good support level. So now that we've kind of bounced off that hard, I think we're just neutral on equities right now, but I would counsel even hedge fund managers to trade cautiously because there's erratic policy coming out of the White House. They can announce it at 1:10 in the afternoon, and so it's better to just get to your position and kind of hold it.
When you're thinking about potentially the names that you like and want to recommit to, how much are you thinking about exposure for China at the moment?
100%, I guess, and also to overseas markets. So we favor, I think you had a guest on earlier, regional banks. They have no exposure to international. They do have credit exposure, but we think we have a non-consensus call that the economy is pretty strong. And so those banks have come down almost as hard as the investment banks, but they're not dependent on investment banking. They're really just dependent on rates and spreads. So be more conservative in this market.
Jay, I'm just staring at a 5-day NASDAQ 100 chart. And I'm staring at it because effectively net, we're flat over the course of 5 trading days. Then you think about the drama that we're within those 5 trading days. Do you net understand the tariff policy of the White House, and are you able to make informed markets decisions based on your understanding of that policy?
Thanks, Ed. Definitely not. I mean, that's really why we're neutral on equities. We're actually very constructive on inflation, which that view is validated this morning. So we had negative headline inflation. And just to mention that, too, that everybody wants to talk about tariffs, but nobody talks about the 20% drop in energy. That's very profound. That's very stimulative to the U.S. economy. It's very positive for inflation, but it never gets mentioned. But to your point about uncertainty, there's basically 2 camps in the White House, the hawks and the doves. The doves are more pro-business. You kind of saw that when Elon Musk called Navarro a dumb bag of bricks. Like, that's almost unprecedented. I don't think that happens in normal organizations where colleagues are highly pejorative. So because we don't really know who's going to win that debate, it seems like Besant has the latest victory. We are, like I said, we're neutral on stocks. We'd be more conservative, and also fixed income looks pretty attractive.
Jay, recession calls were pulled on the White House's 90-day pause. Should our audience of technology investors, technology employees, founders, startup leaders be braced for a recession in your mind?
Our call is there's no recession, but slow growth. But the real thing that also people are missing, in our opinion, is that the slowdown is mostly caused by hawkish Federal Reserve policy and not by tariff policy. As I mentioned, energy decline pretty much offsets the tariff increase. So the real issue is ultra tight Fed policy. We think the Fed has a flawed structure, policy framework. They're very dangerous, and they potentially could create a recession. But we do think the inflation data is going to be so positive they'll be forced to cut rates later in the year.
I'm really interested in that U.S. economy positivity, basically, and the fact that means maybe we've got a resilient consumer for Apple phones, maybe we've got a resilient consumer for Amazon products. Mm-hmm. Are there any stocks in the tech world that you think are worth adding to, not just regional banks?
Absolutely, and this doesn't sound conservative, but we think is more conservative. Amazon, they're kind of half Walmart, and they're price insensitive. They're just pass-through entity. And the CEO is on this morning saying that AWS demand is extremely strong. So they get traded like a tech stock, but they're half a retail stock, and they're cutting costs. So that's, again, like regional banks, pretty defensive in a market that has been destabilized by this White House that can't really sort out who's in charge.
Andy Jassy has been putting out his investor and shareholder letter today and responding to some of the, current volatility that his consumers see. But then push us forward as to what your view is on AI, and if AWS still sees insatiable demand. Many have been trying to work out whether the AI bubble that has so inflated this market is anyway intact. Is it?
We think so. I mean, everybody looks at the market and says, oh, well, the stocks are way down, so AI must be falling apart. They're just high beta stocks. They have 2 betas, so they're twice as volatile as the market. So the market's going down. What do you sell? You sell the volatile stuff. You sell the investment banks. You sell tech stocks. This doesn't mean the AI market has changed. And that's one reason, though, because we do believe there will be continued AI spending, and Jassy's comments certainly validate that. Really, it's investment and not consumption that drives recessions. So AI spending is offsetting a slow housing market. And another thing that people haven't focused on, rates have come down 50 basis points. Yeah. It was disconcerting yesterday when they were skyrocketing, by the way. I thought the market might crash then. But that is helpful. It's not going to get the housing market to boom, but stabilize. So if you look at investment, you can predict recessions pretty well. Stabilizing housing, strong tech, spending. That adds up to slow growth, say, in that 1% to 2% range.
Jay, our case study today, I think, is Apple. And in the short term, they're airlifting iPhone handsets from India into the United States. In the long term, the White House sees a world in which the iPhone is assembled in the United States. Do you see that future being achievable for this White House?
Not really. That's sort of the fundamental flaw of the hawkish trade outlook, is there's a notion that you can have a trade balance with all countries, which is ridiculous in the sense that, low-income countries have low labor. They're going to be exporters. That's one way they grow. And then the second thing is, if you run a gigantic budget deficit, you have to have a trade deficit. Financial flows need to equal physical flows. So the first thing you need to do if you want to have zero trade deficit is lower your budget deficit. So that objective is ridiculous.
Yeah.
It might have led to the bag of bricks comment from Musk, not me. And so that's why it's disconcerting to be in this market, because one side is arguably nutty and the other side is more pro-business, and we don't know who's going to win.
Jay, at the moment, it looks as though the House is going to adopt a plan to advance Trump's tax cuts and also the debt ceiling hike. I want to get your take on how we can align what many had thought would be a tax policy that offsets some of the volatility of tariffs. If the House can push forward and agree $1.5 trillion in cuts for the budget, is that the right policy right now?
Absolutely. So that offsets if we end up with sort of 2% of GDP, that's about a $600 billion tax increase. So we need to offset that. And in fact, that's what the flaw of the initial strategy is that it just came too fast. You could have just said, well, in a year we'll do this, and then you had plenty of time. And so they came way before the tax cut, and that's what's destabilized the market. And it's just an own goal if you play soccer, because they didn't need to do that. It was just coming out of this.
Yeah,
good. I tried that with one of your reporters, and they looked at me like, what does that mean? I'm not the biggest soccer fan either, but I know what that is. So that's the issue, is that timing was horrible. They could have gotten the exact same place by just saying they're going to do this without doing it right away, waiting for the tax cut, waiting for the Fed to figure out inflation's coming down. So it was just at the absolute wrong moment. Also, it wasn't earnings season. We think earnings season will calm people down, maybe not get the market to skyrocket. But when you hear from companies, their stocks tend to rally, because then you get certainty, even if it's not great, like Delta's guidance was highly, was bad actually, and the stock, this is before the announcement, skyrocketed. So we think any news, or most news, will be viewed positively, and that earnings season will stabilize it. So all this tariff news came at the absolute terrible time during a normally weak March. So now, not that we're super bulled up about the market, but we think it'll stabilize kind of in this 5,000 to 6,000 range. It's not very stable, 5,000 to 6,000, but be banging around in that range. So we're neutral, not negative. We were negative before this policy change.
Jay Hatfield of Infrastructure Capital Management, who I think was quoting Howard Marks on the own goal analogy. Thank you very much. Now, coming up, tariff threats actually helped fuel TSMC's AI-related growth surge at the start of the year. We'll have more next. This is Bloomberg Technology.
Quick check on the US listed shares of TSMC, their ADRs. Look, they're going to be following the broader market lower at the moment, off by 4.8% after they rallied hard yesterday. But we've got to keep in mind that the company actually posted sales growth, 42%, on, of course, AI demand ahead of US tariffs. For more, let's bring in Peter Elstrom. And what's interesting is the inventory buildup is so plain to see. This is the chip provider for Apple, for NVIDIA.
Right. We don't have all the numbers from TSMC yet. All we've gotten is the revenue for this quarter. As you say, though, it's a 42% growth rate. It's very, very strong. They bumped up revenue to $25.5 billion. So you've got a $100 billion run rate company that's growing at 42%. It's pretty extraordinary. What we don't know, we'll find out next week as they report more broadly their earnings. We'll get more detail on that. We'll figure out how much of this is inventory. As you say, there's probably some stockpiling going on right here. Two of their biggest customers are Apple and Nvidia in particular. They may be accelerating some of their purchases to get ahead of some of these tariffs so that their customers don't have to pay high tariffs as they get into the next few days.
You know, the data is highly analogous with what we saw from PC shipments, right? Front-running tariffs they knew were coming. That's short-term. Long-term, TSMC has pledged billions of dollars to build chips in this country. Have we learned anything more about that in its progress?
Well, they didn't say anything at this point, but you're right. They had previously pledged to invest $65 billion. More recently, they said they're going to add another $100 billion onto that in U.S. investments. They clearly want to make chips in the U.S., partly to diversify themselves geopolitically. Partly they'll be able to serve these customers like Apple, like Nvidia, like Tesla more effectively if they're able to do it in the U.S. And they'll avoid some of those tariffs if they're going to get hit with those. Now, TSMC doesn't sell that many chips directly into the U.S., but via Apple and via Nvidia, some of their other customers, they could get hit by tariffs that go through their end products.
Bloomberg's Peter Elstrom, thank you very much. Right, next on the show, more on Apple. Really important conversation. Stay with us. This is Bloomberg Technology.
Quick look at shares of Apple falling after yesterday's massive rally. But there's also reports that it shipped about 1.5 million iPhones from India to the United States in an effort to beat President Trump's tariffs. It's according to Reuters. Ed, it's fascinating that 600 tons worth from India. Who knows what they were shipping on jumbo jets from China?
Right. I did the math. I checked the math. 600 tons, the average weight of an iPhone around 7 ounces. So with packaging, I think 1.5 million makes sense. That's short term. Long term, the only question is, can they build the iPhone outside of China and where? Here, the United States? Who knows? Let's get more on the fallout of US-China tariffs and its impact on Apple. Carolina Milanesi, president and principal analyst at Creative Strategies, joins us. I mean, in a world where the iPhone's built in America, there are many estimates. Bank of America this week said it would be 90% more expensive. That is an interesting scenario, Carolina.
Is a very interesting scenario and one that I don't think is going to happen anytime soon. I think that Apple has other options before coming to the U.S., and that's because unless we are moving part, at least, of the supply chain to the U.S., it's really unreasonable to think that Apple can be successfully building iPhones here. So what you're seeing with the shipment coming from India is that Apple has the opportunity not just to ship, but to actually rethink how and where they build iPhones that are targeting the U.S. market. So they could shift from China to India or other manufacturing facilities to avoid some of the harsher tariffs that China is faced with today. Obviously, all of this can change tomorrow or this afternoon.
What about, of course it can, but the margin pressure? How much will they suck up some of the margin pressure? How much do you think they can pass on to a pretty stressed consumer here in the US right now?
There's two aspects of it. One is to remember how strong Apple's relationship with their supplier manufacturer is. And so there might be a negotiating part there where it's not about just Apple passing on to the consumer, but is Apple trading with their supply chain to see how best everybody can ride this wave, right? At the end of the day, you want to keep the Apple business with you for the longer time. And then when it comes to consumer, I think it's a very critical moment for Apple here in the U.S. market when it comes to services and Apple Intelligence in particular. So they will want the upgrade cycle to continue. And they might decide that it's worth sacrificing some of their margins in the short term to then have more revenue coming from services and Apple Intelligence longer term.
A story's hit the terminal just now clarifying that the Trump tariffs on China now add up to 145%. You see Apple declines accelerating 5%, NASDAQ 100 pushing even lower. An airlift, though, have you ever seen that in your career? We just have 30 seconds, Carolina.
I have not. It's definitely something new, and I think it comes with the volatility that we're in right now.
Carolina Milanese there with all the expertise and the context, President and Principal Analyst at Creative Strategies. Thanks so much for joining us from Vegas. Meanwhile, coming up, more on the market reaction as we see losses accelerate. The Nasdaq is currently off by more than 4%. Nancy Tengler, the voice we go to, CEO of Laffer Tengler Investments, where she's adding. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Quick check on these markets, Ed, because we are accelerating our losses. We're sub 4% on the Nasdaq 100 after a monster rally yesterday, the biggest gain since 2008. We fade some of that. Is it profit taking? Is it once again trying to understand what Chinese tariffs that now are to the tune of 145%, what that means to the overall risk sentiment? We're off by 4% on Bitcoin, but hold above 80,000. Move on to the individual movers that I want to shine a light on, because look, JD.com up more than 3.75% in terms of ADRs traded here in the United States. China looking to improve stimulus locally. That means e-commerce players that are domestic related and focused are going to be doing well. But we are fading our rally in Alibaba. We're fading, of course, even more on Apple. Best rally since 1998 yesterday. We're now off by more than 5% as those tariffs to China impact that company. Amazon off by almost 5%. Andy Jassy looking strong into his investor and shareholder note. But more broadly, we're worried about exposure there as well. Ed, what have you got?
Well, let's get back to the tariff story. President Trump's tariff on Chinese imports now total at least 145%. Bloomberg's Kaylee Lyons, who leads our political coverage for us in D.C., is actually going to come and do some math for me because I've lost track on whether this includes reciprocals, it doesn't, and how we got to 145%. Kaylee.
Yeah, Ed, this really is about math and how these tariffs layer on top of each other, as there are different tariff regimes that China is subject to. As President Trump made clear yesterday in his post on Truth Social, he has raised the reciprocal tariff rate on China to now 125%. That, of course, has been escalated multiple times due to China's retaliation. But that did not include the 20% tariff that he had already put into place on Chinese goods earlier this year over the trade of fentanyl. So it's about adding that 125 to that 20% that was already existing, which gets us to the total rate of 145%. Now, this was actually all there in the White House's fine print, but obviously, it's difficult to understand with this fast-moving story how all of these tariffs work in tandem together. But it does seem that this is a figure that was higher, at least, than the market previously understood it to be, which is why we are seeing things take a turn. And this comes despite the fact that President Trump in the Oval Office yesterday said that he couldn't imagine taking tariffs on China any further than he already had. But maybe perhaps this is further than was previously understood, keeping in mind that China has still an 84% retaliatory rate on U.S. goods. It remains to be seen whether or not they will escalate that further and whether or not they are willing to pick up the phone and talk to Donald Trump, as he has suggested he is willing to talk to Xi Jinping, wants to make a deal, thinks China wants to make a deal. But we have seen no sign of that yet, as this trade war between the two largest economies only seems to be intensified.
Bloomberg's Kaylee Lyons, out of D.C., chief mathematics correspondent. Appreciate it. Thank you very much. Let's get back to the market's reaction to tariffs, specifically the pause on tariffs. Like yesterday afternoon, crazy. Bloomberg's Ryan Fostelika, who covers the tech sector, joins us. Apple, I think, biggest jump since 1998. Tesla, biggest jump since 2013.
Control and monitoring technology with Vodafone Business IoT enables life-saving medicine to be delivered safely around the world.
Having a secure infrastructure that you can reliably use globally is a key ingredient for our success.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The tariff roller coaster rolls on. The dollar extends losses after its biggest plunge in 3 years, with treasuries and stocks under pressure as uncertainty hits US assets. President Trump acknowledges tariffs may cause transition problems, but says, quote, "We're in very good shape." Plus, Spain's Prime Minister visiting Beijing today, calling for solid and balanced relations with the European Union. This as China's president reportedly plans to host top EU leaders in July. Good morning. Happy Friday. From Liberation Day to Liquidation Day, investors dumping US assets, equities, treasuries, the dollar, all dropping in unison. Yes, futures stateside are putting a little higher today after the losses of between 3.5% and 4% on equities. But again, the focus on the bond markets, the focus on the dollar, and the moves around the currency space have been extreme. European futures, let's start there before we unpack what's been happening in terms of FX and fixed income. European futures pointing higher by 0.4%. You had gains by the end of the close yesterday. They were faded, but still ended up about 3.5%. Let's see if we can build on that today, given all of the uncertainty and the fact that the euro is now jumping to the highest level versus the US dollar in about 3 years. FTSE 100 futures focus on commodities. The squeeze is there, apart from gold, which is benefiting as a safe haven. FTSE 100 futures pointing higher by 0.3%. Stateside, S&P E-minis then, after the losses of yesterday, just flat, essentially, pointing to very modest gains of 0.1%. We'll see how that adjusts through the session. Nasdaq 100 futures now in negative territory by the skin of their teeth. Let's flip the board and have a look cross asset then. The 30-year stateside has seen yields up 40 basis points since April the 2nd. The 30-year closing in to 5%. 489 right now. Speculation in the markets about foreign selling. We'll see if there's any evidence of that. Euro dollar at 113. That's the highest level versus the US dollar in 3 years. The single currency is surging 0.9%. The Swissy bid yesterday, the biggest surge in a decade for the Swiss currency. It rallied more than 4% versus the US dollar, currently at 0.81 and gaining again in the session 0.6%. Gold is a clear safe haven as assets are relocated out of the US and liquidated. 3,209 right now on the yellow metal, close to fresh record highs, up more than 1% so far in the session. Let's cross over right now to Asia. The Nikkei is in focus. Yen strength with that currency also bid. Aira Hong standing by in Singapore to break things down for us.
Yeah, Tom, Asia equities and currencies have been on quite a ride this week, given the back and forth on tariff headlines. Today, we're seeing Japanese stocks, the underperformers, because of these concerns with the US and China, the two biggest economies going head to head, not backing down. What is this going to mean for the global economy, especially the export-reliant economy of Japan? And given the yen strength, the rally that we're seeing, that's the pressure you're seeing on Japanese stocks. But the region's benchmark is still headed for weekly declines on a day where Chinese equities actually not faring that badly. They are holding up remarkably well, all things considered. We had the White House clarifying that these tariffs on China, 145%. The performance you're seeing here, partly to do with this idea, I think, that given the trade ructions, the back and forth, ultimately the biggest losers are the dent in investor confidence for U.S. assets. So maybe China not doing as badly. The idea of policy support as well. Flip the board. Take a look at the Chinese tech stocks. The Hang Seng Tech is on its 4th day of gains. So continued recovery. And today is being helped by a jump in chip stocks. But word of caution, we are still really far away from the peak in March. And analysts have also pointed out that it's still this risk of tit-for-tat retaliatory action. And we're hearing these murmurings, right, that for Chinese stocks, you could experience forced delistings on U.S. exchanges. So those are key risks that investors are still keeping close watch on. Flip the board, take a look at the currencies as well, because today we've been watching very closely the PBOC's messaging. Given the dollar slump, there were expectations that we would see a fix that was 400 pips stronger than the day ago, but it was only slightly stronger by about 5 pips. And the messaging, MLive's Mark Cranfield says here, is that despite despite whatever is happening in the wider world, the messaging from the PBOC is that they want to guide quietly the depreciation of the Chinese currency. Tom.
Yeah, looking to avoid that disorderly unwind for the Chinese currency, even as they use it, arguably, as something of a pressure valve, given the tariffs, of course, on Chinese exports. Ava Hong in Singapore with a market check. Thank you. President Donald Trump, meanwhile, saying that his tariffs may cause transition problems. He's conceded that, but he has expressed confidence in his plan after the White House clarified that US tariffs on China have risen to an eye-watering 145%, just in term 2 of President Trump, by the way. The staggering import taxes on the world's second largest economy have triggered a tit-for-tat trade war, unnerving, of course, global financial markets. Trump says he would like to make a deal with Beijing.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
Let's get more and bring in Bloomberg China correspondent Min Min Lo. Min Min, the key question then, we keep hearing from Trump that he wants to get a deal, he wants to have that phone call from Xi Jinping and the team. What are we hearing from China? How willing, how close are they to picking up that phone, to making some moves, to getting a deal done?
Yeah, so President Trump has said that he is waiting for Beijing to make that call. Meanwhile, the Chinese Commerce Ministry has said that they are open to having dialogue as an equal partner. But if the U.S. is not ready for that, they're going to fight till the end. So it looks like both sides are waiting for the other party to extend the olive branch to make the first move to create that opening for dialogue. And I just don't know when that is going to happen. But for now, though, China has responded by retaliating with restricting the number of imports of U.S. films, which is an interesting move. First of all, it is a high-profile move with very little downside for China. It could mean that these Hollywood films could lose maybe about 10 to 15 or 25% of their global revenue. And the wording there from the Chinese Commerce Ministry is that they are going to moderately reduce it. So some analysts say maybe China will still import the big blockbuster films to whet the appetite of Chinese consumers, something they desperately need to do now, and just restrict the smaller films. But of course, this is also a signal that China may be widening the scope of the trade war beyond tariffs to the services sector, because that is where U.S. has a trade surplus with China. It's in the services sector, things like transportation, IP royalties, travel, for example. We are also seeing it expanding to the financial services sector, given that some of China's retaliation has been announced just ahead of U.S. futures trading hours. And now there are speculations that maybe Trump could consider delisting Chinese companies from U.S. exchanges as well. And if China feels that the tariffs are so prohibitively high that further tariffs are just not going to make any marginal impact, we could see this economic war really expanding to different fronts.
And we're seeing at the same time, of course, amidst this economic war between the world's two largest economies, attempts by other nations to repair or at least build out trade ties outside, beyond, to offset what is happening with the US. And we've got the Spanish Prime Minister in Beijing today, and he has already attracted a lot of Chinese investment into that country, at least the Spanish government has, and he has been calling then, alongside China, for close relations. The Spanish Prime Minister calling for close relations between Brussels and Beijing. What do we know about the importance of this visit and what it tells us about whether or not the EU and China will move closer?
Yeah, we got the introductory remarks earlier just in the last hour. So President Xi telling Sanchez that the world is seeing changes unseen in a century and calling for cooperation to stabilize the global economy. And Sanchez is making this trip to China in defiance of threats from the U.S., from Scott Bessent, saying that any tilt from the EU towards China is equivalent to cutting your own throat. And still, Spain is going ahead, saying that while they want negotiated solutions with the U.S., they are still still not just going to carry on trade with China, but increase trade as well. As you said, Spain has been rewarded before. The last trip from Prime Minister Sanchez to China, it has attracted a lot of Chinese investments in the field of renewable energy, a battery plant, the EV sector. We could see more new deals as well on this trip. And this comes as we had seen increased dialogue between the EU and China this week. 2 calls being made, one between Premier Li Qiang and Ursula von der Leyen, as well as another video call between the trade representatives from both sides that yielded some significant results. We had a readout from Xinhua saying both sides are looking to immediately start negotiations on price commitments on EVs, which could hint at possibly the EU considering to lower tariffs on Chinese EVs. We already see Chinese EV stocks bouncing today on the back of this expectation, and certainly is an outreach by China as well to intensify these trade talks with other countries. China said to be hosting some of these European leaders in July, according to SEMP.
Yep, the South China Morning Post reporting on that potential meeting between EU leaders and officials and leadership, of course, in Beijing. Thank you, China correspondent, of course, Min Lo, joining us with the latest as Spain's Prime Minister continues his visit to Beijing. Now, President Trump's flip-flopping has sparked massive swings across the markets, of course, from record losses in US stocks to routes in debt, FX and commodities. Bridgewater Associates founder Ray Dalio told us that Trump's dramatic shifts on tariffs are having an impact on America's reputation as a trading partner.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Well, let's bring in Bloomberg's Valerie Teitel for the market reaction and analysis. Valerie, to what extent are investors questioning now the credibility of the U.S.?
Look, yesterday's session, especially when it comes to FX and rates, I think was unprecedented, Tom. We saw a huge flight out of the U.S. dollar into other safe havens, one of those being the Swissy. Dollar Swiss saw one of its biggest moves since the Swiss depegged in 2015. A 4% move into the Swiss franc is really starting to pose some questions. Are we fleeing U.S. assets and possibly repatriating them into other currencies? The Swiss was a big mover. Yen was a big mover as well. But take a look. This move is continuing to extend, Tom. The euro up nearly 1% so far in the overnight session as we begin to question whether the dollar is acting as a safe haven and if this is possibly permanent damage to the dollar as a safe haven assets. I want to show you one chart which I thought very surprising is that normally in the past when we see huge bouts of volatility in the FX market, when we see the VIX spiking, it normally goes hand in hand with a surge for dollar assets. We have definitely not seen that in the last week. If anything, we've seen the exact opposite.
We're seeing a breakdown of some of the fundamental assumptions underpinning global finance, and we'll see to what extent that becomes crystallized. What a week it's been, Valerie. We'll take a beat and just kind of take a breath. And you've been front and centre on driving our focus, again, around the routes in the debt market and what that could portend. Just as you wrap up what we've seen this week in terms of the size, the scale, the historical context, talk us through where we've landed.
Look, historical swings in all markets, Tom. I want to say that if you're looking at the equity market, you're missing the main point. The equity market was actually up on the week, Tom. The S&P 500 had its best week since Election Day, but that is completely missing the point. You flip on, take a look at this next chart. We're seeing a flee from dollar assets when it comes to the dollar and treasury yields delinking. This is normally something that is only seen in emerging market economies, not an economy that is known as the safe haven status that is known as the world's reserve currency, that we see treasury yields rising alongside a huge crash in the dollar. This is posing big questions over whether Trump's trade policy is perhaps going to put this safe haven reserve currency status in peril. And with that, the big structural demand for treasuries, many people scratching their heads this morning, thinking that if the U.S.-China trade relationship comes to a standstill, so does China's recycling of those dollars into the treasury market. And does that perhaps put the U.S. deficit on an unsustainable path?
Major questions that need answers, and those answers may not come quickly. 490 right now on the US 30. At Bloomberg's Valerie Teitel. Thank you. Here's what else to be thinking about today then. 7 a.m. UK time, German inflation data, CPI dropping. We'll break that for you. 1:30 p.m. UK time, we're going to get US producer prices after CPI yesterday came in with a more benign print than some had expected. Producer prices then rounding out the picture in terms of some of the pricing pressures that we may be seeing in the US, or to what extent that may be fading. Of course, much of this coming in, the data, before factoring in the additional tariffs. And today, US bank earnings kick off. We're going to give you a preview of those earnings as well later in the show. Still ahead, EU finance ministers set to meet in Poland to discuss Europe's response to tariffs and the key issue of defence funding. We bring you the details of that meeting. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, EU finance ministers will meet in Poland today to discuss the latest on tariffs and the European response, as well as financing European defence. Speaking at a White House cabinet meeting, President Trump said he views the EU as one bloc for trade negotiation purposes.
They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China. And they said, you know, we're going to hold back a little bit. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States.
OK, just for the record, that is not why the EU was formed. But let's bring in Bloomberg's Oliver Cook right now. He stands by for us in Warsaw. It does seem that the tone from President Trump, at least in that clip, suggests that he has, at least on some levels, Ollie, moderated his view on the EU, something of a reprieve. They are not being hit by these 20% tariffs at this point. How has all this been digested in Brussels?
Yeah, Tom, I mean, he may be a bit humbled by the bond market and the moves that we've been seeing in the currency market and across the world over the last couple of days, and maybe taking a slightly less aggressive tone when it comes to taking on all of his trading partners, particularly the EU, the biggest trading relationship between the U.S. and the EU in the world. For finance ministers that are gathered here in Warsaw who have a huge docket to deal with, and when you think about the number of issues, the multifaceted issues that emanate from this trade question that has been set off over the last week, I think you can break it up into basically three categories. The first is negotiation, retaliation. What are they willing to put on the table to bring to the Trump administration? They talk about non-tariff barriers. What are they able to and willing to look at there? What are they looking at in terms of the architecture, in terms of forming defense? They are not going to publish early next week, as we had been anticipated, a retaliation to the reciprocal tariffs ever since he rolled them back very slightly. But I can guarantee you they will be coming up with an architecture of how to deal that in the eventuality that this comes back to the fore. The other thing they need to do, Tom, the second thing, is to evaluate the kind of damage that the tariffs that have been imposed will do on the economy. We're dealing with 10% across the board, still 25% on the auto sector, 25% on steel and aluminum. Other finance ministers and economy ministers I have spoken to already have basically no idea the far-reaching impact is going to be. And basically also then, how do you support those markets? How do you support those different industries? To say nothing, Tom, of the impacts that we've seen on the markets. I mean, for the EU ministers, we talk about the dollar selling off, long-dated treasuries, yields rising, the equity market in the U.S. selling off. That has an effect here in Europe, where you have the euro up 3.5%, 3.3% over the last 3 days. And the Swiss franc, we'll be speaking to the Swiss president a little bit later today. The Swiss franc is up close to 5% over the last 2 days. That is the biggest move since 2011. So all of these issues have to be dealt with by finance ministers and central bankers here, who, by the way, can't speak because of the quiet period ahead of the ECB next week. But all of this has to be dealt with. Monetary policy, fiscal policy, how do they respond?
Yeah, wow. Talk about being stretched and that support for those particular industries, the auto sector that you flag, being, of course, weighed up with that support for the defence sector domestically within Europe, but also for Ukraine as well. What are you hearing when you speak to people on the ground about that conversation, Ollie?
Yeah, so Tom, listen, this is the other issue that this is initially what you would have thought about this. The only thing they had to really discuss is to figure out financing for the defense sector. We're actually at the Polish Army Museum, and this is a sort of appropriate place to have those discussions because Poland, as you know, is one of the only countries in the EU that is going to now hit 5% of their GDP spend on defense, and that was going to be one of the main issues, and of course supporting Ukraine. So I spoke to the Ukrainian Prime Minister yesterday to get an update for how things were going there, and particularly an update on that critical minerals deal in order to get continued support from the United States. Have a listen to what he had to say.
We have the first draft of agreement, first draft of proposal from the United States this week. I think not later than tomorrow. Our special technical working group will goes to the United States for technical negotiations with Treasury working group, with specialists on the technical conditions of this agreement. I think it will take next week, so we will continue these consultations and we're looking for the best solution. So there are some important principles which are important for Ukraine. So this agreement can't hurt our European aspirations and can't hurt our association agreement with European Union. So this is number one red line which we communicate to all of our partners. It's important. So other issues are connected with Ukrainian constitutions, with international legislation. In the end of the day, it will be international agreement which should be ratified in parliaments of our countries. So I think it will take some time, but we are very intensively cooperate with the United States, and I will repeat, our technical specialists, our lawyers will go to United States for very concrete negotiations in person.
Okay, great. And then another question about the sort of military aid coming from the United States. You're still benefiting from aid that was given by the Biden administration. I'd like to get a sense of how much of that aid is left and at what point you're going to have to come back to the United States and talk about another deal.
So you're right. Now we have some support from United States. This support is going to Ukraine according to existing agreements. So we now have negotiations about next steps, but it's still on its way. So there is no additional information for the last weeks and days. But we understand that we have much closer cooperation with European Union, with European Commission. Now we have negotiated about additional financial resources for 2 million big caliber rounds for artillery. We also negotiate about additional supplying and additional production by our joint venture military equipment and ammunition to support Ukraine. So it arises our mutual production and supplying everything what Ukrainian defense forces needs today on the battlefield.
Ukraine's Prime Minister speaking to Oliver Crook, who is on the ground for us in Warsaw. Ollie, thank you for the update and bringing us that conversation as well with the Prime Minister of Ukraine. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. The tariff rollercoaster rolls on. The dollar extends losses after its biggest plunge in 3 years, with treasuries and stocks under pressure as uncertainty hits US assets. President Trump acknowledges tariffs may cause transition problems, but says, quote, "We're in very good shape." Plus, Spain's Prime Minister visiting Beijing today, calling for solid and balanced relations with the European Union. This as China's president reportedly plans to host top EU leaders in July. Good morning. Happy Friday. From Liberation Day to Liquidation Day, investors dumping US assets, equities, treasuries, the dollar, all dropping in unison. Yes, futures stateside are putting a little higher today after the losses of between 3.5% and 4% on equities. But again, the focus on the bond markets, the focus on the dollar, and the moves around the currency space have been extreme. European futures, let's start there before we unpack what's been happening in terms of FX and fixed income. European futures pointing higher by 0.4%. You had gains by the end of the close yesterday. They were faded, but still ended up about 3.5%. Let's see if we can build on that today, given all of the uncertainty and the fact that the euro is now jumping to the highest level versus the US dollar in about 3 years. FTSE 100 futures focus on commodities. The squeeze is there, apart from gold, which is benefiting as a safe haven. FTSE 100 futures pointing higher by 0.3%. Stateside, S&P E-minis then, after the losses of yesterday, just flat, essentially, pointing to very modest gains of 0.1%. We'll see how that adjusts through the session. Nasdaq 100 futures now in negative territory by the skin of their teeth. Let's flip the board and have a look cross-asset then. The 30-year stateside has seen yields up 40 basis points since April the 2nd. The 30-year closing in to 5%. 489 right now. Speculation in the markets about foreign selling. We'll see if there's any evidence of that. Euro dollar at 113. That's the highest level versus the US dollar in 3 years. The single currency is surging 0.9%. The Swissy bid yesterday, the biggest surge in a decade for the Swiss currency. It rallied more than 4% versus the US dollar, currently at 0.81 and gaining again in the session 0.6%. Gold is a clear safe haven as assets are relocated out of the US and liquidated. 3,209 right now on the yellow metal, close to fresh record highs, up more than 1% so far in the session. Let's cross over right now to Asia. The Nikkei is in focus, yen strength with that currency also bid. Abraham Hong standing by in Singapore to break things down for us.
Yeah, Tom, Asia equities and currencies have been on quite a ride this week, given the back and forth on tariff headlines. Today, we're seeing Japanese stocks, the underperformers, because of these concerns with the US and China, the two biggest economies going head to head, not backing down. What is this going to mean for the global economy, especially the export-reliant economy of Japan? And given the yen strength, the rally that we're seeing, that's the pressure you're seeing on Japanese stocks. But the region's benchmark is still headed for weekly declines on a day where Chinese equity is actually not faring that badly. They are holding up remarkably well, all things considered. We had the White House clarifying that these tariffs on China, 145%. The performance you're seeing here, partly to do with this idea, I think, that given the trade ructions, the back and forth, ultimately the biggest losers are the dent in investor confidence for U.S. assets. So maybe China not doing as badly. The idea of policy support as well. Flip the board. Take a look at the Chinese tech stocks. The Hang Seng Tech is on its 4th day of gains. So continued recovery. And today is being helped by a jump in chip stocks. But word of caution, we are still really far away from the peak in March. And analysts have also pointed out that it's still this risk of tit-for-tat retaliatory action. And we're hearing these murmurings, right, that for Chinese stocks, you could experience forced delistings on U.S. exchanges. So those are key risks that investors are still keeping close watch on. Flip the board, take a look at the currencies as well, because today we've been watching very closely the PBOC's messaging. Given the dollar slump, there were expectations that we would see a fix that was 400 pips stronger than the day ago, but it was only slightly stronger by about 5 pips. And the messaging, MLive's Mark Cranfield says here, is that despite whatever is happening in the wider world, the messaging from the PBOC is that they want to guide quietly the depreciation of the Chinese currency. Tom.
Yeah, looking to avoid that disorderly unwind for the Chinese currency, even as they use it, arguably, as something of a pressure valve, given the tariffs, of course, on Chinese exports. Abraham in Singapore with a market check. Thank you. President Donald Trump, meanwhile, saying that his tariffs may cause transition problems. He's conceded that, but he has expressed confidence in his plan after the White House clarified that US tariffs on China have risen to an eye-watering 145%, just in term 2 of President Trump, by the way. The staggering import taxes on the world's second largest economy have triggered a tit-for-tat trade war, unnerving, of course, global financial markets. Trump says he would like to make a deal with Beijing.
Well, we'll see what happens with China. We would love to be able to work a deal They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
Let's get more and bring in Bloomberg China correspondent Min Min Lo. Min Min, the key question then, we keep hearing from Trump that he wants to get a deal, he wants to have that phone call from Xi Jinping and the team. What are we hearing from China? How willing, how close are they to picking up that phone, to making some moves, to getting a deal done?
Yeah, so President Trump has said that he is waiting for Beijing to make that call. Meanwhile, the Chinese Commerce Ministry has said that they are open to having dialogue as an equal partner. But if the U.S. is not ready for that, they're going to fight till the end. So it looks like both sides are waiting for the other party to extend the olive branch to make the first move to create that opening for dialogue. And I just don't know when that is going to happen. But for now, though, China has responded by retaliating with restricting the number of imports of U.S. films, which is an interesting move. First of all, it is a high-profile move with very little downside for China. It could mean that these Hollywood films could lose maybe about 10 to 15 or 25% of their global revenue. And the wording there from the Chinese Commerce Ministry is that they are going to moderately reduce it. So some analysts say maybe China will still import the big blockbuster films to whet the appetite of Chinese consumers, something they desperately need to do now, and just restrict the smaller films. But of course, this is also a signal that China may be widening the scope of the trade war beyond tariffs to the services sector, because that is where U.S. has a trade surplus with China. It's in the services sector, things like transportation, IP royalties, travel, for example. We are also seeing it expanding to the financial services sector, given that some of China's retaliation has been announced just ahead of U.S. futures trading hours. And now there are speculations that maybe Trump could consider delisting Chinese companies from U.S. exchanges as well. And if China feels that the tariffs are so prohibitively high that further tariffs are just not going to make any marginal impact, we could see this economic war really expanding to different fronts.
And we're seeing at the same time, of course, amidst this economic war between the world's two largest economies, attempts by other nations to repair or at least build out trade ties outside, beyond, to offset what is happening with the US. And we've got the Spanish Prime Minister in Beijing today, and he has already attracted a lot of Chinese investment into that country, at least the Spanish government has, and he has been calling then, alongside China, for close relations. The Spanish Prime Minister calling for close relations between Brussels and Beijing. What do we know about the importance of this visit and what it tells us about whether or not the EU and China will move closer?
Yeah, we got the introductory remarks earlier just in the last hour. So President Xi telling Sanchez that the world is seeing changes unseen in a century and calling for cooperation to stabilize the global economy. And Sanchez is making this trip to China in defiance of threats from the U.S., from Scott Bessent, saying that any tilt from the EU towards China is equivalent to cutting your own throat. And still, Spain is going ahead, saying that while they want negotiated solutions with the U.S., they are still not just going to carry on trade with China, but increase trade as well. As you said, Spain has been rewarded before. The last trip from Prime Minister Sanchez to China, it has attracted a lot of Chinese investments in the field of renewable energy, a battery plant, the EV sector. We could see more new deals as well on this trip. And this comes as we had seen increased dialogue between the EU and China this week. Two calls being made, one between Premier Li Qiang and Ursula von der Leyen, as well as another video call between the trade representatives from both sides that yielded some significant results. We had a readout from Xinhua saying both sides are looking to immediately start negotiations on price commitments on EVs, which could hint at perhaps, possibly the EU considering to lower tariffs on Chinese EVs. We already see Chinese EV stocks bouncing today on the back of this expectation, and certainly is an outreach by China as well to intensify these trade talks with other countries. China said to be hosting some of these European leaders in July, according to SEMP.
Yeah, the South China Morning Post reporting on that potential meeting between EU leaders and officials and leadership, of course, in Beijing. Thank you, China correspondent, of course, Min Min Lo, joining us with the latest as Spain's Prime Minister continues his visit to Beijing. Now, President Trump's flip-flopping has sparked massive swings across the markets, of course, from record losses in US stocks to routes in debt FX and commodities. Bridgewater Associates founder Ray Dalio told us that Trump's dramatic shifts on tariffs are having an impact on America's reputation as a trading partner.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Well, let's bring in Bloomberg's Valerie Teitel for the market reaction and analysis. Valerie, to what extent are investors questioning now the credibility of the U.S.?
Look, yesterday's session, especially when it comes to FX and rates, I think was unprecedented, Tom. We saw a huge flight out of the U.S. dollar into other safe havens, one of those being the Swissy. Dollar Swiss saw one of its biggest moves since the Swiss depegged in 2015. A 4% move into the Swiss franc is really starting to pose some questions. Are we fleeing U.S. assets and possibly repatriating them into other currencies? The Swiss was a big mover. Yen was a big mover as well. But take a look. This move is not. This move is continuing to extend, Tom. The euro up nearly 1% so far in the overnight session as we begin to question whether the dollar is acting as a safe haven and if this is possibly permanent damage to the dollar as a safe haven assets. I want to show you one chart which I thought very surprising is that normally in the past when we see huge bouts of volatility in the FX market, when we see the VIX spiking, it normally goes hand in hand with a surge for dollar assets. We have definitely not seen that in the last week. If anything, we've seen the exact opposite.
We're seeing a breakdown of some of the fundamental assumptions underpinning global finance, and we'll see to what extent that becomes crystallized. What a week it's been, Valerie. We'll take a beat and just kind of take a breath. And you've been front and center on driving our focus, again, around the routes in the debt market and what that could portend. Just as you wrap up what we've seen this week in terms of the size, the scale, the historical context, talk us through where we've landed.
Look, historical swings in all markets, Tom. I want to say that if you're looking at the equity market, you're missing the main point. The equity market was actually up on the week, Tom. The S&P 500 had its best week since Election Day, but that is completely missing the point. You flip on, take a look at this next chart. We're seeing a flee from dollar assets when it comes to the dollar and treasury yields delinking. This is normally something that is only seen in emerging market economies, not an economy that is known as the safe haven status that is known as the world's reserve currency, that we see treasury yields rising alongside a huge crash in the dollar. This is posing big questions over whether Trump's trade policy is perhaps going to put this safe haven reserve currency status in peril. And with that, the big structural demand for treasuries, many people scratching their heads this morning, thinking that if the U.S.-China trade relationship comes to a standstill, so does China's recycling of those dollars into the treasury market. And does that perhaps put the U.S. deficit on an unsustainable path?
Major questions that need answers, and those answers may not come quickly. 490 right now on the US 30-year. Bloomberg's Valerie Teitel. Thank you. Here's what else to be thinking about today then. 7 a.m. UK time, German inflation data, CPI dropping. We'll break that for you. 1:30 p.m. UK time, we're going to get US producer prices after CPI yesterday came in with a more benign print than some had expected. Producer prices then rounding out the picture in terms of some of the pricing pressures that we may be seeing in the US, or to what extent that may be fading. Of course, much of this coming in, the data, before factoring in the additional tariffs. And today, US bank earnings kick off. We're going to give you a preview of those earnings as well later in the show. Still ahead, EU finance ministers set to meet in Poland to discuss Europe's response to tariffs and the key issue of defence funding. We bring you the details of that meeting. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, EU finance ministers will meet in Poland today to discuss the latest on tariffs and the European response, as well as financing European defence. Speaking at a White House cabinet meeting, President Trump said he views the EU as one bloc for trade negotiation purposes.
Guys, ये क्रूड ऑयल में थोड़ा सा रिस्की ट्रेड था, लो क्वांटिटी में ही लिया हुआ है. प्रॉफिट चाहो तो बुक भी कर सकते हो इन क्रूड ऑयल, ठीक है, या फिर एटलीस्ट एसएल कॉस्ट पर रख लो, इसमें रिस्क मत लेना आप. ओके, पुट यूर एसएल ऑन कॉस्ट। थोड़ा सा और रह गया, अगर आ जाता है ऊपर को। थोड़ा सा रिस्की ट्रेड है, इसलिए रिस्क नहीं मैं बोल रहा हूँ, नहीं तो खाली में रिस्क ज़्यादा हो जाएगा। बाकी इंपॉर्टेंट रहेगा ये लेवल, यहाँ पर एक छोटा सा एफईजी है, अगर देख पा रहे होगे। ठीक है, करंट एरिया पे यहाँ पर एक छोटा सा एफईजी बना रखा है मार्केट ने। इसके ऊपर निकलता है तो एग्जैक्टली टारगेट पे पहुँच जाएगा। ठीक है, थोड़ा कम क्वांटिटी में लिया था, लेकिन रिस्क रिवॉर्ड बड़ा था। रिस्क देखोगे लगभग 25 पॉइंट का, टारगेट लगभग 120 पॉइंट का है, तो ठीक ही है। लाइक थोड़ा सा रिस्की है तो क्वांटिटी कम रख ली है, नथिंग एल्स। नाउ लेट्स सी, ये थोड़ा सा ऊपर और निकले अगर, एंड वहाँ से फिर बाइंग एक्टिवेट, सॉरी सेलिंग होती है एक्टिवेट, तो देखते हैं, क्योंकि ये इम्पोर्टेंट ट्रिगर पॉइंट रहने वाला है लेवल। क्या ये एफईजी मार्केट होल्ड करेगा क्रूड ऑयल में या फिर नहीं? ठीक है, तो अब ये थोड़ा रिस्की ट्रेड था, एसएल कॉस्ट पे रख लो थोड़ा सा। बाकी ओवरऑल देखोगे तो लगभग 80 पॉइंट मिल चुके हैं। हाफ प्रॉफिट चाहो तो बुक भी कर सकते हो। थोड़ा सा टारगेट और है, आता है तो देखते हैं, नहीं आता है अगर एफईजी से रिवर्स कर गया तो फिर नीचे सपोर्ट होल्ड नहीं करने वाला, फिर गिर जाएगा यहाँ से सीधा। बाकी अभी ऑलरेडी 340 हो चुका है लंदन सेशन ओपनिंग के बाद। अब न्यूयॉर्क सेशन ओपनिंग की बारी है। बाकी चाइना ने एडिशनल टैरिफ लगा दिए हैं, तो यहाँ मार्केट में भी नो वॉलेटिलिटी बहुत बढ़ सकती है। देखते हैं क्या करता है मार्केट अब इस लेवल पे। बाकी अगर निकला एफईजी के ऊपर क्रूड ऑयल, तो फिर ये मेरे अकॉर्डिंग तो जाना चाहिए ऊपर तक, यू नो। फिर प्राइस को 5400 5460 तक जाना चाहिए। बाकी अगर एफईजी यहीं पर रोक लेता है प्राइस को, तो फिर डाउन साइड पे दर्शन हो जाएंगे इजीली हमें, और फिर वहाँ पर एक बाइंग का प्लान करेंगे। अच्छा सपोर्ट रहेगा 4920 के अराउंड। दैट इज़ अ वेरी गुड एरिया फॉर फ्रेश बाइंग। इस लेवल के नीचे नेक्स्ट सपोर्ट, वो लेवल अभी भी पेंडिंग है मार्केट के पास टेस्ट के लिए, तो वहाँ आता है तो बेस्ट और अच्छा रहेगा ट्रेड करने के लिए। तो ये एफईजी डिसाइड कर देगा कि मार्केट बुलिश होने वाला है या फिर आज यहाँ से वापस बेरिसनेस मार्केट में बढ़ने वाली है। ठीक है, नीचे वाला सपोर्ट स्ट्रॉन्ग है, बट देखते हैं कि ये एफईजी करता है यहाँ से होल्ड या नहीं। इम्पॉर्टेंट लेवल है काफ़ी ज़्यादा। हाफ प्रॉफिट बुक करके ट्रेल करना, ठीक है गाइस, फिर रिपीट कर रहा हूँ क्रूड में। बाकी 2 ट्रेड बन चुके हैं, अब देखते हैं और कोई 1-2 ट्रेड और बनते हैं, तो टाइम है अभी। 5:30 के बाद शायद मोमेंटम करे। बाकी नेचुरल गैस भी सपोर्ट पर ही होल्ड करके बैठ गया, कंटिन्यूसली ओपन इक्वल टू हाई कैंडल बना रहा है, इसलिए शायद जा नहीं पा रहा है ऊपर। थोड़ा बहुत मॉर्निंग पे ही आया था मोमेंटम, उसके बाद से तो मत ही पूछो। कैंडल देखो ओपन इक्वल टू हाई बनी है, ऐसा लग रहा है ब्रेकडाउन के लिए जाएगा अब की बार। देखते हैं नीचे ब्रेक करता है या फिर ऊपर जाता है, और यहाँ पर कोई रेजिस्टेंस भी नहीं था, फिर भी रुक गया, बताओ। एक बार लिक्विडिटी लेके आता ना बेटर था। नीचे आएगा तो फिर हमारे पास ये नेचुरल गैस में यहाँ पर मिलेगा सपोर्ट आपको 289 290 के अराउंड। कैंडल का ध्यान रखना, सपोर्ट पे ओपन इक्वल टू हाई नहीं बननी चाहिए कभी भी। ओपन इक्वल टू हाई पे भी बाइंग नहीं होती, वाली प्राइस रुक जाए, इट मीन्स वो ब्रेक डाउन के लिए ही जाएगा। ये सारे सपोर्ट हैं या फिर लाइक अभी अच्छा ये सपोर्ट अभी बना नहीं है, ये वाला नीचे वाला 280 290 275। So ये तो रिटेस्ट तक कर दिया इसने ऑलरेडी। यहाँ से अगर ना रिजेक्शन लेके गिरे क्रूड भी अच्छा लाइक इस तरीके से, नहीं तो फिर ऊपर के पूरे स्पेस खाली है, ये तो है नहीं रेजिस्टेंस अब। नेचुरल गैस डेड हो गया एकदम। सही कह रहे हो, आएगा आएगा 5:30 के बाद आएगा मूव, डोंट वरी। और डेटा भी है आज 6 PM पे पीपीआई का, ठीक है ध्यान रखना, और कंज्यूमर सेंटीमेंट का इंपॉर्टेंट है। एक्चुअली यूएस और चाइना के बीच में जो चल रहा है ना, उसकी वजह से मार्केट भी खुद पता नहीं है कि जाए कहाँ, ऊपर जाए नीचे जाए। एक टैरिफ लगा रहा है ऊपर जा रहा है, दूसरा टैरिफ लगा रहा है नीचे आ जा रहा है प्राइस। सो इट इज़ वेरी नहीं, अभी सेलिंग का कोई प्लान नहीं है क्रूड में, बनेगा तो देखेंगे। सेटअप बनना चाहिए, देखो सेटअप बनेगा तभी ट्रेड बनता है, नहीं बनता है सेटअप तो फिर ऐसे रैंडमली बाय सेल नहीं कर सकते। प्रॉफिट बुक करके ट्रेल करना क्रूड में, ठीक है थोड़ा सा रह गया, टारगेट मिल जाता है तो अच्छी बात है। 120 पॉइंट का टारगेट है, 120 टू 130 का टारगेट है। बाकी देखो मैं तो कर रहा हूँ कि एक्सपेक्ट यहाँ पर एक सेलिंग का ट्रेड अगर बन जाता है ना क्रूड में तो बेटर ही रहेगा, अगर एक सेटअप बनता है। नहीं बनता है तो बात अलग है, अगर बनता है तो फिर सेलिंग में भी बड़ा टारगेट मिल सकता है उसके इसमें। बाकी अगर ये ऊपर ही जाता गया तो फिर ऊपर ऐसे कोई डायरेक्टली अभी फ़िलहाल के लिए रेजिस्टेंस है नहीं, काफ़ी दूर ही बने हुए हैं, फिर तो वो बहुत बड़े टारगेट हो जाएंगे 200-300 पॉइंट के।
The Asia-Middle East corridor is booming and is expected to grow to about 1.7 trillion by 2035 from a goods perspective. And there's multiple opportunities for investors across tech, renewables, infrastructure and services.
Economy and lots of tech companies like Grab is at the heart of it.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 of Bloomberg World Headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. We have recovered somewhat in the equity market in that we are well off the lows of the session. That's a 2-for-1. President Trump saying you have a first deal on tariffs. That's very close, and they'd love to get a deal with China. That helped to move the S&P off the lows, but we're still down 3%. It did nothing, though, when it comes to the dollar and the bond market as well. Those sell-offs continue. 10 basis point move on the 30-year yet again. We're looking at like 54 basis points over the last 5 days. And Bloomberg Dollar Index, the biggest sell-off that we've seen since 2022, Scar.
So clearly it's from U.S. exceptionalism to sell everything American. Yesterday's tariff reprieve did not last long, with U.S. stocks resuming their decline, bonds not getting much love, the dollar sliding, and corporate credit default risks rising. Now, reality is setting in that President Trump has narrowed his trade war into a high-stakes showdown with China. According to the White House, tariffs on China are now at least 145%, and Beijing shows no signs of blinking. So investors need to position for an economy that's likely to get worse before it gets better.
We might have to go through a brief recession in order to rebuild our foundation. And you say, how much longer can investors hold? Look, the market's not up and to the right, every year of every decade.
And companies are now doing the hard work of forecasting through a fog of uncertainty. CarMax following Delta and pulling its guidance, in this case, backing away from the timing of its financial goals. Others are deciding whether to absorb higher costs or raise prices, and then by how much. We're going to be speaking with Stu Leonards later in the program to hear how the grocery chain is positioning itself. Alex?
All right, taking a look at what we're about the relationship between the equity market and other asset classes here, I thought it was worth taking a look at the 30-year and the S&P. And this is a normalized chart that goes all the way back to the beginning of the year, and they relatively move somewhat in tandem. Now, the real dislocation started around Liberation Day. Let's take it back about 5 days ago, and you saw a huge move higher in the bond market as equities also drifted lower. So the question is, with this big gap between yields and the equity market, which one's going to be right? How can the equity market stay risk on in any meaningful way when the 30-year yield continues to grind higher? As I mentioned, you had a 54 basis point move in the last 5 days in the 30-year. The traditional kind of assets in the bond market shouldn't be moving like that. So how do you take on true risk positions within the S&P, Scar?
All very good questions. So let's kick things off right now with Gargi Chaudhary. She's Chief Investment and Portfolio Strategist of the Americas over at BlackRock. And Gargi, I want to start with that idea that the bond market is driving everything right now. Given the volatility that we're seeing there, how do you begin to price other assets?
Good afternoon. It's good to be here, Scarlett. So absolutely, on your point on the bond markets, obviously the auctions this week having passed, that I think there were big clearing events, especially the 30-year auction, that having gone off reasonably well as the 10-year. I think that is giving a little bit of a pause to that vicious sell-off that we'd seen. Obviously, yields are higher today as well, but only on the very long end. The front end is still a little bit more stable. So I think from here on, we have to acknowledge that there is still uncertainties ahead. And I think the market got very excited yesterday when we saw that headline come through around 1 o'clock. But we still have slowing growth. We still have companies that I think are going to either pull guidance or at least cautiously guide lower. And then lastly, we still have the most liquid market in the world, the Treasury market, behaving in manners that can be quite panicky.
Did you guys have any signals that over the last few days there were liquidity issues in the Treasury market or no?
So a couple of things that we look at, obviously, number one, how ETFs trade. And that's one where the signal's been very good. ETFs as a percentage of the total tape being over 40%, that means risk is changing hands. There is that release valve in the markets. That's good. We also look at on the run and off the run spreads. Remember back to 2020 during the COVID illiquidity crisis where all of those spreads blew up pretty wildly. I think keeping an eye on that, and then repo markets. That's really big. Understanding, making sure that there is no massive swings there. And so far, again, those signs are not pointing to massive panics or anything that should suggest that the Fed needs to step in yet.
Also, as well, what companies do and whether they proceed with their original plans. A couple of companies began tiptoeing back into the corporate bond market to raise some money. I know that Japan Tobacco, AutoZone, Diageo, among those marketing new bonds. As long as things like that keep happening, that's a good sign, isn't it?
I think that's an important sign to keep an eye on. Obviously, any kind of news that deals are getting pulled back is not a good sign, especially in times of stress. So yes, functioning in the markets is credit trading well, ETFs trading and being a large part of what the total trace volume for high yield markets are. I think those are all great signs, and we're seeing that so far.
Is the U.S., though, in some asset classes trading like an emerging market at this point?
You know, the one thing that, especially last week, when we saw that at one point saw a 72 basis point swing from the lows in 30-year yields to the highs in 30-year yields overnight, as well as at the same time the dollar sort of going down maybe slightly, it did feel a bit scary. I won't go as far as to say trading like an emerging market, but it didn't trade how you would have expected it to trade. Having said that, look, at this juncture, we're just now learning about the impacts of growth. It's still too early to say that we're absolutely going into a recession or not. I think we all have to recognize that whatever your expectations of growth were on February 19th, the peak, it is much lower than that. Now, is it recession? We don't know yet. And whether it's going to continue to trade in a panicky fashion, we think investors should be adding hedges.
Right. And Larry Fink, of course, spoke earlier this week saying that for a lot of companies, they're already feeling like they're in recession now. How does this set us up for earnings season? Because obviously everyone's going to be fixated on what company management say about what they see. And there's really no upside for being too specific in your outlook right now because there's so much that's unknown.
So a couple of things that we're noting there is, number one, to what extent, like normally we get about 20% of companies that obviously guide forward, or 43% of companies that give you full year guidance of some sort. So to what extent is that getting pulled back meaningfully? And number two, to what extent are, instead of pulling back or giving no guidance, to what extent is it moving further negative? So right now, the spread between how many companies are guiding positively versus negatively, the negative is picking up significantly. That spread is the highest it's been in a decade, which makes sense. People are saying zero earnings growth for 2025. It's still too early. So what I will be watching for, number one, what are companies saying around what they're going to do around their margin protection? Are they pulling back CapEx? We're going to be watching for those kind of headlines. Are they going to do anything about headcount adjustments? Probably still too early for that, but certainly looking out for any signals there. And lastly, what kind of future guidance for the full year 2025 they're able to provide.
That's why I was so confused when Walmart was able to reiterate their guide for 3 to 4% growth. Like, how do you know that at this point when they were in the middle of all that turmoil? You mentioned earlier about adding hedges. Where, how?
Absolutely. So a couple of things that we're thinking about. First of all, let's look at what has worked in this kind of volatility and what hasn't. Certainly, assets like gold have worked. Assets like long duration, unfortunately, have not. We have a couple of market neutral strategies that have worked really well, that are up for the year. We have global equity market neutral strategies that have done super well, especially when you look at broad equity markets. We think adding those, what we like to call diversifying diversifiers. So usually bonds were your diversifiers. Now you diversify your diversifiers with other sort of market neutral strategies, add things like gold, and then frankly, add a little bit of defense to your equity portfolio as well. So don't move to cash. We don't think this is the time for that, but maybe going towards things like US minimum volatility strategies, which again have outperformed by 1,000 basis points since the peak of the market.
All right, Gargi, hang out for 1 second. Gargi Chaudhry, Chief Investment and Portfolio Strategist at BlackRock. She's sticking with us. We do want to briefly touch on some of the company stories today, and one is U.S. Steel. That stock is down by 8% after President Trump reiterated his long-held position. He doesn't want to see the steelmaker owned by a Japanese company. Bloomberg News' Joe Doe joins us with more. Joe, can U.S. Steel survive on its own?
Yeah.
Okay, so why is the stock down?
Everybody is just paying attention to a deal. And to be clear, this market is what's happening in the broader markets is affecting U.S. Steel, right? Like last week, I was on the phone with an arb trader who you could call in any day and say, okay, what's the stock price of U.S. Steel saying right now about the probability that a deal will happen? And this particular person said, I guess it was on Wednesday, I don't know, because right now the markets are such that we're having trouble pricing the fair value of the steel market.
Ah, I see.
But putting that aside, U.S. Steel, I mean, this is like a crazy chart, right? So the President of the United States yesterday afternoon after the markets closed came out and said in so many words when he was just talking about the steel market, but decided to talk about U.S. Steel, I don't want U.S. Steel to be owned by a Japanese company or any other, which we think he was referring to other foreign companies. He came back today in the cabinet room and was asked about steel, in particular tariffs, and he said, and by the way, the tariffs are helping the steel industry, they're helping U.S. Steel, that's why U.S. Steel doesn't have to be owned. And then he threw in another comment, which was, we like Japan, we like Nippon Steel, they're a big, great company, but we think they should be an investor. We've heard that comment before. The investor comment came back in February when he said he didn't want them to be majority owned by Nippon Steel. He wanted them to be an investment. We had reporting back in February that said when the President of the United States said that, the two companies were shocked by the comment. They didn't know that was a comment that was coming. And the question the market had was, what does an investment mean? My point is, we're back at that point. What does an investment mean? We thought Monday, wow, they're going to re-review this CFIUS review, the National Security Review, going to give them 45 days, and that'll give the President of the United States the cover to say, you know what, maybe it's a good deal.
So investors want to see something happen with U.S. Steel. U.S. Steel wants to stay independent. Are there any other tie-ups, maybe domestically, that could be in the works or are being discussed?
Sorry, to be clear, U.S. Steel doesn't want to stay independent, right? U.S. Steel has said we like the deal on the table, which is the $55 all-cash deal that Nippon Steel, but it could survive on its own if it had to. What are other options? I mean, there are plenty of rumors out there, but this is the focus right now of all the biggest holders. You're trading at, I don't know what we're at right now, 45, 46?
41, 56.
41, sorry, that was a few days ago.
Right.
We're still well below that $55 a share offer, but you can ask any of the investors, they would say, give us the $55 a share and let's get out of here, and then we'll let Nippon figure out how to operate the company moving forward.
So do the tariffs actually help steel companies because they increase steel prices so much? In theory, right?
In theory, they help them in the short term.
But
in the long term, it's a lot more questionable because then you're getting into the variables of actual fundamentals in the market. Construction's being crushed, the automotive market's looking weak, and now we have these across-the-board tariffs that I think it can go without saying have affected the entire calculus behind the markets, and that hits everyone all the way down to U.S. Steel.
All right, lots of unanswerable questions here when it comes to U.S. Steel and how it moves forward. Bloomberg's Joe Do, thank you so much for recapping all the headlines there. Let's bring back in Gargi Chaudhary. She is Chief Investment Strategist and Portfolio Strategist at the Americas at BlackRock for her perspective on all of this. And Gargi, I guess one of the big things investors were looking forward to was a spate of deal making, the animal spirits unleashed with the new Trump administration. But as Joe made really clear, there's a lot of cross currents. And now with the tariff question still, unresolved, people and companies are afraid to move because they just don't know the operating environment. How much of a tailwind does that remove from the market?
Yeah, and I want to take us back to, if we can even remember, the time before April 2nd. So we think back to February and March. The markets were already selling off. We were already down 10% before Liberation Day, and that wasn't anything to do with these large reciprocal tariffs. A lot of it was just personal real disposable income slowing down. A lot of people had come into the year with the expectation of about a 1.5% GDP, and the recognition was that that number was perhaps going to be a little bit weaker. So I think now with the added pressure of higher prices, even if they are transitory, I think with the higher pressure of higher prices and goods inflation going up, I think it's just going to be a little bit more uncertain, i.e. volatile for some period of time. Now, if we see a deal come through with China, for example, if we see some headlines on taxes, for example, can we see a reprieve in the market? We obviously saw what happened yesterday when we see one positive headline. We can absolutely see that, and I think the positioning has been a little bit more cleaner today. But I think that broadly, we need to recognize that markets aren't cheap. And at the same time, yes, we've had a pullback, but at the same time, The forward is still a little bit more murky. We're not out of the woods yet, and therefore add hedges. Don't move to cash, add hedges, add some minimum volatility, add some front end for fixed income. These are great opportunities to clip some coupon, but not take a lot of duration. And we think gold has, held up pretty well. That's another good one to hold in your portfolio.
It's so true. And also, what I was struck by what Joe was saying is that it's really hard for the arb traders to value a stock because you don't know what's in it. Like, what is macro, what is micro, and what is just straight up, say, just it's over-owned or oversold or whatever. How do you guys, have you changed your models in the last 4 minutes?
One of the things that I was talking with my team about is everyone's pointing to the PE and looking at how much of it used to be trading at 20 and now we're at 18 and now it's no longer at such a premium. But we don't know what the E is. No one, looking at any of that doesn't make as much sense. So I say, again, I'll repeat, add some diversifiers to your portfolio. Remain quite nimble because there are going to be opportunities. I think this is a trading environment. I don't think we're going to see the highs that we had seen earlier in February for some time as we begin to learn how to dissect the new news on growth, on inflation, and frankly, what that means on the Fed. We haven't even discussed that, and I think that's because it's less relevant these days. Yeah. And finally, I'd say just the huge moves in the bond market themselves has led to tighter financial conditions, which also have an impact on growth. So all of that, plus the destroyed wealth effect that has taken place, I think is going to weigh in on markets for some time.
And I'm sure the Fed is happy to be out of the spotlight for a while here because they're also trying to grapple with everything that's happening right now. In light of all this, you talk about diversifying your portfolio. What are the safe havens? Because treasuries have not proven to be much of a haven the last few days.
So we've been telling investors, look, if you think that the peak of uncertainty is behind us, and if you want to start sort of buying the dip, if you will, there are pockets that can work well for you. I think there are parts of tech, again, those that are a little bit more software focused that can work for you. But we think at this moment of time, defend and diversify. Yep. So defend with things like USMV, which is U.S. minimum volatility strategies, which have a lot of staples and utilities and things that are, again, a little bit more defensive in nature. One area of the market that I think can continue to, again, defend, but yet has good earnings potential is actually healthcare. That's something that has held in okay, and we think that can, again, broadly be all right. Front end of fixed income, clip some coupon in a world where we're probably not going to see a positive number in your year-to-date return for S&P for some time. Clip some coupon, own some bank in your portfolio that's giving you that income of about 6%. And then finally, diversify with gold.
Yeah, to Gargi's point, consumer staples up 0.5% right now, Alex, and you look at a name like United Health, gaining for a third day, up 3 to 3%.
Yep, I mean, there was fundamental news for that too, right? Because of the Medicare reimbursement, but still, nonetheless. Gargi, before we let you go, we were talking about sort of companies coming to the credit market and issuing debt today, so it was open a little bit, but spreads have really started to blow out in a way that we haven't seen in the last 6 months, right? When do you get worried?
So I won't use the term blowout quite yet. Yes, they've widened, but if you look at
relative basis,
relatively from where they've been, I don't think they're at worrying levels. Yes, high yield and IG have both widened, but if you look at where they were versus the average of where they've been from GFC to now, we're significantly below levels we had seen. So blowout, no. I think if we get to 150, 200 basis points wider than here, if high yields get back to levels that we had seen, high yield spreads get back to levels that we had seen in the pandemic, so, 550-ish type levels, I think that could be something that people stop and get concerned about. But for right now, the starting fundamental point of credit is actually pretty strong. If you just look at the index, HYG, a lot more of it is BB rated than used to be about a decade ago. I think that's a good starting point. On top of that, for now, low default rates, maturity walls have been pushed out. Those are all okay signals, and there are buyers that like the all-in yield that 8% in high yield provides.
All right, we're about to start earnings season. The big banks kick things off tomorrow. What about earnings seasons could surprise us?
So I think we've all turned quite negative for all the right reasons. So I think if it's a blowout earnings seasons, I think the market will be very surprised by that. If all companies are coming in beating, I think that's going to be a surprise. I think if we're hearing nothing around profit margin squeeze, I think that could be a positive surprise, which, the market needs at this point. On a negative side, I think if we start hearing about any kind of capex pushback or any kind of positioning around headcount readjustment, I think that could be something. And then another, obviously, a big negative surprise for the markets would be if many companies just push back on giving any guidance altogether. I don't think that's a good sign.
Well, I mean, we saw that with Delta.
We saw that with a couple of companies this week. If that continues to happen, I think that becomes a little bit worrying.
I just don't know how you can possibly give guidance. This very much feels like that first quarter of the 2020 pandemic, right? Gargi, it was so great. Thank you so much for your time and for coming into the studio. Gargi Chowdhury, Chief Investment and Portfolio Strategist of the Americas over at BlackRock. So speaking of, you got the financials falling. KBW Bank Index is down by about 5%. It's not been a good couple days for the KBW Bank Index. We got JP Morgan, Morgan Stanley, and Wells Fargo reporting tomorrow. Here to discuss is David George, a senior bank analyst at Baird. Hey, David, I don't even know where to start, but let's try and dissect it this way. What would be a positive earnings result for the banks, considering it's all going to be about guidance?
Yeah, I was just going to say, Alex, good afternoon. I think the earnings are going to be, I would say, fine to good. The traditional business of banking has been fine. Loan growth has been a little slow, but would expect favorable net interest income trends and fees, particularly out of JP Morgan tomorrow, may be a little lighter from an outlook perspective. Trading, we think, is going to be pretty good, actually. So Q1 is going to be probably pretty good. Unfortunately, that's not going to give us a lot of answers. The game has kind of changed a little bit, Alex, in the last week since Liberation Day.
You think?
And there's going to be a lot of questions, obviously, around guidance. As you and your guest just were discussing, does guidance get pulled? We think there'll probably be, because 70% of the bank's P&L is net interest income, and I think you have pretty good line of sight around that. Credit and investment banking and more fee-centric businesses, I think, are a little bit more questionable at this point. So I think maybe you may see some companies consider giving a wider range of guidance based on a certain number of outcomes. But clearly, there's going to be a lot of questions. Jamie, tomorrow is going to be, I'm sure, a must-see TV, so to speak. So we're looking forward to seeing what we find out from the banks tomorrow.
Absolutely. I wonder how much of a better trading revenue picture we're going to get, because most of the volatility really happened in the last couple of days, and that's after the quarter ended. But how much of that will be reflected in the first quarter results, and how sustainable does that tend to be, of volatility-induced record trading revenue?
Yeah, it's not particularly sustainable. Volatility is a very mean reverting statistic, right? So it's unusual that you have a 50 VIX, and it typically doesn't stay like this for a long period of time. But the volatility has been not only in equities, but in rates, so fixed income rates, currencies, commodities. So there's been a lot of movement in the first quarter. So we would expect the likes of B of A and JP Morgan to benefit from that. And it wouldn't surprise me, Alex, to see JP Morgan with that excess trading strength throw a little money in the reserve just to prepare for what is clearly now a more uncertain environment.
Well, to that point, I wonder if we can distinguish between banks that are more geared towards the capital markets versus banks that are more geared towards the consumer. Because first line of defense is going to be the capital markets just seize up and nothing happens, versus, say, what happens with the consumer, what happens with loan demand, what happens to net interest income. That's going to take a little longer to filter through.
I think that's right. I think you said it very well. On the fee side of things and capital markets, as I said, trading is going to be very good. Volatility clearly in April was quite high, so I would imagine that Q2 trading should be good. But M&A, which there, as you know, post-election, there's ironically was so much optimism around M&A, and to your point, I think that activity levels have ceased in M&A, and it's very logical. It's really hard to know kind of the rules of engagement and what profit margins in certain sectors are going to look like. So we would expect that to have an impact on M&A. for the balance of this year, or at least the next 3 to 6 months. And then I think corporate loan demand is going to suffer a little bit as a result as well. Now, fortunately or unfortunately, the stocks are coming into earnings season, guys, with pretty low expectations. We stressed the bank earnings for 2026 and assumed a 300% increase in losses, and we came up with not only the banks being profitable, but they trade around 9 times that adjusted earnings number. So just to kind of give you a sense as to how low expectations are.
Yeah, high single digits there. So what are the growth areas, David, for banks? What will they want to talk about? And I bring this up because I saw that Chase, for instance, is offering 100,000 bonus points for people who sign up for its high-end Sapphire credit card.
Yeah, so in the case of Chase, they obviously, given their size, are unable to do a lot of M&A, but they really have been a leader, Scarlett, with respect to investing in the franchise, really throughout all of their major businesses, whether it's just a traditional retail bank, capital markets, asset management. They've been on the kind of leading edge as it relates to technology. So organic growth, I think, is going to be a focus for JP Morgan, but I think that's going to probably take a backseat to kind of what we're all talking about all day, all night, as it relates to the markets and the kind of the implications of that.
Yeah, totally.
I feel like we're probably in a 3 to 6 month period of just potentially, I would expect a shallow recession, and I would imagine that the commentary tomorrow about the macro is definitely going to turn a little more negative.
Silly question, David, but based on what you hear from earnings, how willing will you be to adjust your price target or your outlook, considering that things can change? Like we saw what happened yesterday, for example, with tariffs. Like what's your conviction level?
The lower the stocks go, the more conviction we have, Alex. We typically like to think about banks through on a normalized lens. And what I mean by that is, what is the normal earnings power for a bank? And that right now, banks are benefiting from abnormally low credit costs and potentially a little bit below normal net interest margin. So if you normalize everything, the banking sector is probably 7 to 8 times earnings. So it's not going to really change. A 3 to 6 month slowdown in capital markets activity isn't going to really change our outlook. Now, the credit side is, I think, a bigger wild card, and clearly there are going to be some segments of the economy, both in the corporate and the consumer sectors, that are going to have some challenges in the near term. Fortunately, the industry is very well capitalized and has got pretty significant earnings power to earn through higher credit costs, but that's going to be what we're focused on for sure.
All right, good stuff. David, really appreciate your joining us. David George is Senior Bank Analyst at Baird. And of course, we've got Wells Fargo reporting earnings tomorrow, along with JP Morgan Chase, and all eyes on the guidance that these executives are able to offer right now. Alex, we're looking at a market that is down, down, down. I mean, it really has not, we have not seen much of a relief, a sustained relief from the reprieve that President Trump gave yesterday when he put on hold most of the tariffs, except for China, which goes up to now 145%.
Yep, talking to Justin Wolfers on inflation coming up next, right after this. This is Bloomberg.
It is just about 3:30 in New York. This is the countdown to the close. I'm Scarlett Foe.
And I'm Alex Steele. Taking a look at these markets here, we're well off the lows of the session, but we're still looking at a decline of over 3%. The VIX also, again, off the lows of the session, but still high at around 44, but we are not near that 50 level that we saw earlier.
I don't know what it says about the current environment that we both looked at the markets down almost 4%. It's kind of like, oh, okay, no big deal. Not that it's no big deal, but it feels relatively modest compared to what we saw in previous days.
Yeah, Scarlett had FOMO last Thursday, and I was like, there's going to be plenty of time to get involved with all of this. What's so staggering to me, though, is the difference that we're seeing in the bond market and the FX market. You're still having the 30-year up by 12 basis points. You're still seeing that sell-off in the dollar, despite stocks off the lows of the session. It kind of begs the question, like, what's leading what?
Right. The bond market, clearly, it was what the Trump administration was looking at yesterday, right before President Trump hit pause on most of the tariffs. You mentioned the dollar right now down 1.3%. That is not a normal move in the FX market.
It's not what you usually see for the world reserve currency. Also, we saw some economic data today, of course. That was CPI coming in a little lower than estimated. But tomorrow we get PPI. So we wanted to get a read on that with Michael McKee, economics editor with Bloomberg News and Bloomberg Television, economics editor and political. Your title changes every time I read it. So I don't know what's up with that. But all right, what did we learn from CPI? What did we learn from PPI tomorrow?
We didn't learn a lot from CPI. CPI. It was good news. Absent Donald Trump and the tariffs, it would have been seen as very good news by the markets because it would suggest the Fed is making significant progress on inflation. And now it's just sort of, well, nice, but we got to worry about what happens going forward. It was down 0.1% on the headline, which was good, but that was largely because gasoline prices went down 6.3%, which was largely because people were pricing in the idea of an economic slowdown. And we had the same thing happen with airline fares and with hotel charges. They went down for basically the same reason. So there wasn't a lot of information about what's going to happen going forward in this, but we may get a little more out of PPI because you remember all the imports we got in the last 2 months of industrial supplies and things like that. We'll see if there were any price changes as companies ordered massively to try to get ahead of the tariffs. But still, it's what's going to happen in the April and May inflation areas that's going to matter really to the Fed, which is what matters to the markets.
And clearly the CPI report didn't do much for markets today. You could argue that PPI might not do much tomorrow. The data point I'm really curious about tomorrow is going to be University of Michigan, because the consumer expectations on inflation has been pretty awful the last couple of times, and that's what everyone's fixated on, where consumers see inflation headed.
Well, you know, that's one of the things the Fed is fixated on, is they don't want to see inflation expectations get unmoored, because then that feeds into future inflation. They tend to watch the shorter end, 1 to 3 years, much more than the longer end. They're not sure that the long end view that people have is going to be particularly accurate, unless it goes significantly higher for a while, and then it just shows that people are worried about inflation. But they will be watching the shorter end, and it's gone up significantly. We're like 5.1% now, and that would be a terrifying number to the Fed if it actually got there. But just the idea of it, and then we want to see what people are saying. We've said many times that what consumers say and what they do can be two different things. But we get retail sales next week, and maybe this gives us some view of what consumers are thinking.
Well, they've been, buying up all kinds of things before tariffs kick in, right? That's kind of.
I mean, that's the game theory, right? We'll see if we
all
see
the articles online are talking about what you should be buying now.
Okay, going to the Fed real quick before you let you go, Mike. We had a slew of Fed speakers over the last 48 hours. Has the tone changed? Has the focus changed? Is it more about inflation versus growth? Is it still equally distributed?
Well, it hasn't really changed over the last week, ever since Liberation Day, the so-called Liberation Day. Fed officials have been saying that we're going to see inflation from tariffs, and we are probably going to see an economic slowdown. We can't measure that yet because we don't know exactly what's going to happen, but we have to worry about both. They're a little more concerned about inflation because it's harder to deal with than a slowdown, and it will come on us faster than an economic slowdown. So their focus is a little bit more on that, but right now, their focus over the last 24 hours was how the markets were functioning, and we talked to a number of them over the last 48 hours, and they basically think the markets are volatile, but functioning fine.
All right, Michael McKee, thank you so much. Chief Correspondent on International Economics and Policy, I think, has been one of his more recent titles, right?
Yeah, we'll go with
that. Just keep moving. Just keep moving.
All right.
Call me on time for dinner. That's all that matters.
Mike McKee, thank you so much. All right, let's continue the conversation here on economics and policy and bring in Justin Wolfers, Professor of Economics and Public Policy at the University of Michigan. Justin, so good to speak with you. You heard what Mike was saying in terms of the setup here and the Fed focusing both on the inflation question and the growth question. Which are you more concerned with right now?
I mean, there's two great flavours coming right at us, courtesy of the White House. We've got fears about inflation getting reignited at exactly the same time that you might end up with the real economy slowing. So you should be scared of both. You should be worried about both. It's a very, very good time not to be Jay Powell, because you can't fix both at the same time. So,
but based on that, though, is there a possibility that tariffs, okay, different question. How long does it take tariffs and that mentality to actually filter through to the hard data like CPI and PPI?
Right. So based on past experience, you'd probably expect it to take a few quarters, but equally, we haven't had a tariff shock like this in our lifetimes. This is a tariff shock larger than Smoot-Hawley, the famous Depression era tariff. So it's very hard to get a lot of guidance from that. You know, on that point, there's actually, I think, two economic crises right now. One is tariffs, and that's driven a lot of the market action. But I think one of the reasons you saw markets respond so strongly is there's a crisis of confidence. It's a crisis of confidence in the competence of the administration. They've rolled out tariffs based on formulae that make no economic sense. They stick with a plan where, they say it's all about one thing and then they roll it all back and then say, you know what, we've been lying to you since Sunday when I already decided to change paths. Tariffs on China yesterday, we were told, are 125%, and today they're 145%. And I want you to stick with that for just a moment. You've got tariffs between two of the world's great economic powers, and people in the White House couldn't tell you the correct tariff within 20 percentage points, which would normally be the entirety of an entire trade war, and they forgot whether it was 125 or 145.
Feels like the more important thing is just that it's a high number. It's a big number. It's a wow, eye-grabbing number, and that's what they want to go with to shock Xi Jinping to the negotiating table.
Look, if you want to shock the Chinese to the negotiating table, absolutely you've done that. By the way, you could probably just pick up the phone instead. But if what investors are looking at is the competence of this administration and how much they trust this economic team, it matters a whole heck of a lot. Look, I think this is a time where if I were on the economic team, and no part of me is joking right now, I would be checking everything for spelling mistakes, literally spelling mistakes, because right now they look like Keystone Cops. They look like they're making it up as they're going along. And if that's not the case, then they want to take every opportunity they can to signal competence. Instead, they've done the opposite.
Okay, so that's your take. And then what's the filter through to the actual economy? Or, is that what you think is unfolding now through the data and through the equity market?
So we've seen equity markets move by extraordinary amounts, much more than could be based on than would make sense purely on the tariffs. So that's the sense in which I think the confidence crisis is here at the same time as the tariff crisis. Look, if you want me to back that up, I'm happy to math it out for you a little bit. We saw US equities fall by 14% after Liberation Day. Markets had already surely priced in 2/3 of what Trump's plan ended up being, which means that the true effect must be 3 times larger. 3 times 14, what's that? 42%. It seems implausible that tariffs could take 42% off the net present value of future corporate profits. It must be the case that markets were responding to something else. What is it? It was a misguided policy that the administration was happy to double down and keep doubling down on. That's the only other shock that comes to mind.
Yeah, there's a lot of question marks there. And of course, the way that this whole tariff policy has unfolded raises a lot of uncomfortable questions and raises questions about the reputation and the credibility of this administration in negotiating some of these tariffs, which it apparently is actively doing right now. Talk a little bit about how much we can then rely on what happened in the first Trump administration. I know that up until yesterday, we were saying you can't use Trump 1.0 as a template for Trump 2.0, but apparently you can because he is willing to negotiate now. The renegotiating of NAFTA into the USMCA, does that kind of serve as a template for what we can look for when it comes to tariffs for Canada and Mexico?
I think that template matters for 2 very important reasons. So Trump arrived, had a free trade agreement with Canada, said it was terrible, ripped it up, wrote a new one. That's what he did in the first term. By the way, turns up, arrives in the second term, has the same agreement he negotiated, rips it up, says he's open to creating a new one. So that says he likes ripping up agreements. So that says something about the credibility of any promises the United States makes in this round of renegotiation. Look, everyone's going to play ball with him. They're just not going to go home and believe that he's going to follow through. And if you don't believe that, then you're not going to make the appropriate investments around that, which means we're going to get the costs of tariffs, but not the benefits. Having said that, Scarlett, let me come back. I actually think what you just said is really, really smart and exactly on the money. So here's how the first administration played out. NAFTA created essentially free trade between the United States and Canada, as well as Mexico. There were a few carve-outs for politically sensitive industries, so it was essentially zero, but not precisely zero. Trump arrives, points at the few cases where tariffs aren't zero, gets very upset, rips up the agreement, starts a trade war, and then says, I'm open for negotiation. Negotiates, and then decides to basically write down the same agreement because, well, zero tariffs was pretty good 6 months ago. It's still pretty good. The politically sensitive stuff is still really hard to do. So we end up with NAFTA, they get out the pencil eraser and relabel it, give it a new name, and he struts out and calls it the art of the deal. Well, what we have is Europe and most of our other trading partners already have very, very low tariffs on average, 1 or 2%. Don't believe the numbers the White House are telling you. They're not telling you anything about average tariff rates. We essentially have free trade around most of the world. He's ripped up those agreements. In some cases, they're not agreements. They're just countries doing what they want to do. Summons them to Washington, D.C. Very quickly, he's going to discover you can't get tariffs below 0%. So if they're nearly 0%, you can't negotiate something much better. Of course, he'll negotiate something close to 0%. It's pretty much where we already are. Slap his name on it, march out to the front lawn of the White House and say, look at me, out of the deal. I got tariffs, say with Vietnam, close to 0. I just want your viewers to understand they're already close to 0. So this whole shebang can't move us very much in a positive direction because global trade is still, before this week, mostly tariff-free.
Justin, just to push on that for a second, how would then you categorize China, for example? I mean, clearly there are trade imbalances, right? Like, I mean, we've heard this from both sides of the aisle, right? So doesn't there need to be something fixed there?
Alex, there are real problems with China, but saying there's a trade imbalance is not one of them.
Why not?
That just means we buy more of their stuff than they buy of ours. That's all that says. Look, there are real issues with China. Issues like intellectual property is, I think, probably one of the most important ones. And so I said most of the world, but it's still the case that most of our trade with China, if you go back a couple of months, was at pretty close to no tariffs. There are issues with China, some of them geopolitical. Those would call for a very specific tariff response. That's not what we're seeing. You don't put a 47% tariff on Vietnam because you want to bring China to the table to talk about intellectual property. So, yes, there's a serious way forward. There's also questions of China's influence in the region. The White House recently has been saying what we need to do is get countries in the region together so that they can talk to China collectively from a position of strength. That's something that was once called the Trans-Pacific Partnership.
Yeah.
We had that agreement. He ripped it up. He's going to rediscover it. And hopefully we'll actually move forward with it this time.
All right, Justin, we'll get you back. Want to talk about break-evens, too, because they've been moving. So we'll put on your economics hat next time. All right, Justin Wolfer is professor of economics and public policy at the University of Michigan. All right, time now for top calls. A look at some of the big movers on the back of analyst recommendations. First up, Adidas getting a big upgrade from HSBC to buy from Hold. The broker says the company's market share gains could accelerate during a time where macro conditions are tough, calling the sportswear brand a beacon of hope compared to other competitors like Nike and Puma. HSBC did cut its price target at 240 euros from 260. Shares, though, still down by about 3%, Scar.
All right, I'm looking at GM, which got a downgrade at UBS to neutral from buy. The bank citing the possibility of tariffs raising prices and disrupting production, saying, quote, we see potential for a new era for U.S. autos with lower volumes and higher costs to produce. GM's price target also reduced to $51 from $64. You can see the shares down about 4.8%, and for the year, lower by about 15%, Alex.
Let's stay with autos for a moment. Ford getting a downgrade at Goldman Sachs on similar concerns, also cutting its recommendation to neutral from buy. Goldman lowering its outlook for U.S. auto sales and global production. Goldman currently has a price target now of $9 on the stock. We're trading pretty much right there. Those shares down almost 5%. And those are some of our top calls. Scarlett.
All right, let's stay with the auto sector. We're keeping an eye on CarMax. The used car retailer did report quarterly results that missed several Wall Street estimates, with management also pulling several financial target timelines on trade volatility. CarMax joins a growing list of companies indicating uncertainty around President Trump's trade war. Here with more context is Seth Basham, Managing Director of Equity Research over at Wedbush Securities. Seth has an outperform rating on the stock and a price target of $100. Looking at CarMax today, lower by about 13%, the biggest drop since September of 2022. It didn't exactly pull its guidance. It just said it's not committed to the time frame for the financial goals, right?
That's exactly right. The guidance is still in place. The company will hit those targets at some point. It just doesn't know when. So it's likely to be later than fiscal 2029, which was the high end of its prior range.
So why did the stock get dinged so much?
Yes.
Yeah, we're surprised at the extent of the decline today. I think that was one reason that investors are misinterpreting the company's ability to hit that target at any point in the future. So that's one. The second is their comparable store unit sales for the fiscal fourth quarter they reported were a little bit light of consensus forecasts. And then the third is associated with the near-term uncertainty. So it's not clear how well the used car market will do and how well CarMax will do in this very volatile macro.
But there's this narrative, certainly when the auto tariffs were being discussed, that this was going to be good news for used cars because people wouldn't be able to afford to buy new cars. So there's going to be this bustling market for used cars, and everyone was going to flock to go to a CarMax, for instance. Where did that narrative go wrong?
The narrative went wrong is that we're seeing a slowing economy at the same time. Consumer confidence is declining. So consumers' ability and willingness to buy used cars, especially late model used cars that are expensive, $30,000 plus, is not there. So we very well could see a slowdown in used car sales because of that, partially offset by the trade down from new to used.
Okay, yeah, I was going to say flip it, because you can also make an argument that like a GM and Ford are going to make more expensive cars and not make as many of them. So if I wanted to buy a cheaper car, I'm going to have to buy a used one, which in theory then could be good for CarMax. When do we get that kind of clarity?
We're going to have to get that clarity in another quarter or two. So right now, I think we're seeing strong sales of both new and used cars. There are more car shoppers out there, some who are going to buy new cars ahead of the tariffs. They get into the marketplace, still end up choosing used over new, which is positive. We expect that to continue for at least the next week or two. As we move into the summer, I think it'll be telling whether or not we see that trade down offset any economic weakness.
So the company says that it's seeing a lot of interest in used cars right now, given the expected impact of tariffs. How does CarMax really take advantage of this opportunity right now? How does it maximize this situation?
Well, it sells as many cars as it possibly can. And that means it has to acquire the vehicles, recondition them, get them ready for sale, merchandise them, et cetera. So we think their comparable store unit sales are very strong right now. They'll be able to press on that for the next couple months.
So to that point, do their input costs also rise if they have to get something up to spruce up a car, or no?
Modestly.
Or it's manageable?
Modestly.
Okay.
We're talking a very small amount, maybe $100, $200 in terms of higher part prices that they'll be experiencing. But on a $25,000 ASP, not a big deal.
Right, not like a $15,000 increase on a new car that you might have to pay.
Exactly.
Yeah.
So you have a price target of $100 on the stock that's currently at 67. What needs to happen for there to be a jump condition to get even in the neighborhood of that?
I think we need to see more consistent, strong comparable store unit sales and great flow through to the bottom line. This is a company that's invested heavily over the last 6 years in omni-channel, and it has the best experience out there for consumers shopping for used cars. So it delivers on that experience. We should see strong sales, we should see strong flow through, and we should see earnings help drive the stock to those higher levels.
What other stocks in this arena do you like?
The other used car retailer I follow is Carvana, which also has a great market, but we're more favorable on CarMax at this point in time. We also like the auto parts retailers like AutoZone.
Or O'Reilly, for instance. Okay, are there any of those that are not positioned well for this current environment?
In terms of the auto parts retailers, they're very well positioned for the macro uncertainty, and they have very good pricing power. So I would put them on the list of well positioned. In terms of the hard lines retailers that I cover, the ones that are least well positioned are names like Best Buy, who get most of their products from China, are selling to a mass market, so they don't have much pricing power of highly discretionary products they're selling.
Yeah, I was just looking at the all the companies that you cover, and that is definitely a wide array in terms of consumer. Like you have RH, and then you got Chewy, and then you got the Best Buy and AutoZone, and then also Lowe's. When do you think we're going to get clarity on the consumer for the names that you cover? As in, when you're listening to all of these earnings calls that are going to come up in the next 4 weeks, what's going to be the buzzword you're looking for?
Well, near-term sales will definitely be a key focus. Obviously, Walmart yesterday talked favorably. We're seeing some of that pull forward potentially because of tariffs, so we're not going to have clarity on sales trends for another month or two, in my view. So I think it's going to be really 2 months before we have really good clarity on how the consumer is responding to all this.
All right, Seth, thanks a lot. We really appreciate it. It's great to have you here. Seth Basham, Managing Director of Equity Research over at Wedbush Securities. Just some breaking news for you. There has been a helicopter crash in the Hudson River. This is according to the FDNY. You're looking at a live shot now, Scarlett.
Yeah, it's crashed in the Hudson River on the west side of Manhattan. It occurred in the vicinity of the West Side Highway and Spring Street, according to the NYPD, which posted this on social media. We will continue to monitor these headlines and let you know if we learn of any new developments.
Yep. All right, let's go back to the markets here. We are about 10 minutes away from the closing bell on a pretty brutal day. S&P is down 4%. We are off the lows, but we are rolling over as we head into the close here. You're also looking at tech down, Magnificent 7 down over 5% as well. Scarlett, one of the worst performing sectors in the S&P, though, continues to be energy, when you had oil closing at a 4-month low. Also the semis, that SOX index low as well. It's really chip stocks and big tech and energy are leading the way lower now for the S&P.
Autos as well. If you look at the S&P 500, 500 on a 24-sector basis. There are 3 groups actually in the black. Household and personal products, food and staple, and telecom services, your classic defensive sectors, Alex, that tend to do well, that people flock to as their safe haven. They have steady dividends. They'll continue to do business, even in a difficult economic environment, and they are now the havens of choice at the moment.
Yep, taking a look at that as well. The big question, though, becomes what happens with the dollar, really whippy action. The front end as well. The back end of the Treasury market, that 30-year, still struggling. The 10-year yield is up by about 6 basis points. For more on that, let's welcome Steve Sosnick, Chief Strategist over at Interactive Brokers. Steve, it's always good to see you. All right, what's your biggest takeaway right now? Like, volatility still up, but off the highs. S&P still down off the lows. What's my takeaway today?
Couple of them. Volatility begets volatility. If you and I thought we would be sitting here with the S&P's down 4% and VIX at about 47 and sort of having a calm conversation, this just shows you how inured we've gotten to
It's
it,
so
right?
true. And just in like 5 days.
It's been a week since this tariff, since Liberation Day. It was Thursday, a week ago. Today was the first day we had to react to it. So this is like a year's worth of volatility compressed into a week. That's really one of the big takeaways.
And there's more to come as well, because we haven't really resolved anything. One thing that did become apparent yesterday is that there is a Trump put, isn't there?
You know what? If there wasn't a Trump put, it was awfully something that looked an awful lot like it. We were wondering when it was going to show up, because, really he'd been sort of, we've been led to think that he was, at least from the first administration, that he was going to keep an eye on the stock market. Then we were told, no, we're not watching it. No, it's all about bonds. I think the put, in all these cases, though, I do think it's about the bond market.
Yeah, but I was going to say the put's the bond market. It's the long end of the bond market.
Well, it's certainly the Fed put. Anybody who's an equity person who talks about the Fed put, I think they're a little bit delusional, because that's hubris, because the Fed is watching the bond market and liquidity. But I think the Trump put was also the bond market, and part of it had to do with, I think, this is the realization that could be one of China's way of fighting back against some of the tariffs is go on strike about, we buy stuff from them, they buy bonds from us.
Right. A lot of talk about perhaps China and other strategic buyers of treasuries holding off and saying, we don't need to do this. That being the case, do you think the Fed was close to jumping in or intervening in any way because of what they saw as perhaps illiquidity in the treasury market?
I can't answer that, because I don't know what was going on in terms of their mindset. In terms of the reasons why people might expect them to jump in, they can't really do it because prices are not going down. There's no real crisis in the labor economy, so there's your dual mandate right there. Neither one of them saying it. The third leg of the dual mandate is keep the system running, but I can't gauge how bad things were or were not, because there were some contraindications that maybe this was just people positioning ahead of the auction. So
yeah, exactly.
They're not going to intervene on that.
Okay, let's get to retail traders, because JP Morgan had a note out that said that the retail guys were buying shares in recent days as institutional investors and hedge funds dumped equities, and they're now, cost-wise, almost break even for the year. Are you noticing that? Like, are we still seeing buy the dip in some portions of the market?
Our customers never stopped buying.
You're kidding.
Never.
Why? What was the rationale behind that?
I think it's just people have been conditioned to buy every dip. This has been, with the exception of most of 2022, buying the dip has worked really, really well. For certainly for the last 2 years, every dip appeared to be a buying opportunity. Now, it's tough to know when buying the dip becomes catching a falling knife, Alex. But what we've seen here is, I look at our 25 most active names, and pretty much consistently 22 through 25 of them have been consistently on seeing more buy activity than sell activity. It's the usual suspects, Nvidia, Tesla, but also our customers have been very active in leveraged ETFs.
Single stock names or sector specific?
Both. TQQQ was, I think, the third most active name on our platform through last week, but also TSLL, but SOXL, which is telling you that our customers, in the most volatile of environments, they're going for more volatility.
Amazing. Talk to me about funds. What are you seeing for funds? CTAs, commodity trading advisors. You also have volatility trading funds. They have to rebalance really quickly when we get these whippy moves, right?
Yes.
What have you noticed from that?
It's tough. We don't break out the activity that way, so it's a little tricky for me to parse it out. I do think some of the aspects about, risk factor, the funds that that manage the risk factor, there's a little bit of what I would call negative gamma type of trading in there, meaning you're sort of forced to sell low and buy high to stay in touch with your volatility targets. I do think that made things a bit worse and sort of added to the crisis. The ultimate, my first real experience in the market was the crash of '87. I happened to be relatively new on the desk then, and that was the ultimate let's sell into a declining market strategy. As an option trader, many years you always want to be avoiding a situation where you're forced to sell into a down market and buy into an up market. And I do think that there's a lot of that, what we've seen from very strategic type of funds that mechanically rebalance.
Never a dull moment. We look at the S&P 500 down about 3.3% with about 3 minutes to go in trading. And of course, the news keeps going because tomorrow we get the start of earnings season. What are you looking for from the banks? I know that they're, of course, leveraged to interest rates, and they give us a read on that. But what will you be taking away from those results that inform what the rest of earnings season might look like?
I'm going to be listening for the conference calls because, I used to basically specialize in trading bank stock options, and I hated that banks went first because they're so fluky. No one else has trading revenues that matter. No one else has that leverage to the interest rate cycle. So you can't take away the rest of earnings season from if Goldman Sachs had a good quarter in equities and commodities. It doesn't translate. But what does translate is what is Jamie Dimon going to say? What is Brian Moynihan going to say? Jane Fraser, et cetera, because they have great visibility into what customers large and small are doing.
Fluky. I love it. Steve, awesome stuff. Steve Sosnick, one of the best chief strategists at Interactive Brokers. Great to get that perspective. All right, we're just about a couple minutes to the closing bell. We got full market coverage for you here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Alex Steele alongside Scarlett Fu going to take you through the closing bell on a global simulcast. We're joined now by Bonnie Quinn, Carol Masser, and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide. We're going to parse through the crucial moments of the trading day, which is pretty much every single moment. We are off the lows, but we're still looking at S&P down 3.3%.
Yeah, exactly. Right. Lots of volatility once again. Very different tone from what we got yesterday. We are, as you said, Alex, I think it's important that we did see a bounce off the lows. We'll see what happens in these final minute and a half or so of trading. But you are seeing broad-based selling. Most names in the S&P lower here.
We just had a really sobering conversation with Rich Weiss at American Century Investments. He's not buying the dip. He said it's like catching a falling knife. Vonnie, he says this downturn is more serious than the other ones. He called this a man-made catastrophe.
And by the others, he means the great financial crisis or COVID. I mean, this is what he's saying the environment is.
Yeah, I mean, Ben Emmons calling it this morning a yippee-ki-yay market, and it really does feel like the Wild West out there. We haven't had any circuit breakers triggered, but we certainly have had moves of more than 5%, 6% in some cases, and we may not be done. Bloomberg's Matt Levine saying this is a buy the truth, sell the news moment. So what is the truth? The truth is that there are plenty of tariffs, and they have been put into effect.
Well, the truth is nobody knows what's going to happen, and the data will be backwards looking, although we do get the University of Michigan Consumer Sentiment report tomorrow, and inflation expectations on a one-year basis. That'll be critical because that's a lifetime read, although it is based on what people say, not what they do.
I love me that you mish. I should point out, guys, we just talked to Steve Sosnick, and he was saying that retail clients are still buying that dip. That conditioning still stays. There we go, the closing bells on this Thursday. You're looking at declines for the S&P coming in around 3.5%, the NASDAQ around 4.5%, the Dow off 2.5%. I should point out, if you take a look at the S&P, the NASDAQ 100, the NASDAQ, the MAG 7, they all fell the most at one point today, since the most since 2020.
All right, to the S&P 500 I go, guys. 428 names to the downside on this Thursday, 74 to the upside. Scarlett, one unchanged.
All right, let's take a look at the IMAP, which shows you the different sectors in the S&P 500. Basically a sea of red, although you can see that consumer staples did finish the day just marginally higher. Yeah, by 0.2%, and that's thanks to the likes of Kroger, Church & Dwight, Colgate, and Kimberly-Clark. So classic defensive consumer staples, companies that will be around, that will continue to do business even in a tough economic environment.
All right, that's a lot of red. I was terrified to find gainers today that they would hold, but I got a few.
You did it.
Kroger up 3%, guys. The consumer staples.
You got 4. That's what we call an overachiever.
I was. Consumer staples, I think as a whole, I think they finally blipped into the green a little bit overall, but nonetheless, we saw some pressure on that group. But Kroger, among the names that did actually show some gains, up about 3%. Gold, right? Mining stocks advancing today. Bullion prices climbing to a fresh record. And so you saw investors moving into this. A safe haven, right? Gold. And so you saw Newmont among the gainers, up about 4.5% in today's session. This one's up about 35% year to date. Here's a biotech company, folks. Keros Therapeutics, up about 18.5%. This is after initiating a review to evaluate strategic alternatives. They're also thinking about a potential sale. It's based in Massachusetts. It also adopted a shareholder rights plan in response to, quote, significant and rapid accumulations of the company stock by investors who have indicated a desire to influence the control of the company. So this one was an outperformer. And here I go. PriceSmart. I've never heard of it. It's up 7% today. This is a $2.7 billion market cap and operator of warehouse clubs in Latin America, and they reported second quarter earnings per share that beat estimates. So that's where investors were hiding today.
You got to travel abroad to find those gainers,
so.
Carol. Easy job that I had. In fact, I picked a couple indexes because there were so many stocks lower.
Embarrassment
today.
of riches.
It really was. I want to start with the Mag 7, down 5%. Dragging down indexes a day after posting its best day ever. Yesterday it rose 15%. Today it fell as much as 8%, but it settled in lower by 5%. Tesla, Meta, Nvidia, and everything else in the Mag 7 were lower. And have you guys talked about what happened to CarMax today? Shares falling 17%. This after the company said it's removing timelines from its financial goals due to uncertainty around President Trump's trade war and broader macro factors. They are, though, seeing increased demand for used cars, and prices are going up for them due to expected tariff impacts, though they're facing rising costs for parts, and they're looking at mitigation plans as well. Also, keep an eye on shares of Disney. Disney fell by, let's go ahead and round that up to 6.9% today. This after we learned that China will reduce the number of imported U.S. films and introduce more films from other countries. That's according to a government statement. Disney got about 10% of its revenue from the Asia Pacific region in 2024. That's how it breaks it down. The president was asked about this news from China earlier today at his cabinet meeting. His answer to the question was, quote, I think I've heard of worse things. He did not elaborate beyond that. And finally, semiconductor stocks getting beat up today. This after they were up 19% yesterday. The stocks fell 8% today. Everything was in the red.
An interesting one as well was the 30-year auction. We were all waiting for that at 1 o'clock to see if there would be a bid, and there was no buyer's strike. It was good news for that auction. Pretty strong demand, although if you're looking for any kind of a directional signal, the bid didn't hold quite so well as yesterday's auction after the auction. So we had the 30-year rise about 4 more basis points after that auction to finish the session now at 486.51. I will point out, though, that the 2-year went in the opposite direction, down 6 basis points, 384.33, right in the midpoint of its 2-day range, if you like, because we have seen a 40 basis point round trip for the 2-year yield, but it's in the midpoint there, and that was after the CPI data salved some egos out there.
Yeah, and I should point out, too, that 30-year moved 54 basis points in 5 trading days. You had that 5-10 spread really steepening out, the widest, I should say, since 2021. And my question is, until bonds calm down, can stocks calm down?
Probably not, right? And so this is why I guess our shift begins now. Earnings, right? Bake earnings tomorrow. And I'm looking at the KBW Bank Index down another, 5% in today's session after a 9% rally yesterday. Very different tone. But what we get on those earnings call, nobody cares about the quarter that was. Everybody cares about the outlook. What do we get in terms of commentary? And on that, I'm going to bring you in, Tim, because we just had a great conversation with Sri Natarajan and Max Abelson. There's a great story on the terminal about a JP Morgan analyst kind of holding back in a conference call, a presentation, because concerned about maybe saying certain things that might get the attention of the White House. Yeah, this story getting a lot of attention. The strategist has been lauded by Jamie Dimon as one of our firm's great thinkers, and he's taken this unusual step to highlight fears on Wall Street over speaking out against the Trump administration. To that point, Max and Sri also telling us loan loss provisions and any commentary on how these banks tomorrow are thinking about this current quarter, given the impact of tariffs, how they view consumers and how they're doing. Remember, it's JP Morgan, Wells Fargo, and Morgan Stanley that are reporting tomorrow morning.
Thank you for the reminder. Going back to that.
I sense like you know this already, Scarlett.
Going back
it's
to
like
that,
the moment we've all been waiting for.
Exactly. Going back to that story, though, that you mentioned about JP Morgan strategists being careful about what they're saying, it kind of shows us how the U.S. is starting to, I don't know, in some ways behave like an emerging market. And you see this in the way that people are being extra careful in what they say and how they say things, as opposed to a developed market.
Yeah, I mean, it's going to be interesting to see the price action tomorrow, right? Because we have another day's trading and we've had such a whippy week and so many differing things out there. And don't forget, there may be another China response later on this evening. China just getting up to start their day. They're meeting with some of their products with a 145% tariff upon them. What's the response going to be? A further weakening of the yuan?
Well, you have to also wonder, too, what the tape is going to look like for these banks, guys, which I'm really curious about, right? I mean, we saw Delta rally despite pulling guidance because we had an up tape, and then you saw CarMax saying that their targets might not be hit in their time frame, and you saw it get pummeled. So I think how we set up the tape will be really interesting as well.
I agree, right? How investors read into it, or whether they're like, I don't care. All I care about is what I'm getting in terms of tariffs and what the future looks like in terms of a trade war. Do we have one? Do we have one that lasts for a long time? Do we have one that just lasts for a little bit of time?
Well, I think key is to watch what happens in China. I mean, if you just look at the tariffs each and every day, we're seeing more tariffs imposed by this administration on China, up to 145% from 125% just earlier this week.
Yeah, well, that number can still increase because it went from 125 to 145 today. It's kind of clear that there are a lot of tariff threats issued over the last couple of days, and in adding it up, it's hard for us to understand where we're at because it's a moving target.
And what I'm curious about is, does China and Europe try to strengthen their alliance? It certainly seems like the PR messaging out there from China, at least, is that it's, making definite advances to Europe and offering things to Europe and asking Europe for help. Will Europe, decide to help China, to the detriment of the United States, or, does that get nipped in the bud pretty soon?
Gotta say, I was sick on Monday, and it feels like this has been a month this week.
Oh my gosh, totally.
Crazy. All right, guys, that's a wrap. Across platform coverage on radio, TV, YouTube, Bloomberg Originals. We call it the closing bell, and we will see you all tomorrow.
And let's have a look at where markets finished the day, because we did have another down day, although we were off our session lows at the end of the day. For the most part, the S&P 500 down 3.5%, 52.68. So we're still well off the lows that we have seen this week. The Nasdaq Composite Index down 4.3%, the Nasdaq 100 down 4.2%. If you look at the 10-year yield, it was up 6 basis points. That's kind of a middling picture of where we were, because we had the 2-year yield down 6 basis points and the 30-year yield after that auction up a whopping 11 to 12 basis points. Gold at a record, basically. We hit an intraday record earlier of 3,176.14. We're just a couple of bucks off that. And that's interesting because correlations had been really at 1. We had seen almost all asset classes move together, from Bitcoin to bonds to stocks. Perhaps now we're seeing a little bit of settling in the market, and some of those safe haven assets might become safe haven assets again.
All right, well, let's take a look at some individual movers. I wanted to start with CarMax, mainly because as a used car retailer, it certainly is affected by the various tariffs that have been threatened and imposed. The CarMax down 17% on the day after it removed timelines for its full year guidance. Even though it says it sees increased demand for used cars, it can no longer stand by its original timeline for those financial goals. So not exactly withdrawing its guidance, but certainly making some adjustments for the timing of being able to achieve its guidance. United Health, the massive health insurer, up almost 3%, in fact, gaining for a third straight day. And certainly this is part of the flight to safe haven, but also the White House's 5.06% pay increase for Medicare Advantage plans from United Health and its rival Humana does remove an overhang for the industry after some recent reductions. So perhaps a little bit of relief there for UNH and Humana. All right, let's talk a little bit more about the broader market overall and just kind of take stock of where things stand when it comes to price action this week. Bloomberg's Michael Ball joins us now. He's a market strategist for us, and of course, he's had a career working at the New York Fed as well as some other places. Michael, good to speak with you.
Thanks for having me.
In retrospect, when we look at what's happened, yesterday there was this massive rally. A lot of it was short covering. Have the shorts been squeezed out? Where do we stand in terms of positioning, do you think?
Yeah, that's a great question, because I think more shorts were put on today. You saw everyone that rallied yesterday basically underperformed today. So the macro narrative hasn't really changed to give anyone reason to have a longer term view change.
It's interesting because TD Securities said earlier that CTAs continue to hold that short position, as you're saying now, that there is a big short out there, or at least not the big short, but maybe quite a sizable short, but that they'll only abandon those short positions above 5,900. We're not above 5,900 today.
No, we look like we're wedged between 5,500 and 5,000. So it may be a volatile, choppy range for a while until we get further clarity on the China-U.S. relationship.
What assets are you going to be looking at? What asset classes? I know the bond market, obviously, because it's like the tail that wags the dog here.
Yeah, I think the steepener makes sense because the front end still works, but obviously there's worries about support in the back. I think gold will work too because the dollar is obviously under pressure as well. So it's tough to know, but equities will probably be even a rotation further into defensives.
Okay, so the staples that we've seen rising, we can continue to see some strength in those.
Potentially. I think as you guys have hit, the earnings season is going to be really the key, and whether the guidance is more uncertain is where everyone will be looking.
All right, well, you've got a couple of hours of a lull now, Michael, before it all gets going again.
It's
One
been
more
something
day.
else.
That is Michael Ball here with us from Bloomberg, and do follow his writings on Bloomberg T Live.
You can check it out on MLive Go as well as T Live Go. All right, Bridgewater Associates founder Ray Dalio weighing in on Trump's tariffs. He says the turmoil is hurting the U.S.'s reputation and we could see a recession. Take a listen.
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable.
All right, here now to discuss all of that is Peter Cher. He is head of macro strategy at Academy Securities. Peter, if nothing has been made.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Clear, it is the fact that the economy has taken a hit, certainly perception-wise, even if most of the tariffs have been rolled back. This idea of recession, where are we with that? I keep hearing shallow recession as kind of the default scenario.
I think I've already moved to recession with a capital R. I think it's going to be deeper. I think the friction that's going on globally is going to cause a global recession, and we're not going to be spared. At the same time, right, we're cutting government spending, which I think is necessary. We've got to get the deficit down. But we've been reliant on government spending for the economy, so I think that's a hiccup here. The trade war, and I think we're close actually to upgrading the trade war to almost calling it an economic war with China. When we look at the DIME framework of diplomacy, information, military, and economic, this feels with China, this is growing beyond a trade war and runs the risk of being an economic war, which I think will be problematic for global markets.
Problematic for global markets, problematic for investors as well. What are you hearing from your clients at Academy Securities? What are they saying in terms of, how they can position themselves for the next 90 days?
I think everyone's just trying to, stay awake at this point. It's been insanely busy. It's, I mentioned one client feels like we're going through a TARP vote every single day, and the client pointed out at least TARP was scheduled. We're going through this crazy market. I think people are tired, but I think it's starting to sink in that there is so much uncertainty out there that people aren't going to spend money, that corporations aren't going to spend money, and I think that's the risk that's starting to settle in. Right? Yesterday we rallied off the back of, and I think it was good. Like, let's delay, let's see what we can negotiate, but that still leaves a lot of uncertainty out there. The global economy is under pressure. I think companies have still not priced this in. Investors still haven't fully priced this in. I think we get back to the lows, and I think we could be down maybe 30% from absolute peak. So we got down 20%. I think there's room for that to go through, and we'll bounce once in a while on these positive headlines. But if we're really convinced that we have to have this economic friction, it's going to be painful. And I think Xi is quite prepared to go the distance with this, as is Trump. So I don't know what the off-ramp is right now.
Yeah, I mean, that's what I was going to ask, Peter. What is the best case scenario here? Even if we leave China aside, it's its own thing, it's its own set of negotiations. What else do we have? A bevy of bilateral agreements at some point? What does that do for the market, or for corporate America, for that matter?
Well, we've been thinking a lot about what these bilateral agreements might look like, and I think tariffs will only be a part of it, is my concern, right? I think tariffs are relatively easy to negotiate. I don't think tariff barriers are the biggest problem to trade. I think, really the 10% tariff Europe has on us on autos? Is that really what drives U.S. auto sales in Europe? I don't think so. But my concern is that Trump, who is very, very focused on trade imbalances, may require quotas of purchases of U.S. goods. That might make these tariff negotiations harder. And he may also try and include language that restricts how much trade you can do with China, right? China was able to get around some of the earlier tariffs by setting up in Mexico, by doing things through Vietnam and other countries in Southeast Asia. So I think these negotiations won't just be about tariffs. They will try and incorporate something about quotas to get the trade balance, and may even have things that restrict what countries can do with China. So I think that's going to be far more difficult to do. And if China gets a whiff of that, and it's coming true, then it could get derailed. So hopefully it's just about tariffs. I think that'd be simple and easy and we can move on. I suspect it's not, because I don't see how you solve the problem of China trying to use alternate countries to get their products in here if you don't try and clamp down on it.
Peter, is there any scenario in which Europe at least messages that it's cooperating in some way with China? That seems to be one of the only ways that you might be able to turn the screws on President Donald Trump.
Yeah, and I think that's why he's going to try and push back in these deals he offers. I think we'll have some sort of restrictions on, what you can do with China. That's why I think this gets worse probably before it gets better, as everyone really has to figure out. I think China and Trump may make every country pick a side. Who's more important to you? I don't know that will happen, but kind of from the messaging, this goes well beyond tariffs now, right? This is about trade. This is about Trump wanting to rebuild the middle class. He wants manufacturing here, and I think he will push very hard to get that. So I don't know what an obvious solution is, and I don't think China will take this lightly either. What will they do to kind of try and force trade to them? Yet to be seen. I think they're going to use a lot of their own tariff sort of diplomacy. I think they may look at Taiwan and say, what can we do in terms of one country, quote unquote, two systems, to maybe impose duties? Because that is one real weakness the U.S. faces, is critical minerals, rare earths from China, but also all our AI chips are coming from Taiwan right now. That's right in China's sphere of influence. We don't think they'll do anything aggressive militarily. That's not something, we work with 30 generals at Academy Securities. We don't see military imminent, but we do see gray zone type activity and the potential to use tariffs or other sort of economic levers to fight the U.S.
And one of the economic levers that China has at its disposal is perhaps to sell U.S. treasuries. There was some worry about that, and that might be why treasury yields continue to climb, especially at the long end of the curve. Peter, why was the 30-year auction, which met fairly strong demand, not providing relief to the market today?
It's two small events, and I think it was good. We had pretty solid, what looks like, indirect bidding, which typically means foreigners. But again, I don't think that solves the issue of where we're headed. If we're not going to generate all this tariff revenue, where do we, how do we fight the deficit? We've now talked about upping military spending from $800 billion to $1 trillion, which I think would be really good and really interesting, and will let the military get a lot of new equipment. Having said that, that's not good for the deficit. So maybe they're starting to creep in some doubt about our ability to decrease the deficit, that the trade war is going to be inflationary, that it's going to put pressure on the U.S. economy, it's going to restrict what the Fed can do. So I think all those things are coming to play. And I do think a lot of countries, and not just countries themselves, but I think pension funds within those countries are going to be reducing their exposure to U.S. treasuries in particular, but U.S. assets, including corporate bonds. Two things that, the Mar-a-Lago Accord has some vague reference to, maybe countries will be forced to turn their treasury bonds into zero coupon perpetual bonds. I don't know if anyone took that serious 2 weeks ago. Given what we've seen in the last week and a half, you might have to take that serious. So I think all countries might reduce their treasuries to the extent they can, and pension funds. And then there's also chatter about raising revenue by charging fees to foreign holders of treasuries. All those things, I think, play against us. And this all just feeds onto me. I think what we are seeing right now is damage to the American brand, and we've traded off, and I think this could be the mistake, though I guess I shouldn't say any mistakes would be made by you, given what you said earlier, but that we've traded off trade imbalances for capital flows. We were massive beneficiaries of capital flows and global brand recognition, where people wanted to be affiliated with the U.S., they wanted to be associated with the U.S. I think that has taken a turn for the worse, and that's what we're seeing play through markets, and I think it's going to start hitting corporate earnings as well. So that's why I remain bearish that we haven't yet hit the lows of this, cycle.
All right, Peter, we will be on to you again very shortly, no doubt. That is Peter Thier, head of macro strategy at Academy Securities. The Nasdaq 100 closing the day down more than 4%, with Tesla and Nvidia leading the Magnificent Seven lower. Joining us now is Dan Ives, Global Head of Technology Research at Wedbush Securities. Dan, obviously we're seeing a rotation out of US tech. This is all part of, the maybe beginning to be a lack of confidence in U.S. hegemony. Does it cross the gamut of U.S. tech, or does it particularly hit chip companies? And is there any way back from this?
I mean, it's the hearts and lungs of the U.S. tech world, and I think that's the issue. Is that executives you talk to, or even what we're seeing in terms of CapEx. I mean, you're going to see just massive uncertainty throughout earnings season. And I think it's not just about the stocks, and we've talked about it's about the real economic damage done here. But for U.S. tech companies, this would be like being in the ocean. They're in a boat, you flip them, no life raft, say, okay, good luck, we'll see you on shore.
President Trump obviously wants manufacturing back in the United States. If there's one area where there is spending, it's on things like fabs, it's on things like, chip making and so on. And he's, got some investments coming to the United States for that. Is there any reason to believe that he won't exempt all of these companies?
I mean, if you like iPhones being $3,500, we should make them in New Jersey or Florida. But the reality is that they would take Apple $30 billion, 3 years, just to move 10% of the supply chain. So my view is that it's one thing to talk about. The reality is we're talking about something that could take the U.S. tech industry back a decade, and that's why these China tariffs, that's the black cloud over the tech sector.
It's a huge black cloud, and it's not going to be lifted anytime soon. And it's under that black cloud that these executives need to give some kind of clarity on what their plans are. In terms of their spending plans, the story for the last couple of quarters has been about spending and investing in AI. How much is that going to be a theme this time around? I mean, can they turn off the spigot, or will they continue with some of what they had planned?
No, I mean, the shut-off valve's there. I mean, I think about 15, 20% of these projects automatically have stopped or significantly slowed down. The snowball starts going downhill, you can't stop it. And I think that's the reality. In terms of guidance, I'd be shocked if companies actually give guidance in terms of tech, because you don't even know rules of the game in terms of where they're going. So I do think investors will look through June. They'll basically throw out that quarter, September. You'll start to look through, can this be something in the next 60, 90 days that gets negotiated, and then to some sort of baseline. Then you start to look at 2026 numbers. That'll be the bull case as a tech investor.
Okay, so hardware companies really have no visibility in terms of they are directly impacted by the tariffs. What about software companies? What about cloud companies that, don't rely on overseas manufacturing?
That's really been our call, is that more of a shift. In terms of names defensively, you look at Oracle, Microsoft, IBM, cybersecurity, Palo Alto, CrowdStrike, CyberArk, Fortinet, among some others, Checkpoint. I think software is going to be the one that's more defensive, less exposed from a tariff perspective, but clearly also impacted in terms of CapEx and projects. But I mean, you're going into, when it talks about hardware, semis, I think the reality is there's the cost input, but then there's the uncertainty that's happening in enterprises. That's the big issue.
Dan, NVIDIA, it depends so much on TSMC, right? What is Jensen Huang thinking, given that one of the things China could do is cut off access to a Taiwan-based company? I
mean, look, that's what we've always talked about, is that when, as you go down this path, there's a lot of unintended consequences. And obviously, some of these black swan events will continue to be there. I think the bigger worry is that what does that do to the supply chain? What does it do to cost? Who's exempt? Who's not? That's the other thing, is that ultimately, what are the companies, Trump talked about yesterday, some could be exempt. And that's going to be a huge variable. I could tell you, that's what investors are asking us. Who's exempt? Who might not be? And then ultimately, what does that mean for numbers when you look through it? Worst case, best case, base case. You're kind of taking that COVID playbook in terms of investing in tech.
I know when you talk about companies are exempted, I think of Apple because they were able to negotiate an exemption in 2018. And you mentioned Jensen Huang, Vani. He was just over at the White House over the weekend. What kind of convincing argument can he make to President Trump?
Well, I think the reality is that these tariffs, in my opinion, it's the body blow. It cuts the knees off of U.S. tech. And I think what Jensen would probably say is, look, you hurt us. Guess who wins? Beijing, China. Because that's the reality of the situation. So I think it's one where it's one thing in negotiations, but as you're doing it, you can't burn the house down. And I think that's the worry, and that's why you see these tech names selling off the way they are. Obviously, after the rally yesterday, is that you don't know the E with a PE. You don't know what that E is. Investors are trying to figure it out.
And NVIDIA doesn't report again until the end of May. We might know more by then, although we may not. Our thanks to Dan Ives, Global Head of Technology Research at Wedbush Securities.
All right, let's bring you some other news outside of financial markets. This happening in New York. There was a helicopter that crashed in the Hudson River on the west side of Manhattan. This is according to the FDNY. We want to get you the latest here and bring in Bloomberg's New York bureau chief, Katya Porzakansky, for a little bit more. Katya, what can you tell us about what we know so far?
Well, so far we know that the helicopter had what's believed to be 5 people on board, including, I believe, 3 children. And at least two have been, 2 of the passengers have been rescued and taken to a nearby hospital in Jersey City. We still do not have confirmation on the operator of the helicopter or the purpose of the flight. Some flight radar suggests that it might be a tourism charter. I believe that's most of what we know for now. This is reminiscent of a crash that we had in New York City almost 10 years ago, also in the river. That brought a lot of awareness to the harnesses that they wear and the ability to get out of the water.
Yeah, and we're looking at live pictures right now, Katya, and conditions don't seem to be particularly clear. It does seem to be a rainy, perhaps even a little bit foggy of a day, but helicopters take off and land at that area all the time, right?
That's right. I will also say this is a very crowded part of Manhattan. This is in Lower Manhattan, off Pier 40, which is off of Hudson River Park. Tons of businesses in there and homes. Lots of traffic right now on the West Side Highway and the Holland Tunnel. As a result of this, and yeah, that is had this occurred just closer to shore, this could have been an even greater disaster. But yes, we still do not know the cause of the crash.
All right, Katya Porzakansky, thank you so much. And just to recap here, there was a helicopter crash in the Hudson River west of Manhattan. We will continue to keep you posted on further developments. This is Bloomberg Markets The Close. We have the S&P 500 closing the day down 3.5%, resuming its sell-off, down for a 5th day in 6. The Nasdaq also giving back a big chunk of its gains as well from yesterday, after we had the biggest rally since 2008 on Wednesday. This is The Close. All right, we want to talk about inflation because we did have a CPI report today that came out and it was better than expected. But if you look within it, there were still some concerning areas. For instance, egg prices hitting yet another record, rising 5.6% in March and doubling from a year earlier. Here now to discuss food inflation overall, the impact of tariffs, is Stu Leonard Jr. He is president and CEO of Stu Leonard's. It's a family-owned food retailer, food grocer in Connecticut. Stu, always a pleasure to speak with you. I guess I want to get straight to food prices and how you see tariffs affecting your products. How much of your products are sourced outside the U.S.? How detrimental are the tariffs to you?
Well, one cool thing about Stu Leonard's is we're probably 80% fresh, where most supermarkets are probably like maybe 50%. So we rely heavily on fresh products. Most of that isn't tariff. A couple of our big guns are salmon out of Canada right now. We do about 1 million pounds of that a year, and right now we're okay. So salmon prices are the same as they were. Another thing you get into, which gets me a little nervous, are these little babies right here that everybody loves. It's our -- selling item in produce, believe it or not.
Avocado.
And believe it or not, it's a fruit. Okay. So, that with the guacamole and everything, I can't really buy avocados anywhere else except Mexico. And that's exempt right now. So I got 2 biggies that are exempt. The things I worry about are things like this, tequila right now. It's coming out of Mexico. You can't buy that anywhere else in the world, okay? But our suppliers saw this tariffs coming. They said, cool it, Stu. You got probably 90 days before there'd be any price increases.
So, Stu,
Yeah.
Sorry to interrupt. I kind of want to pick up on that. You know, the commentary that they provide you, the assurances that they give you. You have 90 days to sort things out. What are those conversations like? Are your suppliers offering to eat some of the tariffs, or are they, you know, negotiating with you to take on some of it? How do you split that?
You know, that's a great question, and it has to be handled different depending on the company. Like, we deal with a lot of small local farms and ranches out west and everything. These are family businesses. They're small. I'm not going to put the screws to them and say, you know, we're not taking any of your tariffs, okay? Some of the bigger companies are taking a harder line. We just got a call from an Irish butter producer that, they want to increase prices 10% right away. We said no. And most of the blinking lights out there, and it's probably the same with the market, you know, same thing. Nobody knows what's going on. Nobody knows what's going on with food right now. But the big thing is wait and see. That's what we're hearing from most of our suppliers. We're on the phone every day with these people, sometimes multiple times a day, because things are changing so fast.
Well, for sure.
Yeah.
For sure, people will miss their Irish butter, Stu. I have to say that in there.
Yeah.
But talk to us about stockpiling. You know, you said you had some suppliers that said, you know, cool your heels. There's going to be a few more weeks. But are you getting extra shipments then? Are you getting extra product and stockpiling it in case what happens in 6 weeks is what you were anticipating would happen now?
I would say most of the non-perishable food items, we have stockpiled, and so have our importers. Like, for instance, our pasta out of Italy, our marinara sauce that's made over in Italy, our olive oil, Reggiano Parmesan is not like a great alternative to that. If people want the Reggiano, they're going to want it. But there's a lot of items you can buy U.S. For instance, even we got Easter coming up. These are beautiful lamb chops right now, okay, from New Zealand. But the United States has great lamb chops in Colorado. You know, take wine or champagne, for example. You know, here's a great bottle of California and Sonoma Valley champagne. It's sparkling wine, so it's not champagne, but the same family that makes it over in France makes it here. So the big question we're looking at is how much shifting is going to go on from foreign-made products over to U.S. products. Like you know, here's an example of a big wheel of French brie right here, okay?
Stu, you're making us hungry.
This is This is $2 a pound more than the United States brie.
Yeah.
So I did a little taste test yesterday, and most people like the USA brie more. So is the customer going to shift right now? That's really what we're waiting to see what will happen.
Stu, what about the products that are paper products that we might think come from U.S. companies, but probably source a lot of it from places like China and other, you know, Southeast Asian nations? And I'm talking about, you know, toilet paper makers and kitchen paper makers.
Hey, why is toilet paper such a big item? We found that during COVID, too. I almost don't want to hear about it anymore. I mean, it seems to be the number one item. People like to stockpile whenever they're a little concerned about food prices and stuff. I mean, I have 4 daughters and a wife, so I understand the toilet paper thing. But, you know, I'm not worried about grocery too much. A lot of that's U.S. made. There's odds and ends you get imported from Europe. Fortunately, we don't get anything from China. No food comes from China at all. So, you know, we're going to probably feel it in some of the packaging expenses and things like that. But I don't think customers out there have to expect any, at this point, shocking increases. You might see bananas go up 5 or 10 cents a pound right now, okay? Those are coming from Costa Rica. Same with pineapples right here. So you might see a little bump, nothing serious.
Stu, I'm looking forward to price reductions on things, and I know that might be a tall order here, but you did mention that because you're not importing a lot of things from China. Of course, a lot of the U.S. exporters are not sending things over to China as well. Talk about lobsters, especially as we get closer to the warmer weather.
Yeah, well, lobsters are pretty calm right now. Nobody's really into it, but they're going to be exploding when, you know, within the next month or two right now, usually by Mother's Day. So at least in the Northeast. So we're going to be doing a lot of lobsters right now. We've been talking to our Canadian lobster farms up there. But we also have we have 60 boats up off of Stonington, Maine. We've been up there to the nicest people in the world. You know, we're going to start buying more and more from them, which is a Maine lobster zero tariff on it. So the big question I have, and I don't really understand the lobster global industry, but I know we ship a lot to Japan and China too. So, you know, that's going to maybe offer more supply here on the U.S. side, and maybe you'll see lobster prices go down this year.
Well, Stu,
I'm hoping for that.
Yeah, exactly. Stu, you're like Mary Poppins. You literally had every product to hand right beside you there, except for those lobsters, of course. We'll wait to see the lobsters next time. All right, thanks to Stu Leonard Jr., President and CEO of Stu Leonard's.
All right, and of course, we got to recap what happened in trading today. I don't know what it says about this market environment, Vani, where 3.5% on the S&P 500, a loss there feels kind of like a normal day, especially in the last couple of days. 3.5% down in the S&P 500. There was some rotation to some of the safer sectors like consumer staples, but really it was down all across the board, across asset classes. You could see yields rising as prices fall on treasuries, especially at the long end of the curve. There was a 30-year auction that met decent demand, but still we have a lot of big question marks over what the fiscal picture of the United States looks like. The dollar lower by 1.5%, perhaps reflecting flight out of U.S. assets. And crude oil now at $60 a barrel when it comes to WTI.
Yeah, it was an insane day. Gold at a record basically as well. And we just have to wait and see what happens tomorrow after we get another response potentially from China tonight. Well, President Trump successfully corralling House Republicans to approve a Senate-passed budget outline, paving the way for a tax cut package and debt ceiling increase. Joining us now to discuss this and lots more is Libby Cantrell, Managing Director and Head of Public Policy at PIMCO. Does this become the story now, Libby, at least at some point where you can, talk about the debt ceiling in relation to these tariffs and it suddenly becomes more intertwined again in the public consciousness?
Yeah, well, I think the Trump administration really wants the narrative to be around tax cuts, right? We've been describing this as a combination of vegetables and dessert for our clients. We've had a lot of vegetables in terms of tariffs, the Doge headlines, and now they really want to pivot to the dessert, which is, I think, going to be, they hope is going to be the tax cuts. The composition of what those tax cuts, though, look like, I think, really are to be determined. The upshot here, though, is I think there's a $1.5 trillion number that's being floated around. The real number, though, for the Treasury market is more like $5.5 trillion, because this budget actually includes, as a policy baseline, just an extension of the Trump tax cuts that costs around $4 trillion over 10 years, plus an additional $1.5 trillion over 10 years. So that's going to be, again, maybe not necessarily assuaging the bond markets in terms of really getting the sort of the fiscal house in order, despite maybe some of the rhetoric from the budget hawk.
Yeah, exactly. And the bond markets have been throwing their own sort of mini tantrums here, right? So there's a lot to consider, and we get the score, then there'll be a lot more to consider. What's the earliest possible date that we'll see something actually effectuate?
Yeah, so you mentioned the debt ceiling, and I think importantly here, from maybe a good thing for the bond market here, is that we probably won't see some of the volatility that we've seen before in terms of a debt ceiling increase. That debt ceiling deadline, though, that could be as early as May or June. I think that will be actually a forcing mechanism to get this thing done. So we're probably looking at a summer time frame, kind of at the latest at this point. Again, I think the president and Republicans on the Hill really want to change the narrative. They want to pivot from some of the implications of tariffs, a headwind to growth, upward pressure on inflation, to some of the risk market tailwind that is associated with tax cuts.
But when it comes to tariffs, the amount of revenue that it's expected to generate has gone down because President Trump rolled back so many of the tariffs that he had announced on April 2nd. According to the Yale Budget Lab, they now expect all of the latest announcements to raise about $1.82 trillion in revenue over the next decade. That's a far cry from how much the tax cuts will cost.
Yeah, I mean, I think that, well, it remains to be seen. There's a lot of, I think, wiggle room in those numbers. I mean, I think our economists have put this together, and it looks like it could raise up to $400 billion a year. It sort of depends, though, right?
Yeah.
It depends on what consumers actually do in terms of the substitution of goods. The one thing I think that, and maybe the market is internalizing this today, is that the headwind from tariffs, the tariff level is going to be very high, even if he doesn't add on any additional tariffs in 90 days. So if you just think about the 10% universal tariff on everything, the 100 and whatever it is, 45% on China. I mean, it keeps going. Yes. The sectoral tariffs, the tariffs on the non-USMCA compliant goods. So I think from a growth and from an inflation perspective, these tariffs are very likely to still bite, even if we maybe avoided the kind of the worst possible scenario.
So taking a step back here, when we look at how the Trump administration is rolling out its economic policy, how it's moving forward with everything, personnel is policy, and we've seen different voices come out and they're fighting for supremacy. Whose voice matters right now most to you as you listen to different people come out? Is it Navarro, who seems to have taken a step back because of the rollback in tariffs? Is it Scott Bessent, the Treasury Secretary, who made really clear that he was dealing more with the tax situation rather than tariffs? Or is it Howard Lutnick?
Yeah, so I think, obviously, given our remit as bond managers, we're always going to pay a lot of attention to what the Secretary of the Treasury says. But even though they're sort of shades of gray in terms of what they are all saying, they really, Secretary Bessent included, are really echoing the president's view on trade in particular. So again, maybe shades of gray, Peter Navarro maybe at one end of the spectrum, but they're all talking about what their view is around trade deficits being bad, trade deficits being symptoms of broader problems in terms of not only unfair playing field in terms of tariffs, but taxation, currency, industrial subsidies, and also they all believe that tariffs work to some extent. Now, are they revenue generators? Are they a means to an end? Are they an end to themselves? I think they're differing views, but I think that is kind of what we are guiding our clients to, is that the president believes in this. He believes trade deficits are bad, tariffs are good, and everyone around him pretty much shares that worldview, even if, again, there's some shades of gray.
Libby, what can we say about the president's potential impact on the markets now after yesterday? So we saw yesterday there was a very, very temporary impact on the market. It seemed like it was going to be a long-term impact, and today the markets have forgotten again, what president, I don't want to call it the Trump put. I don't like that phrase. But I do think that this sort of proves that the president really can't do anything about this unless it's policy that he's actually creating.
Yeah, well, I think a couple of things from yesterday. Just in general, we have seen that the president's pain threshold for sort of market indigestion, if you will, is much higher than it was under the Trump 1.0. And I think a lot higher than a lot of market participants assumed. I think, again, maybe they were not underestimating the passion in which he really believes this, the ideology around this sort of worldview around trade. So that's one. Two is that as of yesterday, he's paying as much attention to the bond market as he is to the equity market. I think Trump 1.0, very focused on risk assets. Trump 2.0, and probably led by Secretary Bessent, he really is paying attention both to the functioning of the bond market, like any kind of politician or policymaker would, but also to that 10-year rate. And Secretary Bessent in particular has put a lot of emphasis on that rate. So I think, again, we've seen a higher pain threshold from the president. He, of course, is attuned to the markets. But what we have seen broadly from this administration 80 days in is a more maximalist view. He believes there's a sense of urgency. He believes there's limited time to effectuate change, and he's really committed to that change.
All right, good stuff. Libby Cantrell, really appreciate your joining us. PIMCO, Managing Director and Head of Public Policy. And we want to broaden this out and talk a little bit more about what the public policy means for the economy and for companies and their confidence, because Wall Street is racing to really game out the tariff impact on earnings as well as the economic picture. Joining us now is Roger Altman. Roger is founder and senior chairman of Evercore. The firm handles over $2 trillion of mergers and acquisitions, recapitalization, and restructuring transactions. We should know as well, Roger previously served as deputy secretary at the U.S. Treasury. He has worked in the Carter and Clinton administrations. Roger, thank you so much for joining us. Really appreciate it. And this is a great way to kind of wrap up what we've seen so far this week. How much damage, in your mind, has the turmoil over the past week created on corporate confidence?
A lot. I made a point this week so far of speaking to quite a few CEOs of large cap companies in order to exchange views on the financial market turbulence and the implications of it, and to ask what they were feeling or sensing in their businesses. And across the board, they're either already detecting some weakness or expect to see it shortly. So the level of business confidence is weakening because business conditions themselves are starting to weaken, which is not surprising given the shock and awe character of these markets in the last few days, and the dimensions of the tariff war.
A bunch of Wall Street voices have been speaking out this week. We heard from Bill Ackman, we heard from Jamie Dimon, we heard from Elon Musk as well, who plays a prominent role in the Trump administration. Jamie Dimon seemed to break through, the chairman and the CEO of JP Morgan Chase. Based on what you've observed and in your conversations, what's been an effective and perhaps the most effective way to reach out to this administration and to let him know, let President Trump know some of the costs of his pursuit of his policy and maybe convince him to slow down?
Well, Scarlett, it's pretty difficult for almost any CEO, maybe not Jamie Dimon, but almost any CEO, to by herself or himself make an impact on the Trump administration's approach to tariffs. I think that's asking a lot for any individual CEO. Most of them, after all, only talk to the media on a regular basis at the time of their earnings calls, and they're not a constant presence as in the media ecosystem. So I think that's just a lot to ask. But I can tell you that in private, there's almost universal disaffection toward the tariff policy. Because after all, if you think about it, the idea that if country A is running a trade deficit with country B, then by definition, country B is ripping off country A is simply fallacious. There are lots of reasons for trade deficits, and they're not all bad ones. For example, the United States is not a serious coffee producer. Brazil produces a lot of coffee. So we buy tremendous amounts of coffee from Brazil and certain other coffee producing countries like Colombia. And we don't sell them any coffee. That's not a bad thing in and of itself. Furthermore, exchange rates have a lot to do with trade deficits. Also not a bad thing in and of itself. So the very premise of the trade policy, that any trade deficit with any particular country reflects they're ripping us off, is just not seen as logical by the business community, or for that matter, anybody who seriously thinks about it.
Roger, just looking at the markets, we're seeing IPOs getting delayed, we're seeing deals getting put off, we're seeing money flow out of leveraged loan funds, we're seeing spreads widen. Are you anticipating any kind of market event over the next day or two if this doesn't settle down?
Well, today you saw an alarming thing. You saw the dollar weaken, bonds weaken, and equities weaken at the same time. That's quite uncommon, because typically it's not common to see the dollar weaken and bonds weaken at the same moment.
Right.
That happens often in emerging markets, but not in the case of the United States. That is not a good sign, because it signifies capital outflows, and it signifies diminishing confidence in the growth outlook for this country, and for that matter, the attractiveness of dollar-based assets. So I don't know if that continues or it's a one-day thing. No way of knowing that, but it's not good.
On that point as well, Olivier Blanchard was on X this week saying that China does seem willing to sell U.S. treasuries, even if it means absorbing capital losses. What's your take on how much China is willing to sell U.S. treasuries and what that might mean?
I don't know the answer to that, Bonnie. I don't know that anybody outside of the Chinese leadership could possibly know the answer to that. But again, think about today. Typically, when bonds weaken and yields go up, the currency strengthens, because on an overnight basis, you're getting a better return on it for holding it, right? Higher interest rates mean better return if you hold the currency, even overnight. So this is, as I said, quite an uncommon dynamic. Now, we'll see what happens tomorrow and what happens beyond it. But I think the markets are essentially saying they don't like this tariff war at all. And they want it to be unwound. They want it to be stopped. That's the message, especially of today's reversal relative to what happened yesterday.
Well, sorry to interrupt.
And that's what the market is saying.
That's what the market is saying, and I think the intention was very different, that the tariffs would push yields lower, and the Trump administration has put a huge premium on lower yields, which would reduce borrowing costs for companies and consumers, but also make it less expensive to refinance government debt that's coming due. There's this theory that they were intended to do just that. Bessent reportedly said that for every 1 basis point reduction in the interest rate that government pays on its debt, that would save $1 billion a year. Is that a sound strategy, Roger?
Well, if you're asking whether the expectation of lower yields was sound, let's just say it's not working out so far. But if you step way back and you imagine day one of this administration.
News when you want it with Bloomberg News Now. I'm Karen Moscow. We're going to have the latest on the trade war in just a moment, but first, some breaking earnings news to bring you. Morgan Stanley's out with its numbers, and we get details with Bloomberg's Sonali Basak.
You're looking at equities trading revenue coming at more than $4 billion for Morgan Stanley. That is handily not only beating analysts' expectations, it is also beating out JP Morgan. Another critical metric, you saw Morgan Stanley beat out JP Morgan, and I don't remember how often this happens, but not very often. It is the return on tangible common equity came in at 23%. Absolutely stunning in this type of environment. You also have them missing, however, on their margins for the wealth management business. There will be questions around how both retail and institutional clients are behaving in asset management and trading.
And that's Bloomberg's Sonali Basak. Well, earlier this morning, we heard J.P. Morgan Chase's stock traders took in a record haul in the first quarter, boosted by chaotic market moves set off by President Trump's policy announcements after he took office in January. Still, Chief Executive Jamie Dimon struck a cautious tone about prospects for the U.S. economy in a statement that accompanied the results. Wells Fargo missing analyst estimates for net interest income in the first quarter as soft loan demand hurts the bank's largest revenue stream, and BlackRock pulled in a less than expected $83 billion of client money to its investment funds in the first quarter. Now to the latest on the trade war. China retaliated against Donald Trump's latest tariffs by hiking duties on all U.S. goods while calling the administration's actions a joke and saying it no longer considers them worth matching. Beijing will raise tariffs on all U.S. goods from 84% to 125% beginning April 12th. This was after the White House clarified that levies on Chinese goods rose to 145% this year. We get more with Bloomberg senior editor Bill Ferries.
There's a real question at what point do these tariffs kind of start becoming meaningless numbers? I mean, we know an analysis by Bloomberg Economics showed that once you get over 100% tariffs, at least in the medium term, you basically bring an end to bilateral trade. It's basically a complete decoupling.
And that's Bloomberg's Bill Ferries. Bloomberg News has learned top European officials are planning to visit China later this year to discuss trade with President Xi Jinping. Sources say European Commission President Ursula von der Leyen and European Council President Antonio Costa have agreed to the summit in Beijing. The possible meeting comes as Spanish Prime Minister Pedro Sanchez visited Beijing today, saying he sees China as a partner of the EU. Bridgewater Associates founder Ray Dalio is saying that the tariff turmoil has damaged the U.S. reputation for reliability. Dalio spoke with Bloomberg's Francine Lacroix.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Dalio said that while he's pleased about Trump's decision to pivot, he cautioned that the volatility will have lasting effects. Hear the full conversation on the latest edition of the Bloomberg in the City podcast. Some other news we're following this morning. A New York City sightseeing helicopter broke apart in midair and it crashed into the Hudson River, killing the pilot and a family of 5 Spanish tourists. The victims included Siemens executive Agustin Escobar, his wife, and 3 children, along with the pilot. Here's New York City Mayor Eric Adams.
We lost 5 family members and a pilot to an incident. We're still investigating. There are many unknowns here, but with our federal, state, and city partners, we'll find out exactly what happened.
The helicopter was on its 6th flight of the day. It was found upside down in the 50-degree water when rescuers arrived at the scene, which was closer to the New Jersey side of the Hudson River. The NTSB and the FAA are investigating. Britain has announced a surge of military support to Ukraine as the war-ravaged country's Western backers gather at NATO headquarters to drum up weapons and ammunition. The Supreme Court says the Trump administration must work to bring back a Maryland man who was mistakenly deported to El Salvador, rejecting the administration's emergency appeal. And Donald Trump is undergoing his annual physical today. He's potentially giving the public its first details in years about the health of a man who in January became the oldest in U.S. history to be sworn in as president. S&P futures are higher, up 0.1% or 6 points after those bank earnings. Dow futures are little changed. NASDAQ futures up 0.2%, and the 10-year Treasury yield at 4.41%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
It is as troubling as I've ever seen because there's so much nervousness in terms of uncertainty. We don't know our inputs. What's demand going to look like? CapEx, do we cut it now? No one's giving guidance. So, I mean, I just find that as someone that's been the most bullish, over the decades, you cannot go into this earnings season and be like, it's baked in. Look, it's a new reality. And that's why when they say near-term pain, we've talked about it so much. Near-term pain, it would take Apple 4 to 5 years to build a new factory, $30 billion, just to move 10% of the supply chain, and iPhones would be 3,500. We should build them in New Jersey if you like iPhones being 3,500. That fundamentally is the issue in big tech, CapEx, projects. That, to me, is what's so scary in terms of, all the conversations that I've had.
Can you give a sense? Apple seems to be on the lowest end of flexibility when it comes to rejiggering the way it does business in the wake of some of these new rules of the road. What about some of the other tech companies? What about the Microsofts of the world, as well as the Oracles, some of the companies that are integral to a lot of corporate business planning in the U.S. right now?
Yeah, look, software, and we've told investors, defensive-wise, like in this bunker mentality, software is going to outperform in terms of Oracle, Microsoft, Salesforce, cybersecurity, Palo Alto, CyberArk, among others. But it's still, okay, I ordered a server, $100,000, comes in a rack, so am I going to get hit with a bill 2 months later for another $100,000 in terms of what happened, in terms of what's coming from China? So the uncertainty, software is impacted because it's CapEx. They're also driven by hyperscalers, driven by CapEx, driven by the AI, a lot of this spending. So that's why it's the ripple effect that impacts software as well. I think they're the best house relative to this neighborhood and probably, we will say, less impacted, but they're not immune because this is going to impact all of tech. And I think across the board, tech earnings comes down off the gate 10 to 15%, just for starters. And then you wonder, okay, what's baked in from there? Where do we go?
Dan, you're talking about potentially, if it's made in the U.S., a $3,500 iPhone. With a 140% tariff rate, is it still cheaper to make it in China?
And that's why you're going to have $2,300 iPhones, $2,100. And that's why it just comes down to, Amber, I think the reality, and Apple, they're in the eye of the storm. They have no flexibility. And you can talk about things like, do they get exemptions? Where do they play? India.
Do they get exemptions?
Well, and again, no one knows because you don't know rules of the game. And maybe they get some exemptions, but not all exemptions. But then what about A, B, C? What about, do they get exemptions? And I think that's why, from an investing perspective, every other time in 25 years, from financialcrisis.com, you could be able to look through things and be like, okay, on the other side. Here, you don't know rules of the game. You could wake up, you drive on the left side of the road, your name's Tim, it's not Dan. And so that's the reality when it comes to these stocks.
Okay, but these companies have had warnings, and I'm not just talking about Trump on the campaign trail. Even Biden was pushing for de-risking when it comes to Beijing and Washington. Trump talked about this. in the first term, and there was tariffs in the first term. Why didn't they do more to put supplies outside of China?
Because you basically can't. I mean, the reality is, like, this is a supply chain that's been built for 20, 30 years. The reality is, like, the IP, the way these products are made, anyone like myself that spends so much of my time in Asia, in China, you know, throughout Taiwan, Vietnam, and others, you just can't. We don't have the manufacturing, the consumer cost basis from an employment perspective to actually do that here. And I think that's the whole issue, is that saying it and doing, they're two different, there's a reality and a fictional. And I think that to us is why we've been so troubled by what we've seen, because in my opinion, it takes U.S. tech back a decade. It cuts the knees off when it comes to AI revolution, unless we see negotiation otherwise. And guess who the winner is? It's China tech.
So why have you still got to buy on Apple?
Because my view is that if I thought this was permanent and I thought this stays, then you downgrade every stock that you cover. It's the view that this is basically, whether it's 30, 60 days, it's the view that June, September quarters you basically throw out. You start to look at some sort of normalized 2026 number and a baseline situation. So my view is, like, you can't, but John, if you assume this stays for an elongated period of time, then it's game, set, match. So our view, the way that we've navigated is, like,
your assumption it doesn't hold, it doesn't stick, it's that bad.
If this holds, I mean, you talk about Armageddon, like, that would be probably a good term to where I would see that, just given the amount of products that come from China, the supply chain, U.S. tech. We could say it. I could say I want to play in the NBA. I could say it 100 times, but I'm not. Okay, so. Good.
Thanks for clarifying.
But again, good 3-point shot. But the reality is, that's where I see, and that's why we're navigating investors through this software. We're going to worst case numbers and kind of getting some sort of baseline to where you should own certain names if they get to those points.
It's a difficult moment. Dan, it's good to see you. Appreciate your time. Thank you for being here. Dan Ives of Wedbush. It's so bad it's not going to hold. Seems to be the takeaway from a lot of people we've been speaking to over the past few days.
Right, but then you hear from the energy secretary, who's in the Gulf talking to partners about things like tariffs, and he says it's the start of a negotiation. 145%, maybe more. How can it hold?
Only a few days ago, we asked the chair of the Council of Economic Advisors over at the White House whether it was a negotiation or the rules of the game, and we were told it could be both.
Could be both.
So it could be both. PPI data's up next. This is fun, isn't it? Veronica Clark of Citi joins us in just a moment. From New York, this is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
bringing you up-to-the-minute news,
technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets whenever, and
तो guys 6 PM का डेटा आ गया है गोल्ड और सिल्वर के लिए पॉजिटिव है, डॉलर के लिए नेगेटिव है। पीपीआई का डेटा और कोर पीपीआई का डेटा नेगेटिव फॉर डॉलर, पॉजिटिव फॉर गोल्ड एंड सिल्वर। 7:30 का डेटा है, अब देखते हैं 7 PM पे यूएस मार्केट भी ओपन होगा तो उसके बाद मोमेंटम और आएगा। क्रूड ऑयल एक बाइंग का ट्रेड था, अच्छा मूव कर गया था, टारगेट बड़ा था, लगभग 130 पॉइंट का एफईजी था, वहाँ हाफ प्रॉफिट बुक कर लिया था, फिर नीचे आ गया। आई होप बुक कर लिया होगा, उसमें ट्रेल कर रहे हैं तो एसएल कॉस्ट पर रख दिया होगा। यहाँ पर एक छोटा सा सेलिंग का ट्रेड प्लान है। आ गया मोमेंटम तो वेल एंड गुड, 7 PM तक नहीं आया तो फिर 7 PM के बाद देखेंगे। नेचुरल गैस भी बहुत ही स्लोली स्टडी कल वाले सपोर्ट पे था, गया जरूर, ऊपर एक एफईजी था, एग्जैक्टली आया नहीं तो वहाँ से एक सेलिंग का प्लान जरूर रखा था, एग्जैक्ट नहीं आ पाया, वहाँ पर देख पा रहे होगे। ट्राई जरूर किया प्राइस को वापस ऊपर लेके जाने का, बट फाइनली सपोर्ट ब्रेक करके रीटेस्ट करके नीचे आ रहा है। नीचे एक सपोर्ट है, यहाँ से एक बाइंग का प्लान रखेंगे। कैंडल का ध्यान रखना, ओपन इक्वल टू हाई ना बने, ओपन इक्वल टू हाई नहीं बनती है तो बाइंग होगी, अगर ओपन इक्वल टू हाई बनी तो मत बाई करना। बाकी टारगेट उसके इसमें 300 एंड 304 दो रहेंगे टारगेट, ठीक है। बाकी थोड़ी वॉलेटिलिटी रहेगी इस कैंडल पे बिकॉज ऑफ द पीपीआई डेटा इंपॉर्टेंट है गोल्ड और सिल्वर के लिए। कल वाली हैं सपोर्ट रेजिस्टेंस, नैस्डैक के कल मैंने बताया था वो सपोर्ट परफेक्ट सपोर्ट बना मार्केट में। इंडियन मार्केट तो क्लोज हो गया था बट उसके बाद लगभग 11:30 बजे के आसपास या 11 बजे के आसपास नैस्डैक में आईजी जो ब्रोकर था एग्जैक्टली 17,800 टू 830 के बीच से सपोर्ट आया, मार्केट वहाँ से 800 पॉइंट ऊपर गया। ऊपर एक रेजिस्टेंस था 18,750, वहाँ से थोड़ा सा पहले ही सेलिंग आ गई है अभी, दैट इज अ रेजिस्टेंस जोन। कोई और सपोर्ट रेजिस्टेंस बनता है तो वी विल सी, अभी तो कोई नहीं है। कोई न्यूज आएगी तो ध्यान रखना, सडनली कैंडल मूव कर सकती है। नहीं अभी तो नहीं है सपोर्ट यहाँ पे कोई। अच्छा ये रीटेस्ट, ठीक है। दो बार रीटेस्ट कर दिया इसने तो यहाँ पे। ले चुका है रेजिस्टेंस अच्छा खासा ठीक है भी करो गाइस जिन लोगों ने लाइक नहीं किया 6 PM का डेटा आ गया 7 PM का देखते हैं
The Fed is going to lean on that employment mandate more.
You said that you're expecting to see the increase in consumer goods with tariffs. When do you actually start to see that drip in, especially since the administration is talking about negotiation?
Yeah, I mean, it is really hard. Usually these pass-throughs maybe happen a couple months after the tariffs take effect. So yeah, it's not in this March data yet, but as we're getting into May, June, maybe that's when you start to see it. But there is, the uncertainty question does mean maybe you pause everything. You're not investing, you're not hiring, but maybe you're not changing your prices yet. You don't want to raise those prices, for a consumer that can't necessarily pay it just to then have to cut them later. That's creates more volatility. So maybe we're holding off a bit longer, but the size of these tariffs that you probably will see higher consumer prices.
Had some bank earnings this morning. The guidance was pretty decent from JP Morgan. In fact, they increased it. The CFO spoke just moments ago. Jeremy Barnum has said the narrative is wait and see. And that's what it feels like for the broader US economy. What's the high frequency data that you're looking at the moment to sort of gauge how this economy is developing?
Yeah, this is very much wait and see, and this is an interesting time for the labor market, I think, to be in this wait and see mode, because this is a time of year when businesses start hiring. This is when you're hiring for the summer. This is when new students are entering the labor force. So I'm really watching trends in hiring, and the best high frequency data for that, I think, is continuing jobless claims, because that's going to tell you if you did happen to get laid off, how quickly are you coming off of those unemployment benefits. If those start rising, that correlates really well with the unemployment rate.
What's the trend at the moment coming into this?
Yeah, I mean, I think this is a labor market that has been loosening for a while, and it has been driven by that low hiring dynamic, which I think was going to be a problem this time of year anyway. That uncertainty, that pause in activity is going to make that dynamic even worse. So this was, I think, already a labor market that couldn't handle a shock like this.
I just wonder how much the dynamic and the way that we talk about the Fed has to change, given the fact that they cannot respond in the same way if truly treasuries are not the risk haven that they have been in the past.
Yeah.
They are dealing with a very different dynamic. I just wonder, especially if they're dealing with stagflation, especially if they're dealing with companies that are coming off a really resilient place, at what point do you change the parameters of how you even understand what kind of Fed intervention looks like, given some of these uncertainties?
Yeah, I mean, I think their tools are, the toolbox has grown, right? We know that, the last 15 years, but their tools are somewhat limited. Certainly interest rates are a blunt tool. I mean, I think we have to just know what we know about this Fed, and this Fed has been a Fed that has been surprisingly dovish. It's a Fed that cut rates 50 basis points in September. It's a Fed that in 2019, when we did have tariffs, we had manufacturing weakness, and we had some wobbles in the equity market. It's a Fed that cut rates 3 times in 2019.
You and the team haven't been shy about big calls. I remember that very aggressive call in the hiking cycle, and people laughed about it, and then they went even harder than you were expected.
Yeah.
So nothing would surprise me. I think we've said it repeatedly on this program. programme after the pandemic, then we've all got to be humble about what could happen here. Veronica Clark of Citi looking for that first interest rate cut on May 7th from the Federal Reserve. Michael McKee's back with us for more. Mike, have you got more details?
Yeah, we got some interesting numbers in here that the Fed will be interested in, and of course people on Wall Street. We didn't have a lot of tariffs in March, but we did have the steel tariffs and steel mill products, and this is in the United States, went up 7.1%. Economists have been warning, American producers are going to raise prices if they can because of the tariffs as well. But some of the numbers that go into the PCE have been pretty good. Portfolio management up only 0.2% after an 8% rise last month, and we saw airline fares drop by 4% during the month. So some good news there. It'll be interesting to see after the smart nerds put their pencils to the paper what they think PCE is going to be. One other one that I wanted to mention was egg prices. Yesterday we criticized the administration because egg prices had gone up at the consumer price level. At the producer price level, they fell 21.3% last month. So maybe we'll get a tweet on that soon.
Nice. Saw what you did there, Mike. Appreciate it. Mike McKee, thank you very much. Joining us now around the table, Tony Crescenti of PIMCO. Tony, good to see you. It's been a while.
Great to see you.
Thanks for dropping by. I just got one question. Help us answer this.
ओके जी, क्रूड ऑयल का ध्यान रखना है। क्रूड ऑयल में जो अभी मार्केट चल रहा है ना, बहुत ही स्लो चल रहा है। मुझे ऐसा लग रहा है कि कोई बड़ा मोमेंटम आने की तैयारी है। वॉल्यूम ही नहीं है, बिल्कुल भी ऐसा लग रहा है। तो थोड़ा क्वांटिटी को संभाल के ट्रेड करना, ठीक है। मॉर्निंग से देखोगे बस एक रेंज बना के बैठा हुआ है, मार्केट कहीं भी जा सकता है अभी। अगर अपसाइड निकला तो बहुत ऊपर मोमेंटम आएगा, नीचे साइड निकलता है तो भी मोमेंटम अच्छा आएगा। तो ये फंस गया है फिलहाल के लिए। किसी एक साइड की रेंज ब्रेक कर दे अपर लेवल पे या फिर लोअर लेवल पे, तभी कुछ बड़ा मूव देखने के लिए मिलेगा। तो थोड़ी जब तक रेंज के अंदर है, रेंज के बाहर चला गया फिर तो अच्छी बात है। क्वांटिटी साइज का और एसएल का ध्यान रखना। एसएल जा सकता है क्योंकि रेंज है, रेंज नहीं होती है, थोड़ी ब्रॉडर रेंज होती तो बेटर रहता। अभी इतनी स्मॉलर रेंज है कि 50 पॉइंट के लिए ऊपर से मार्केट देखोगे एक बिल्कुल परफेक्ट आप कह सकते हो पैटर्न बना के बैठ गया यहाँ पर, फ्लैग पैटर्न जिसको हम कहते हैं। या फिर तो ऐसा लग तो बिल्कुल रहा है कि कहीं ना कहीं बड़ा ब्रेकआउट या ब्रेकडाउन पॉसिबल है इन सिनेरियोज में। आवाज कम आ रही है, अब ज़्यादा आ रही है या अब भी कम ही है? कमेंट बॉक्स में बता दो। नेचुरल गैस में भी एक ट्रेड बनेगा वापस से, थोड़ा सा और ऊपर आ जाए अगर ये। भी नहीं आ रही गिरीश राणे जी वॉइस, अब तो आ रही होगी, आई होप सो। नाउ इट इज क्लियर टू एवरीवन वॉइस, राइट? 615 डन 615 हो गए हैं। बन जाएगा इसमें भी थोड़ा सा, अगर ये तो साइड भी चल रहा है। तीसरी बार आएगा आएगा तो यहाँ पर भी नेचुरल ये क्रूड ऑयल ये लेवल ना ऐसा नहीं है पहली बार का है, थर्ड टाइम का है। बट मैं एक्सपेक्ट कर रहा हूँ थोड़ा सा ऊपर आ जाए, इसमें सेल ही करें अब नेचुरल गैस में ना। बाइंग इतना प्रेफरेबल लग नहीं रही है। ये एक ट्रेड एक्सपेक्ट मैं कर रहा हूँ, अगर ये मिल जाता है वेरी गुड ट्रेड आई थिंक, अच्छा रहेगा। बाकी ये बीच वाले लेवल को अब रिमूव करना चाहो तो कर सकते हो, इसकी अब ज़रूरत नहीं है। इसको उल्टा कर दो। उल्टा कैसे होगा? वो 7:30 पर है डेटा, दैट डेटा इज अराउंड 7:30, नॉट राइट नाउ। थर्ड टाइम आएगा मतलब फोर्थ टाइम में तो ब्रेक ही हो जाएगा ये सीधा मोस्ट प्रोबेबली। करो नीचे वाला सपोर्ट ज़्यादा स्ट्रॉन्ग होगा एज कम्पेयर टू दिस वन, राइट। ये ना नीचे जो सपोर्ट बनाया ना नेचुरल गैस में, दिस वन, यहाँ पर तीसरी बार आएगा प्राइस। बेटर है कि इसके नीचे वाले पे आ जाए, क्योंकि ये 3 बार टेस्ट कर चुका है तो देर आर वेरी हाई चांसेस कि प्राइस फिर नीचे ही जाएगा ब्रेक करके। पीपीआई का डेटा पॉजिटिव है या नेगेटिव है? पीपीआई का डेटा डॉलर के लिए नेगेटिव है, गोल्ड और सिल्वर के लिए पॉजिटिव है। 6 PM की डेटा की बात कर रहे हो ना, आ गया ऑलरेडी वो। टू 86 तक गिर सकता है प्राइस, 286 पे बाई करते हैं, ज़्यादा बेटर रहेगा। ठीक है, इस लेवल पे ना बाइंग अवॉइड ही करेंगे नीचे नेचुरल गैस में, बिकॉज तीसरी बार आ रहा है, मुझे थोड़ा सा वीक लग रहा है, पता नहीं क्यों। इवन तो है सपोर्ट ही, बट कॉन्फिडेंस नहीं आ रहा है इस लेवल पे। बेटर है कि थोड़ा नीचे आके अगर आनी ही है बाइंग, थोड़ा लोअर एंड पे आके दे दे, कैसा रहेगा? व्हाट डू यू से गाइस? यहाँ पर आके बाइंग हो जाए, यहाँ पर पहली बार ही आएगा प्राइस। लाइक नहीं रुकनी चाहिए गाइस, लाइक नहीं रुकनी चाहिए। जहाँ लाइक रुक गए समझो वहाँ काम खत्म। ठीक है, मैंने बीच का एक लेवल रिमूव कर दिया है नेचुरल गैस में। रीजन मैंने बता दिया है, कुछ स्पेसिफिक नहीं है, बट वहां पर थर्ड टाइम आ रहा है। हो सकता है रुक जाए यहीं पर 290 पे, बट थोड़ा नीचे अगर आ जाए 286 के अराउंड, तो 4 ही पॉइंट का डिफरेंस है, वहां से थोड़ी बाइंग ज़्यादा बेटर है, क्योंकि पहली बार आ रहा है तो ऑब्वियसली स्ट्रांग होगा ना दूसरे तीसरे बार के कंपैरिजन में। ठीक है, दैट इज़ द ओनली रीजन। वही सेम ही प्लान है, कल के लेवल ही है, बता दिया हैरी जी। कल का लेवल जो बताया था, दोज आर द लेवल आर स्टिल इंटैक्ट। क्या आज नेचुरल गैस 280 के नीचे आएगा अमन बाबा जी? देखते हैं सर, 280 के नीचे आता है या 300 के ऊपर जाता है, समय ही बताएगा। मुझे पता हो 280 के नीचे हो तो मैं तो सारी क्वांटिटी लोन लेके सेल कर दूं, बताओ। हु नोज। तो इस पे मैं क्या कह सकता हूँ? इतना कह सकता हूँ, ऊपर रेजिस्टेंस पे सेल, नीचे सपोर्ट पे बाई करना। एसएल जाएगा तो निकल जाना, प्रॉफिट हिट होगा तो टारगेट हिट होगा तो प्रॉफिट बुक कर लेना। बाकी 280 जाए ना जाए, मैं इसको इस पे कुछ कमेंट करना सही नहीं लग रहा है अभी, है भी नहीं सही कमेंट। बाकी नीचे सपोर्ट तो अच्छे हैं, 280 तो मुश्किल लग रहा है मुझे जाना। 286 285 तक जा सकता है, उसके नीचे जाएगा चांसेस आर वेरी लेस। कोई न्यूज़ आ जाए तो बात अलग है, ठीक है, उस पर मैं कुछ नहीं कह सकता। सडनली कोई न्यूज़ आ जाए और प्राइस लोअर सर्किट लगा दे, वो तो किसी के कंट्रोल में नहीं है। समझ रहे हो? समझे नहीं समझे? बाकी लास्ट ट्रेडिंग सेशन है, सैटरडे संडे 2 दिन मार्केट क्लोज रहता है, तो थोड़ा संभल के ट्रेड करना, ये नहीं कि सारी क्वांटिटी आज ही ट्रेड कर देनी है। मंडे को भी मार्केट ओपन होगा। बाकी वीकली एनालिसिस करेंगे कल, सो डोंट फॉरगेट टू ज्वाइन वीकली एनालिसिस टुमारो। इफ़ यू हैव एनी क्वेश्चन, कोई क्वेश्चन रहेगा, कोई भी प्रश्न आप लोगों का रहेगा, अपने प्रश्नों के उत्तर के लिए आप कल का हमारा लाइव सेशन ज़रूर ज्वाइन कीजिए। एंड निफ्टी बैंक निफ्टी कमोडिटी क्रिप्टो के बारे में वीकली एनालिसिस करते हैं कि क्या व्यू रख सकते हैं कल दोपहर 12 से 2 बजे के बीच में, कभी शेड्यूल हो जाएगा। बाकी ज़्यादा रिस्क ना लें आज, सैटरडे को और संडे को मार्केट क्लोज है, इसलिए नॉर्मली मैं हर बार बोलता हूँ अवॉइड हैवी ट्रेडिंग इन सैटरडे, बिफोर सैटरडे, इट मीन्स लास्ट ट्रेडिंग सेशन ऑन फ्राइडे। फिफ्टी थ्री पीपल आर वॉचिंग, 25 लाइक्स, बताओ आधे लोगों ने लाइक ही नहीं किया। से आते हैं लोग, इसको ट्रेल कर सकते हैं, कोई इशू नहीं है। हाँ, ट्रेल कर लो, बढ़िया है। ट्रेल दिया सर। क्रूड में जिन लोगों ने सेल किया है ना, अपना एसएल कॉस्ट पर डाल दो। 630 हो गया। अपना एसएल कॉस्ट पर डाल दो, जिसने भी क्रूड में अगर सेल किया है, पुट योर एसएल ऑन कॉस्ट, कॉस्ट टू कॉस्ट। वो ऊपर वाला एसएल मत रखना, आप कॉस्ट टू कॉस्ट पर डाल दो। अगर ये सीधा नीचे नहीं आया तो ये पलट जाएगा अब यहाँ से पक्का, और वापस चला जाएगा 5230, फिर हो सकता है वहां से वापस जाए। कितना पॉइंट मूव किया? ठीक है, लगभग 30 पॉइंट मूव किया है, कोई बहुत बड़ा मूव नहीं किया है। चाहो तो प्रॉफिट थोड़ा बुक कर लो, नहीं तो एसएल कॉस्ट पर रख लो। ठीक है, कॉस्ट टू कॉस्ट एसएल जाएगा, निकल जाना, वापस री एंट्री बाद में करेंगे। क्रूड ऑयल जिन लोगों ने सेल किया है, अपना एसएल कॉस्ट पर रख लो। वापस आएगा तो वापस सेल कर देंगे वापस से 5220 टू 30 के बीच में। बट फिर उस केस में अगर पुल बैक यहाँ से आया सीधा नीचे नहीं आता है, अगर यहाँ से गिरता नहीं है, तो फिर एसएल बढ़ाना पड़ जाएगा हमें अननेसेसरी। फिलहाल के लिए प्राइस एक्शन यही कह रहा है, या तो गिरे डायरेक्टली, अगर नहीं गिरा तो फिर पुल बैक में 5220 टू 30 वापस आएगा। तो रिस्क नहीं ले सकते अब यहाँ पे, सीधा ही आ जाए तो बेटर है, टाइम बच जाएगा दोनों का, बायर का भी और सेलर का भी। नहीं आया तो फिर ये बचता। अराउंड डायरेक्टली आ जाए तो ही बेटर है, नहीं आया तो फिर वो खाली टाइम वेस्ट होगा एक फ्लैग पैटर्न के अंदर। इसको यहाँ से अगर होल्ड करते हैं तो हाँ ये भी ठीक है, क्योंकि अभी भी देखोगे ना क्रूड ऑयल है रेंज के अंदर ही है। मैं समझना कि क्रूड ऑयल कोई ट्रेंडिंग चल रहा है अभी, 5150 से 5230 की रेंज है 15 मिनट टाइम फ्रेम पे। जब तक इस रेंज के किसी एक साइड पे सस्टेन नहीं होता है, तब तक ये टोटल मिला के आप देखोगे तो 80 पॉइंट की रेंज है, यही बनी हुई है मॉर्निंग से ही है, ऐसा नहीं कि अभी बनी है, मॉर्निंग से यही रेंज है। तो देखें तो एक बार मॉर्निंग पे सपोर्ट लिया है, दूसरी बार यहाँ सपोर्ट लिया है, लोअर हाई बनाया है, ये थर्ड टाइम सपोर्ट लिया है। इसका थोड़ा सा प्राइस एक्शन देखोगे ना मॉर्निंग से, ये कुछ इस तरह का प्राइस एक्शन बन रहा है इसका। इसका मतलब ये नहीं कि बिल्कुल नीचे ही गिरेगा, नॉर्मली इस पैटर्न के अकॉर्डिंग तो ब्रेकडाउन ही होना चाहिए, बट क्योंकि ये एक फ्लैग पैटर्न भी है, और मैंने बताया है फ्लैग पैटर्न दोनों साइड ब्रेक कर सकता है, ये कोई सिमेट्रिकल ट्रायंगल पैटर्न नहीं है। सिमेट्रिकल ट्रायंगल पैटर्न होता तो जिस साइड ट्रेंड होता, अगर मार्केट अप ट्रेंड में होता तो फिर अप साइड ही ब्रेक करता, या डाउन ट्रेंड में होता तो ये डाउन साइड ही ब्रेक करता। बट फ्लैग पैटर्न में मार्केट दोनों साइड ब्रेक कर सकता है, डजेंट मैटर कि ट्रेंड कौन सा है। बुलिश ट्रेंड है तब भी मार्केट अप साइड भी जा सकता है, डाउन साइड भी जा सकता है। मार्केट का ट्रेंड नेगेटिव है और फ्लैग पैटर्न बना तो भी मार्केट डाउन साइड भी जा सकता है, अप साइड भी जा सकता है। तो जो फ्लैग पैटर्न होता है वो कंटिन्यूएशन और रिवर्सल दोनों तरह से काम करता है ट्रेंड में। किस साइड का एसएल जाता है पहले भी देखते हैं, 5140 के नीचे या 5237 के ऊपर क्लोजिंग कहाँ पहले आएगी। 5140 90 पॉइंट ज़्यादा हो जाएगा, 140 पे डाल दो, 73 इज इनफ। क्रूड नीचे ऊपर करता रहेगा क्या आज, ब्रेक करेगा, डोंट वरी। सैयद जी वॉइस कम आ रही है, अब ठीक है वॉइस, अब भी कम है, कमेंट बॉक्स में बताओ। माइक थोड़ा पास रखो, अरे मुंह के अंदर ही डाल देता हूँ माइक, बताओ। आ रही है वॉइस, माइक बिल्कुल लगा रखा है, बिल्कुल ले रहा हूँ, माउथ पर ही टच है बिल्कुल। अब इससे ज़्यादा पास और क्या रख सकता हूँ, इट इज़ नॉट पॉसिबल, नहीं तो फिर बोल नहीं पाऊंगा। वॉइस मेरी थोड़ी कम है शायद बिकॉज ऑफ हेल्थ इशू सम, थक गया हूँ आज। टू मच टायर्डनेस टुडे। अब आ रही है वॉइस, अभी तक नहीं आ रही थी। वॉइस तो आती रही है, ये माइक तो अच्छा है, इस वॉइस से आ रही है, मेरे मोबाइल में तो आ रही है वॉइस। कभी कभी ऐसा होता है लाइक थोड़ा सा वॉइस पीछे चले जाती है बैकग्राउंड में, टाइम के अकॉर्डिंग, स्ट्रीम की वजह से। तो एक बार रिफ्रेश भी कर लिया करो, कभी कभी हो सकता है कि आपके एंड से थोड़ा बहुत प्रॉब्लम चल रही हो, तो एक बार बीच बीच में रिफ्रेश भी करते रहो, अपनी स्ट्रीम को लगा के मत छोड़ दो। स्पेशली अगर मोबाइल में देख रहे हो तो 7 PM पे ही अब होगा कुछ क्रूड ऑयल का, उससे पहले तो लग नहीं रहा कहीं भी जाने वाला है। परफेक्ट फ्लैग पैटर्न है, देखते हैं किस साइड ब्रेक होता है, नीचे 5140 के नीचे या फिर ऊपर 5237 के ऊपर। बाकी जिन लोगों ने सेल किया है क्रूड ऑयल में वो अपना प्रॉफिट इन द सेंस अपना एसएल कॉस्ट पर रखे रहना, वापस री एंट्री बनेगी तो फिर कर लेंगे, लेकिन अब नहीं कर सकते, अब रेंज के अंदर है, किसी ना किसी साइड पर निकलेगा, ब्रेकआउट या ब्रेकडाउन होने वाला है अभी उसमें कहीं भी। और सिमेट्रिकल ट्रायंगल पैटर्न नहीं है, फ्लैग पैटर्न है, बार बार रिपीट कर रहा हूँ, दोनों साइड मूव हो सकता है। बाकी आधे घंटा और है, यूएस मार्केट के बाद तो होना ही है। अब वॉइस ठीक है, ऐसी रखी है, ऐसी रख दी सर, कांस्टेंट है बिल्कुल। इक्वल टू MC स्क्वायर होता है ना, जहाँ पर M इज इक्वल टू मास विच इज़ ऑलवेज कांस्टेंट, तो वैसे ही यहाँ पर our live stream is equal to my voice into the chart का whole square where voice is always constant. Siva 550 CR 2025 गुड इवनिंग। गोल्ड का यार देखो, थोड़ा सा वेट कर लो 7 PM का, मार्केट वैसे ओवरऑल ऑल टाइम हाई पे ही चल रहा है, लेवल देख लेते हैं एक बार, मैंने देखा नहीं है गोल्ड, सुबह देखा था तो ऑल टाइम हाई प्रीवियसली ब्रेक करके थोड़ा बहुत प्रॉफिट बुकिंग में आ रहा था तो ऊपर ही, वही है ऑल टाइम हाई पे ही चल रहा है। देखो अब यहाँ पर मैं क्या ही बताऊँ, यहाँ पर कोई रेजिस्टेंस तो है नहीं, ऑल टाइम हाई पहुँच गया, पिवट का यूज़ कर सकते हो, पिवट पॉइंट एक इंडिकेटर आता है वो आपको दिखा देगा कहीं पर अगर रेजिस्टेंस बना होगा। इस पर मैं क्या बताऊँ, करने के लिए बोलूँ क्या, क्योंकि कोई रेजिस्टेंस है नहीं, रेजिस्टेंस बना होता तो मैं क्या देता। बाकी नीचे सपोर्ट जरूर है, अगर नीचे पुल बैक आता है, बाकी मेरे अकॉर्डिंग 7 PM का वेट करना चाहिए, आधा घंटा है, उसके बाद थोड़ा सा क्लैरिटी आ जाएगी मार्केट क्या और ऊपर जाने वाला है या फिर थोड़ी प्रॉफिट बुकिंग आएगी। बाकी नीचे आता है 15 मिनट पे, मैं फॉरेक्स चार्ट की बात कर रहा हूँ, तो फिर 3220 के अराउंड बाइंग का प्लान कर सकते हो। कैंडल का ध्यान रखना ओपन इक्वल टू हाई ना बने। बाकी अगर 3220 नहीं होल्ड होता है, ब्रेकडाउन रिटेस्ट कर जाता है 15 मिनट में, तब थोड़ा सा फिर बड़ा एक फॉल देखने के लिए मिल सकता है टिल 3190। बाकी ऊपर कोई रेजिस्टेंस है नहीं तो पिवट का ही यूज़ हो सकता है और कोई ऑप्शन नहीं है एज अ ट्रेडर। ये मैं फॉरेक्स की बात बता रहा हूँ, MCX की नहीं, ठीक है। ब्रेकआउट के चांसेस नेचुरल गैस में अपसाइड हैं क्या? देखो अगर नेचुरल गैस को ऊपर ब्रेकआउट करना है तो 304 के ऊपर एटलीस्ट एक कैंडल 15 मिनट की क्लोज करनी पड़ेगी, तभी हम कह सकते हैं कि ये वापस बुलिश होगा। नीचे हो सकता है सपोर्ट से बाइंग आ जाए, वो एक अलग सिनेरियो बनेगा, बट अगर यहाँ से ब्रेकआउट चाहिए तो 304 के ऊपर कैंडल क्लोज होनी जरूरी है, क्लोज हो गई तब ब्रेकआउट आ सकता है, उससे पहले तो दिख नहीं रहा है ऐसा कोई लेवल ब्रेकआउट का। बाकी देखो बेस्ट तो यही था कि मार्केट को यहाँ से सपोर्ट लेके ना ये एफईजी को ब्रेक कर देना चाहिए था, इसको ब्रेक करता तो ये बुलिस हो ही जाता ऑटोमेटिकली, एफईजी ने ही रोक दिया बीच में। बाकी ऊपर ये रेजिस्टेंस है अभी भी, तो जब तक 304 के ऊपर क्लोजिंग नहीं होती या फिर थोड़ा सा एक राउंड नंबर ले लो तो 305 के ऊपर क्लोजिंग नहीं होती तब तक रेजिस्टेंस है, ऊपर आएगा वापस रेजिस्टेंस मिलेगा। कैंडल अगर बन जाती है ओपन इक्वल टू लो और यहाँ पर ब्रेकआउट मिल जाता है इस लेवल के अराउंड कहीं, तब ब्रेकआउट माना जाएगा, नहीं तो फिर नीचे यहाँ पर एक सपोर्ट है 290 और फिर 290 एंड 286 के अराउंड मिल जाएगा आपको। ओके 25 मिनट लेफ्ट ओनली, यूएस मार्केट ओपनिंग। क्रूड ऑयल भी ठीक ही आ रहा है, देखो ब्रेक डाउन करता है या नहीं करता है, फिर वापस सपोर्ट लेता है। कर दे, रेंज ब्रेक कर दे तो बेटर ही है। नीचे कहाँ तक जाएगा अभी? नेचुरल गैस में, सॉरी, क्रूड ऑयल में जो लोग निकलना चाहें तो निकल सकते हैं पूरा प्रॉफिट बुक करके। क्रूड ऑयल में निकलना चाहो पूरा प्रॉफिट बुक करके निकल जाओ। अगर होल्ड करना है तो एसएल कॉस्ट पे रखा हुआ है। अब तो यूएस मार्केट ही ब्रेकआउट करा सकता है रेंज का, अभी भी रुक रहा है थोड़ा बहुत, इसलिए बोल रहा हूँ। मुझे भी नहीं पता अभी किस साइड ब्रेक करेगा। तो जो लोग क्रूड ऑयल में थे सेलिंग में, हमने एसएल कॉस्ट पे रख दिया था। बुक करना है करो, होल्ड करना है तो एसएल कॉस्ट पे रख लो। अगर ब्रेक हो गया तो और अच्छा प्रॉफिट मिलेगा, नहीं होता है तो फिर ट्रेलिंग एसएल जाएगा कॉस्ट पे। बाकी ब्रेकडाउन मानना, कंसिडर करना 5141 के नीचे कैंडल अगर क्लोज होती है तो। विक से फ़र्क नहीं पड़ता। अरे इसमें प्राइस एक्शन भी नहीं है नीचे तो। फाइव नीचे आया तो 5037 इस जोन के आसपास नेक्स्ट सपोर्ट। तो हो रहा है ठीक है, नीचे आता है तो क्रूड ऑयल 5035 के आसपास रुकेगा। बाकी निकल गए होगा ट्रेड से तो बीच में एंट्री मत करना अब क्रूड में। बाकी 5000 नीचे आया तो 5035 के आसपास एक बाइंग का प्लान रखेंगे वापस से। बाकी व्यू तो थोड़ा सा बेरिस हो जाएगा अगर ब्रेक डाउन कर देता है नीचे। क्यों नहीं कर रहा यार? Fifteen, 20 minutes left. US market opening. Crude oil is still stuck. Breakdown नहीं कर पा रहा है अभी भी. $5140 के नीचे वापस सेल कर सकते हैं. ब्रेकडाउन रिटेस्ट पे कह रहे हो? देखते हैं सर अभी यहाँ पर बेटर रहेगा. नीचे आता है तो 5035 के अराउंड बाई कर लेना. ब्रेकडाउन रिटेस्ट का देखते हैं. अभी रुक जाओ. कल से 300 का कॉल ऑप्शन रखा है नेचुरल गैस में. ऊपर ओवरनाइट होल्ड किया था क्या? ऊपर आ ही नहीं रहा. ओवरनाइट मत रखा करो. अभी मैं देखो इतना ही कह सकता हूँ फिलहाल के लिए. थोड़ा बहुत ऊपर आ सकता है प्राइस. 300 303 304 के अराउंड एक ट्राई मार सकता है. बट वहाँ पर कॉस्ट टू कॉस्ट आएगा नहीं आएगा मुझे नहीं पता आपका, क्योंकि आपने कितने पे लिया है मेंशन नहीं किया है. बाकी देखो ज़्यादा लॉस हो रहा है तो मेरे अकॉर्डिंग तो निकल जाना चाहिए. होल्ड करना है तो फिर एसएल आपके पास नीचे रखा हुआ है 284. इससे बड़ा एसएल लेना मत. बाकी अगर ये पुल बैक देता है थोड़ा सा 303 304 अगर प्रॉफिट में या कॉस्ट टू कॉस्ट आते हो तो निकल जाना. मदन सलोदिया जी, फ्रेश ट्रेड के लिए तो देखो नीचे यही बेस्ट है कि नीचे आ जाए यहाँ बाई कर लें. बाकी जो आप वो रीटेस्ट वाला कह रहे हो तो देखते हैं. अभी उस पर मैं थोड़ा सा वेट करो. उसके लिए नीचे बाइंग कर सकते हो. सपोर्ट पे आता है पर्पल कलर की लाइन पे के अराउंड. रीटेस्ट का थोड़ा देखना पड़ेगा क्योंकि इस कैंडल के बाद सिर्फ एक कैंडल और है जहाँ पर फिर सीधा यूएस मार्केट ओपन हो जाएगी. 15 मिनट और हैं. लेट्स सी, थोड़ा न्यूज़ ही देख लेते हैं जब तक.
Negotiations that are going on, we anticipate that that's going to continue to bolster demand for dollars and dollar-denominated securities and reduce some of the volatility that's currently in capital markets.
Deputy Secretary, we really appreciate your time this morning. That is Deputy Treasury Secretary Michael Falkender. Meanwhile, let's get a check on these markets. As Shanali mentioned, the bond market really spiking right now in terms of yield. That sell-off reigniting. You can see the 10-year Treasury yields up about 6 basis points right now. We're knocking on the door of 4.5%. That is taking some momentum out of the equity market before the bell. You can see the S&P 500 futures flipping to the red, now down 0.5%. Same story if you take a look at the NASDAQ 100. We were up slightly just a couple minutes ago, but you can see that maybe that bond sell-off that we're seeing putting some fear back in this equity market. Now coming up, bank earnings season is officially underway. We'll take a look at this morning's heavy hitters with Baird analyst David George next. This is Open Interest.
this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
In case you missed it, on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way, faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline, or trying to send one out. You could transfer millions and millions and millions of dollars worth of Bitcoin overseas, while having a glass of wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
You're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
And of course, that is Jamie Dimon striking a cautious tone as bank earnings roll in this morning. JP Morgan and Morgan Stanley have beat on equities trading, while Wells Fargo topped estimates for expenses and loan loss provisions. Joining us now, David George, senior research analyst at Baird. And only Jamie Dimon would bring in a record haul for equities trading and still have a weather report here that is so cautious. And of course, you would expect that in the midst of these tariffs. I think what investors expected less of is how well these banks are doing. Can they continue this, or is the party over?
Oh, I don't know that it's either of those. I think it's a situation where first quarter numbers were excellent. And as you mentioned, some parts of the capital markets, most notably trading, in the case of JP Morgan, was up almost 50% year over year. That's 5-0. So they did benefit quite a bit from that volatility. And then they took around $1 billion and threw it into the reserve because they can. They've got the earnings power to be able to do it. They've got the balance sheet to withstand virtually any economic environment. So I think that what Jamie is saying is that whatever we're going through at this moment, whatever we want to call it, has paralyzed business activity, and there are a lot of unknowns. But the only thing we do know is that JP Morgan's very well positioned to weather any environment, and they did guide up for their net interest income, and the NII number, Shanali, is simply just a math equation. So bank NII should be fine, but fees and credit are kind of the open questions at this point.
Yeah, I wonder if you can expand on that a little bit, David, because it seems like they may be getting a lot of trading revenue in this current quarter, but I wonder if advisory fees are going to tank, not just now, but throughout the rest of the year. Do you see a chance for that coming back?
Yeah, I think, and good morning, Matt. I think that that trading so far in April is probably pretty robust, but clearly I think everyone could agree that JP Morgan is over-earning on trading this quarter, but it did offset, as you mentioned, some softness in M&A and advisory. And I think it's fair to say, and Jamie said this a moment ago on the call, that activity levels have come to a halt, particularly in some sectors that have either direct or indirect impacts from these tariffs or prospective tariffs. So I think it's reasonable to assume that any M&A activity is going to be on pause. And I would stress that it's probably a pause rather than a cancel. And I think that's important to note. But clearly there is a ton of uncertainty. The stocks are, the quarter was very good. The outlook seems reasonable. The stocks are cheap. But for the moment, we are just going to be a victim of what's happening in the macro and around tariff discussions and really bond market volatility and equity market volatility at the same time.
Right, David. I think that's true of many industries right now. I also want to talk about Wells Fargo, also out with their earnings this morning. You saw initial positive reaction in the market, but now you can see that shares down about 2%. What's your read? I'm looking through it. I see that, their non-interest expenses actually declined. What they set aside for loan loss provisions, that came in a little bit below analyst expectations. What do you make of the numbers?
Yeah, I thought the numbers at Wells were good. They have Charlie and his team have done a great job in the face of this asset cap kind of continuing to execute their business plan. And if we're not dealing with tariff headlines, I would expect the stock to be up today. So the numbers were good. The provision came in a little light, which was a little surprising, but leading indicators, interestingly enough, on credit are good. Non-performing loans at both JP Morgan and Wells were down sequentially. So the credit situation today is quite good, and the next 6 months, I think it's reasonable to assume a shallow recession, and I think that both companies are positioned for that, and the stocks and the bank group broadly, I think, are pricing that in at this point as well.
I want to point out some of the comments that Jamie Dimon is making in the earnings call, because he's talking about the bond market. He says there could be a kerfluffle in Treasury markets. He also talks about the 10-year. He says that the notion that it has to go down is false. So you're seeing Jamie Dimon kind of draw caution to the Treasury Secretary, his wish of the 10-year being lower. He says that there could be substantive effects here at the longer end of the curve. When you think about the bond market equation for these banks, what is the scenario here that would start to concern you?
That's several questions in one, Shanali, but I think the concern is there's both direct and indirect impacts. So the direct impacts, and that it has an impact potentially on bank capital, that's something that's not particularly concerning. But I think it's important to just kind of consider how the 10-year is an integral part of our economy. On one hand, that's how the government presumably is going to fund itself. Eventually, they're going to need to issue longer dated paper. So that's a complete other TV show you may want to consider having. But as a practical matter on Main Street, which is what the administration is claiming to be in favor for in all of this, this is going to make its way into mortgages. So mortgage rates, so 10 years up 50 basis points this week, mortgage rates will be up at least 50 basis points on a week-over-week basis. So this will have implications across the entire economy. Borrowing rates for companies that want to do longer-term financing will go up. So I'm not going to try and paint it as a positive, because it's not.
All right, David, let's end on that note then. That is David George of Baird breaking down the heavy hitters on the bank earnings reporting season stage. Meanwhile, we want to pivot here and talk about these markets, because Bank of America's Michael Hartnett, the latest strategist, to tell investors to remain cautious of these rallies. He recommends actually that investors sell any rallies for the S&P 500 until the Fed steps in or the U.S.-China trade spat comes to a conclusion. He suggests a short position on stocks and a long bet on 2-year treasuries. Let's discuss with HSBC Chief Multi-Asset Strategist Max Kettner. Max, it's great to have you with us. So it's one thing to say, sell the rally, be cautious of the rally. It's another thing to say, actually, you should short the S&P 500. Where do you stand on that debate?
Yeah, I do see the same thing, actually. I think particularly on U.S. equities, still a bit cautious. In fact, there is another complication that has just been added in the last 48 hours. Just a week ago, we were trading at 385 on the 10-year. So we were anywhere near a level where higher yields would be any kind of trouble or spelling any kind of trouble for risk assets. Now at 4.5% at the 10-year, actually, we did some analysis earlier this year in January, Where's the kind of level of the 10-year where it really starts hurting all the risk assets? And incidentally, we're right at that level right now. We're at that 4.5%. We're just breaching what we call that danger zone. Now, you might argue that that is, in the current environment, not particularly important because it's all about tariffs, it's all about politics. But I would say, given this persistent uncertainty and now yields having entered that bearish, that danger zone where it puts additional pressure on equities, that makes me even more cautious in US equities, and it makes me really think, you know what, every sort of short-term rally that you've got, just like on Wednesday, for example, those are really the kind of rips that you want to continue to sell.
All right, so yeah, cautious or actively selling? Do you just sell the rallies? Do you actually short US stocks?
Yeah, I mean, look, in our asset allocation, we're massively underweight US equities. We're massively underweight US high yield, right? So we are really having right now a much, much bigger allocation to rest of world equities. I think particularly Eurozone, even China, I think stand to benefit, at least in relative terms right now. But of course, it's all about where do you hide out right now? Because previously we were thinking, okay, if I short equities, Matt, just like you were saying, what do I do? Where do I put it? Do I put it in long-term bonds? Well, that's not really working right now. The correlation has snapped back into positive, and obviously perhaps we might even get something like debt sustainability concerns once again, and that would be weighing on the long end of the curve, at least temporarily again. So, you know, US Treasury is probably not the place to hide out. US dollar as well. I think it's much more yen and gold.
Max, you're sticking with us. That is HSBC's Max Kettner. Futures lower ahead of the opening bell, less than 4 minutes away. Stick with us. This is Open Interest.
Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Mondays on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Futures are down just about 1/3% here on the S&P, a little bit less on the NASDAQ. But really, I think a focus should be on yields because they continue to rise, and that is not a great thing, as we heard from Andrew Sliman yesterday, for stocks, or vice versa. There's the opening bell at the New York Stock Exchange. Project Hood ringing the bell down there. I don't think they necessarily sell anything, but PetMeds tries to, and they brought dogs to the NASDAQ marketplace, which is something I think we need on this Friday of doom and gloom. Unfortunately for those dogs, the stock is down 90% over the last 5 years. What stocks, Katie Greifeld, are you watching this morning? How are they doing?
Well, I'm looking at the banks, and they're also not doing too hot. They did post strong trading revenue thanks to these very volatile markets. You did hear Jamie Dimon warn of turbulence ahead, though. You can see that his stock, though, is up about 0.7%. But you look at some of his peers, Wells Fargo, Morgan Stanley, after actually gaining pre-market, Shanali, now down as the cash trade begins.
Certainly a choppy market. I'm looking at Apple taking a downturn because, of course, they face major headwinds from the U.S.-China trade war, with analyst Dan Ives saying iPhone prices could rise to $2,000 in a matter of weeks. Apple now down about 1.3% at the market open. And Matt, I'm feeling kind of bummed that I just broke my iPhone this week.
Well,
gonna have to get a new one.
Buy one now before those tariffs hit. Dan Ives was saying 90% of iPhones are made in China. That's even more than I thought. Tesla is halting sales in, speaking of China, of 2 of its models of EVs imported from the U.S. Obviously, they are subject now to 125% tariffs, so that would make the price exceedingly high. Bloomberg Intelligence senior analyst Mandeep Singh joins us now to break down what we're seeing in terms of the tech trade. Let me first just ask about Tesla. I don't even know if it's in your wheelhouse, but does it matter about car sales? I mean, this is a robot AI company, right?
Well, not really. I mean, if you look at how they make their money right now, it is all about the EV car sales, and to an extent, autonomous driving. Is less than 10%, but I think EV car sales do matter a great deal for Tesla.
So it still matters for Tesla. Let's talk about the rest of the food chain here. When you think about the Magnificent Seven, obviously it's been a very tough trade. And I mean, what is the bull case right now? We've heard a lot of bearish takes, a lot of doom and gloom. Dan Ives is changing his stripes as well. What do you see as the light at the end of the tunnel here?
Yeah, look, just this week we heard 2 of the Mag 7 give their CapEx guide, and they reaffirmed it. They said, irrespective of the economy, we are spending CapEx. So to my mind, 4 of these hyperscalers are spending their CapEx dollars. It benefits the 5th one, NVIDIA. And if you leave aside Apple and Tesla, I mean, AI is what has carried the weight of this market since end of 2022. And I feel it's still the secular trend that everyone is bullish on. Companies are spending. So from that perspective, you could see, sentiment improve. And this earnings season obviously will be a good indicator in terms of the impact of tariffs. But what these companies are suggesting is even if there are tariffs, they're only going to bear, part of the tariff impact. The rest will come from suppliers. Probably 1/3 will be borne by the customers. So from that perspective, the margin downside, at least for now, seems to be limited. And as long as these companies are bullish on CapEx, I think the AI side of the story still remains intact.
Mandeep Singh of Bloomberg Intelligence. We are now back also by Max Kettner, HSBC Chief Multi-Asset Strategist. And I want to double down on the tech story in this market because the declines you're seeing in Apple, I just took a look at how steep they are relative to other times. And almost 25% decline into April this year is equal to nearly their entire loss for 2022. We knew how the market ended up that year. And so you are seeing a mixed trade when it comes to big tech. How do you treat it, and do you worry about much steeper declines ahead?
I do worry. I'm not sure whether that's just tech. I don't think it's just a tech-driven story. Where I actually worry a bit more, rather than just the Magnificent Seven, is when we look outside of the Magnificent Seven, I think cyclicals over defensives, not only in the US, but really also globally, are not yet pricing in enough pain. So you could argue, when you look at the Mag 7, that perhaps they've already started pricing in quite a lot of pain already. The issue, of course, is that would be probably applicable in a normal sort of downturn scenario where the data slow down because of, let's say, cyclical reasons, a kind of sort of typical risk-off scenario where you would say, fine, that is where I'm more buying the structural stories, the structural growth stories like the Mag 7, and I'm going short the cyclicals. Of course, right now, with the tariff headlines, you sort of probably make the argument, at least short term, that it's probably going to be both the Mag 7 and the cyclicals. And to your point, Janali, that probably means, you know, steep declines. Yeah, if it's both the cyclicals declining and the Mag 7, that means there's quite a bit of downside ahead, I think.
Are there index levels, Max, or individual asset price levels where you have picked out a buy? I mean, when you're sitting in bed thinking about this at night, are you like, man, I'll buy the Mag 7 index when it gets to 1700?
Not sure that's what I'm thinking about when I go to sleep, but you know, apart from that, when I think about it, I think when we look at some of our fundamental models, then you know, the gap between cyclicals over defensives globally relative to our sort of fundamental models is at the moment around 9 percentage points high, and that gap really needs to be closed. So we need to see a sort of underperformance of cyclicals over defensives globally of another 9 percentage points. I think then we're at the place where we can say, look, if there's a recession coming, it's now thoroughly priced in, so buy at these levels. If there's no recession coming, or only a shallow slowdown, then buy even more, right? So that's sort of what we're waiting for. I think it's a 9 percentage point roughly out underperformance of globally cyclicals over defensives. Right. Then I think we can really say this is pretty likely the bottom.
I want to talk about drivers here, because it just feels like the bond market is in the driver's seat. I mean, we know that President Donald Trump is watching the bond market because Jamie Dimon is watching the bond market, and it just feels like stocks and equities in general around the world are responding to what's happening in the U.S. Treasury market. So how hard is it to make a call on stocks right now, given that it seems to be technical factors that are at play in fixed income?
Yeah, so I would, you know what, I'm going to be a classic strategist and agree with half of your statement and disagree with half of your statement. I think, you know, when we look at it, the technical drivers, I think you're 100% right. We've seen a lot of unwinding of systematic strategies, of trend-following strategies. That's likely coming to its end. That's number one. Number two, the bond market move, of course. Like I said in the first segment, you know, we are starting to enter that danger zone, that zone where really higher yields start biting risk assets across the board. Again, that doesn't help that it's technically driven. But I would argue, when we look at the next 3 weeks, the reporting season, look, I mean, as a corporate, as a CEO, CFO, you've got every incentive right now to pull your guidance, or to cut your guidance at least. And that, of course, would be, I think, taken by the market as sort of the first evidence that on the ground, things really start deteriorating, or perhaps have already deteriorated. And then, of course, the recession worries intensify even more. So I would say half of it, yeah, technically driven. The other half, however, is really very, very classic old school fundamentals around a recession and slowdown fear.
We are going to bring you guys a lot more about those guidance cuts in this show. But first, Max, I want to talk to you about the VIX, because you're looking at sustained volatility here at levels that you really have not seen. We saw, of course, the carry trade unwind last year, but to stay above 40 for this long, you really haven't seen it since the onset of the pandemic. And if you're sitting there, a trader with an itchy trigger finger, do you sit there and buy volatility now? Do you think it actually gets worse from here? Do you sit there and, given the bearishness that still exists out there, do you head for put buying? What is the trade that you could make here that is the safest one?
Yeah, I don't think it's VIX buying right now at the moment, because when we look at the VIX futures curve, so look at the first versus third future, look second versus fourth or something like that, it is fully inverted, i.e. really buying protection now on the front end is extremely costly. So that's probably not it. I think it's much more raising cash. Where do I put the cash? Do I put it in gold? Yes, absolutely. Still at these levels, I think I'd be an absolute buyer of gold, because, you know, in a stagflation scenario, that should be outperforming the long end. In In a scenario where we are more worried about debt sustainability, it outperforms the long end. And if we get proper recession, I would argue probably the long end and gold perform pretty much in line with each other. So it is still gold levels to buy gold. I think also in terms of parking cash, what currency? I think the Japanese yen still really stands to benefit here. And in terms of where do you put the money, it's probably more like something like euro rates. You know, the ECB has more room to cut, and it is perhaps less prone to these sort of technical factors that we were just discussing around the bond market. So euro rates is probably a bit of a better risk-off alternative and hedge than treasuries. But on the VIX specifically, I think it's got a bit too punitive, certainly too costly because of this full-on inversion of the VIX futures curve.
All right, Max Kettner talking to us about the inversions out there. Thank you so much for joining us from HSBC. We will be watching that ECB decision in 6 days from now. Big bank earnings began this morning. Shanali's been here since like 3 a.m. We'll recap all of those reports next and tell you what they mean. This is Bloomberg Open Interest.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
We give longer term money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things.
Could I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
All right, so now for our top calls, some of the analyst action in focus this morning. And first up, American Express getting upgraded to a buy over at Bank of America. The firm says it's recession resilient and that high quality customer base should drive earnings and also keep those credit losses in check. Next up, we have Cinemark getting raised to a buy over at JP Morgan. The firm says that the cinema company is one of the least economically exposed firms in today's volatile environment. People are still going to the movies. And finally, we have Cody getting downgraded over at BNP Paribas Exane. The firm sees a more unfavorable backdrop thanks to lackluster beauty trends and tariffs, Janali.
And now we're going to head back to the banks because JP Morgan reporting strong results, but CEO Jamie Dimon expressing caution about the economy.
People are not doing things because of this. They're going to wait and see, and that's M&A. That's M&A with middle market companies. That's people's hiring plans and stuff like that. So people have to adjust this new environment.
For more, we are joined by Bloomberg finance reporter Catherine Doherty. There are live blogs going on for both calls, JP Morgan, Morgan Stanley, from all of our colleagues on the finance desk. I know bagels are around the corner for us, too. Long morning. You know, despite the numbers themselves, we saw record trading at Morgan Stanley and JP Morgan. How do you describe the kind of caution we're hearing from the bank executives?
So there's the two consumers and the corporate clients that they're both painting this very tepid, uncertain outlook ahead, and that is affecting behavior. So for consumers, what JP Morgan's on their call, what they highlighted was that the behavior has been actually a move forward. People are spending with the expectation that costs for some of the goods, whether it's an iPhone or maybe it's something that you were holding out to buy, a car, you might be going to get that item now with the expectation that prices could increase tied to tariffs. Now, with corporate behavior, what was referenced on today's call is that they're starting to see a lot of the companies that they're working with hold back on, they're changing their strategies. So they're looking at what are the things that we need to do to shore up our ability to potentially handle price increases, or if these tariffs do change the way that we need to manufacture, potentially moving to the U.S., those are the types of decisions that money managers at these companies are starting to think about, rather than how to spend to be more on the offensive, rather than, I think right now what's the change in the mood is moving to the defensive.
I've been monitoring savings account levels and debt levels, and they seem to be savings account levels moving lower, debt levels moving higher across income groups. Have you heard any bifurcation of consumers? Have you heard anyone talk about a low-income consumer is having a tougher time, a high-income consumer is doing better, or are they all put in one bucket now?
So across the board, JP Morgan just highlighted strength for the consumer and that they're not seeing cracks yet. But I do think that what they are also pointing out, in the difference that you're alluding to, is that with the higher end consumer, there is a slight advantage that they're given. And I think that they're seeing that in the form of spending, and also the savings are they have a little bit more of a cushion than at the lower end of the consumer, but they're not yet saying that that low end consumer is experiencing financial stress that would cause concern as of today.
And Catherine, I want to talk a little bit about Jamie Dimon, the man himself. I mean, he just said on the earnings call that the bank will be in the crosshairs of the trade war. But as you've reported on throughout this week, Jamie Dimon has been also an influential voice when it comes to our trade policy.
That's correct. He has spoken an earlier interview on Fox. He put out his annual letter on Sunday night. So those were both moments that the market and even President Trump was digesting, putting out his own reactions to what Dimon was saying. And on today's call, analysts did ask Dimon, was this changing how you were given your own outlook, or were you even aware of the president listening in to your commentary? And he said, I was not aware, and it does not change my approach or how I want to communicate to our customers and to the market at large.
Kat, thank you so much for this. Catherine Doherty of Bloomberg News. And I want to point out, guys, Morgan Stanley, one little gem in all of these standout figures is the almost $700 million they made in so-called other revenue, much of which was tied to selling off the debt tied to X. So Elon Musk, a friend to Morgan Stanley in this administration.
But did that debt cost them money over the last 4 or 8
That's a good
or
question.
12 quarters?
I would say the opportunity cost, you can consider cost. And also, by the way, because Jamie Dimon was saying there's more hung loans, we know that that could hurt for a while. But, you know, a happy end to what has otherwise been a long, frustrating story. Don't forget to tune in. We have an interview with Wells Fargo CFO later today at 3 p.m. New York time. Wells Fargo has been choppy in the trade. We'll see what he has to say. Now coming up, President Trump's dreams of phones being made in America. We're going to look at how realistic that is next. This is Bloomberg Open Interest.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. The Spanish bank BBVA has gained worldwide respect for its efficiency and commitment to innovation. CFO Luisa Gomez Bravo welcomes the challenge of keeping her company on the cutting edge.
In the world that is changing so fast, having a finance function that adapts quickly is crucial.
Watch Chief Future Officer only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. Check on stocks. Right now, we are seeing gains on the S&P 500 at 1/3%. The NASDAQ rising 0.4% as some of the big tech stocks are rising. I think it's interesting that you're looking at yields that continue to climb, although we're a little bit off the danger zone in the 10-year yield of 450 right now at 448.16. These tech stocks are the reason that you're seeing green on the screen. Okay, Tesla is down, but not by much. Nvidia is up 2%. Apple is up 0.5%. You've got Google and Microsoft gaining, and then the banks, well, JP Morgan, the one bank that's really putting up some gains, Katie. And that is enough to lift the market 1/3%.
And you can see also Apple shares up about 0.5%. And that's where I want to focus in on, because this week the White House made its stance clear. President Trump wants Apple to begin building iPhones in the U.S., but the dream of an American-made iPhone really faces a reality check. So let's discuss that now with Bloomberg Technology co-host Caroline Hyde. So Caroline, walk us through the different components here. There's the issue that I don't think we have the factories that are needed to build these iPhones in the United States, but talk to us about labor, suppliers, the list goes on.
The talent, the engineering tooling, that we just don't have the labor capabilities. There's a great sort of visual that Mark Gurman, who is our key Apple reporter, paints. Do you want the entirety of Boston to become iPhone City? Because that's what it's going to take. It's going to take hundreds of thousands of people, and you'd have to totally flatten Boston, remake it into a manufacturing hub where people can sleep, they can eat, they can go and get their hair done, they can have gyms. It would be an entire city where the right labor supply comes together with the right ecosystem of STEM learning to supply that labor. And then you need the ecosystem of suppliers to come in as well. Asia is perfect for it. The US is not.
How insane is the supply chain? And well, you know, you have another comment that you made in the IB that I have to bring up too.
Yeah.
Why Boston, right? I mean, maybe
well, that's all right.
real
It's
estate,
500,000 people, and that's about the amount of people that you're going to need
in the whole city. But you know, just to kind of talk through the
tiny town. There's only 500,000 people in Boston. It's got to be more than that.
Maybe not sprawling Boston, inner Boston.
Got it.
You know, to the point that you guys are making here, it's not just the size of the amount of workforce we need or space that's needed, it's the actual materials as well.
Precisely, and that's why some of the rare earths and some of the imposition of stopping selling things into the United States is going to be a real hamper for the tech ecosystem if you wanted to build it here. Look, actually, Apple already makes Mac Pros in Texas, but where do they get the parts to assemble that Mac Pro? From China. Ultimately, this is about having to have the entirety of the chemicals, the rare earths, the ecosystem, the fact also that we are turning over iPhones, every 6 months? So it's not just about having one manufacturing unit that's good to go. It's about re-catering that manufacturing unit every 6 months to be able to make the most precise little changes. This is why they've tried in India. This has been for a decade. They've tried to make India a hub. And it almost is. Look, they're going to be fulfilling about 35 million phones. That is going to satisfy a lot of the demand in the United States. That is where Tim Cook is going to be focusing all his energies. But this isn't easy to do. They've been trying to diversify for many years, and ultimately India has got the space and it's got the people, it's got the STEM education. They've been able to replicate to a certain extent, but 220 million phones are sold per year,
right,
and of varying degrees with different intricacy. Over in Brazil, in Latin America, they do have a hub, but for much lower end phones as well. So this is really sophisticated and hard.
Well, and also diversifying to India and to Brazil is a lot different than producing here in America. When I talk to car makers, they all tell me, none of them on the record, obviously, that you know, it takes so long to do this, and it's such an investment for the future that maybe they wait 2 years and see how the Republicans do in the midterms. And certainly, unless he changes the Constitution, right, Donald Trump isn't staying here for longer than one term. So,
and Apple has committed a lot of money. Look, we heard from the spokesperson of the White House, of course, Caroline herself, good name, but spelled with a K. Caroline Leavitt was saying, look, they're already putting a big chunk of change into the United States. What was it, $500 billion that they've committed to spend over the next few years? But that is in the manufacturing and more of data centers. This isn't going to be about the intricacies of making an iPhone. It is a decade-long program, and this is why you're seeing Apple sell off so hard. Yes, it's up today. Yes, it's up on the week, but it's still down by more than 5% on the month. More broadly, people are worried about a 90% increase in costs of making an iPhone if you brought it to the US. That's what Bank of America say.
all right. Caroline, thanks so much for joining us. Caroline Hyde, they're talking to us about Apple and the iPhone, how much it'll cost if these tariffs stay in effect. Coming up in the next hour, we'll talk to Joanne Shu from the University of Michigan on the consumer sentiment data that we're going to get out at the top of the hour. This is Open Interest.
In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. Our lives are migrating online, and I think these data centers are a critical part of that infrastructure. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. You take a check at these markets right now at or close to session highs. The S&P 500 up about 0.3%. The NASDAQ 100 up by about 0.5%. You're also watching a bond market sell-off really gain momentum as we await for some numbers here at the top of the hour when it comes to University of Michigan sentiment. Still waiting for those figures, but you can see the 10-year yield up about 9 basis points or so, now above 2.5%. And here we have it, the data for the April preliminary period. University of Michigan sentiment, the headline read here is 50.8. That is below expectations, and that is well below the prior read of 57. I want to go to the inflation expectations because, boy, what a pop. The one-year inflation expectation, the short term, coming in at 6.7%. The estimate had been for 5.2%. So really, inflation expectations on a short-term basis rising rapidly. Similar story, but less so if you take a look at the 5 to 10-year inflation expectations coming in at 4.4%. That is above the estimate for 4.3%, Matt, and it's well above the prior read of 4.1%. So sentiment going down, inflation expectations going higher, Matt.
Yeah, along with yields, right? The 10-year now at 4.52. So rising up and over that danger zone. Joining us to talk about this survey is Joanne Shu, University of Michigan Surveys of Consumers Director. Joanne, thanks so much for your time. Is this, again, the kind of survey that can be broken down and incredibly divergent when you look at Republicans and Democrats?
Actually not divergent at all this month or for the past 2 months. We have Americans from across the political spectrum telling us that the outlook for the economy has deteriorated over the last 2 months. The inflation expectations increasing for the short run, that was across political affiliation. For the long run, that was largely driven, most visible among independents. So we're really seeing across the board widespread concerns that the outlook for the economy is getting worse.
A few of the data points that Katie had just mentioned, and you say this word in this statement as well, that there's some alarming nature of how consumers are behaving right now. And when it comes to inflation expectations, costs rising 6.7% in the coming year, the highest since 1981. What is the risk with that type of an expectation that inflation becomes entrenched?
So I do want to note that our interviews closed on April 8th. So that's prior to the recent April 9th announcement about the tariff rollback. But that being said, we've seen a lot of increases in inflation expectations with all the developments with tariff policy, whether the tariffs are going up or whether they're going down. Consumers are acting on their beliefs back in November and December when people were saying you should buy big ticket items now before before tariffs kick in and things get more expensive next year, we indeed saw very strong, robust sales in durable goods as well as automobiles in Q4 of 2024. The thing that is a little bit different right now is that since the election, sentiment has gone down, and the outlook for not just inflation, but for labor markets, for personal incomes, for business conditions have all gone down. So we have two competing risks here. We have the risk of escalating inflation, but consumers are also likely to pull back given they're so pessimistic about their own incomes and labor markets.
Joan, I want to look at recent history because especially during the pandemic, still in the midst of it, 2020 to 2022, the sentiment readings were also very poor, but you never saw the consumer really crack. The narrative out there was like, okay, we have sentiment in the gutter, but people are still willing to spend through it. Do you think that that's the playbook now if you take a look at the balance of risks in this economy?
The reason why consumer spending remained robust during that pandemic period, despite low sentiment, was because labor markets were so incredibly strong and income growth was robust. Consumers were confident that if that their incomes would be reliable and if they needed a new job, that they could get it. And that's the big thing that's completely different right now. Consumers are seeing vulnerabilities in labor markets, which, if you just expect the unemployment rate to go up and you don't feel like you're going to be personally affected, that might not impact your behavior. But across the board, and most concerningly among higher income people, we're seeing their forecasts of their own income growth weaken quite a bit. The probability of your own job loss over the next few years, that's gone up to very high levels. Consumers are worried that weakening labor markets are going to hit them personally, and that does not bode well for continued consumer spending.
So they're worried about their own jobs. They want to get some goods now or have already bought them before tariffs go into place. And then are they putting off purchases, Joanne?
I think it's too early to tell. Consumers are in a very much a wait and see situation. They're really bracing for the other shoe to drop in terms of trade policy leading to eventual price hikes and higher inflation. So you have kind of these competing things of people are trying to beat future price increases, but at the same time, they're not really willing to plan very far into the future because there's just such a tremendous amount of uncertainty.
Joanne, I want to go back to something you were just talking about, this idea that it's not just the lower income consumer feeling the pressure at this point in time. I know a lot of investors, economists have been calling this a bifurcated economy. To what extent is the concern about the consumers starting to eke up in terms of income scale?
Right now, we're seeing vulnerabilities across the income distribution. We're not saying that people are vulnerable right this moment, but people's outlooks are weakening even for those at the top of the income distribution. One of the things that also supported consumer spending in 2022, 2023 was that higher income folks, their sentiment actually recovered quite nicely, and they.
तो guys 7:30 का डेटा भी आ चुका है प्रीलिम कंज्यूमर सेंटिमेंट का एंड इन्फ्लेशन एक्सपेक्टेशन का भी मार्केट ओपन हुआ क्रूड स्टिल रेंज के अंदर ही अटक गया नीचे से वापस सपोर्ट ले लिया ऊपर से रेजिस्टेंस तो इन रेंज कहीं ब्रेक नहीं हो रहा है बाकी इन्फ्लेशन एक्सपेक्टेशन का डेटा तो न्यूट्रल था कंज्यूमर सेंटिमेंट का डेटा नेगेटिव डॉलर के लिए पॉजिटिव फॉर गोल्ड एंड सिल्वर अब आज और कोई डेटा है नहीं बाकी नेचुरल गैस को भी देखोगे लास्ट कैंडल 7:30 की जो कैंडल थी मार्केट ओपनिंग के बाद तो यूएस मार्केट ओपन होते ही असर उड़ा दिया इसने यहाँ पर लेट्स सी वापस नीचे आता है या फिर रुकता है यहीं पर Nasdaq plan to enter but cannot find the level then find the level press Control F you will find any level ठीक है गाइस ज़्यादा रिस्क मत लेना अब ठीक है क्रूड ऑयल में बाकी मॉर्निंग से देखेंगे 4 ही ट्रेड बने हैं एक बाइंग का क्रूड में एक सेलिंग का उसके बाद एक हल्का सा बाइंग का था नेचुरल गैस में काफ़ी देर रुका नहीं गया एक सेलिंग का लगाया था इसमें एसएल जा चुका है लेट्स सी कोई नया और ट्रेड बनता है तो अब जी ब्रेक नहीं कर रहा है, किस चीज़ का वेट कर रहा है क्रूड? वाई क्रूड वाई? इसमें देखो अगर ये वापस नीचे आ गया इन केस 303 के नीचे वापस आता है तभी सेल कर पाएंगे वापस, और तो इसमें कोई ट्रेड नहीं है। ऊपर जाएगा तो कोई सपोर्ट तो है नहीं कि बाई कर लें। पुल बैक देखेगा देगा तो देखेंगे 300 के आसपास। बाकी इसका एसएल जा चुका है, ध्यान रखना, ठीक है? ये सेलिंग वाला ट्रेड नेचुरल गैस का जो था, इसको रिमूव कर दो। नेक्स्ट वीक कौन सा डेटा है अभी? और संडे 14 मंडे से लेकर 19 के बीच में। मंडे को तो कोई खास डेटा है नहीं। ट्यूसडे को एम्पायर स्टेट मैन्युफैक्चरिंग इंडेक्स का डेटा है, गोल्ड और सिल्वर को थोड़ा बहुत इम्पैक्ट करता है। ये है वेनेसडे को डेटा, एक को रिटेल सेल्स और रिटेल सेल्स का डेटा रहेगा, क्रूड ऑयल की इन्वेंट्री और फेड चेयरमैन पावेल की स्पीच है। ये इंपॉर्टेंट डे रहेगा। इसके अलावा थर्सडे को अनएम्प्लॉयमेंट क्लेम्स, नेचुरल गैस इन्वेंट्री, हाउसिंग स्टार्ट का डेटा, दैट इज आल्सो फॉर गोल्ड एंड सिल्वर। तो नॉर्मल डेटा है। एक ये फेड चेयरमैन की स्पीच का ध्यान रखेंगे क्योंकि रेट कट के बारे में कुछ ना कुछ तो ज़रूर बोलेंगे इस स्पीच में। क्रूड मूव क्यों नहीं कर रहा है मुझे भी नहीं पता। नॉर्मली इतना तो नहीं रुकना चाहिए। किसी चीज़ का वेट हो रहा है शायद नेचुरल क्रूड ऑयल में। मॉर्निंग से मोमेंटम ही नहीं है। लाइक करते रहो गाइस। 40 लाइक्स आर डन, 100 का टारगेट है। जिन लोगों ने नहीं किया लाइक अभी तक, कोई क्वेश्चन हो तो कमेंट बॉक्स में पूछ लेना। वो ना उसको 5 करते हैं। हाँ, ठीक है, चेक करेगा तो देख लेंगे। लेट्स सी। नेचुरल गैस तो सपोर्ट से ही सपोर्ट लिया है। यार नेचुरल गैस में सपोर्ट तो नहीं था यहाँ पर कौन सा सपोर्ट था? यहाँ पर एक सपोर्ट था इस एरिया पे, आया नहीं हो एग्जैक्टली देख पा रहे होगे, हिट नहीं किया, थोड़ा सा रह गया। एक सपोर्ट यहाँ पर जरूर था पर्पल कलर की लाइन के आसपास, बट एग्जैक्टली नहीं आया वहाँ पे, आ जाता तो बेटर ही था। मंडे को मार्केट ओपन ही है, क्लोज की होगा। नेचुरल गैस ब्रेक, सॉरी क्रूड ऑयल ब्रेक करता है तो देखो नीचे ब्रेक करेगा तो फिर 5037 के अराउंड देखेंगे, वहाँ पर एक सपोर्ट है। अभी रेंज के अंदर ही है, ब्रेक ही नहीं हो रहा ना ऊपर ना नीचे, कोई ट्रिगर पॉइंट नहीं। अब तो यूएस मार्केट भी ओपन हो चुका है ऑलरेडी। क्रूड ऑयल कहाँ तक आज क्लोज देगा पूछ के आता हूँ सर, थोड़ा टाइम लगेगा। हाँ हेलो ट्रम्प, क्रूड ऑयल को कहाँ क्लोज करना है बताओ। अच्छा नीचे क्लोज करना है, ठीक है। देखो ट्रम्प तो कह रहा है कि नीचे क्लोज करो करके, 5000 के नीचे लेके जाओ। एक बार मोदी से भी पूछ लेता हूँ उनका क्या कहना है। ट्रम्प का भरोसा नहीं ना, अभी हमें क्या बता के नीचे क्लोज करना है, अपना खुद बाय करके ऊपर चला गया तो गड़बड़ हो जाएगी। तो डबल कंफर्मेशन, सेकंड एडवाइस लेनी जरूरी है। कैसा क्वेश्चन पूछा है बताओ सर, मुझे कैसे पता होगा क्रूड ऑयल कहाँ तक क्लोज होगा, हाउ कैन आई नो इट। ये चीज़ें अगर पता हो तो फिर तो मैं भगवान ना हो जाऊं। बाकी कल मैंने बताया था इंट्राडे में कोई प्रिडिक्शन होता ही नहीं है। अभी मार्केट बुलिश लग रहा है, बाई कर रहे हैं, अभी थोड़ी देर में बेरिश हो जाएगा। तो मार्केट कहाँ क्लोज होगा जाने दो, जहाँ क्लोज होगा हमें क्या करना। सपोर्ट है बाई करो, रेजिस्टेंस पे सेल करो, एक एसएल रखो, एक टारगेट रखो, एसएल जाए तो निकल जाओ, टारगेट जाए तो प्रॉफिट बुक कर लो। इतना ही काम है, इससे ज़्यादा नहीं सोचना। एक और था यहाँ पर, हाँ ये खोल में है क्या ये? अभी फिलहाल रेंज ही ब्रेक कर दी है, तब तो कुछ समझ में आया इसमें। क्रूड में रेंज ही ब्रेक नहीं हो रही है तो खुद पता नहीं है मुझे कहाँ ब्रेक हो गए। ऊपर भी हो सकता है, नीचे भी हो सकता है। मैंने प्राइस सेक्शन बता दिया है। ये जो फ्लैग पैटर्न, इसको हम फ्लैग पैटर्न बोलते हैं। फ्लैग पैटर्न चाहे डायरेक्शन कोई भी हो, मतलब ट्रेंड कोई भी हो, उससे फ़र्क नहीं पड़ता। बुलिश ट्रेंड होगा तो भी ब्रेकआउट भी हो सकता है, ब्रेकडाउन भी हो सकता है। बेरिश ट्रेंड होगा तो ब्रेकडाउन भी हो सकता है, ब्रेकआउट भी हो सकता है। हाँ, अगर ये सिमेट्रिकल ट्रायंगल पैटर्न होता और मार्केट अप ट्रेंड में होता तो ब्रेकआउट ही होता है, और अगर डाउन ट्रेंड में मार्केट चल रहा है और ये सिमेट्रिकल ट्रायंगल पैटर्न होता तो ब्रेकडाउन ही होगा। तो कुछ रूल्स होते हैं पैटर्न्स के, उसके अकॉर्डिंग इससे एक सिमेट्रिकल ट्रायंगल पैटर्न नहीं है, दिस इज़ अ फ्लैग पैटर्न, जिसको हम पीनट पैटर्न भी कहते हैं। तो उसके अकॉर्डिंग ये दोनों साइड ब्रेक कर सकता है। तो सबसे बेकार पैटर्न है, मतलब सबसे इंटरेस्टिंग भी कह सकते हो, बट प्रोडिक्ट थोड़ा सा कर पाना मुश्किल होता है। कई बार ऐसा होता है एक फ्लैग पैटर्न या पीनट पैटर्न बनता है, उसका ब्रेकआउट होता है, फेक होकर नीचे निकल के चला जाता है ऐसे। तो इसमें रीटेस्ट भी बड़ा इंपॉर्टेंट एक रोल होता है रीटेस्ट का, ये मैंने बताया भी है। हेलो सागर जी, हेलो सागर जी, कैसे हैं आप? सागर जी, आपकी हेल्प चाहिए? मुझ तुच्छ प्राणी से आपको क्या सहायता चाहिए? हैरी पॉटर, अपनी छड़ी घुमाओ और एक मंत्र गाओ, पवन मुष्टिका। सब आपके आगे आ जाएगा, बताओ। हैरी जी, हैरी पॉटर। ठीक है, देखो वापस आ गया नेचुरल गैस फेक ब्रेकआउट देके। आना इसको नीचे ही है, बट वो यूएस मार्केट की कैंडल 7 PM की ओपन हुई है, उसमें एक थोड़ा सा ट्रैप करने की कोशिश करी इसने, कर ही दिया, मतलब एक तरह से वापस नीचे आ गया लेवल के। कितना नीचे आ सकता है बेबी कॉन्सर्न है, ज़्यादा नीचे आने के चांसेस भी नहीं है। 300 तक तो आना चाहिए। 300 के नीचे देखते हैं जाएगा नहीं जाएगा, 300 पे रुक जाना चाहिए। 300 पे रुक जाएगा। नैस्डैक का चार्ट 15 मिनट। तो ये नेचुरल गैस फेक ब्रेकआउट दिया, वापस नीचे आ गया, वापस अगर सेल किया है तो इसका टारगेट अब बड़ा नहीं है, 300 के आसपास एक टारगेट रख सकते हो बस। ये ना सब एक साथ ही ओपन हो जाना चाहिए, यूएस मार्केट, कोई डेटा आने वाला हो, फॉरेक्स मार्केट, सब एक टाइम पे ओपन होना चाहिए ताकि जितनी वॉलेटिलिटी होनी है उस कैंडल में हो जाए। अदरवाइज अच्छे खासे लेवल के ऊपर नीचे हो जाते हैं पूरे। ये 286.54 सबसे बढ़िया वाला। ठीक है, थोड़ा बहुत 300 तक आने के चांसेस हैं, उसके नीचे देखना पड़ेगा गिरेगा नहीं गिरेगा, 300 तक तो आ ही जाएगा ये नेचुरल गैस। इसके नीचे देखते हैं। 300 तक तो पक्का है। नैस्डैक को देख रहे हैं, ठीक सेकंड। यार अभी यूएस मार्केट ओपन हुआ उसके बाद से देखोगे यूएस मार्केट की पहली कैंडल के बाद रेंज के अंदर ही चल रहा है, ऊपर से थोड़ा सा रेजिस्टेंस था, नीचे आ गया है। फ्रेश क्या प्लान कर सकते हैं, रेंज के अंदर ही है। ओके, ये हो गया आपका। ठीक है, देखो ऊपर 18,740 के अराउंड एक रेजिस्टेंस मिल जाएगा आपको, 740 760 के अराउंड 15 मिनट टाइम फ्रेम पे। या कुछ खास लेवल नैस्डैक के दिख नहीं रहे हैं अभी, एग्जैक्टली सपोर्ट से दूर है, रेजिस्टेंस से भी दूर है। मैं हूँ, कहाँ तक होल्ड करूँ अब इसमें, मैं वही कुछ नहीं कह सकता सर, अभी इसमें मेरे सामने कोई लेवल बने नहीं है। ट्रेलिंग ऐसा लगा के ट्रेल करते रहो 18,065 के अराउंड। वहाँ पर थोड़ा बहुत रुक सकता है 18,065 के अराउंड। ओपनिंग ठीक है 18,065 के अराउंड थोड़ा बहुत रुक सकता है प्राइस वापस से अगर सेल किया हुआ है। सपोर्ट जोन ही है फिलहाल के लिए तो 18,040 से लेकर 18,100 के बीच में नैस्डैक में थोड़ा बहुत तो रुकेगा यहाँ पर रुक ही रहा है वो देखो थोड़ा बहुत बाकी ऊपर रेजिस्टेंस है डे हाई 18,500 टू 550 एक छोटा सा ऊपर से 2-3 बार रेजिस्टेंस लिया नीचे से भी 2 बार सपोर्ट ले चुका है थर्ड टाइम है यहाँ पर ओवरऑल रेंज कह सकते हो प्रॉपर देखो ज़्यादा अच्छा रेजिस्टेंस मार्केट के ऊपर 18,950 के अराउंड ही मिलेगा अभी वैसे तो डे हाई भी है बट ये रेंज के अंदर फंसा हुआ है तो लुक एट दिस क्या पुल बैक आया है 15 मिनट में 225 225 पॉइंट का पुल बैक गैस भी एज एक्सपेक्टेड 330 तक आ गया है। इसके नीचे देखना पड़ेगा गिरेगा नहीं गिरेगा, और इम्पोर्टेंट लेवल है बिकॉज ये अब प्रॉफिट बुक कर लिया हुआ हैरी जी। प्राइस एग्जैक्टली सपोर्ट से 215 पॉइंट रिवर्स कर गया है। नेचुरल गैस के सेलिंग में ही अप्रोच में हूँ, मुझे लग रहा है सेलिंग ही आनी चाहिए थोड़ा, अगर यहाँ से ऊपर भी जाता है तब भी। आई एम नॉट एक्सपेक्टिंग मच बाइंग अबव स्पेशली 315। बाकी किसी ने वापस सेल किया था तो एज एक्सपेक्टेड 300 तक आ गया है, वो निकलना चाहो निकल जाओ। कोई फ्रेश ट्रेड अभी यहाँ पर है नहीं नेचुरल गैस में। फेक ब्रेकआउट सा वापस नीचे आ गया, थोड़ा वेट करेंगे अब। थोड़ा सा अगर और पुल बैक दे या फिर 300 के नीचे निकले तभी कुछ और नया ट्रेड बनेगा अब। नो न्यू ट्रेड। इसने यही एक रेजिस्टेंस कंसीडर कर लिया लगता है। बाकी 315 के ऊपर क्लोज तो नहीं होगा प्राइस आज के दिन, इतना मैं कह सकता हूँ। नेचुरल गैस में 315 के ऊपर क्लोजिंग तो नहीं आने वाली। इस पूरे जोन को रेजिस्टेंस मानना पड़ेगा अब। मॉर्निंग पे आ जाता है यहाँ तक तो बढ़िया था, यहाँ से वापस सेल कर देते हैं। नहीं प्राइस से हटाओ। ठीक है, जिन लोगों ने सेल किया था 300 तक आ गया है, होल्ड करना है तो कॉस्ट पर डाल दो, नहीं तो बुक करना है तो कर लो। मैं एक्सपेक्ट नहीं कर रहा हूँ इस रेंज के ऊपर जाएगा प्राइस। वापस ऊपर आएगा, वापस सेल कर देंगे। जो ऑलरेडी अगर सेलिंग में फिर से आ गए थे, वो एसएल उड़ाने के बाद प्राइस नीचे आ गया था लेवल के, वो लोग चाहें तो एसएल कॉस्ट पे रख सकते हैं। अब अगर 300 के नीचे सस्टेन करता है तो फिर और गिर सकता है। इसका लो कितना है? नीचे आएगा तो फिर अच्छा खासा आना चाहिए। नहीं किया है तो कॉस्ट पर डाल दो। ओके, ये है, मिल गया। ठीक है, इस लेवल को अब कंसिडर, नीचे वाला लेवल भी अब थोड़ा सा रिमूव कर देते हैं, कन्फ्यूजन हो रहा है बार बार। बाकी वो सेलिंग वाला जो ट्रेड था उसका एक बार एसएल चला गया था, बाद में वापस नीचे जरूर आ रहा है। किसी ने अगर लिया है तो एसएल कॉस्ट पे रख लो। 300 तक ही एक्सपेक्टेड था, आ गया है 300 तक, और नीचे जाएगा भी नहीं, कह नहीं सकते। ऊपर आता है तो वापस सेल जरूर करेंगे फिर से। कोई अगर रुकना चाह रहा है तो एसएल कॉस्ट पे रख के छोड़ देना। T9 क्रूड में भी कुछ मोमेंटम नहीं है, नो ट्रेड। क्रूड मूव नहीं कर रहा। यहाँ पर एक बाइंग का ट्रेड बनाते हैं, यहाँ पर एक बाइंग कर लो। 300 हो गया ना, टच हो गया 300, 300 टच कर दिया इसने। ये 300 टच कर दिया है तो बाइंग का ही ट्रेड करते हैं। 300 टच डाउन, हो गया 300 टच कर दिया। ठीक है, जो लोग सेलिंग में थे 300 आ गया है, टच कर दिया है उसने लास्ट कैंडल ऑलरेडी। तो यहाँ से एक बाइंग का प्लान देखते हैं, ऊपर थोड़ा जाता है ऊपर से वापस सेल कर लेंगे। ये इतना स्मॉल क्यों है लेवल? क्रूड तो बिल्कुल ही मर जाए। वो हम जब मार्केट क्लोज होने वाला होगा ना तब क्लोज होने से पहले मोमेंटम देगा, उससे पहले नहीं। स्क्रीन पे लिखा हुआ है नितिन विजय जी। नहीं अभी नहीं है, कुछ नहीं है, मोमेंटम ही नहीं हो रहा क्रूड में। अब रेंज ब्रेक करेगी तभी कुछ कर पाएंगे, विदाउट रेंज में क्या करें। ठीक है, नेचुरल गैस में एक ट्रेड लगाया है बाइंग साइड पे। सेलिंग में एक ट्रेड था, उसका एसएल चला गया था, वापस नीचे आया, किसने री एंट्री करी होगी तो 300 तक का एक टारगेट था छोटा सा, बुक कर लिया होगा। यहाँ से एक बाइंग का प्लान पुल बैक के लिए अगर छोटा सा मिलता है, ऊपर से वापस फिर सेलिंग का देखेंगे। So, 324। अब कोई न्यूज़ ना आए बस। क्रूड में कुछ और हो सकता है यहाँ पे। कल से देखोगे ना, कल भी कुछ मूव किया नहीं था मार्केट ने कुछ खास। शाम को ओपन हुआ रेंज बाउंड में चला गया, उसके बाद आज ओपन हुआ उसी रेंज में बना हुआ है। परसों जो एक सडनली मोमेंटम आया था उसके बाद कुछ ट्रिगर ही नहीं मिल रहा है मार्केट को, कहाँ जाए करके। थोड़ा सा अगर ऊपर आए तो वापस सेल करें क्या इसको? यार ये कैंडल चीज़ मेरे को लग रहा है क्रूड ऑयल में बेटर रहेंगी जब भी रेंज ब्रेक होगी। कब होगी नहीं कह सकते, बट जब भी रेंज ब्रेक अगर होती है, इन दैट केस कहाँ कहीं एक बाइंग का प्लान रखेंगे उस केस में, अब अगर रेंज ब्रेक हो जाती है। राजा 906 इसके नीचे तो मुश्किल हो जाएगा। चार्जर 5000। सिंगल लॉट वाले को लेना ही नहीं चाहिए, नेचुरल गैस भी साइडवेज हो जाएगा। देखो क्रूड में तो आना चाहिए, मोमेंटम अब बहुत देर से साइडवेज है, तो मेरे अकॉर्डिंग क्रूड तो मूव करना चाहिए। स्क्रीन पे नीचे नीचे दिख रहा क्या? अरे ये क्या लगा दिया स्क्रीन पे, किसने लगा दिया ये? मेरी स्क्रीन पे ये क्या हो गया? मोबाइल नंबर के बदले ये तो कुछ और ही आ रहा है। तो पेज पे जाओ, वहाँ पर मिल जाएगा सर नंबर। आई थिंक वो शायद मिसमैच हो गया है, यहाँ पर नंबर के बदले कुछ और ही आ रहा है। ठीक है, इसके वो मेरे स्क्रीन पे जाओगे वहाँ दिख जाएगा आपको, सॉरी चैनल पे जाओगे वहाँ पर दिख जाएगा अबाउट सेक्शन में। नहीं तो इसके वेब यहाँ पर एक लिंक दिया हुआ है, उस लिंक पे क्लिक कर लो जो मैंने पिन किया हुआ है सबसे ऊपर, वहाँ से सीधा व्हाट्सएप पे पहुँच जाओगे, उसी नंबर पे, वही सेम नंबर है। ओके, 7836087184। नेस्डेक का बताया था अभी। में थे ना, आप निकल गए होगे, आई होप सो। बाइंग में थे तो प्रॉफिट बुक कर लेना। नीचे से सपोर्ट लिया अभी, और कोई नया ट्रेड, वो भी सेम क्रूड ऑयल की तरह ही साइडवेज चल रहा है अभी। बाकी अगर वापस सेल करना है तो 18,580 590 के अराउंड ट्राई करना। बाकी नीचे सपोर्ट बता ही रखा है, कल ही आ गई थी यहाँ से सेलिंग रेंज में। इसको कैसे कंसिडर कर रहे हैं लोग, यहाँ तो हुई नहीं ना। Nasdaq कंफ्यूज है। अच्छा जी, ज़्यादा कंफ्यूज है। US Treasury slide in worst sell-off since 2019.
Our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. The trade war between the US and China, it continues. China raising its own tariffs on all US goods from 84% to 125% starting tomorrow, after the US raised tariffs to 145% on China. China saying, your tariffs are a joke, United States. It's no joke to investors. What an extraordinary week we have had. We are currently up almost 6% over the course of the past 5 trading days, Ed, on the NASDAQ. But it really doesn't paint the picture of the extent of the whiplash that we've seen throughout that week as we pull back on tariffs towards other nations. Look at what we've done on the month, though. This context is needed. Sure, we're up on the week. On the downside for the course of April, the trading month, we're off 5% on the NASDAQ 100. Dig into the details, Ed.
Yeah, I'm looking at the chip sector, and across semiconductors, there's divergence in the session between fabless names, those American companies that design chips but don't make them, and those with domestic operations in the US. And buried among the headlines overnight was the Chinese regulator and industry body saying, by the way, when we think about tariffs on US goods imposed by China, this is how we'll define it. You and I are going to get into that throughout the course of the show. We have to talk about Apple. I feel like Bloomberg Technology as a show was early to this discussion on Monday. Will the US build an iPhone in the future? 5 days we're higher, but it's been so volatile, and the analysis from different corners of the market is so different. I think we should get into it, Karen.
We should, because we've been debating time and time again, a made-in-America iPhone is the goal that President Trump believes could be a reality, Ed, but replicating China's advanced supply chain, its skilled labor in the United States, would prove nigh on impossible for the tech giant. Anurag Rana of Bloomberg Intelligence joins us. You've got a new note out just talking about the implications of tariffs on the margin of Apple. But what would it do to the margin of Apple if they ever brought production for the iPhone to the United States, Anurag?
See, I think a lot would depend on the raw materials that go there, the component cost, the labor cost, and I think it'll be very hard for Apple to, let's say, raise the price of the phone to 2x and then make it in the U.S. It has to be done in a way that actually keeps the cost down, and at that point, keeps their margins. The reason why Apple shines compared to any other consumer electronics company is because it has very high gross margins compared to, let's say, somebody who just sells an Android phone in Asia, for example.
But those margins are under threat. Team, let's bring up Anurag's research that published, I think, about 30 minutes ago, 20 minutes ago. I'm just going to read it. Our analysis suggests a margin impact of 100 to 170 basis points for every 10% tariff increase on China-manufactured products. Apple could mitigate some of the impact through price increases. You've been talking about price increases all week. The key question seems to be where, and you think that will be on the services side, not on the handsets.
Because, as I said, it's very difficult to take $1,000 phone and double it up to $2,000, but it's slightly easier to take a $299 iCloud plan and, let's say, make it up to $5 or $7. And also remember, some of those revenue streams, when it comes to the services business, especially cloud services, they have very high incremental margins. These are products with 75-80% gross margins, much more than the product side of it, and it doesn't really pinch the consumer that much. And they could phrase it as it's only going to be done over the next 6 months or the time period when the tariffs are, and then they can scale it back. I think from a consumer point of view, it is less, it hurts them less. But again, that's just one service I talk about. There could be others as well. But I feel very, strongly that I don't think they can raise the price of a phone up by, 50, 60%, maybe slightly, maybe 5%, 10% or so. But anything above that, I think destructs demand.
Anurag Rana, Bloomberg Intelligence, thank you very much. Let's stick with Apple and the impact of tariffs on technology. Tony Wong, T. Rowe Price Science and Tech Equity Portfolio Manager, joins us now. Apple, the #1 holding of T. Rowe Price's Science and Tech Fund that Tony oversees. Tony, when I was learning about the technology industry and the markets and making my way through Bloomberg Television's newsroom, I was always told that Apple and names like it had an entrenched market position, strong balance sheet, and in crises or recession, that's where they would survive and thrive. But I think right now you can't necessarily look back at history and precedent. How on earth are you modeling the future of this company?
Yeah, well, it's a great question. Obviously, it's historically been kind of a balancing name, just that could weather a real kind of stock market storm. I'd say here, I think that there is a lot of fear in the market and concerns around trade war and what deglobalization could possibly do to kind of Apple's manufacturing advantage in China. And so, when I take a step back, they do have diversified supply chains. I think they do have the ability to move around, and they do produce iPhones in India. And when you think about the U.S., the consumption of iPhones is roughly 25 to 30%. And so I expect that there's probably some flexibility to move some of that production to India more and therefore diversify that risk a bit. And, at the end of the day, I think that it is about how much of a staple the iPhone is. And so if there's price, kind of sensitivity among the customer to actually, pay up for the iPhone, I think that actually could be bullish for the stock. That just demonstrates it's more of a staple than people appreciate. But here, I do think that there is a lot of fear there, and so generally, historically, you've been rewarded for leaning into weakness.
Then in this weakness, Tony, yes, on the day Apple is trading somewhat higher. On the week it is too, but on the course of the month, it's down 14%. Have you been adding to your #1 holding? Has it at any point looked attractive to get back in with more addition?
I think, the company's still really well positioned over the long term. You look at the ecosystem they've built, the quality of the product, and then potentially you also have an iPhone upgrade cycle coming. And, replacement cycle has been elongated. And if you get a new form factor, I think that could be really attractive. And at the end of the day, like the valuation has become more attractive, especially at these levels versus where they were 6 and 9 months ago. In addition, it is one of the Mag 7 that hasn't been spending a ton on large language models. So the capital intensity and the free cash flow quality of the company is still very, very high quality.
Go there, Tony, for a moment, because people were wringing their hands about Apple before the trade war because of a lack of urgency on AI, the implementation within Siri. This distraction that tariffs cause, does it set them back even further about upgrading the product from an AI perspective?
Well, I think that they are, constantly optimizing their supply chains. Obviously, it's additional work on their plate, but I don't think that they are standing still on the AI front. I think they are investing more, actually, if you see that, some news of them purchasing more GPUs. And, when I think about the space, there's just a lot of things evolving. And what we thought a year ago has kind of changed in a lot of ways in terms of, who can participate in AI and, what these large language models can cost and which one is the best. So every time, it feels like every month there's a new headline of who is in the lead. And so it could be prudent of Apple to kind of, focus on what they're really good at, what their competitive advantage is, which is designing really high quality products that fit into our lives, that can be incorporated elegantly. And at the end, they do own that kind of ecosystem. And, over time, I think they can, derive value from that for their shareholders.
Tony, let's end this conversation on Apple with a yes or no. Does Apple manufacture and assemble an iPhone in the United States in the future?
I think it's possible in the very kind of long-term future. I think in the near term, you look at kind of what it takes to manufacture an iPhone. I mean, there's thousands of people that are living at the factory that can be woken up at, any time of the hour to make a change. And so, I think that in the long term, that could be possible with additional advancements in robotics and AI, but I don't think it's going to be a next year kind of thing.
Right. I saw a headline overnight that we think is critical, right, which is China's Semiconductor Industry Association issued this emergency notice. And they clarified that in the context of tariffs, they define point of origin where a semiconductor is taped out. In other words, where the electronic instruction set is formulated before it goes to the fab. And if you think about the fabless US names, many of which you have big holdings in, they use TSMC or maybe Samsung, so the tape out happens in those countries as well. How much insulation do you think that gives them from the heavy China tariffs on US products?
Yeah, well, I think that if you take a step back, right, the two countries have been trying to disentangle each other from major kind of supply chains and, areas of where if you could substitute a domestic product, that would be preferred. And that's nothing new over the past few years. And I think that, this kind of the latest piece of news is further kind of a step in that direction where, it doesn't make sense to hurt yourself by kind of tariffing the only source that you have. And so in terms of stuff made in TSMC, both countries need that. So it makes a little bit less sense to put a high tariff on that when it's sole source. So that's kind of my perspective. That it's a continuation of industrial policy that kind of makes sense.
Let's talk about the others, though, that are exposed. Now, I'm interested as to whether you have holdings in those that are manufacturing in the United States or looking to even more with, of course, money coming from federal government wanting them made in the US, and what that does to the business model if they ship to Asia, to China specifically, Tony. Do you have to get out of Intel's and Texas Instruments?
Well, I think that over the long term, it's more about the technology and the differentiation and what you can, the value add that you can. So if you have leadership products, I think that's still number one. I think number two, I think that diversified supply chains, serving the local industry that it's based out of or the region is probably going to be, a good thing. And so at the end of the day, I think it's those two things, some flexibility in manufacturing, but the main thing is the product leadership and the secular trends that a company is kind of positioned to capitalize on.
Tony, like all technology investors, you have had to digest and understand communication from policymakers. How would you rate and rank what you've heard from the President, Treasury Secretary Bessent, and others?
Well, I'm a tech investor, so geopolitics is above my pay grade, obviously. But at the end of the day, I think that the U.S. administration and the leaders that we have elected, they will do what's best for the country, for our companies here in the U.S. So I think that we need to trust them, and they do. I think they are trying their best, and at the end of the day, I think that they will protect American interests. And what's most important is keeping U.S. technology at the forefront, that's what I look for as an investor.
Tony Wang, thank you so much. Of T. Rowe Price, so important to have the investor take today and after one long week. Coming up, we'll take a look at how Chinese tech investments are handling trade tensions and outlook for a TikTok sale to a US buyer. We've got Lead Edge Capital's Mitchell Green joining us, the holder in ByteDance. This is Bloomberg Technology.
On the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially. Right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes. Do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no. You could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Chinese social media giant ByteDance. It saw its revenue jump 29% last year. It was driven by the global expansion of, you guessed it, TikTok. International sales grew $39 billion, contributing about a quarter of the company's revenue. It's all according to people briefed on the numbers. Now that, as the Chinese business slowed. Now, of course, tensions between Washington and Beijing expect to impact both the global economy, possible sale of TikTok in the United States. We've got to get to it all. Mitchell Green, founder, managing partner of Lead Edge Capital, longtime investor in names like ByteDance, is with us. Mitchell, have you been adding to ByteDance? What do you make of where we stand in terms of TikTok in the United States?
Yeah, hey, Caroline, thanks so much for having me on. What do I think? We can talk about that for a while. The company continues to obviously do very well, as we've said in the past. In the grand scheme of things, uncertainty kills deals. I wish I could tell you exactly where things stand in this negotiation between the White House, ByteDance, the Chinese government, discussions around tariffs. Look, we've always had, frankly, questions on U.S. TikTok. Again, as I've mentioned in the past, we model out TikTok USA to be worth 0. I suspect something will come of it. I don't know if it's in a month from now, 3 months from now, from 6 months from now. We shall see. It is obviously a very valuable business that a lot of constituents want to figure out. Not only board members and shareholders and the CEO of ByteDance, but we now have this giant tariff war going on between the U.S. and China, so it's all going to get dragged into it and play out together.
Mitchell, you've been on the secondary market picking up ByteDance in recent months. Would you want exposure to U.S. TikTok if it was indeed extricated out of ByteDance and had U.S. ownership?
Absolutely, and we have also not bought any ByteDance shares this year. There's been some changes with CFIUS. A lot of people don't know about this, but publicly known that CFIUS came out and put some restrictions on what kinds of companies you could buy globally related to if the AI model speed was fast enough or not. It's a questionable area if ByteDance falls into this or not, but in order to just stay conservative and be on the right side, we have not bought any more over the last several months. Would I like to own TikTok USA? Absolutely. If they allow existing investors, and again, about 60% of investors in the company are non-Chinese investors. If we could add to our position, obviously it depends on price. We could be quite interested.
Mitchell, starting Monday night into Tuesday morning, I started getting phone calls that there was quite a lot of activity on the secondaries market for ByteDance. Valuation range 280 to 320 billion, depending on the offer lot size, right? But to your point, what I was told is a lot of that activity was from Asia, right? China, maybe Singapore. But it followed the president on Sunday night. You may have seen the clip on Air Force One saying if it weren't for tariffs that he'd put in place, they had a deal. How do you interpret that trading? If the outlook for the deal is poor, but you see private market investors in Asia trying to get more of a foothold?
The Chinese business is doing phenomenally well, which is actually incredible, given I don't think the Chinese economy is roaring right now. And I don't know if it's falling apart, but I mean, it's been weak, and you can look at some of the other e-commerce businesses across China. And so actually how the performances in ByteDance is doing in China is strong. I wouldn't read into, I have no clue if a deal was almost done or close to done or whatever. I have, when it comes to politics, I tend to just listen and not really make opinions, and I don't really know. But, we'll see. Again, there's a handful of people that need to be involved. Xi, the President of the United States, and the CEO of ByteDance, and I can't say any of them are good friends of mine. So
if they do telephone you, let us know.
I'll let you know if Xi calls me this afternoon.
There is a technology conversation here, right? I go back to when I was at CES and at GTC very recently, and Jensen Huang's point, the CEO of NVIDIA, that basically more than 50% of all the computer scientists in the world working on artificial intelligence are doing so in China, or they are from China. What kind of future is there to sort of work with that country on technology and founding new companies?
I strongly believe whether it's technology transfer, technology exports, imports, the trade is global. We all need to figure out how to work together. China plus the U.S. working together is a good thing. I am a strong believer in the education system in China, the entrepreneurship in China, as well as in the United States as well. But again, for instance, I've talked about this on I think on Bloomberg and other sessions. Chinese regulate social media. In the United States, kids go on TikTok and post ridiculous videos about all kinds of stupid stuff. In China, they learn about science and math on TikTok. I think maybe we should ask, should we be regulating this stuff more? Should we be repealing some of these laws that don't hold social media companies accountable? By the way, TikTok ByteDance does it in China. And so I think there are things that we should be learning out of some of the things that are happening in China and applying them to the United States.
Interesting take, Mitchell. And I want to go there because you have exposure not just to China. We bring you on because you've been so long in the names like Alibaba, you're in Ant, you're in ByteDance, long-term investor understanding that economy. We look at the rest of your portfolio, you know well US exposure too, Uber, Bumble, you know Europe with Spotify. How difficult is it to remain committed to China right now when CFIUS is changing up the rules, when you are unable to commit capital in the way you'd like to?
It's complicated. And again, most of our business is actually North America and Western Europe. You know, we have a team of 18 associates that are 22 to 24 years old that, you know, speak to about 9,000 companies a year. And we don't, you know, we might speak to 10 to 20 companies and all across Asia. So what we've done in China is a very handful of some of the largest businesses over there where they could effectively be, they are effectively public companies. They just happen to be private. We tend to like to be contrarian, you know, and it was funny. A year ago, 9 months ago, nobody wanted to invest anything in China. Yet then you saw stocks like Alibaba go from from $60, $70 a share to like 130, 140. Now people were liking China again because they saw Xi and Jack Ma, I think, at some conference together. And I don't know where Alibaba is today. Maybe it's back at 100 a share. So this stuff is so volatile. But we find that you buy China when the rest of the world hates it, you can tend to make lots of money. But again, most of the stuff we invest in is right back in the United States. And right now, look, I think in the tariff situation, I can have an opinion of it today. It'll probably change in a week, a month, in 6 months. But uncertainty is what actually slows down the economy, right? And you know, our portfolio is mainly high margin software companies that don't have direct, inputs coming overseas and things being shipped in. But that being said, if you sell airline software, or you sell software to manufacturing companies, and those companies are nervous about what's going to happen to their businesses, they might start to pull back on spending, and the whole thing kind of unravels on itself.
And if there's cuts to R&D in healthcare research, and you're in a name like Benchling, which is all about community of scientists. I'm really interested, Mitchell, ultimately how difficult this environment is when some of the companies that we thought were going to go public now can't or don't want to. How is that impacting the way in which you raise the next fund, for example?
Yeah, so we were very, we don't talk about performance on obviously on public media or anything like that, but we believe that funds that took advantage of getting liquidity and what's called DPI, it's how much money you've given back on a net basis to your investors over the last few years, the last 5 years, is really going to matter for funds as they go forward raising money. Everybody thought 2025 was going to be the year of the IPO. There was going to be this giant IPO wave. Well, that's dead. That's not happening. And now, again, I think these companies could go public. It's just a question of what valuation could they, and will they then go public? And your guess is as good as mine. But I think this liquidity drought is going to continue. And I think as a result of liquidity drought, you're going to have a lot of endowments and foundations and other big institutional investors that are over allocated to private equity, venture capital, growth equity, real estate, private equity, everything. That are going to unlock the secondary market. And the secondary market has already been busy. It is about to, if this continues, call it 6 months, 9 months, 12 months, you are about to see a huge amount of institutions that are going to be massively over allocated to private equity that are going to need to turn to the secondary markets and sell things. That, for us, will create a great opportunity because you want to be buying from sellers that are forced to sell.
Mitchell Green, Lead Edge Capital. Thank you. Really appreciate the conversation. Caroline, what you got?
It's time for Talking Tech, Ed. And first up, Logitech. It withdrew its full year 2026 outlook due to, quote, continuing uncertainties of the tariff environment. Now, Vontobel analysts say this is a sensible move, but the company's margins will certainly be challenged, and you saw the impact on the shares. Plus, Tesla, it stopped taking orders in China for its Model S sedans, its Model X sport utility vehicles, both of which are imported from the United States. That's after the countries raised tariffs on one another, of course. This could be a setback to the company's already shaky position in the Chinese market. Meanwhile, Alibaba co-founder Jack Ma, he's warned that AI shouldn't replace humans, but work instead to meet their every need. The Chinese billionaire, who once likened AI to love, he argued that the technology should protect livelihoods and make lives better. Ed.
Okay, coming up, analog devices, Texas Instruments, big declines. We take a deep dive into two of Citi's top semiconductor picks. The timing of that call, very different from where the stocks are heading right now. This is Bloomberg Technology.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global economic news from around the world whenever and wherever it happens. I'm Oliver Crook at the European Commission in Brussels, and this is Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. San Francisco's Mayor Daniel Lurie is pledging an economic and tech revival, aiming to restore the city's status as a global innovation hub. I sat down with the mayor to discuss his growth strategy in the face of tariffs.
First off, we're the most beautiful city in the world. Second, the horsepower is here. The intellectual horsepower is here. We have great universities, including UCSF around here. And young people want to be in urban environments. They want to be in San Francisco. That's been proven true throughout history, and we're going to prove that again. We have great arts and culture institutions. We were just named the culinary capital of the country. So we have so much to be proud of, and we know that workers want to be here. Our CEOs who we're talking to, they know that their employees want to be in San Francisco. No offense to my friends down in the peninsula, but people live in San Francisco, and we want them to work here, and we do have to get competitive. But it starts with safe and clean streets. Our property crime rates have dropped 35%. Our violent crime has dropped 15%. Car break-ins in February, the lowest in 22 years. This is a safe American city, and we want everybody coming back to work here, to play here, and to live here.
Mr. Lurie, how is the White House and its tariffs policy going to impact your ability to do what you've just outlined, bring more of the technology industry to the city?
Well, listen, we are all, and you all are reporting on it minute by minute. The uncertainty is impacting everybody around the globe. And so we have to plan for that here at City Hall. We're working with our department heads. We have a big budget deficit. We inherited one of the largest deficits in our city's history. So we're working day and night to make sure that we tighten our belts. We deliver core services to our taxpayers and to our residents, making sure that we focus on public safety, focus on the behavioral health crisis and the drug crisis that is causing people to feel, the disorder on our streets. But that is all starting to improve. And so we can only control what we can control here in San Francisco, and that's our $15.9 billion budget. We have a $1.1 billion budget deficit over the next 2 years. We're going to get that under control. We're going to fix our structural budget deficit. And I'm telling you, we're then going to be off to the races. Databricks knows it. They just secured an office space, 150,000 square feet. OpenAI just opened new headquarters by Chase Center. We are on the cusp of liftoff here in San Francisco, and we want everybody to come be a part of it.
So that was my conversation with San Francisco Mayor Daniel Lurie. And Caro, like, the pitch to the technology industry seems to be San Francisco is beautiful and it's full of nerds. And that's not really a policy platform. But if you think about how the history of Silicon Valley's worked, right, there are many tech people here in the city. And what do they do each day, right? Where are all the big tech companies that they go to work at?
They're not in SF. They reverse commute out to the valley. But also what I wonder about is when we've got an economic quandary coming from the United States, when advertising dollars might be pulled back, when we've already got a Meta, for example, that has been laying off people, how does that affect an SF economy going forward? We'll have to debate that a little bit more in terms of what's happening over in San Francisco. But we also want a little bit more context about what the global tech policies look like in this current context that Meta has to navigate, that Alphabet has to navigate, that these SF giants have to navigate. Liza Tobin's with us, Managing Director at Garnot Global. And Liza, I'm so interested in just your take right now on where we stand in this so-called tit for tat that today China's leader came out and said, it's a joke, we're going to stop raising to meet you, but we stand at more than 100%, 125% tariff on US goods. The US has 145% tariff on Chinese goods. Where do we go from here?
Yeah, so of course, about a week and a half ago, President Trump declared a trade war on the entire world. And then over the last couple of days, it seems to have kind of slipped into an isolate China strategy. Clearly, the president is torn between his deal-making and his decoupling instincts. He's hoping for a phone call with Xi Jinping. But what we've learned really over the last 20 years of U.S.-China relations is that U.S. trade negotiators are always disappointed with what Beijing brings to the table. And I'm seeing things play out this week that remind me of when I was in the White House in 2020. And that, of course, was when President Trump got his phase one trade deal with the Chinese. And then a couple months later, he started getting seriously disappointed and blaming Xi Jinping for COVID, which, of course, tanked the global economy. And he felt ruined his electoral prospects. And so in some of the president's comments just a few days ago in a speech, he's talking about Xi. He's hoping for a phone call, but he's referring back to COVID and saying, you know, I like Xi Jinping, we get along great, but COVID, that was a bridge too far. That's what the president's saying. So he seems to be remembering the disappointment and the anger from 2020, and he seems to be shifting from deal-making to decoupling.
We go to you because of your depth of expertise when you've worked with the CIA, when you've done the U.S. Indo-Pacific Command analysis for them as well, Liza, not to mention what you've done over at when you were SCSP, I should call it, of course. And I'm interested, Liza, therefore, on where you go from who has the upper hand, whether TikTok's involved in this negotiation. Just take us forward as to what plays out next if we are seeing a US president getting more and more triggered by what happened in 2020.
Right. So I think we could potentially see some kind of a deal. Clearly, the president still would like a deal, perhaps involving some tariff concessions, maybe Americanizing TikTok, although he's already conceded that Beijing will retain the algorithm, which is really the brain that controls TikTok and controls Americans' media diet. So we may or may not see that, but I want to remind your audience not to over-index on the strategic importance of a deal, because we've always been disappointed by how China actually implements that deal. So I think if folks are looking for some kind of grand bargain that really makes some, goes beyond symbolism and short-term measures and really addresses the fundamental imbalances of Chinese economy, this massive trade surplus, unfair trade practices, they're going to be disappointed by that. So markets will react and go up and down on news or rumors of a potential deal, but a true grand bargain is really off the table, I think.
Liza, I'd like to hold you to account on 2 points that you've made, or at least debate them. One, isolate China as an accidental strategy, and then the data that you just flagged, the deficit between the United States and China. So this is the ECTR function on the Bloomberg terminal. It's 2023 data showing the deficit with China, $260 billion, but I think I'm right in saying prelim data showed the deficit growing in 2024. Materially, when we think about technology, what we're talking about is a country that dominates the manufacturing of most of the world's consumer electronics and other things. So forget numbers and tariffs and markets and trade. Do you see the White House ever resulting this policy in more of that stuff happening in America?
The president certainly wants to, and he and his advisors are constantly talking about reindustrialization. I mean, the problem is the devil's in the details here, and it's unclear if President Trump really understands the details and the extreme intricacies of these supply chains and what it actually takes to reindustrialize. And of course, there's big structural challenges, like, do we have the workforce for this? The administration talks about manufacturing jobs coming back. Well, that's great, but actually we have a shortage of skilled manufacturing workforce, and advanced manufacturing is now a knowledge industry. This is a highly skilled profession. It's more like software coding and applying AI to the factory floor, and it's not yet clear to me if that kind of advanced manufacturing is front and center on the administration's agenda. It's very much right now a tariffs first, tax cuts, deregulation, and energy. And those may be a great start, but they also need to be kind of leaning into these more structural issues.
Certainly if they want to make iPhones in the United States. Liza Tobin, Managing Director of Garneau Global. It was great to have you join us. Thank you. Now, Federal Reserve Bank of New York President John Williams, he expects slower economic growth, higher unemployment, and a pickup in inflation. All of this due to the U.S. tariffs policy and reduced immigration. Take a listen to what he had to say just moments ago.
While uncertainty about the economic outlook reflects many factors, the effects of tariffs and trade policy on the economy are certainly at the top of the list. For example, my business and financial market contacts highlight that this has made it more difficult to plan for investments and for hiring.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. The top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg. Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Let's get right back to financial markets. It's Friday at the end of a long week, basically flat on the NASDAQ 100, but up more than 5% over the course of the week. Basically flat on the Philadelphia Semiconductor Index, down 0.2%, but up more than 7% on the course of the week. And Kara, if you allow me to, there was a really important headline overnight that I think our audience needs to understand. And it came from China's semiconductor industry body, basically citing customs regulators that how are they going to define the point of origin of a semiconductor, right? Think about global supply chains. And in the market right now, you see names like NVIDIA higher. NVIDIA doesn't manufacture its own chips. Names like Intel and Texas Instruments that do, significantly lower. Here's what they said. The point of origin for a chip in deciding whether to apply tariffs or not will be at the point it is taped out. And what that means is when an American company, for example, is done designing its chip in San Diego or here in the Bay Area, it then needs to send the designs to a contract manufacturer. We're talking TSMC and Korean names like Samsung. But that happens locally. And so they're saying that's how we decide where your chip comes from. You tell me the big story that we've learned in the last 2 years about all these American chip makers. What are they actually not?
Well, they're not makers of chips. But some of them are trying to be. Some of them are trying to be contract makers of chips. Intel, for one, which is actually expanding its presence of making chips in the United States. What does that mean in terms of business model? You've just got to take out China from the equation. And on the flip side, of course, domestic chip makers in China rallied hard. You saw the CSI 300 index up more than 3% on the day. This had real tailwinds for Chinese local players and, of course, pressure on some of the local makers here in the United States, Ed.
Yeah, and the one thing I would say is that it all comes back to the end market. What does China do? It makes most electronics, high-end or low-end. And so that's why I was tracking this so closely. But you're exactly right. But in some of the names you've just mentioned, analysts are paying attention for other reasons.
They certainly are. Let's get to one of those analyst calls, because likes of Analog Devices or Texas Instruments, as you say, pressure today. But Citi named actually those two companies in its top semiconductor picks amid tariff pressures and recession fears. Citi Managing Director and semiconductor analyst Chris Stanley writing, high-end analog companies such as ADI and TXN have outperformed during downturns. We would expect the same to occur in a recession, with ADI performing best given higher margins. Bloomberg's Ryan Fristella can break down some of the moves. On Semi, got a fair few downgrades in terms of price targets today as well. On Semi, meant to feel more of headwind versus some of these players, according to Citi.
Absolutely. I think people are still really struggling to kind of figure out what this environment is going to be like for different chip makers, depending on their end market, depending on their manufacturing systems, their supply chains. It's all very uncertain, very up in the air at the moment. So beyond the naming TI among one of its top picks, Citi also said it was taking out the lawnmower. Those were exact words, cutting estimates by 20% on average across the board for chip makers. That just speaks to how much uncertainty there is when it comes to this sector at this point in time.
The firm Citi had this estimate a while ago that the SOX, the index, would drop 20% if there were to be a recession. And I think I'm right in saying that they now assume a recession as a firm. There's a lot happening in the market. You also wrote about the taped out point of origin story yourself this morning. Just go back to explain some of the moves of the market in the here and now.
Yeah, so absolutely. Like you were saying before, companies like TI, Intel, Global Foundries, Microchip, all these have sort of domestic manufacturing plants for their products. And these are the stocks that are really falling today. Other ones that do most of their manufacturing abroad, Taiwan Semi, NVIDIA, AMD, Qualcomm, Broadcom, all those names, they're probably higher in the morning. It's obviously a very volatile situation. There's a lot of cross currents going on right now, but certainly we are seeing Texas Instruments in particular weaker today, Intel particularly weaker today, whereas companies like NVIDIA are higher.
Let's go to NVIDIA for a moment, because a different analyst over at Citi has actually been downgrading NVIDIA as well. Their key concern is that these hyperscalers, Meta, Alphabet, you name them, are going to actually start to curtail their spending on AI data centers. How much of an overhang is that for names like, whether you're a fabless or fab kind of a chip maker?
Well, for NVIDIA in particular, I'd have to go and look, but I think 40% or so of their revenue comes from just 4 companies, which is Microsoft, Meta, Alphabet, and Amazon. So to the extent those companies pull back, and I'll say Alphabet a couple of days ago, it had a big cloud conference, and it did affirm its CapEx plans. Microsoft, it affirmed its own plans earlier this year. So right now, it seems like maybe for the next 12 months, all those spending plans are pretty intact. But if we get to 12 months from now, and maybe especially if we're not seeing a huge ROI on all this AI spending, especially if the cost picture has changed dramatically due to tariffs, if the whole picture has just changed because of weaker economic growth, all these other kind of factors, it would not be super surprising under those circumstances if these companies started pulling back on their CapEx, especially as it pertains to their AI infrastructure, which is at this point a lot of NVIDIA products. And what that means for them in terms of their growth, in terms of their profitability, well, just given its customer concentration, that would be a pretty dramatic hit to a company like NVIDIA.
Bloomberg's Ryan Vlastetica, terrific. Thank you very much. All right, coming up on the show, and speaking of the square-off between China and the US, a startup preparing to build autonomous ships aims to help with the US goal of reclaiming shipbuilding supremacy. We'll talk to a founder next. This is Bloomberg Technology.
In case you missed it on Balance of Power.
Governor, I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area, and they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now and You know, I just don't know. All I know is that people were promised lower prices on Inauguration Day, and guess what? They're going up.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A single shipyard in China now produces more ships every year than all of the American shipyards combined. Think of that. And it was a business that we used to dominate.
President Trump there. Now one startup looking to manufacture ships in the United States is Blue Water Autonomy, preparing to build large vessels able to travel between San Francisco and Hawaii without a captain or a crew. Rylan Hamilton is the CEO, co-founder of Blue Water. Rylan, you're coming out of stealth, $14 million in the bank. You've got VCs that backed your prior really successful companies. You were in warehouse automation prior to this. How much is the time now to be making automated ships suddenly far more prevalent when we've got US-China tensions?
The time is definitely now. If we hear the current administration, they're talking about shipbuilding, shipbuilding, and shipbuilding. And we're designing and building autonomous ships. And when you make them autonomous, you can remove the bridge, the berthing, the galley, the showers. So you can make them a lot smaller. And because they're smaller, you don't have to build them at the big Navy shipyards. So we should continue to build the big warships, the guided missile destroyers, the aircraft carriers, the submarines, as quickly as possible. But our ship can be built at all these mid-tier shipyards that have capacity today.
Why is now the right time from a technology perspective as well? What is going into making automation far more easy, or certainly not easy, but far more able to enact right now?
Yeah, well, this is a hard problem. This is not easy because we're designing ships that can operate across the open ocean. And the last thing our Navy needs is for these ships to be dead in the water in the middle of the ocean. And the ocean is extreme. You're thinking about extreme temperatures and salt water. In fact, ships get hit by lightning. And so we need to build a very... It happens. As we did research for this, and we talked to the chief engineers on some of the sort of workboats that operate around the United States, they said, yeah, last week my ship got hit by lightning and it fried all the electronics. And so there's a ton of challenges to do this, but we feel we have the team to do this because we've been at some of the most successful robotic companies in the United States, and two of my co-founders, including myself, we were also in the Navy.
Rylan, the big picture is to modernize the maritime industry, but this is a Navy application, as you just point out. American dynamism, this big emphasis on the private sector's relationship with the military-industrial complex. What is it that you actually want the president to do to allow for you to make this a success?
So we want to move fast, and we'll move as fast as the Navy wants us to move. And so we definitely want the president to continue to focus on shipbuilding and innovation, especially around autonomous systems. And there are autonomous systems that are in the air, that are on the surface, and that are underwater. Our focus is on these autonomous ships that can operate on the surface of the water and have high endurance and range, the range that you need for the Pacific Ocean.
Anduril picked Ohio for its skilled labor and for its history in aviation, for example. Yeah. Where is your Ohio? Where do you think you need to build these ships?
So we'll have more to announce later this year, but we've definitely been looking for the perfect place to go build these ships. And there are a lot of really good options, whether it's on the East Coast or the West Coast or sort of in the Gulf. And so we'll make an announcement later this year.
You were early leader in Amazon Robotics when you were building Six River Systems. How good is US at manufacturing now? Can we bring back what we want to bring back?
Yeah, so the U.S. is actually really good at advanced manufacturing. So early in my career, I was at Amazon Robotics when there were a couple thousand robots in the field. There are now over 1 million robots in Amazon warehouses throughout the world. That is amazing what that company has done over the last 10 years. So when it comes to complex systems where you need to take sort of commercial off-the-shelf components and put them together and then and write the software on top, we're amazing at that.
Ryan Hamilton, CEO, co-founder of Blue Water Autonomy, you have to come back when you announce the location, right? That's how it works. That does it for this edition of Bloomberg Technology. What a week. This is what markets look like, Caroline. I mean, it's kind of odd in a way to give a snapshot of a session in the moment. NASDAQ 100 higher by modestly, right? Pressure on US-listed shares of Chinese names. Take it away. What are you seeing?
What's extraordinary is we've had a week where we're actually more than 5% higher. But what a volatile 5 days. The bond market has seen extraordinary moves. And then over the course of the month, that NASDAQ is lower, Ed.
Happy weekend, everyone. This is Bloomberg.
On the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially. Right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Don't miss the close, live every weekday.
We give longer term money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things
Could I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
Key investors, top executives, global innovators. Join me for in-depth conversations with them.
ओए गाइस, ये नेचुरल गैस में निकल जाओ, बाइंग के रेट से बहुत रुक रहा है. अवॉइड. नेचुरल गैस के रेट से निकलना चाहो निकल जाओ, कॉस्ट टू कॉस्ट पर एग्जिट. मोमेंटम ही नहीं आ रहा है. ये नेचुरल गैस का बाइंग का ट्रेड था, एग्जिट कर लेना कॉस्ट टू कॉस्ट. ठीक है, नेचुरल गैस के ट्रेड से एग्जिट कर सकते हैं. जिस हिसाब से मोमेंटम एक्सपेक्ट होना चाहिए नहीं हो रहा है. अवॉइड. हो सकता है और ऊपर चला जाए, बट अवॉइड. जो लोग बाइंग में थे नेचुरल गैस से निकल जाना. यहाँ पर कोई ट्रेड नहीं है, बस सेलिंग ही लग रही है मुझे तो इसकी भी अपर लेवल से. और ठीक है, जो लोग हैं कॉस्ट टू कॉस्ट पे एग्जिट कर सकते हैं. अबाउट क्रूड ऑयल मोमेंटम ही नहीं है सर, रेंज के अंदर चल रहा है। हाँ की लेवल वही है फिलहाल के लिए नैस्डैक में। क्रूड ऑयल साइडवेज कह सकते हैं, थोड़ा सा अगर ऊपर आता है तो देखते हैं वापस सेलिंग का प्लान। 2 बार तो आ गई है, तीसरी बार आएगा। ये ब्लू कलर की लाइन के आसपास है, एफईजी ब्रेक हो जाए तो फिर देखते हैं इस लेवल के आसपास एक सेलिंग का प्लान अगर आया ऊपर, नहीं तो फिर मोस्ट प्रॉब्ली 5480 के अराउंड ही है लेक्स, उतना पीछे चार्ट ही नहीं जाएगा।
To Treasury market functioning, we've had a lot of yellow flags go up in the course of the last week. We're still not at a level where the Fed will intervene. And I think the good news is we have the toolkit. We've used it in the past. We used it after the COVID crisis. We used it after Silicon Valley Bank, and of course in 2019. So the toolkit is there. What's the threshold for the Fed to use it? We're not quite there, but I think we're definitely quite close.
You know, Mike, what do you think the biggest reasons are to worry about further sell-offs in the Treasury market at this juncture? There are a huge range of reasons, but I'll take two. A foreign buyer's strike being one big risk that people are talking about, and leverage in the system. That was something that Treasury Secretary Scott Bessent earlier this week said was an issue to the earlier part of this unwind. Moving forward, what's going to be the cause if we see one?
I think those are absolutely two of the key causes. I think the third, which of course Bessent did not hit on, was long-term inflation expectations really skyrocketing. You know, listen, you probably still have, quite frankly, if you go into a huge growth slowdown, you know, 5, 6, 7% unemployment, negative earnings growth, et cetera. If that were to happen, you know, later this year, next year, whenever, I still think treasuries will be the safe haven asset. However, when I look out past 10 years, you look at the 20-year, you look at the 30 years examples, they're probably not going to rally nearly as much as in past cycles. And so the reason for that, we have the deficit, of course, but I think it's really the long-term inflation expectations, an inflationary impulse through tariffs and deglobalization and a change in demographics that, you know, the market's really waking up to. So for me, it's that inflation component that's really going to be that third component.
You know, you were a huge voice this week at the markets. I've seen you cite it over and over about the leverage part of the unwind. There are complicated dynamics between how funds have been trading treasuries, whether you're looking at the swaps market or the hedge fund basis trade, which didn't seem to cause the same blow up now as it did in 2019. What are you worried about when it comes to positioning, Ed?
Yeah, I think two things are happening. One, we went into this relatively long. I think markets were anticipating some volatility, particularly in risk assets. We got it, and so we went into this relatively long. The second thing is balance sheet capacity across markets right now is significantly diminished versus where we were even 2 months ago. And so whether that's in the leverage part of the market, hedge funds, asset managers, foreign buyers, trading desks, that balance sheet capacity is being pulled back. Margins calls are going up. And so the ability to intermediate the treasury market is definitely diminished. And so that's what I worry about, that pullback becoming a little bit more violent.
How long does this become a situation that remains so volatile, Mike? If you think about what will actually create some calm in this market, given the macro uncertainties even beyond tariffs, what do you need to see for this to be a market that moves in a direction that's not so tumultuous?
You know, probably, unfortunately, you need to see one of two things happen. You either need to have growth stabilize and inflation start to fall, or you need really to find a bottom on growth, right? Which could take some time. I think if we think about the next 6 to 12 months, it's going to be a pretty volatile and rocky period for all assets, not just treasuries or credit, but also equities. We sort of, thought of the markets this year as being an Act 1 and an Act 2, Act 1 being defined by stronger growth, and Act 2 being by weaker growth. And I think everything we've seen with the uncertainty around Washington has really pulled forward Act 2 a little bit. And that's not a process that's going to be quickly resolved, especially as earnings were already peaking and as growth was already slowing. And so, unfortunately, Chanel, I think this is going to be a bit of a slog. And I think we need to basically hit bottom, which could take some time.
How much of a risk is the fiscal situation in the U.S.? We're getting to the point of the story where we have to talk about it. There's an X date that is generally on the table. Ed, is it a big risk in the future, given that we've already seen at least one ratings firm come out and draw concerns about the outlook?
Yeah, I mean, it's interesting. It's happening in an environment where growth expectations are being taken down. And so incrementally, having some fiscal stimulus is not that bad. At the same time, particularly the conversation that's happening on the Senate side at the moment is a significant expansion of the deficit for the foreseeable future. It's coming at a point of weakness in the Treasury market in precisely the wrong time. So I think that fiscal risk premium is something you are seeing, particularly in the long end of the curve, the 10-year and the 30-year part of the curve for sure right now.
Ed, we thank you so much for your time. And Ed Al-Husseini of Columbia Threadneedle and Mike Kontopoulos of Richard Bernstein, both of you, I hope you have a great, restful weekend because, of course, it's been a heck of a long week. Now, coming up, the auction block, market volatility causing credit risk to rise across parts of the credit market. This is Real Yield on Bloomberg.
In case you missed it, on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way, faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline or trying to send one out. You could transfer millions and millions and millions of dollars worth of Bitcoin overseas, while having a glass of wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. The Spanish bank BBVA has gained worldwide respect for its efficiency and commitment to innovation. CFO Luisa Gomez Bravo welcomes the challenge of keeping her company on the cutting edge.
In the world that is changing so fast, having a finance function that adapts quickly is crucial.
Watch Chief Future Officer only on Bloomberg.
I'm Shonali Bazik, and this is Bloomberg Real Yield, and it's time now for the auction block, where issuance, or the lack thereof, had drawn the attention of many bond watchers. Starting with treasuries, we had the highly anticipated auctions for the 10-year and the 30-year, and both had healthy demand, signaling there are still plenty of buyers. The 30-year auction yield, though, had hit the highest level since January. Over in U.S. high-grade sales, basically on hold, as there were 3 shutout days for sales this week, with only 5 deals coming to market. This follows only 4 sales all of last week. Total volume coming in close to the bottom end of dealers' expectations. And when speaking of credit, you have to look at the widening of spreads, which potentially have room to widen even further. This comes as we saw fears about corporate credit defaults escalating, driving overall credit risk higher. Speaking of credit spreads, Kelsey Barrow of JP Morgan says they're too narrow to reward investors for the amount of risk that we're seeing in the economy.
Each day that we exist in this environment of high uncertainty and tightening financial conditions does unfortunately raise the prospects of recession and suggests that credit spreads are probably not wide enough to compensate us for that risk.
Joining us now, Lotfi Karui, Chief Credit Strategist at Goldman Sachs, and Ashley Allen, Global Credit Strategist at JP Morgan Private Bank. And I know both of you come from the same lineage here, but, you know, Ashley, just starting with you, wondering if you think that spreads could widen materially from here. Working at a private bank situation, do you tell your clients that there's anything to be picking at given the spread widening?
Yes. Broadly speaking, we do think credit spreads could widen from here. The magnitude of which, though, is going to depend on policy and just the uncertainty that we hear coming out of the administration or just in the economy in general. That said, though, to your guest's previous point, we do think it's still a very interesting time to get involved in fixed income for our clients, and so our messaging there hasn't been the same. We have adjusted a bit, though, to suggest clients stay up in quality within credit ratings, given the volatility that we're seeing and given the uncertainty with spread widening. Specifically, I'll just highlight in investment grade. We like single A's right now. We're seeing a little bit of a pickup to the typical spread compression to triple B's. So up in quality, get a little bit more defensive. But broadly speaking, investment grade credit still attractive. That's the message we're communicating to our clients.
Lotfi, I also want you to speak here to flows. Ashley signaled where flows could be going, but I want to talk about what we saw this week. You've called it Flow-mageddon. You had U.S. high yield and leveraged loan funds experiencing their largest outflows ever. It was a shock, as you had written. How much more pain do you think those riskier parts of the credit markets might see? And is it on a fundamental basis, or is it because of the flows?
Well, I think, demand technicals in general have been sort of the bedrock of credit markets for a number of years now. And so this was truly the first negative shock to demand technicals we've seen in a number of years. We're keeping a very, very close eye on that because, as the previous guest kind of said it, if you look at the value proposition of credit from an all-in yield standpoint, it actually doesn't look that bad. High yield is at 8 3/4, 8.5%. IG is around 5 1/4, 5.5%. And so relative to the equity market, that's a pretty compelling value proposition. However, things have shifted this week. I mean, for the first time in a long time, we're seeing the correlation between rates and spreads move to positive territory. That's bad news because that means that as spreads widen, the ability of duration to provide you with that hedge against, a risk-off scenario has also eroded. And so your price returns are going to come under pressure. So I'll take it one day at the time here. But I would say, in general, we would be still quite selective, and we do expect the direction of travel to be skewed towards more spread widening on a forward basis.
It's the real yield kind of day when you have both terminal viewers watching and writing in, as well as ones online on X. And a good question here is, how do you think about products tied to credit, like the ETFs, where there are concerns, and you saw some decoupling with net asset value and what you saw on the trading of, for example, CLO ETF just this week. Do you worry about the ETFs tied to the bond market at this point, Ashley?
At the moment, no. Their liquidity still seems to be present in the market. So to the extent that, again, we have long-term investors that choose the ETF route instead of maybe the single line item route, I don't think you necessarily have to be concerned longer term. In the near term, just given the volatility, we may continue to see a little bit of a disconnect. But if anything, I would argue that potentially is an opportunity for clients to get invested at the higher yields. Again, long-term investor here needing to be able to stomach some volatility, but again, opportunistic.
How do you feel about this dynamic of market structure, Latvia? I mean, there are just so many more ways for investors to get in, and those ETF products have been the way that retail investors have been able to access the bond market of late.
Yeah, I mean, I completely agree with what Ashley was saying, which is, I know there's been a lot of negative buzz about market fragility on the Treasury side, but I would say the one silver lining in credit is that as violent as the price action has been, it's been actually quite disorderly, and I think ETFs have actually kind of played a big role in that. And so we've seen a couple of days where the NAV basis kind of moved, in a volatile fashion, but it was nowhere near sort of the levels that we had in March 2023 on the back of the SVB failure, or prior to that during COVID. And so for now, I would say the microstructure of the market, or the plumbing of the market, is actually holding up remarkably well. And I think that's a good thing, because it avoids a scenario in which, you see gappy price action and spreads kind of moving in a nonlinear way. And so I would say for now, that's been a net positive for the market, 100%.
Ashley, I want to differentiate between investment grade and high yield at this point in time. How worried are you about lower rated securities at this juncture? And are you sitting there at JP Morgan with that pencil out, looking security by security on tariff exposure to China and other countries?
Yeah, so we are. To answer your first question, triple Cs broadly concern me at the moment. That's where we would expect to see a pickup in default or default risk, especially heading into a slower macro, even holding tariffs aside. But some of those lower rated companies will likely see stress in the near term. Maybe they won't be able to tap the market to refinance their debt. There may have to be some restructuring. So we have concern there. We've been avoiding it. Similar to IG and high yield, we've been recommending up in quality. So that's more of those BB type rated credits there. With respect to companies that can be impacted by tariffs, kind of consumer discretionary broadly, or consumer is taking it on the chin recently and has been. I would say I'm very cautious with respect to that broad sector at the moment, just given the exposure maybe to China, Vietnam, Cambodia. I'm concerned about the ability of those companies to pass along potential price increases to the extent that tariffs do become sticky. That said, for companies that have strong balance sheets and pricing power, good brands, those could be winners.
Ashley, we got to leave it there. That is Lefty Curry of Goldman Sachs and Ashley Allen of JP Morgan Bank. Out of time, and I could go for the full hour. I swear, it's been such a crazy credit market, but still ahead we have the final spread, which will give you the week ahead, which includes more bank earnings, tariff fallout, and central bank decisions from around the world. This is Real Yield on Bloomberg. What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say. With the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
With investors on edge as tariff headlines spark volatility across global markets, Bloomberg Surveillance has the insight and commentary to give you a jump start on the trading week. Tune in for special coverage this Sunday starting at 6 p.m. Eastern. Context changes everything.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, Monday, EU foreign ministers meet with tariff strategy front and center, plus earnings from Goldman Sachs. And Tuesday, bank earnings continue with Bank of America and Citigroup. Plus, it's tax day. File your taxes. Don't forget. I did mine back in January, I think. Wednesday, Fed Chair Jay Powell speaks U.S. sales data and regional bank earnings. Of course, every piece of economic data being watched very closely. And Thursday, we have an ECB rate decision, plus earnings from TSMC, Blackstone, Netflix, and more. Friday, more global markets are closed for Good Friday. And before we let you go, we're going to take a check on those yields as we close out the half hour, because we, of course, are watching some stunning moves on the week. That 10-year has broken out of that 4.5% trading range, and it has gone higher, now back to that level and fluctuating around it, a relative set of calm for a week that has seen drastic moves higher and another nearly 8 basis points today. The 30-year yield now below 4.9%, but still higher on the week. And from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yields. This is Bloomberg. In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco. And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. Our lives are migrating online, and I think these data centers are a critical part of that infrastructure. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome to Bloomberg Markets. I'm Vonnie Quinn. Another day of hypersensitivity in markets to economic data, PPI coming in better, consumer sentiment coming in worse, but also, and perhaps more particularly, to Fed speak and John Williams, who had been one of the more sanguine members of the Federal Reserve and its position, out with basically nothing good, looking for lower growth, looking for higher inflation, looking for higher unemployment. And what does that spell? Well, it spells something like this. The S&P 500 has been whipsawing all day. It's up about 0.5% now. Lower volumes today, being a Friday and having been a long week. But we have the US dollar index continuing to fall, down 0.7%. We have the 10-year yield continuing to climb today. The whole curve, in fact, climbing. Money just flowing out of US fixed income and the US dollar. What else does that tell us? The 30-year yield at 4.88. We did top 5%, remember, on some of these yields in the last few months. So it's not like we haven't seen those levels. But with the other assets trading where we are, it's quite a different story. Let's take a look, in fact, at the yield curve, the 2s, 30s. We are at 100 basis points of a spread right now. That's a level that can signal recession. And that's not the only place in the markets that are signaling recession. We're also seeing it signaled in energy. We're seeing the VIX above 40, and we are waiting for more headlines. And then are we going to have an information vacuum into earnings season as companies withdraw guidance? It's one of the things Jamie Dimon has been telling investors because, of course, earnings season has started. Let's get to some individual movers now with Bloomberg's Emily Griffeo.
Yeah, Vonnie, big banks kicking off this earnings season, and take a look at shares at Wells Fargo because this bank is underperforming its larger peers today after net interest income missed estimates at $11.5 billion in the first quarter due to soft loan demand and, of course, tariff uncertainty. Analysts did flag those two areas as weak spots for the bank. That stock down about 3% right now. JP Morgan, it's a different story. Their stock traders notched record revenue on all of that market volatility that we've been seeing since Trump took office. That stock was up as much as 4%, down a little bit, but they did raise their net interest income forecast for the full year and boost equities market revenue 48% to a record of $3.81 billion. Again, all due to that market volatility. Though we did hear from CEO Jamie Dimon. He struck a cautious tone about the prospects for the U.S. economy and, in fact, said he expects a, quote, kerfuffle in the U.S. Treasury market that prompts a Fed intervention. Finally, take a look at shares of both Intel and Texas Instruments. Both of those stocks, chip makers with manufacturing in the U.S., are falling today after China announced new tariffs targeting semiconductor imports. Other chip makers like NVIDIA are higher, but anyone who has that production in the U.S. is falling today, Vonnie.
Absolutely, Emily. Thank you so much, and well done on getting through the week. Wall Street insiders continuing to weigh in on all of this market volatility. Greenlight's David Einhorn spoke Thursday with David Rubenstein for his show, Bloomberg Wealth. Einhorn gave his take on the increase in tariffs.
Look, I think that tariffs are a tax. I think they're a regressive tax. They affect consumers as opposed to people based on how much income that they have. And so I think they are raise prices. If you bring in a tariff, maybe the supplier has to pay part of it.
And consumers seem to be agreeing with all of that. The University of Michigan survey out today, the preliminary survey for the month, shows consumers expecting inflation in the year ahead to rise at a 6.7% pace, the highest since 1981. And consumer sentiment itself continuing to tumble. Let's bring in Stuart Poll with Bloomberg Economics. Maybe the beginnings of tariff information in that data, right? But certainly in the PPI data, we don't really have any tariff impact yet. When do we expect to see that?
It'll start showing up in the next several months. I expect to see a more material impact, especially in consumer prices, in about 6 months. Rolling back to yesterday, we did see core goods prices fall, and that gave people a little bit of relief. And everybody did see the PPI data show deflation in the month of March. But most of that deflation for producers came from food and energy. If you distill down to capital equipment and to goods, core goods within the PPI, producers are seeing prices rise for those core goods. And it is just going to be a matter of time before they try at least to pass along those higher prices, partially as a consequence of tariffs, eventually to consumers.
And as much as the Federal Reserve had been able to ignore, at least for the most part, these soft sentiment surveys, as the tariffs now go on, they maybe can't ignore them so much, or there'll be other surveys showing, the same thing, even worse. I want to zone in on what John Williams said today, because he basically predicted some kind of stagflation or worse scenario.
He did. He suggested that growth would basically be sub 1%. Inflation would rise to an annual pace of about 3%. As you said, stagflation, pretty bad. And it is the sort of thing that makes us need to start thinking about the Fed's dual mandate. Are they going to focus on that slow growth and cut rates, resume cutting rates, or are they going to focus on the price stability side of their dual mandate? Based on what we've been hearing from most Fed speakers, they are more focused on trying to encourage stable inflation expectations. They're not succeeding based on what we've seen in the Consumer Sentiment Index today, and they're focused on trying to rein in inflation by leaning against demand, keeping rates elevated.
If we ignore the sentiment indicators and just look at the bond market, are any longer end expectations for inflation becoming unmoored in any way?
Well, so it's sort of difficult to fully disentangle all the signals that we're getting from the bond market this week. Of course, rates just shot up pretty dramatically. 10-year rising above 4.5%, 30-year nearly touching 5% this week. So it's difficult to fully disentangle. One thing that we are seeing, if we look across all asset markets, is that the U.S. is getting less of that haven bid that typically comes when recession fears become more pronounced. So I think that a big part of that likely is an expectation that the Fed is going to be in a position where it's going to have to start perhaps monetizing a bit more than it would. Inflation could become a bit more untethered, as you said, unmoored, and inflation expectations should maybe stay permanently higher.
Stuart, thank you. Get a restful weekend, because we're in for more of this next week, no doubt. That is Stuart Paul with Bloomberg Economics. Well, the University of Michigan survey, just one of many factors weighing on markets today. Stocks for the moment are actually shrugging it off. The S&P 500 is hitting a session high. The dollar is weak, though. Maybe that's a factor. Let's bring in Keith Lerner. He's co-CIO and Chief Market Strategist at Truist Advisory. Hesitate to ask you about this increase in stocks, Keith, because, in 10 minutes' time, we might be lower again. Is this market trading with any rationale? Is there any philosophy behind this trading?
Yeah, well, great to be with you. At least, Vonnie, we got some green on the board today, and believe it or not, we have some green for the week, even though we know that was loaded on Wednesday with that big pop. So, I do think the market being up, and as you said, it may be like an hour from now, it could change, but there is something to it. If you think about back in February towards the highs, like no one was talking about all the negative news, and there was a lot of event risk coming ahead of us, but the market was trading at record valuations. At least now, when you've had that correction, and especially earlier this week where you were down 19%, you were starting to factor in some of these negativities, right? You were down 19%. The median recession is about 24%. And you became the most oversold in as far as technical indicators that we've seen since the October 22 bottom. So what is that telling you? That was saying that, hey, we saw indiscriminate selling, and right now, and not you have to be careful to say the last seller has sold, but on a short-term basis, we just, markets don't move in a straight line, and you're getting a little bit of, at least more of a two-way battle as opposed to just a one-way battle that we saw before.
Are we over peak uncertainty, do you think, Keith, or is there a lot more to come, though?
Yeah, I'm hesitant to say that we're past peak uncertainty because we just don't know. And I wish I could give you a straight answer, because historically, once you move past peak uncertainty, market forward returns are pretty strong. So the way we think about things, earlier this week, we were saying for investors to, they should start thinking about upside risk, just not downside risk. We've moved we moved up well off the lows now. So I think we're kind of in the middle of the tennis court, right? I'll come somewhat in no man's land on 5,300 on the S&P. Maybe we can push to 56, 5,700 on the upside. That low side is 4,800. So I don't think we're making any type of quick return to new highs because this is going to likely take time, and we're going to have to get through the softness in the economy that's likely going to happen in the next few months.
Keith, I want to take a look at the divergence between the U.S. dollar and yields and fixed income, basically, and how they've been acting. If you take a look at this chart, you'll see a huge amount of dollar weakness in the last few sessions. Perhaps no surprise, but we're also seeing yields rise tremendously. We saw a 50 basis point move since last Friday in the 30-year yield. That's a terrifying chart. That shows a loss of confidence in the United States, at least on a temporary basis. How permanent does it become?
Yeah, well, it's unusual, and it is concerning. I mean, normally the U.S. is seen as a safe haven. Normally in days where you see big market down days, you see a flight to safety, which is the U.S. dollar and treasuries and gold. And gold has been acting well, and we've been overweight gold all year long, but the other has not. So I do think that this is going to be a key thing to be watching over the next week. And the question becomes, we know Secretary Treasury Bessent has mentioned the 10-year. At what point would you hear more from him? And really, at what point does the Fed get more uncomfortable? And I would say, like, at that recent high around 480s when he came out with that comment, I suspect you'll see a lot more jawboning from the administration, even though we don't know how much they can, the market is in control of the bond market. But I think if he's more focused on it, may provide a little more relief. But really, the market's going to want to hear from the Fed at some point if this continues.
Yeah, at some point, a gift becomes a problem, right? Especially if it's signaling that the market is looking at a recession, for example. Are there any offsets beyond the Fed that might give us a hand here? I mean, lower energy prices have been helping, I guess, a little bit.
Yeah, I mean, before the playbook was from the administration was, hey, stock prices are down, but energy prices down and yields are lower. So I think they focus so much on that tenure that we're going to hear more from them. I think the other offset is, again, we just, where we had at the recent lows 5% of stocks in uptrends. Up until this recent down. So I think the best thing that the market does, at least you've discounted some of the bad news, but the upside is likely capped again. And I think that low is somewhat kind of a good short-term low at least. So you're basically stuck in a range. You got to focus on relative opportunities. I think it is encouraging that you're seeing some money actually rotate back to tech. Here's an interesting stat, Vonnie. It kind of blew my mind when I saw this. The Mag 7, before that pop on Wednesday, the forward PE was down to about 22. That's down from 35 back in July of last year, but also back to where it was the month that ChatGPT was released, all the way back in October of 2022. So again, I think there's some relative opportunities in the sea of red or gloom that we're seeing right now.
Sure, it's nice to see those kinds of figures come down, Keith, but really, do they mean anything when you've absolutely no visibility whatsoever? And who could have any visibility right now? Because the tariffs are on. We have no idea what's coming next, and we don't know what it would even look like if China were to back down or if there were to be negotiations. Surely those 125, 145% tariffs aren't going to go to zero, are they?
Okay. No, I mean, I think that's absolutely right. And again, we're not big bulls here. We were big bulls. We actually, as I mentioned, we had downgraded stocks in February to more of a neutral posture. And I think right now we're back to that neutral posture after becoming incrementally more positive, at the lows. But again, I think what you're alluding to is, most of the negatives. Markets are braced for negative outcomes, and I would just say there's likely two-way risk at this point. There's risk, obviously, we can go down, but again, if China basically just said this morning, we're not going to retaliate anymore because it's kind of a joke if we go any higher because, at this point, goods aren't going to be moved. So if there is some negotiation, there's also a risk that you could see a little bit of upside. But listen, this is going to be a bumpy path. Again, we're telling our clients this is not a V-shaped recovery. Don't be over your skis in risk and look at relative opportunities, whether that's in communication services, gold, utilities, a little bit more cash as well. So again, I guess you have to be a bit more nimble in this market today.
Yep, gold at records as well. And as we've been speaking, stocks continue to soar and yields dropping as well. Keith, thank you so much. Keith Lerner with Truist Advisory there, much appreciated. Coming up, banks expected a big year for mergers, but uncertainty has gripped U.S. markets. Cheryl Pate of Angel Oak Capital Advisors joins next to tell us what she sees for the industry. This is Bloomberg.
in case you missed it on Balance of Power.
Governor, I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area. And they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now? And, you know, I just don't know. All I know is that people were promised lower prices on Inauguration Day. And guess what? They're going up.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
The top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy that is how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg.
This is Bloomberg Markets. I'm Bonnie Quinn. Time now for our stock of the hour. We're looking at JP Morgan. Shares higher this after Jamie Dimon gave guidance about the industry and about U.S. companies navigating trade wars. His read of the room amounts to wait and see.
People are not doing things because of this. They're going to wait and see, and that's M&A. That's M&A with middle market companies. That's people's hiring plans and stuff like that. So people have to adjust this new environment.
Joining us now is Cheryl Pate, Senior Portfolio Manager at Angel Oak Capital Advisors, a mortgage specialist. And Cheryl helps oversee FINS, which is the fund that holds bank debt, preferred and common stock. The actual firm doesn't hold equity positions in any of these banks, but does hold debt positions. So a very interesting angle to look at all of this from. Cheryl, what did you make of these comments? We have been seeing sort of freezing up in some markets, but it's hard to say whether it's temporary or going to be a little bit longer than that. What is the outlook for banking as we see markets go crazy like they are?
Yeah, no, I think we certainly entered 2025 with a lot of exuberance around the banking sector, and a lot of that predicated on a capital markets recovery, the return of stronger M&A, as well as NIM expansion and loan growth. And clearly the tariff-induced market volatility has weighed on some of that. We saw good results, I think, out of investment banking today, but the question remains, what does the pipeline look like, and in terms of deal making? And I think that remains uncertain. I do think we will get some clarity as we move through the year, but that certainly puts a little near-term pressure on earnings.
Where is your confidence that deal making will come back, that capital markets activity will start to increase and so on, if things don't improve between the US and China and at a rapid clip?
Yeah, no, I think, one area that we have seen, I think, some good trends in terms of M&A is the banking sector itself. And some of this deregulation, if you will, has resulted in M&A deals closing twice as fast as they had a couple years ago. So there are some pockets of activity happening, but certainly I think it's, pushing more and more towards the back half of 25 or into even 26 until we get, more clarity, to your point, on China tariffs and, the broader economic backdrop.
Cheryl, what did you think about the amount that banks held in reserve? It could have been larger. We were looking for potentially larger loan loss reserves for some of the banks. Does that signal a little bit of confidence on their parts?
I do think that helps a little bit. Certainly credit is top of mind for investors across the equity and the debt spectrum here. I think what we were encouraged with today is you did see some reserve building, but you saw generally guidance for charge-offs holding in well. I think we saw positive commentary in terms of commercial real estate reserves coming down a little bit, actually, at Wells Fargo. And the fact that credit card, I think, remains well in check. Delinquency is coming down, actually. Now, from here, I think the question is, are we sort of status quo, or is there a tick up as the economy may potentially see some slower growth? So second quarter, I think we could see higher provisions than we saw in first quarter, but everything seems to be normalizing in a non-worrying manner at this point.
So, Cheryl, one of the things we've been seeing is companies buying back stock, just a few here and there for now, but we might see more of that going forward. Are you looking for that from any more of the banks? And beyond that, would you be looking for more of a premium now if you were to add to your bank debt holdings?
Yeah, I think in terms of buybacks, I think JP Morgan surprised to the upside today in terms of their buyback. If we get, continued transparency on the regulatory front, I think we will see more buybacks this year. And I think that'll be a lever that's important to pull as loan growth is probably more tepid than we had originally anticipated earlier this year. And NIM expansion is going to be driven more by the deposit side than the lending side. So that will be an important tool in banks' arsenal, I think. When we kind of think of the relative value of debt versus equity here, I think, higher rates and a little bit wider spreads make debt particularly attractive today, although you still have attractive opportunities on the equity side. I think I would pitch more of a quality bias on the equity side, given the uncertainty of the environment. But bank debt, I think we're certainly helped by strong capital levels, strong profitability, and attractive spreads today.
All right, Cheryl, thank you so much for all of that context. Cheryl Pate with Angel Oak Capital Advisors. Just want to point out that we have the S&P at a session high now and in the green. In fact, the majority of its members are higher, just about 140 lower. Newmont Mining is the best performer, up 8.4%. And of course, needless to say, the Nasdaq 100 is up even more than that, up 1.5%. The VIX now below 40 as we head towards the last few hours of this week's trading session. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global economic news from around the world whenever and wherever it happens. I'm Oliver Crook at the European Commission in Brussels, and this is Bloomberg.
This is Bloomberg Markets. I'm Bonnie Quinn. Bitcoin trading around $83,000 a token now. We were down as much as another $5,000 at $77,000 just during the week. So what exactly is Bitcoin trading on? Are investors fleeing into it as a risk haven? Are they fleeing out of it and going to the likes of gold, which is also trading at a record today? Let's bring in Mike Regan to break it all down. What on earth is Bitcoin these days?
Well, I think it's mostly a risk asset at the moment. You know, it's very tightly correlated with stocks, especially the NASDAQ. What's really fascinating, though, is we've looked at the trailing volatility in Bitcoin, the realized volatility. The stock market's actually more volatile than Bitcoin is right now, which I think is causing minds to blow when you think of how volatile Bitcoin's been in the past. But also remember, it peaked about a month earlier. Bitcoin actually peaked right on Inauguration Day, and it is down more than the S&P since then. It's just these last few weeks, it's really been a lot calmer and a lot sort of more range-bound at the bottom here than equities.
And perhaps Bitcoin traders or holders have more of a stomach for volatility.
I think there's that, and I think there's also, when you think about the Trump put, you know, there's a better case for a Trump put in Bitcoin, perhaps, because he has announced that plan to create the strategic reserve. There are ambitions in the White House to figure out a way to actually buy Bitcoin without using taxpayer money, a budget-neutral way, they call it. Perhaps sell some of the Fed's gold, which I don't think everyone would agree is a good idea, but it is something that's being considered. So the market is pretty comfortable that Trump's pro-crypto policies will continue.
Well, and when you think about it, it's kind of the best of both worlds because it's not a U.S. asset, and yet it's kind of a U.S. asset. So there's that to think about as well, right?
Right, and with an asset class with no economic fundamentals underpinning it, you know, what does economic weakness mean? Right?
Exactly. Mike, thank you so much. That is Bloomberg's Mike Regan, who follows everything for us here, particularly crypto. I want to show you these markets now because we have the S&P 500 up 1.4%. But look at that 30-year yield, 4.83% today.
We give longer term money. Our loans are anywhere from 20 to 50 years in length. After I came, I got our board to approve 50-year loans for things
Could I get one of those 50-year loans? I'd like to get one of those.
Absolutely, although you'll have to be around to enjoy it.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
We made it to Friday in the wildest week that ever was when it comes to tariff policy and resulting financial market action. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lyons, live in Washington with David Gura filling in for Joe Matthew as we round out this week in Washington with more escalation in the trade spat between the U.S. and China. China responding to the now 145% tariff rate on Chinese imports. The U.S. has imposed with 125% levy of its own. And yet they suggest, David, it's not going to go up from here because it would be economically meaningless to do so.
Yeah, the Chinese Ministry of Commerce characterizing this as a joke from the White House, but indicating that if this continues, they will hold their own. They will retaliate. They'll fight this to the end, I think, as they put it. So the uncertainty remains here in Washington that's existed since the president put that pause in place just a couple of days ago. The White House indicating they're waiting for a phone call between President Trump and President Xi. So far, no indication that that's in the offing. And yet it seems that equity markets are at least finding some reason to have some risk appetite into the weekend. We're just off the highs of the session on the major benchmarks. And interesting to see the action in treasuries today, which is really the bond market where a lot of the so-called queasiness the president was talking about has been centered. Right now, we're only up 4 basis points on the 10-year yield. We've kind of come right back down from the highs we hit earlier in the session. Very much the focus over the course of this week. Of course, it's what precipitated that pause, as we understand it, from the president, him looking at the bond market going into the morning of that announcement, seeing the queasiness that you described, seeing the yippiness that I think he said he saw as well when he was outside the White House. And of course, we've charted these auctions over the course of the week, the 3-year, the 10-year, and the 30-year. Charlie Pellet up in New York has been following all of this as well and has an eye on the markets for us this afternoon. Charlie, give us an update if you will.
All right, we are higher across the board, David Gura. Do want to begin with the weekly numbers because we are on track for a weekly gain on the S&P of 5.2%. To put that in context, the previous week, the S&P was down 9.1%. So here's where we stand right now. As you both mentioned, very close to session highs on the S&P, now up 57. That is a gain of 1.1%. We've got the Dow up 386, now up by 1%. NASDAQ up 212 for the NASDAQ Composite Index, up by 1.3%. The Russell 2000 Index of small cap shares now higher by 0.3%. The 10-year 4.46%, with the 2-year that's currently yielding 3.91%. Spot gold up $52 the ounce, up 1.6%. 32.28 the ounce on gold. West Texas Intermediate crude 61.10 a barrel, up 1.7%. And Bitcoin ripping higher now by 3.6%. Bitcoin 82,757. Bank earnings fast and furious. Things kicked off this morning. J.P. Morgan Chase up 3.2%. Wells Fargo, though, heading the other direction after earnings, down 1.6%. Morgan Stanley up 0.6%. And BlackRock up by 2.5%. So again, recapping, the Dow, the S&P, and NASDAQ are all moving higher. Right now, the S&P is up by 1.3%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, David Gura and Kaylee Lyons.
Charlie, thank you very much for that update. You mentioned those bank earnings, and I was listening to what we heard from the CEOs of those companies, Charlie Scharf in particular, and Jamie Dimon of J.P. Morgan. And there was a question from Mike Mayo, the longtime bank analyst, to Jamie Dimon about whether he's worried that J.P. Morgan would be caught in the crosshairs of this trade war. And Jamie Dimon said, yes, he thinks that's likely, but the bank is prepared for that if it does happen. And I think that kind of encapsulates the rhetoric that we've heard from Jamie Dimon over the course of this week, sounding the alarm about the long-term prospects of the situation that we're in here, but kind of reaffirming confidence in the institution that he leads in light of all of that. But uncertainty not just in the global economy, in the financial sector as well, as they kind of wait and see, as we all are, for what happens next, Kaylee.
Yeah, certainly we've seen a lot of that uncertainty borne out this week. We also have seen it borne out in consumer sentiment. We've been tracking the UMich consumer sentiment readings incredibly closely, and remarkable to see it dropping today to 50.8. Not only did that miss the average estimate, it's the lowest we have seen in some years, and inflation expectations ratcheting dramatically higher to the highest levels actually we've seen in decades really gives us some insight as to how all of this uncertainty around tariff policy is actually impacting the consumer engine of the U.S. economy. And that is where we begin with Mike McKee, who's, of course, Bloomberg's international economics and policy correspondent. So you put together the UMich data with the incredible oscillations we have seen in terms of policy and resulting market activity this week. Mike, doesn't exactly paint the prettiest picture.
It does not. I got to turn on the button. The Chinese say the Trump policy is a joke, but Americans aren't laughing at this point. The expectations index for the economy down the road in about 6 months fell to 47.2. That suggests people think we're going to have a recession, and that is the lowest since 1980. So we are looking at some really bad numbers here for overall consumer sentiment. And according to Joanne Shu, she's the director of surveys at the University of Michigan, everything's down. People think that the odds of losing a job are much higher. The odds of finding a job are much lower. The odds of inflation are much higher, as you mentioned. And the outlook for business is terrible. The outlook for their own finances is terrible. There is a lot of fear among Americans out there. And the question is, do they follow through on that? You know, we saw a lot of buying ahead of tariffs, and people told the Michigan survey takers they were going to do that. Now, Joanne Shu says that people are saying it's probably too late. So does this mean they all stop spending and a recession becomes inevitable?
Mike, I want to ask you how you look at these data and you report on them. I don't expect you to defend them, but I can give you a taste of what I think the rhetoric's going to be like surrounding all of this. And we've heard it over the last few times this index has come out, complaints that it's perhaps leans one way in a partisan fashion. More people on the Democratic side are surveyed than on the Republican side, et cetera, et cetera. How do you see this in kind of the panoply of data, yes, that we got this week? You can complement it with the hard data that we got on inflation, but even more broadly still, if I'm Jerome Powell in the Eccles building looking at that famous dashboard, how much credence, how much importance do I give these data generally and in this moment as we're sort of waiting to see what happens?
Well, it's kind of two different questions there. If you're the Fed, you look at the data and you ask the question, what are consumers going to do? And you look at the one-year inflation number up to 6.7% after yesterday's CPI at 2.8. You start to worry that inflation expectations might be becoming unmoored, and that rising inflation expectations will lead us to more inflation. There's not much they can do about it at the moment. We've heard from a lot of Fed officials, including John Williams today, saying policy is tight enough to bring down inflation if we just leave it alone. But then you asked about the survey methodology itself, and I did put that question to Joanne Shu today, and she said she defended their work as historically accurate. If you go back and look throughout time, that basically you see the same results. And what they have found this month is that Democratic support for the president's policies or for the way the country's going has obviously fallen into a deep hole, and nobody's surprised by that. Where the president has really lost ground is with independents. And they are now forecasting a recession as well. Republicans, who were approving of all of this by about 99%, are now down to about 71%. So even Republicans are starting to feel bad about the direction of the economy. There's probably some statistical question you could raise about it, but and this is not a political poll that's going to result in anybody getting elected or not. But it does suggest that people are concerned no matter their political party.
Well, I wonder what else the Fed is looking at or will have caught its attention this week, Mike, specifically when it comes to the activity we've seen in the bond market. As we mentioned, and Charlie ran us through, we're off the session high on the 10-year yield. We're now only up 5 basis points at 447. But there was a point today where we were looking at the worst weekly sell-off move higher in yields going back to 2019 when problems in the repo market with the actual plumbing caused the Fed to intervene. Do we have a sense of how close we might be, or are we on the precipice of that kind of moment again?
No, it doesn't appear that way. We've talked to a lot of Fed officials, myself and the others on our economics team, over the last day or so. And basically what we're hearing is that they're monitoring this very closely. They're in touch with all kinds of people in the markets. And while the moves have been extreme, it's not because of a failure of market function. It's not that you can't trade. It's that people at this point are shunning U.S. assets, it appears. There's not as much worry as some might have you think about the basis trade unwinding. There's a feeling that people who had been long leverage have had time to deleverage, so it doesn't look like a hard stop coming. That could always change, of course. But as long as the market is functioning, the Fed is not going to worry about it. And that'll be the big question and the thing to follow. Watch bid-ask spreads. If they blow out, you've got a real problem if nobody wants to trade. But if the market is functioning, Fed, as I've said before about the equity markets, doesn't care if you lose money.
I keep coming to this question of whether we're seeing decoupling in its beginning stage or where we are in that process. And I wanted to ask you, Mike, just about the kind of voracious appetite China has had for U.S. Treasuries over the last many years, and sort of what happens if that seizes up, if China begins to turn away from them or sell them. Just help us kind of play out what that would look like here in the global market.
Well, obviously, if China were to dump bonds, that would be a major problem and would cause major dislocations just because they own so many of them. But at the same time, if they started dumping bonds, they're going to lose a lot of money because, of course, the price will just collapse the more they put into the market. So there's a lot of skepticism that the Chinese would do this. Now, they can buy a lot less. The problem we have in tracking that is that what we're looking at is official government purchases or purchases through official channels, and that has flattened out. But Chinese state-owned banks and other state-owned enterprises have apparently been absorbing a lot of the U.S. securities that the central bank used to, and so they're still holding an awful lot, which is one reason they can keep their currency at about the same level. And so it's going to be hard to know unless they really go into the market. And that, of course, would destabilize everybody, but also them.
Well, I'm glad you mentioned Chinese currency because I want to focus on what's happening in the currency markets as well. Not trying to make you an FX analyst, Mike, but you would think that higher tariff rates, at least traditionally economic theory would tell you, that might lead to a stronger dollar. And yet that is exactly the opposite of what we have seen this week. The dollar today weaker against everything in G10. And I wonder what we should make of that weakness and whether that is actually something that is likely to be persistent.
It's really hard to say. You're right. Theory would tell you that we'd get a stronger dollar out of tariffs. Now, the tariffs have only just come on, so we have to wait and see what the currency demand, the demand for dollars is to pay those. But if the U.S. stops trading with China, which at these tariff levels there would be virtually no trade, then there's no reason for the dollar to strengthen because the Chinese wouldn't need dollars. But if this continues, it could be that we're seeing people start to move away from U.S. assets. And when you need, what we have done is we buy stuff from other countries, send them our dollars, and those countries buy treasuries. Well, maybe they're going to buy German bunds instead, or French oats, something like that. So we could see that having an impact on the dollar as well. It's a little hard to tell how this is going to play out in the long run, but it's definitely not going by the book, and it is worrying some people. There's always the question about whether the U.S. is going to lose its reserve status. I don't think that's going to happen happen because there's really nobody who could pick it up. But we could certainly see a lot less dollar usage if countries really want to do that.
Michael McKee on this Friday afternoon. Mike, thank you very much. Mike McKee, of course, our chief international economics and policy correspondent here at Bloomberg News, kind of giving us the tour here, yes, of how the Fed is thinking through all of this, what we're seeing in the currency markets, in the bond markets as well, and giving us the latest sort of assessment of that sentiment survey from the University of Michigan that we got this morning. I want to turn now to Joe Livornia, who's a managing director and chief economist at SMBC Nikko Securities. He was former special assistant to the president, chief economist at the National Economic Council during President Trump's first term. Joe, great to have you with us, and I'd love to start just by asking you sort of how you see these next few months proceeding here. You've been in the room with the president as he's thought about trade, no doubt thought aloud about trade and sort of how he sees policy. What do you expect is going to happen here, aside from, hopefully, I imagine the president thinking the phone call, the phone ringing? How does he approach these deals? What's he looking for in terms of just the mechanics of putting these deals together?
We had those reciprocal tariff announcements, as you know, April 2nd, and I was pretty confident that, we were going to at least have that in place until, it wasn't going to change until we got to the 9th. And then when the 9th, of course, struck and they were in place, shortly thereafter, the president announced there'd be delays. And I see that because the negotiation process had been done. So you need to come with these tariffs that were very high, very aggressive, and then in the process that was bringing people to the table. And now the negotiation has begun. To me, the maximal amount of uncertainty in some sense with tariffs was earlier this week before that announcement occurred. And now we could just go forward. And my guess is the president is going to make deals with various countries, and that will be to the U.S. advantage, and we're going to kind of clean up this uncertainty, and then we'll move on to the next thing, which would be the budget and what spending cuts, if any, and how they'll impact or help the economy. But I do think this tariff uncertainty will pass. I think the market has I understand why the market's reacted the way it has. I don't expect it to continue. I do expect the volatility to subside as progress on trade negotiation moves forward.
But it's not just about the market activity, right, Joe? It's also about consumer and business activity, who, while they're waiting for clarity to see what the outcome is 90 days from now, they still have to make decisions with their own purchasing power now, decide what they're doing in terms of inventories, where they're sourcing the supply, what purchases they're making. How much damage realistically can be done, even if you think ultimately we end up at a better place at the end of the day, or at the end of this period, I should say. We still have the whole period to get through.
No, absolutely. And this uncertainty, even as it relates to tax policy and the budget, is also a factor. Right now, it's been a very relatively short period of time. If we're looking at the labor markets, the jobless claim numbers are low. If we're looking at the consumer spending side, the chain store numbers look pretty good. If in the next week or two, there is progress on the trade, I don't expect this uncertainty to really meaningfully have any long-lasting or appreciable effect on the economy. The economy is very resilient. It's very robust. It will come back. If we go 90 days or we're day 89 and there's been no progress made, yes, absolutely, that'll be a problem. But I don't expect that to be the case. I do think my hunch and guess, gut tells me we're going to get some good news somewhat soon.
Joe, about the kind of inherent inflationariness of all of this, I'm curious sort of how you're looking at this. John Williams is speaking at the Puerto Rico Chamber of Commerce right now. He says that his expectation is that these tariffs are going to boost inflation this year to 3.5%, 4%. We've heard from the president's economic advisors during this term a sort of more greatly reduced sense of the inflationary impact this is going to have. What's yours? How do you marry your kind of forecast with what I just mentioned there, what we heard from President Williams and the New York Fed and the White House team today?
We've been of the view that energy prices will come down. That'll be a very powerful offset, especially to what I think is still likely to be a modest impact from tariffs. So, for example, if you had a 10% across-the-board tariff, 60% on China, as the president had proposed on the campaign trail, that doesn't even lift in price level terms your CPI more than a point. And, of course, there'd be offsets from the currency and offset from the margins. But on the inflation side, the fact that oil is down at 60 is very encouraging. That might have been due to the administration pushing the Saudis in particular to increase oil production. That will provide an offset. So, I mean, the inflation outlook right now is still uncertain. It's still sticky. The Fed is, I think, looking too much in the rearview mirror on this stuff, because if you look at the markets right now, they're telling you, looking at break evens, there's no inflation problem. And that's also, I think, one of the reasons why the market is behaving. Risk assets have not behaved as well today, is they've listened to Fed commentary from President Williams and think that the Fed might be making a mistake by harping too much on the inflation side and less on the potential growth side, meaning the economy could be slowing. That's what more investors are worried about right now than inflation.
Well, have you changed your own expectation, Joe, for the kinds or the scale of Fed rate cuts we could see this year, the number of them?
No, we've actually been pretty stable. I mean, we marked our growth down based on what will be the weak Q1. We've got GDP around 1.5%, and with most of that weakness concentrated in the first quarter. We did raise our inflation forecast a bit, but not massively. And we kept the Fed basically not cutting until the second half of the year, which is where we've been for a while. I don't think the Fed needs to cut in the short term. I don't think the Fed should cut in the short term. And therefore, we see no change. You've got 2 cuts, one 25 in September, another 25 in December.
I want to ask you about dollar weakness, and Kaylee just a moment ago kind of running through a number of the pairs indicating we're seeing softness in the dollar today. And again, drawing on your experience during the first term, I wonder sort of what insight you can give us into the way in which the president looks at the strength of the dollar relative to other currencies. Of course, there's this conversation maybe swirling in the background still about this prospective Mar-a-Lago Accord, getting folks to the table there. It seems like in this current environment with the lack of communication between the U.S. and China, that would be a difficult thing to pull off, to say the least. But what's your sense of the outlook here from Washington on global currencies, the way that this president is looking at the dollar today?
So in general, the trade weight, if you look at the Fed's real broad trade weighted dollar, it's close to a 40-year high. So this notion that the dollar is expensive, you see it in the Fed data. Investors tend to focus on the DXY, as you could pull up on your Bloomberg terminal, which is a very narrow nominal basket of currencies, and that's been a bit weaker. Over time, I could see the dollar perhaps softening a bit, but for good reasons. On things like the Mar-a-Lago Accord, I don't know if that's going to happen. I'm just not privy to those discussions. I think given the president's love of branding and marketing, it'd be hard for me to think that there isn't a Mar-a-Lago Accord at some point, but what it entails, I don't know. But just for a minute on the markets, right now we're clearly in a very sharp deleveraging period, and I wouldn't be surprised if some of this selling just naturally burns itself out, especially as we get more chatter that, hey, look, the administration with its trading partners is making some progress. And ultimately, my base case for the economy, because I'm still an optimist, is that there will be a deal reached with China, as it's in both countries' best interest. And I think the Chinese will want to negotiate, and the president, having had some successes with other countries that will precede those actions, will basically push China to do so.
I want to ask you about the bond market as well, though, Joe, because obviously that is, we understand what caught the president's attention enough that he was actually inspired to do a little bit of a policy shift with this 90-day pause on reciprocal tariff rates. When you see the kind of activity we've seen in the bond market, the upward pressure we're seeing on the 10-year yields, is that something you attribute mostly to this back and forth over tariffs, or does that signal something else to you about whether or not U.S. Treasuries are seen as the kind of safety asset that they once were, considering the other kind of fiscal trajectory-oriented issues that the United States is still grappling with, knowing we have a debt ceiling fight potentially ahead of us, that we're going to be looking at a tax package that could increase the deficit if there's not enough spending cuts to offset it? How much is that factoring into what we've been seeing?
So there's a lot there to unpack, but on the 90-day, I don't know if I can remember everything, but on the 90 days,
just explain the bond market to us, Joe.
Okay, so I think so. On why did the administration make a very quick pivot? And to me, this is my own 2 cents. I'm just trying to figure this out, piece the puzzle together. But Kevin Hassett was rumored to have said a 90-day extension on Friday. That was well before the bond market had sold off sharply. And coming in Monday morning, the bond market, the 10-year note was at 385, and then since had a big move after. I think once there was chatter among the various parties that there would be negotiations starting, my guess is the administration said there's no point at this point in not suspending for those countries that want to negotiate with us now. What are we gaining by waiting? Now, I don't think it was the bond market. I don't think it was necessarily the equity market. I think it was just a whole array of factors. What are we getting? What are we benefiting from? If we're having a conversation, let's try to provide some clarity by having that negotiation now. In terms of the budget, What I'm interested in seeing is, does the Senate parliamentarian, how does she attribute the scoring? Are we going to go with current policy, or are we going to go to current law? Because those deficit numbers the CBO has, we could debate what the number will be, but the numbers they have on paper simply do not make any sense, because a policy that's been in place for over 7 years that has given us revenue share of GDP in line with its long-term average is not going to create by itself a shortage of revenue and larger deficits. What will be is if we have a recession, which I don't expect, and then what happens, of course, on the spending side, that's up for debate. I have no idea what happens on the spending side. I'm hoping we could find some common ground and make some cuts, but that we don't know, and we won't know anything until Congress comes back in 2 weeks following the Easter holiday.
All right, Joe Livornia, answering my multi-part question. We appreciate it, as always. Former Special Assistant to the President, Chief Economist for the NEC in the first Trump White House, now Chief Economist for SMBC Nikko Securities America. Always great to have you here on Bloomberg TV and radio to help us make sense of the activity we have seen in financial markets this week across asset classes, just as Charlie Pellet does for us each and every day here on Balance of Power. We'll head to him now for a check on the markets in New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. We're looking at a lot of green on this Friday. We are on track for a winning week here with the S&P on the week, up by 4.8%. To keep that in context, the previous week the S&P was down by about 9%. But here's where we stand now on this Friday. S&P up 58, gain of 1.1%. 53.26 where we stand now on the S&P. The Dow Jones Industrial Average up 378, up by 0.9%, while NASDAQ is up 181 points. That is a gain of 1.1%. The NASDAQ 100 index up 1%. The Russell 2000 index of small cap shares gaining now by 0.3%. The 10-year yield at 4.47%, with a 2-year that's currently yielding 3.93%. Spot gold up $50 the ounce, 32.26, up 1.6%. And West Texas Intermediate crude up 1.7%, 61.07 for a barrel of WTI. Bitcoin surging 3.8% now at 82,900 on Bitcoin. Tesla has stopped taking orders in China for Model S sedans and Model X SUVs, both of which are imported from the U.S. after the countries raised tariffs on one another in an escalating trade war. Tesla shares today, on a day when the rest of the market is advancing, Tesla is down by 2.4%. And the retailer Five Below is asking vendors to turn away products waiting for shipment in China before they set off for the U.S. This according to a memo viewed by Bloomberg. Shares of Five Below, they are down now by 5.2%. So again, recapping, equities higher. The Dow, the S&P, NASDAQ solidly in the green, on track for a winning week. A 1% advance right now on the S&P 500 index. Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Kaylee Lyons and David Gura.
Charlie, thank you very much. David Gura here in for Joe Matthew, and I just want to do some market geography here, look at what's driving markets. Obviously, it's what's happening in Washington, the level of uncertainty that we've seen over the course of the week. Taking my geography lesson further, going up to New York and San Francisco, we had these big bank earnings. That's something that people are paying attention to. Folks also watching what's going on in Ann Arbor, Michigan, where the University of Michigan does its survey of consumer sentiment. We got a stark reading today. That sentiment, the lowest it's been, second lowest it's been in history. Inflation expectations haven't been this worrisome since the 1980s. Joanne Chu is the director of the surveys of consumers at the University of Michigan. She runs that survey. Here's what she had to say about its conclusions.
Consumers are in a very much a wait-and-see situation. They're really bracing for the other shoe to drop in terms of trade policy leading to eventual price hikes and higher inflation. So you have kind of these competing things of people are trying to beat future price increases.
So for more, we turn to our political panel as we consider what consumer sentiment means for political capital in Washington for the president and the party in power, which is the Republicans. Rick Davis is with us, Stone Court Capital partner and Republican strategist, half of our Bloomberg Politics Contributors panel, the other being Jeannie Sheehan Zaino, our Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. For those of you who don't know, here on Bloomberg TV and radio, UMich sentiment is Rick Davis's favorite economic indicator. We know he has read this in its entirety today. And Rick, I do wonder what it's telling you about where the American electorate is and whether or not they're still feeling very aligned with the president's policy priorities.
Yeah, look, I mean, obviously, some of it depends upon the party that you identify with. Democrats are the most gloomy. Independents have been becoming more and more gloomy. But I think the real wake-up call for this report out of Ann Arbor is that Republicans are getting gloomy. Their focus on the future has dimmed significantly, that they believe that inflation will continue to get worse and by larger and larger numbers. And so that's the part that this administration needs to be paying attention to. David Gurr asked me earlier what's going to be like for these members to go back home and hold a town hall. And really, I mean, it's the Republican members we're talking about, because they're going to get the brunt of the negativity that is present in this consumer sentiment index. I mean, these are the people who go to town halls, who call their members up and complain, and they're going to get very loud over the course of the next few months. And this report indicates a real slide for people of your own party if you're a Republican.
Rick, of course, this is sentiment data. It's based on anecdote, and I note here that survey was conducted between March 25th and April 8th, so before we had the pause that was put in place by the president. Since it's anecdotal, I'll turn to you, get your sense of how you're feeling about this. But do you think that it's likely to change now? Sentiment has improved because the pause has been put in place. I think that's what we're being told to believe here by this White House, that this pause kind of gives us some breathing room, gives the White House the latitude and time to broker some of these deals. The circumstances have notionally changed as a result. When you think about sentiment, how consumers and small businesses are looking at this moment, how much does that pause matter, I guess, is what I'm asking.
Yeah, I think the White House is trying to believe their own press. I mean, you've had a slide in consumer sentiment since December, right? I mean, it was at one of its peaks for the last 5 years on Election Day. And ever since then, there's been nothing but sort of trouble within consumer sentiment. It's down 30% since December. That is not something that gets then reversed by pausing what is expected to be additional tariffs being levied on these trading partners. So I think that unless there is a clear case being made by the White House for what positive things are going to occur to these consumers as a result of this policy, then they're going to be troubled by the chaotic nature of the policy making. And that's by definition, right? We have to go through 70, 80, 90 negotiations to come out with what is going to be the plan. And consumers are not going to be very patient about that.
Well, of course, the administration also is telling consumers they just need to be patient for a little while longer until Donald Trump's tax package can be passed. Genie tariffs are just one part of the economic picture that this White House is trying to paint. The other being, of course, his sweeping policy he'd like to see implemented, not just on extending his 2017 tax cuts, but implementing no tax on tips and Social Security and overtime, maybe deducting car interest from your taxes as well to offset the pain of auto tariffs. Are we going to find that patience is not that long in duration, that people aren't willing to wait to see that at year end or whenever that kicks in 2026? They need answers from the White House now.
I think so. You know, the danger of this consumer sentiment, it's very much like when I went to college, my dad said, you know, make sure you keep a 4.0 because once that GPA goes down, you'll never get it back up. And of course, I know, Kaylee, you and David know that full well, and you kept yours up. But that's the same thing with consumers. That's the same thing with consumer sentiment. Very, very hard for an administration to turn it around once it starts to dip. And the problem for the administration here is they say, you know, just hold on, the pain will be worth it, and Congress is going to come in and save the day. Well, number one, I'm not sure they've been watching Congress the last few years, but coming in and saving the day by passing legislation is not Congress's strong suit. And number two, to Rick's point, now you've got these people going to these town halls and hearing from Republicans. You know, I was listening earlier, your great conversation with Mike McKee, and David, you asked about the methodology of this survey, and I'm a social scientist. I love to talk about that. The problem for the president is even if you discount this, which they shouldn't, look at all the rest of the data. It is all coming in negative as far as Republicans' views of the economy under Donald Trump. And so that's the problem they face. Congressmen and women, senators are going to hear from their constituents. So unless they get this thing passed in Congress quick, which again is not Congress's strong suit, it's going to be a problem for them. So, I would never say wait and see for Congress. They'll save the day. That's not a good thing these days.
I do want to mention for our audience here on Bloomberg TV and radio that there's currently a briefing underway by the White House Press Secretary Caroline Leavitt, who is talking about where we stand in these trade negotiations. She's citing progress, very good progress in her words, being made in tariff talks, though she also notes the retaliation we saw today from China, saying that Trump will punch back harder if the U.S. is punched, and that if China continues to retaliate, it won't be good for China, though she does reiterate, David, that Trump remains open and optimistic about a deal with Beijing. But again, no understanding yet that Beijing is picking up the phone.
Well, Rick, let's pick it up there. I'm curious what you think the administration still has in its quiver. So we've seen China show a distaste here in recent hours for continuing to ratchet this up. They say they've reached a ceiling. They're going to continue to fight this. But given what we've seen over the course of this week, those tariffs imposed by the U.S. going up to 145%, the pause that the president has put in place here. What's left in the toolbox here for this White House? Should there be concern among him and his advisors that they don't have a whole lot left here, much leverage left here as this goes forward?
Yeah, it's kind of interesting, because I think that what Donald Trump has shown is that he'll use all kinds of public policy mechanisms to try and create that leverage you're talking about, David, to get what he wants on the tariffs. Remember, when we first got introduced with tariffs only a few months ago, in this administration, it was all about fentanyl. I haven't heard the word fentanyl used in the last 30 days. And so we were going to be imposing these tariffs on our closest trading partners, Mexico and Canada, because they weren't doing enough to stem the flow of fentanyl and immigration. So that was a good example of Donald Trump dipping into the policy bag and finding things that he could use to try and leverage his negotiations. And that got everybody scratching their heads saying, oh, well, then if we cure the fentanyl problem, the steel tariffs and the auto tariffs and the things that were applied go away. And now we find out, no, not at all. I mean, you actually don't need to have fentanyl to come across the border to have a tariff applied to you.
Yeah.
So I think that you're going to see more of that policy debate. You're going to see, all kinds of issues from national security to other economic issues filling up those voids.
Rick, thank you very much. That's Rick Davis, along with Ginny Sheehan Zaino, joining us here, our Bloomberg Politics contributors here on Balance of Power on this Friday afternoon as we look ahead to the weekend and recess on Capitol Hill.
On the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially. Right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes. Do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no. You could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have